decides to come back up, price has a good chance to short at that same area, okay, of resistance. Since people sold there the first time, has a good chance to sell there the second time, okay? And then you're going to have areas of support. And these are going to indicate buying zones, okay? And even if it doesn't congruently happen like this, a setup can commonly look like this. I call it the support mirror, resistance mirror, or the stack mode mirrors, okay? So you might see a setup that looks similar to price might come up, it might rally past the resistance, come back down, and then mirror the resistance. You know, very common. You have setups like this for a downtrend type of setup, and then for an uptrend type of setup, could definitely look like this. Price might bounce here, and then price might come back up and then validate it again. So even though it invalidated at this area here, it decided to come back up over here and then go in an upwards direction. Okay. So we have to understand the market is a vertical chart. You're looking at a vertical chart. That's why I do not want you guys to fall into the indicators traps. Okay. Now, there are going to be some pretty good indicators. Okay. Volume. Okay. A lot of people don't even know what volume is. What is volume? Volume is going to be the amount of orders placed at a specific area or time. So volume is the amount of orders placed at a specific area or time. That's going to be volume. So that's the term you always hear. So you want to be buying at key areas of support, okay, because it's going to have most of the volume there. You want to be selling at key areas of resistance because most of the volume is going to be there. Now, let me go ahead and give you guys some secret sauce here. Way more powerful than indicators. Okay, understand that sometimes in the market, resistance can be broken and turned into support. Okay, resistance can be broken and turned into support, and then price can bounce in an upwards direction. Just the same way, support can be broken and turned into resistance. Okay, so resistance can be broken and turned into support, and support can be broken and turned into resistance. Even if it doesn't happen this cleanly, it can happen something like this. And price might run through there, come back up, turn this resistance here into the support later on. Okay, go to the support area, support, say price decides to run under here, come above it, and then come up again. Boom. This area of support made this area of resistance created here. Okay, so I make it simple for you guys, man. I do not want you guys to be struggling. Okay, there's going to be times life is going to be hard. The charts are going to be hard. People are going to be doubting you. People are going to be hating you. And there's going to be times you might not even believe in yourself. And all that doubt has to be killed. Okay, and indicators equal doubt. If you have to rely on indicators to trade, then you can't be a profitable trader. Okay, if you can't just look at the chart and be like, oh, okay, I see why price bounced here, 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 and here, then you cannot be a profitable or successful trader. You will continue to struggle. You will continue to go through hard times. Okay, and it's going to be very, very hard for you to elevate. And the indicators are what's holding you back. So I want you guys to do this. Okay, for a year, No indicators. Okay. No indicators. Just read the candlestick chart clearly. Read it raw. Read it raw. Okay. That's what I need you guys to do. So for a year, no indicators. And I want you guys to just go hard, man. Go hard. Put in 16, 20-hour study sessions. Live on these charts. Understand every single micro reaction. Understand why price bounced at every single area that it did. Understand why price sold off at every area that it did. We have to get the full congruent picture. We want to get to the next level and we're pushing harder than ever. We're not stopping for nothing. Okay, this is real therapy for me, guys. Just sitting here teaching you guys these charts. I'm so passionate about this. You know, I live for God and I live to just get people out of financial poverty. I don't want to see anyone struggling. I don't want to see you guys blowing up your accounts or committing suicide over the markets or just going through any financial hardships. I want you guys to be successful. I want you to get to the next level. And I want you to win. Okay? And I want you to win. And best way to win on the charts, okay, is you have to have your setup. Okay. Follow your heart. Okay. If God put it in you to trade, trade. Don't let anyone stop you. Don't let anyone stop you. You have to trade. Okay. Whatever's inside of your heart, you got to go with that. You got to do that. It's going to be times you're going to be feeling doubt. It's going to be times you're going to feel like, oh, it's not for me. I don't know. But God put it inside of you for a reason. So go hard. Okay. Follow your heart and follow your setup. Okay. You tell yourself, I'm only going to play break and retest. Okay. If you're a break and retest trader, why are you trading anything else other than break and retest? Why? If you're a mirror trader, okay, someone who trades resistance or support mirrors, okay, why are you playing anything else other than mirrors? You need to, if you're a trend line trader, okay, why are you playing anything else other than the trend lines? Okay. That's the things. You have to follow your heart and follow your setup. And most importantly, follow God. Okay. You can get successful. Investing, it's important in this world. Okay. The more shares that we buy, the more companies that we can help, the more that we can help each other on this earth. Okay. Faster healthcare products, more communication so we can communicate with our parents, grandparents around the world, etc. Okay. Investing in the stock market is crucial. It's important. And don't let anyone else stop you guys from doing it. I'm very, very passionate about teaching this. And if you want to learn more about it, and if you want to get a free stock watch list, I should see you at stackmode.net. Stay prayed up to God. Keep grinding. Catch you in the next one. Peace. All right, class, we've all heard about passive investing, how we can live off our money, just making this money infinitely and forever. Let's talk about one of the most popular ways of how to invest and how to live off passive income through what's called dividend investing. Let's jump into it. So let's understand what the core is and what are dividends in the first place. So let's break down the definition and the mechanics of a dividend. So a dividend represents a distribution of a portion of a company's earnings decided upon by the board of directors to its shareholders. And it's essentially a reward for owning a piece of the business. So shareholders pretty much get rewarded for investing into whatever ETF they invested to, whether it be SCHD, BTIC, QQI, any dividend that you invest to, which is going to be a bundle of stocks essentially. And instead of just investing into one stock individually, you could buy a ETF, which pays out dividends, and certain stocks pay out dividends as well too. And they pretty much give you your money back for investing it. They say, hey, thank you so much for investing into us. Here's some money back. Okay, so you can use that into an infinite loop and invest into that and live off of passive income. Okay, so it's essentially your reward for owning a piece of the business and the investment. So it's a source of income. So unlike capital gains, which is required when you're selling a stock or when you sell at the highs, dividends are going to be more of a direct cash flow, and they're often paid quarterly. And this creates an immediate tangible return on your investment. and they're on a fixed payment schedule. There's some dividends that pay annually, once a year, quarterly payments, which are going to be between January, April, July, and October. Okay. Some companies and ETFs pay monthly, and some pay semi-annually or annually. And the key is going to be consistency, depending on the type of income that you're looking for. Do your research before you invest in any type of dividend ETF or stock to see what type of cash flow you're going to be getting. Okay, you don't want to be investing in something and see one ETF or dividend pays out every month, and then you invest into something that pays out once a year, and you're not getting the cash flow you expected. All right, don't just ride somebody else's wave. Make sure you guys are doing your educated research. There's so much free information out there. Head over to Stackmode.net if you need some more investment education. So let's talk about some tax implications, right? So even though dividends can be reinvested, right? So let's say you are getting $5,000 a month from a dividend, right? That dividend money is still taxed. So even if you reinvest all $5,000 of it back into whatever stock or ETF you invested into to get the money in the first place, it's still going to be taxable. Okay, so keep that in mind. Break down your income. Make sure you guys are putting a percentage away of your dividend income away so you don't get taxed on Uncle Sam. You pay your taxes by the year. So let's talk about some declaring dividend dates, right? So the crucial dates include: one, the declaration date. The declaration date is going to be when the board announces it, and the ex-dividend date. Okay, the cutoff to buy and receive the dividend. That's what that date is. And the record date. That's the shareholder list check. And then we're going to have the payment date, which we're all looking for. Okay, the payment date is going to be when the funds hit your account, and you can go pay your bills, pay your debt, or go ball out, take your family on a trip, do what you need to do. Okay, and you must own the stock or dividend ETF before the ex-dividend date to qualify for the payment in the first place. So the power of compounding, right? Your wealth engine. All right, so look, if you're in your bag for, say, a couple of years, you're grinding hard, okay? You're waking up, you're praying, you're working out, you're grinding your business. Say you run up a couple of M's within, I'll say 5 years, 1 to 5 years, you run up around 1 to 5 M's. You could put 2 of those M's into an ETF, stock, etc., and potentially live off of that passive income forever. You'll be getting around $5,000 to $10,000 a month. There's no reason to ball out, start spending $100K a month. There's no reason to live that, that crazy. Stay down, you can still take your nice trips, and you could pay all your bills and live in a pretty nice house for $10,000 a month. And that's just that income alone. Okay, so you can leave your business income alone, leave it for your kids, leave it for your family, your husband, wife, family, grandma, whatever. Okay, and then stay down, pay your bills, make sure you're putting money away for taxes though. Pay your bills, do what you need to do, pay your mortgage, rent, whatever, with that dividend income, okay? Because we're only getting older day by day. Tomorrow's not always promised, God forbid, there's gonna be things like sometimes people go disabled, So we wanna be making sure we can still feed our family if any situation occurs. So what we're gonna do is plant these seeds now, today, okay? So even if you go disabled, even if you die, your family can still be eating, because of the fact that you planted your seeds. Okay, so stay down, you don't gotta pop it. Save, save a little bit. Sometimes it's not time to pop it. It's not time to be outside. Okay, if you work outside, eat at your job. Okay, if you can, any type of food court, try not to spend any type of external money. Okay, try and get what you can, any type of discounts, go back in the house. Okay, if you work in the house, no DoorDash, no Instacart, no none of that right now. Okay, let's try and stay down. And if you are gonna DoorDash, don't DoorDash individual meals. It's something my wife really helped me out with, okay? I was realizing how much money I was spending on individual meals, wasting my time, wasting my money, when that could have been going into some Bitcoin, going into some dividends, etc. Okay, making that income grow. Okay, get some groceries, buy 1 bundle of groceries, okay, a couple times a month, and your income is gonna be spread out a lot more strategically, I promise you. All right, so think about it. Reinvest your dividends as well too. Okay, so once you start stacking up some cash flow, don't get fancy in life right away. Okay, that's something that could really hold you back. Okay, once you start getting financially free, once you clear that debt that's been haunting you down, as you guys been waking up praying to God to just go away so you can increase your income. All right, once you pay off that car, okay, once you get the debt off your back, please don't immediately go get fancy with your life and put yourself right back in the hole. Okay, use the dividend income and stack up. Okay, stack up, get some reserve for yourself, okay? And take that dividend income and replace the bills, even if that's the case. Okay, even if you guys are getting $400, $300 a month from dividend income, that's your car note now taken off. Now you have $400 extra to either A, put it into some business. Okay, you can go donate, do what you need to do, take care of your mom, take care of your family. That's some more grocery money, or put it into some Bitcoin options, futures, Forex, whatever you want to do. Okay, just the fact that you have that money stacked away though into something paying you out a consistent dividend, you're not going to get bills chopped off. The more bills you have chopped off, the more free cash you're going to have to play with. Okay, the more you can help your family out, do what you need to do, and just stand on business. Okay, if you want to go put some money into your business, do that. Okay, get some more income flowing, then take that income, increase your dividend income, and that way you guys can pretty much live off of doing nothing. Okay, if you have a month where you know what, say be like, I've been hustling hard, I just want to focus on myself, I just want to get closer to God, I want to work out, okay, I want to start just working on myself, okay, you guys can do that. Okay, you could take 3 months off because you're going to be good. You planted your seeds in the dividend income. Okay, you're getting that money every single month. Okay, you could take time, get closer with your family if any situation happened. Okay, you guys are feeling like you're not as close as you need to be. You could take a break. Okay, you could pause, and rent's still gonna be paid, mortgage is still gonna be paid, and you're still gonna be putting money in the stash because of the fact that you had that money planted in the dividends. All right, so make your decisions. Okay, you guys want to go ball at the mall? Okay, or put that money into some dividends. Okay, I'm telling you, if the more you invest today, the more you stay down today, your future self is gonna thank you. Okay, because sometimes life's. Okay, God definitely throws some curveballs. Okay, there's going to be times where, God forbid, people lose jobs. Okay, things like that, stuff happens. Okay, sometimes businesses crash, websites shut down, etc. Okay, certain TikTok bans, certain creators couldn't post then, and that was a big major source of income. So what we want to do is prepare for any type of situation so our family and ourselves are not in jeopardy if things hit the fan. Okay, so saving money and investing, it's not just trying to make money, it's survival. Okay, it's survival. Because not everyone has family they can depend on. Not everyone has people they can depend on to go to their house if something hits the fan, or if they happen to not have a place to stay. Okay, so what we want to do is always protect ourselves. All right, so money is going to be survival. Okay, don't just think of it as luxury and leisure items. Okay, protect yourself and protect your family. You don't want to have them starving or have them getting fed by somebody else's accord because you're not hustling, because you're not staying down. So be the one who stands on business. So dividends are also going to be extremely effective during flat or declining markets. And dividends provide a consistent positive return, and they help mitigate overall portfolio losses. And they offer psychological and financial cushion to keep you invested. So you guys can honestly just stay down, invest in the dividends, stack up your cash flow. Okay, if you feel like market's at all-time highs, you can buy some dividends. Okay, you can buy some dividends and you're still going to be stacking some type of cash flow essentially. Okay, and with the power of compounding, guys, I'm telling you, okay, the power of compounding is going to be extremely, extremely essential. Do something every single day, stack up those wins. Okay, and we're going to talk about drips, right? Drips are going to be extremely important, and that's pretty much just taking the dividends and reinvesting it back into the dividends. And they just automate the process of buying low, fostering consistent investments, and taking those dividends and reinvesting it back into those stocks, ETFs, whatever you bought. Yeah. And the inflation hedge, right? So investing in companies that constantly raise their dividends, which means they're getting paid. Okay, if a company's raising their dividends, that means one, they're putting smiles on people's faces because one, people are using their products. So the more people that companies using their products, one, the more taxes that go to the government, the more the United States government benefits, the better. Okay, so everyone wins when these stocks go up in an upwards direction. Okay, don't just think all stocks are just going up to go up. No. Okay, a lot of these companies, Amazon, for etc. Okay, that you can go trade right now, employ hundreds of thousands of people, Microsoft, Google, etc. Okay, so these are really, really important companies that put food inside of people's stomachs. Okay, these companies pay people salaries, help them live. So think about that. Okay, that's also why we don't really want to ideally short the stock market. In a lot of times, a lot of ETFs you'll see will be very, very consistent, especially if they pay out consistent dividends. Okay, they're going to consistently go up in an uptrend due to the fact that the economy is just a lot more beneficial as long as stocks are going in an upwards direction. That means more jobs for people, less homelessness, less government downfalls due to the fact that we don't have enough money to pay certain funding, things that need to be paid, such as
government branches like the CDC, etc. Okay, which would mean less jobs. Okay, so the more money the government has, the better. Okay, because the less scientists we have, the worse for the world in general. Okay, we got to figure out what's going on. So understand that stocks, the higher they go up, the more it literally affects how the world functions. Okay, so thinking of things logically and extremely literally is really going to change your perspective. So evaluating stocks, right? The essential dividend metrics. So how to determine health and sustainability beyond the yield. So before investing, you got to assess a company's ability and commitment to pay and grow its dividends. And these metrics are fundamental screening tools to avoid yield traps. All right. So dividend yield percentages, annual dividend per share / the current share price. So while it's tempting, never let your yield be your only factor. Don't just be only looking at it. Okay. You got to focus on, is it consistent? Okay. You can't just focus on how much it's paying out, because it could pay you out a lot in a 3-month span, and the next thing you know, it's gone. Okay. And then your reliable source of income is not dependable anymore. Okay. So high yields are often a warning signs. Careful. Focus on the payout ratio. That's going to be a big safety check. So automating growth, right? Dividend reinvestment plans. Let's talk about DRIPs again. So leveraging the power of zero cost reinvestment. A DRIP is a service offered by companies or brokerages that allow you to automatically reinvest your cash dividends back into the same stock. So you don't got to worry about nothing. Okay. Money's going to go right back into the dividends, making your cash flow infinite. And it's often commission free, including fractional shares. Now let's talk about fractional shares, right? Maximize. So DRIPs ensure that every penny of your dividend is put to work immediately, maximizing compounding efficiency by buying tiny portions of shares you normally couldn't afford. And automated dollar cost averaging, right? DCA, dollar cost averaging, is really going to be just a good way to stack cash, guys. Okay, put a good amount away that you have after your bills, groceries, etc. Okay, and just keep stacking cash, keep dollar cost averaging, keep stacking up, get into stack mode. So since shares are bought at regular intervals, right? That's the payment date. Regardless of the price, DRIPs are automatically implemented into the dollar cost average, okay? Reducing the emotional risk of time in the market. So you know how much you're going to invest. Okay, just put yourself on a consistent plan, because I promise you, a lot of the times within like a 5-year span, yeah, you'll see positive returns. Okay, now buying at all-time highs though can be a little bit different, but if your goal is just dividend incomes, then just keep reinvesting. So exponential share growth. The number of shares that you own grow exponentially over time, which in turn accelerate the growth of your dividend income stream. And you literally get paid to increase your ownership stake. Okay, so think about that. So most brokerages allow DRIP commissions fee. Go into the settings. They can be a little hidden sometimes, but you can find it, I believe in. And they make it a highly cost-effective way to build with over time compared to manual purchases. Okay, so instead of going back, depositing over and over and over, it'll just automatically put everything on cycle. So imagine you receive $50 in dividends instead of taking the cash, right? Instead of having to have it settle, okay? Or if it goes automatically to a bank account and then deposit back into the broker, okay? Either way, the DRIP is just going to go ahead and buy some more shares. And next quarter, you're going to earn dividends on your original shares plus the new 0.5 shares, making your next payout slightly larger. And so the cycle repeats, and investing and increasing your base constantly. But please make sure you guys are looking out for your taxes. Okay, take care of that. Put some money away. Don't spend everything. So mitigate the risk, right? The downsides of dividend investing. Okay, so there can be dividend cuts sometimes. Okay, no investments can be without risk. And high dividend yields can be trapped sometimes. And tax implications must be understood to maximize the after-tax returns. We must be cautious investors, right? So the dividend cut is the ultimate risk. A dividend cut signals financial distress or a major strategy shift, often leading to a sharp decline in share price. Okay, that's why checking the payout ratio against the free cash flow is going to be essential, making sure it's profitable. And the yield warning, right? A very high yield, which is often above 8 to 10%. It's a pretty good range to check out, and it's frequently a sign that the stock price has collapsed and that the market expects a dividend cut. And when you buy the stock, the dividend is cut, and you lose money on the stock price and the income stream. Okay, and that could really hurt. Okay, so keep that in mind. So opportunity costs. By focusing on only mature dividend payers, you might miss out on certain high growth companies, like many in tech, that reinvest all their earnings back into the business, leading to higher capital appreciation instead of income. Okay, so they're focused on like the super end game plan, okay, which is ultimately the smarter plan. And there's gonna be sometimes some new ETFs that are dividends that you can invest to, instead of just focusing on the super old ones. So do your research. Okay, depending on any time period that you're watching this, okay, some things are going to be more popular than others during certain time periods, and focus on whatever sector that's pushing the future forward is my best recommendation. So taxation, all right, understand the difference between the qualified low tax rate and the non-qualified ordinary income tax rate dividends. So use tax advantage accounts if you want to, like an IRA or 401k. Downsides of those though, they're capped out. So I believe 401k only holds around like $23,000 a year, and you could put way more money than that away, okay, in the stash, especially if you're in stack mode. And a Roth IRA, if I'm not mistaken, I believe it's $7,000, and then when you're 50, it goes up to $8,000. So that's not nearly enough money. You could put that money away in a single month. Okay, it's people who spend $50,000 a day on ads. Okay, so it really just depends. That's not enough money. Those can be traps, so don't really focus on those. Get in your bag and believe yourself. You can run up M's, I promise you, inshallah. So geographic risk. So international dividends often carry foreign withholding taxes, which can be partially or fully recovered, but add complexity and potential cost to tax filing. And they always investigate the specific tax treaties for international holdings, making sure that everything is proper before you just buy into something, okay? And you can construct your income portfolio, okay? So successful dividend portfolios, not just a collection of high yield stocks, but a balanced machine designed for stability and growth across various sectors and time horizons. So sector diversification, okay? Get some different sectors in there. If it's tech, maybe power, maybe it's healthcare, okay? Whatever is important within the time period you're watching this video, do your research first, okay? And go ahead and invest. Take your time. So spread your investments across stable sectors like utilities, consumer staples, healthcare, crypto, etc. Okay, there's gonna be a lot of different sectors you could check out. Okay, and strong industrial companies, etc. This ensures that if one sector struggles, another could be doing extremely well. Okay, or if the U.S. does a deal restructuring the power grids or something, then maybe power sectors might be doing well. Okay, things like that are going to be put into play depending on what's happening in the economy today. So apply what's happening in your current society and just go to the stock market and make the right decisions. And inshallah, you'll make some good money. So look for companies with high cash flow, low debt, consistent earnings growth, and a history of raising the dividend, not just paying it. And consistent growth is going to be your key to beating inflation. So the ETF, right, and mutual fund usage. So use dividend-focused exchange-traded funds like those tracking the dividend aristocrats. For example, Noble or high-yield funds. For example, VYM, to gain immediate diversification with minimal effort. And this can form the stable, low-maintenance core of your portfolio and your income calendar strategy. Okay. Strategically select companies with different payment months. Some pay in March, June, September, December, others in January, April, July, October. And this can smooth out your monthly income stream, giving you a more consistent passive income flow in general. So do your research, invest in the sector that's going to pay you out consistently and make you some good income. Okay. And cultivate passive wealth. So key takeaways. So dividend investment, it's not about getting rich overnight. It's about building, once again, passive income. But what people don't know about what's called passive income is you got to hustle for the income in the first place. Okay, so you got to be hustling for as much active income as possible. Then once you invest, then you earn passive income. Okay, everything in life has to be earned. Okay, you have to understand that there's no such thing as just chilling. No, you got to earn it and then you could chill. All right, so go hustle, go get some money on, then invest and you could chill, live off your passive income. Okay, but right now, you're in stack mode, you're staying down, you're grinding, get to it. So focus on safety and growth. So prioritize dividend growth and safety. Okay. So look for a low payout ratio and low debt. Okay. Especially after you just got in the stack mode for years, however long you just took grinding your company, okay, scaling up your job, doing whatever, okay, putting money away. You don't want to invest into a dividend that you expect to pay you out stably to just crash. Okay, so do your research, make sure they don't have a lot of debt. Okay, even God talks about debt for a reason. Okay, debt can really be a sinkhole. Okay, if you get into debt, it's like your money pretty much gets negated for no reason. You make money, but then it has to go to debt. So it's like you get nothing in your pockets, you can't put it into investments, and you're just in debt. Okay, so debt is extremely trash and it pretty much cancels out your money. Okay. So focus and see, okay, did the company pay it off yet? Okay, is the company drowning? Is it a fresh new company that has took a big loan from someone? Okay, and if they fail, then they're going to be drowning. Okay, that might not want to be something where you want to invest your hard-earned active income into. Okay, so take your time, do your research, and then hop into something. Okay, avoid yield traps. Don't just focus on that. Okay, sometimes there's things way bigger than the direct active income. Focus on the stability. And you can use drips and monthly contributions to take advantage of compounding and dollar cost averaging automatically. Okay, pay your rent, groceries, do what you need to do, give your money to whoever you need to give. Okay, and then put some money away into your dividend investments. Okay, keep stacking cash and watch it grow quickly. And utilize tax advantage accounts if you want. If you have a job, then do a 401k. I don't recommend a Roth IRA. Just do a normal tax account. Okay, once again, believe in yourself. You can do way more than $8,000 a year. Okay, putting away that money is something that everyone could do. And $8,000 a year, you can definitely put way more than that a year away. So do a normal account, individual, taxable, and just take care of your taxes. Not that bad. Okay, and your growth isn't going to be stopped. But if you have a job though, and they pay out 401ks, I would take advantage of that. Just put a piece of your check away, and then if you want, as soon as you're older, you have that money there, and then you can pull it out tax-free if you even want it. So you can maintain diversification like this too. Okay, you can invest into certain ETFs that have a bundle of stocks, so you don't have to just rely on single stocks. Okay, and you could use, once again, dividend ETFs to build a robust, diversified foundation. Okay, so that's how passive income is going to be formed. Stay prayed for God, keep grinding. Head over to Stackmode.net for all trading education. Mentorship stocks, they're getting filled up. Class has been getting booked up. So yeah, if you want to book the next call, go ahead and book before all the slots are filled up. Peace. Discipline, discipline, discipline. I know you guys have heard of it, and it's time to stop struggling with it. Let's improve our discipline, okay? Let's stay humble. That's going to be the number one rule in order to stay disciplined. Stay humble. Even when you achieve your goals, when you start making the amount of money that you want, when you get the house that you want, when you get the car that you want, okay? When you start doing what you want to do, you still stay humble, okay? You still wake up every day. You pray to God. You work out. You stick to your trading plan. You stick to your budget. You keep putting money in the stash, and you stay in stack mode. Don't lose yourself. And discipline in trading just refers to the ability to follow your predefined set of rules. If you're a break and retest trader, then you're going to be waiting for an area of resistance to be broken and turn into resistance, or an area of resistance to be broken and turn into support. Okay, or if you're a short trader, you're going to wait for an area of support to be broken and turn into resistance. And if you don't see what you want, then you don't take your trade. Discipline ensures that traders stick to their plans, avoid impulsive decisions that lead to losses. The losses can come from a quick emotional stint within you. Okay, you might see a candle stoop up really fast, especially if you're on your 1 minute or smaller time frames. That can make you extremely emotional. I highly recommend you guys get off of your smaller time frames, such as the 1 minute and stuff like that, as far as planning out your whole trades. Make sure you guys are doing your higher time frame research first, okay, such as your daily 4 hour. Plot out your trades there first. Then if you're going to enter in after seeing your levels and seeing where the market wants to go on a higher time frame scale, then feel free to go down to your 1 minute time frame. Okay, because 1 minute candlesticks can be extremely fast, spiking up and down, might making you do emotional things that's not even the trend whole time. So check your higher time frames first to avoid making emotional decisions. So discipline also involves psychological control, risk management. Okay, psychological control just ensures that you're not crashing out. Okay, even if you take a loss, you know to hop off the trades. Okay, you're gonna hop off the charts. You're not gonna destroy your P&L that you've been grinding hard for. Okay, and you're gonna come back stronger. Okay, you're gonna be like, okay, what could I have done to make sure that loss into a win? Was that setup clean? Was that entry clean? Talk to yourself, journal. Profitable traders treat trading like a business. When you sign up to trade, you are a business. You are no longer an individual, okay? You're a business. And a business is trying to use money to make more money. Okay, that's pretty much what a business is doing, okay? And providing value to people, okay? So you're going to be trading. So when you're making money, somebody's losing. When you're losing, somebody's winning. Okay. It's a very strategical system. Okay, it's not gambling. Okay, and you can definitely make some money if you stick to your rules. Stick to things like your stop loss, where your trade is going to automatically close, and continuously learn. Okay, always learn, see how you can get better, see what you can change. Okay, and if you're on a hot streak, if you notice you're profitable, stick to it. Okay, the only thing that should change is your contract size. Okay, stick to your setup, don't lose your discipline. Okay, and just don't trade for PNL. Trade from areas of take profits from your entries, and set your stop losses if you are trading like Forex futures, for examples. Keep it simple. And we'll explore why discipline is crucial, common pitfalls, and how to build it step by step. Step number one is going to be just waking up, praying to God every single day, being grateful. Okay, gratitude is going to help you be disciplined. Okay, it's going to help you stay focused. You're not going to lose yourself. You're not going to get emotional, whether you're winning or losing. Okay, you're going to be fine. And consider a day trader who sets a daily loss limit. Discipline means stopping when that limit is hit, no exceptions. Okay, and why discipline matters. Studies show that over 90% of retail traders lose money in the long run. Okay, so say someone puts in 5 bands, even if they make 2K their next trade, if you check in at the end of the year, they might be down like 8K. Okay, and that's because primarily their lack of discipline comes in. So even if you start making money within the market, you have to know how to control it. Okay, withdraw, especially if I'm on my day trade account and I win a day trade. Let's say I make $500. I'm going to keep 50% in my account. I'm going to go ahead and put 50% back in my bank account. Okay, so if I make 500, for example, I'm going to keep 250 in the trading account. This way my account's going to keep growing. My contract sizes can increase. Okay, and I'm going to go ahead and give myself 250. That 250, what I'm going to go ahead and do is take 30% of that off, put that away for taxes. That's going to go ahead and give me the ample opportunity in order to keep stacking up, keep growing my portfolio over time. And discipline turns your real life from a game to really just a skill-based profession. And you're going to be able to stack up, take yourself serious, make certain power plays, and start building some long-term investments for your family. Okay, leaving some growth, leaving some wealth, and leaving some assets that are going to be important for people to potentially turn money into more money. Okay, so it's living an easier time. The more disciplined you are, the more of an easier time you'll have for yourself and loved ones around you. So it's worth it, trust me. And according to a report by the Financial Conduit Authority, disciplined traders have a 40 to 50% higher success rate. So trust me, wake up, pray to God, work out, okay, create your routine, hop on the charts before market opens, okay, or even plot your trades on a higher time frames before they come. Utilize things like alerts so you're not sitting there staring at the charts all day, and keep grinding more income. Grind your business, do whatever you need to do, get more income, set your alerts by the time your trade's ready. You're gonna have bread ready, put it back into the market and come dominate, inshallah. So long-term profitability is going to require patience too. Don't expect things to happen overnight. Sometimes you get to hold trades for a long time, especially if it's shares or crypto. Okay, don't expect to see profit instantly. It's going to take time. Keep your portfolio separate. Try not to touch it, and try not to overtrade as well too. Overtrading is going to be when you're taking multiple trades over and over and over and over and over again, not learning your lesson. Okay, if you want to stop that, okay, one, think about your future. Okay, is your family gonna eat like this? Are you gonna eat like this? Are you about to pay rent if you keep losing money because you want to be emotional? Okay, you can't afford to lose money like that. Okay, take it serious. Okay, so you can go ahead and use discipline within your real life, and how you do one thing is how you do all. When you wake up, you work out Monday through Friday. Okay, your brain muscles are gonna get trained over time. And you're gonna realize, okay, I can do this, I can stay consistent. And your brain's gonna pretty much be disgusted if you're not being disciplined. Okay, and once your brain makes that switch, it's gonna be a lot easier to go ahead and just dominate. You're gonna know what your setup criteria is, and you're gonna refuse to take anything else that's not it. Okay, if it's not your setup criteria, you just don't take it. Okay, and that happens by being disciplined. So I promise you guys, be as disciplined as possible for 90 days. Okay, and watch how all of these things turn into habits. Okay, it might be hard at first. Okay, waking up. Okay, pray to God every day. Have a gratitude mindset. Okay, work out every day, even when your muscles are sore, when you feel like you can't do it. Okay, Monday through Friday. Okay, or at least just 5 days a week. Choose a schedule that works for you. Okay, and flow with the market, preferably Monday through Friday, because that's when the stock market's open. Okay, do your research. Make sure you guys have some hours in order to study the market. Okay, have some study chart time. You got to be checking the chart every single day. It's about discipline. You guys have to understand the type of individuals that you're playing against. If you want to call yourself a trader, you got to change it all. I've had to really look at myself internally and change everything. I had to improve in every single way possible. I realized where my faults were. I realized I need to be more patient. I realized I need to have more of a long-term mindset. Okay, and this is helping me improve, become a better trader, have more of a positive portfolio, lose less money, and increase my portfolio over time. Okay. So some common pitfalls from lack of discipline. Without discipline, traders and human beings just fall into traps that erode your capital, your soul. And let's dive deep into these issues. So overtrading, okay, this is going to come from greed. Okay, God talks about this. Don't be greedy. Okay, this is something I used to be. I used to be extremely greedy when it came to my trading. I would make some good money, especially when it came to prop firms, for example. Okay, let's say I made $1,000 on my prop firm 50K account. Okay, I would try and go ahead and trade again. Okay, try to make like 1.5. Then I would go down to 600, right? Trying to make it back up. And then, I might end up break even. Okay, destroying everything. Because why? Because I wanted some more profit. Okay, once you take your trade, you be grateful. Okay, you be grateful. Okay, have a gratitude mindset. Okay, be grateful for every loss or W that you take on the charts. It just is what it is. You're making bread on the screen. Okay, and I'm disgusted at myself for even not taking advantage of that. But it's okay. I learned, and this is why I come on the charts and come on here to tell you guys not to make the same mistakes I did, because it hurt emotionally. Okay, times where I was like, oh man, I could have used those bands. I could have used that money to do X, Y, and Z. I could have just reinvested that profit to make some more profit. Okay, but it didn't happen at the time. Okay, so don't overtrade, especially if you're a futures or forex trader and you can just spam buy and sell. Be careful with that. Okay, options, you got to be a little bit more strategic. You got to know what contract you want. You got to know what strike you want. Okay, it's a little bit different when it comes to options. It's harder to overtrade. But when it comes to futures and forex traders, make sure you guys are just, please humble yourself. Okay, humble yourself. Don't let that buy and sell button, don't let that instantaneous impulsiveness destroy your whole portfolio. Take logical trades. Okay, take your time too. Market's not going anywhere. Take your time. And trading too frequently can lead to high commissions and emotional burnout. You might feel like trading is not for you. Okay, take your time. You got to keep going. You got to keep grinding. Okay. For example, let's say a novice trader buys and sells 20 times a day. You'll be losing money on fees alone, depending on the certain brokers. Okay, the more trades that you take in a day, you're going to be subject to fees, bro. And that fees is going to be hitting at your P&L. So you're not even going to be making as much money as you think you are, even if you are hitting some profitable trades. Okay, so try and do 1 to 2 trades a day, max. No more than 1 to 2 trades a day. Okay, I like to trade a couple times a month, a couple times a week. Okay, personally. Revenge trading, don't do this, man. This is going to be one of the worst things you can do. When you take your L, you got to be grateful. You got to be grateful. Because if not, you're going to get mad. And you're going to think that you're right. You're going to think that the charts are doing something wrong. And it's absolutely not true. If the trade's not happening, it's just not happening. You can't chase losses with bigger bets. You can't take an L, put on double your size, and be like, you know what, I'm going to make up that loss. And I'm going to go ahead and make some money. Putting on double size, next thing you know, you lose again. Next thing you know, you're super down. And then you're emotional. You're upset at yourself. You're angry. Okay? You're like trading, you know what? I don't know if this is for me. Whoop-de-whoop-de-whoop. All because you got emotional. Blame yourself. Don't blame the markets. You got to wait for the cleanest setup that you can possible. Okay? And if it doesn't work out, it's fine. This is why you manage your risk. You shouldn't even be tripping if you lose. If you're tripping when you lose, you're oversized. You're not trading within good risk parameters. You're way oversized if you're tripping if you lose. So chasing loss over bigger bets is not going to be the play. And this stems from ego. Okay, whenever your ego gets hit, you got to understand, okay, you know what? I'm not going to win everything. It is what it is. I took a loss today. Don't double down and try and get back at the market. That's just going to lead to wipeouts, destroying your account, destroying your P&L. There's been times on prop firms I've been day 4 out of 5. Okay, about to get a withdrawal. And I blew day 4 out of 5. I blew it. Okay. up like 3 bands on a 50K account, boom, destroyed it all in pretty much a day or two. Okay. Hit the daily drawdown, and then day afterward, boom, destroyed it again. Okay. Okay. All because of ego. All because I was trading for P&L, not trading out of discipline, not trading out of consistency. Okay. Ignoring my stop loss, thinking I was more right than the market because I just had a little hot streak. Okay. I had to humble myself. I had to realize, you know what? I can't keep taking losses like this. I want to get better. I want to improve. I don't want to keep being the same type of person that I've been. I'm not going to keep holding positions and hoping for a turnaround. I'm going to play logically according to my plan. This violates your risk rules. This violates your soul rules. Whatever you're trying to do for yourself and your family, you can't do it when you're losing more money than you're expected. You got to stay down. Stay in stack mode. If you took a loss, come back stronger. Try again. But don't destroy it all in one setup. Take your time. Plan an even cleaner setup and win that one. Start over again. Get in stack mode. Restart. Okay, you're good. God got you. Even if it's your last dollars, God got you. You're trim. Okay. Restart. Run it back up again. Try again. Plenty of times I've had to do that. Okay. FOMO. Don't let FOMO get to you too. If you just see candlesticks bursting, you just took a win, for example, don't be like, oh, it's a good opportunity to make some more bread. Relax. That's not the mentality. That's very greedy, extremely greedy, very ungrateful. And take your time. Discipline counters this with rules-based trading. And relying on rumors instead of analysis, okay, can be bad. Don't be social media trading. Do your research. Check out the TA, the technical analysis, and make sure everything just lines up together. Okay, don't be going off of what he and she says. Do your research. Put it all together. Make sure it makes sense with your trading plan. Your trading plan is not going to be the next person's trading plan. Okay, figure out what works for you, and then you go ahead and you dominate with your plan. Okay, figure out what works for you and dominate with your plan. That's all you can do. Figure out what works for you and dominate with your plan. Okay, that's gonna be the best advice I can give you. Okay, and just don't give up. Okay, stay prayed to God. Keep grinding, even when you think it's hard, even when you think it's not for you. I promise you, just keep going. Keep going. If you feel like that loss is frustrating you, keep going. Keep going. You have to. You want to call yourself a boss, you have to be ready to take every single loss in the chest. Take it as a lesson. Let it power you up. Mark an even cleaner setup the next time. You got it. So discipline, it starts in your brain. Okay. So in your brain is where it's going to start first. Okay. Not in your body. You can pretty much almost ignore your body. Okay. But your brain is going to be the thing that controls your body in the first place. So treat trading, everything that you do is a marathon. Even working out. Okay. You can't get a six-pack. Okay. And then be like, all right, I'm done working out. Like, no, you can't do that, man. You got to keep working out. You got to keep grinding, keep eating clean, keep eating healthy. Okay. Keep taking your herbs and doing what you need to do. Keep praying, keep getting your sun. Okay. You can't just get your six-pack and then start eating junk food again every single day, not working out, not being disciplined. You'll lose it. Okay. And just like that bag too, when you touch that big bag, okay, if you're not putting it away, if you're not in stack mode, if you're not being disciplined, if you're not reinvesting smartly, okay, if you're not taking your time, you'll blow it. Okay, just like the six-pack, you'll lose if you're not keeping it up, being healthy, continuously working out, you'll lose it. Okay, anything that you don't consistently keep up, you'll lose. Okay, God puts it in front of us every single day, even in plants, for example. Okay, plants, they need constant sun, constant water, okay, rain and sun constantly, okay, decent soil, okay, and that constant rain and sun has to constantly hit the plant in order for it to grow. Okay, it could grow into a giant bush, giant tree, okay, whatever it is. Okay, and that's how your account and your body works too. You need constant work, okay, constant protein, constant water, constant cardio, constant weight training. Okay, that's how you get a six-pack. Okay, when I was getting my six-pack, I was grinding. Still do, Monday through Friday, not giving up. Okay, pushing myself harder every workout, being consistent, watching my carb intake. Okay, certain things like that. It's really gonna help you. You can head over to stackmode.net. Okay, I do have my free trading education ebook too. Okay, there's a couple other ones you can check out, but you guys can check out stackmode.net. Key Steps to Profitability ebook. Take accountability too. Okay, trade with some buddies if they're solid. Okay, trade with your wife or your partner if you guys are investment partners. Okay. Have someone to keep you accountable. Okay. You can't be doing anything on the block and hiding it. Okay. Post your trades even. Okay. Journal your trades. Do what you need to do. And balance life. You can avoid burnout by scheduling breaks. Okay. If you're about to get angry on the charts and crash out, get off, go pray, be grateful. Okay. Work out before the charts. This way you're going to be too tired to even be angry. You're going to come on the charts with a logical mind. Okay. Think of this from a survival perspective. We're supposed to wake up, hunt for the food, hunt for the berries, and then we eat food. Okay. Not wake up and then just eat food. Okay. Your body's supposed to be tired before we sit down. Okay. So before we sit down, we got to be tired. So wake up and work out. It's really going to help you guys calm your nerves. Okay. And really just put you in a clear headspace whenever you come onto the markets. Inshallah. So the core of discipline. Risk management is discipline in action. Protecting capital is priority number one. Never risk more than 1 to 2% per trade if you're a new trader. My more extensive traders, you guys can do 1 to 10%. Position sizing is extremely important. You can calculate it based on your account size and your stop loss distance. Okay. So for example, 100K account, okay, your risk is going to be 1%. That'd be 1K. Okay. Stop loss 5% away. Position size would be 20K. Okay. Stop losses and take profits. Stop losses when your trade's going to close by itself, and you can set your take profit too to make it close by itself. And always set them. Deep explanation. Stop losses are limit losses, and it pretty much closes your trade if it goes down or up to a certain point. So then you don't lose more than you want. And take profit's going to close at an area and exit you, so you give your money. And diversification. Okay, be careful putting all your eggs in one basket. Okay, try and be invested in like 1 to 3 things. Okay, depending on what you play, because that way you're not going to be panicking, just hoping and praying that one thing goes up the whole time. Diversify. Okay, play geology and spread out your wealth. And you could simulate certain scenarios too using paper trading and see how your strategies work out. Follow your trading plan too. Okay, put your Discord together. Put your Notion together, your journal together. Write what you're going to do. Write when you're going to get in. Write when you're going to get out. Figure out what session you want to trade. If you're a Forex trader, options trader, okay, figure out when you want to trade. Your performance, track it. Figure out how much you're winning, how much you're losing, how much money you're making, okay? What's your year and returns, okay? Are you profitable? Okay. That's really going to be the main thing. Are you profitable at the end of the year? Okay. Are you making money at the end of the year? Okay. Forget the money you're making right now. Are you profitable year after year? That's really what's going to determine who's profitable and who's not for the most part. And avoid deviations. Okay. Don't destroy your account. Being tempted to do anything that's fried or just not logical. Okay. If you see if it's a super bullish candle coming in and you're in a short, cut your trade. Don't hold past your stop loss with ego. Cut your trade. Okay. Follow your plans. Whatever plan it is, you can write it wherever you need to, your phone, wherever. Just follow it, stick to it. Day after day, year after year, and watch where you'll be. So, emotions, they can be the enemy, but you can transmute that into discipline. Okay. Discipline is going to tame them. You can use some certain key strategies in order to improve your emotional control. Okay. If you're feeling angry, okay, once again, have a gratitude mindset. Okay, wake up, pray to God. Just be thankful that you have the opportunity to come onto the market. Okay, be mindful. Be mindful of how much bread that you're playing with and what you're about to do to your account. Especially if you start making more money, you gotta have your emotional control intact. Okay, because it's gonna hurt you. It'd be a lot more traumatic to lose 7 figures than it is to lose a band. Okay, so keep yourself grounded. Keep yourself humble. Keep yourself hungry. Step away after losses too. Okay, go outside, go ground, go give someone a hug. Okay, don't go mute, don't go shutting everybody out or being drawn. Okay, just because you're angry that you lost some money on the market. Okay, you're good. Okay, relax. Don't let it destroy your entire life or your whole day. Okay, that used to be me. You can't do that. Okay, be grateful. Okay, be grateful for the people around you. Okay, don't start treating anyone bad, and don't be frustrated all day just because you lost some money. Okay, come back onto the markets again, plan a better trade, plan a cleaner trade, and you'll be good. So disciplined traders use stops to exit early and then re-enter on certain signals. Okay. Undisciplined traders like to panic sell at bottoms. Okay. So have your stop loss set. You can't just sell when you see market just start dumping exponentially. Okay. Have a plan. Be like, okay, if market ever crosses under here, I'm going to sell my position. Okay. Have a plan. You're a business person. Okay. Be structured. Don't chase hype without plans. No meme coins, no meme stocks. Do your research. Do your fundamental research. Do your TA. And make sure it all makes sense. And play with the trend too. Playing with the trend is going to be a really good way, inshallah, in order to make some money. Okay, trading against the trend or trying to catch reversals, especially to the downtrend and like stocks or crypto, might not always work out. Okay, trying to predict perfect tops and bottoms, it's going to be a lot harder than just trading with the trend in general. Okay, so you can either wait for resistance to be broken and turn into support, or support be broken and turn into resistance if you're in downtrend. Okay, either one. So, what challenges do you face with discipline? You can go ahead and comment below. Head over to stackmode.net. You guys can get my free trading education, free ebook, free course, book a free call. I'll catch you in the next one. So I pray to God. Keep grinding. Peace.
Most beginners lose money trading futures, not because the market is hard, but because they start wrong. Today, I'm going to show you the right way and the simple steps to your first profitable futures trade. By the end of the video, you'll know exactly how to pick the right contract and how to avoid the traps that wipe out new traders, and the exact setup professionals use to stack consistent wins. No fluff, no complicated math, just a clean, actionable beginner framework that actually works in live markets, prop firms, and even if you've never traded futures in your life, inshallah, if God wills, you'll know how to trade it by the end of this course. Let's jump into it.
Okay, so this is going to be how to trade futures and catch dips and certain lows. Okay, so we're just going to go ahead and jump straight into it. So what you want to do is start off doing top-down analysis. Okay, top-down analysis is when you're going to be starting from your highest time frame and scaling down to your smaller time frames. So what we're going to go ahead and start off with is our weekly time frame. Okay, our weekly time frame are going to be our eyes. Okay, you're going to be able to see absolutely everything you need to see on the screen. You got to start on a higher time frame. Especially on futures, you cannot sit there and tunnel vision on things like the 5-minute and the 1-minute and not understand the true directional bias. Okay, we're also going to talk about some logical things and some logistics of why it's better to play certain directions within the US market. Okay, and futures is going to be a US market. Okay, we're going to talk into everything, and this is going to be the full futures guide. Okay, so we're going to go ahead and have the weekly here, right? Weekly time frame is going to be our eyeballs. Okay, we're going to be able to see everything we need to see on the higher time frame basis. That's going to be pretty relevant. Then from there, you want to go ahead and head down to your daily time frame. Okay, you're going to go down to your daily time frame. It's going to show you a little bit more candles than you would see from your weekly. Okay, and each one of the candlesticks that you're going to see is going to determine the amount of price action that's happening within a certain time frame. So if you're on the weekly time frame, each one of the candlesticks that you see will represent 1 week. If you're on the daily, each one of the candlesticks will represent 1 daily. Okay, so that's how things fluctuate and change. Okay, so it's just about knowing when to use certain time frames and how to use the flow. Okay, and once again, the flow is going to be going from your highest time frame to your lowest time frame. Okay, highest time frame to your lowest time frame. So we're going to go from the weekly to the daily to the 4-hour time frame. Okay, the 4-hour time frame is going to be extremely, extremely important, and we're going to talk about why. So if I get on the 4-hour time frame, we're going to see here in the bottom right of trading view, okay, you're going to see the words ETH. Okay, so look in the bottom right here, you'll see the words ETH. ETH is going to stand for extended trading hours. Okay, it's going to stand for extended trading hours, and what that is going to show you more candles that would be hidden than if you didn't see. So market is open normally from 9:30 a.m. Eastern time, okay, to around 4 p.m., okay, Eastern time. Okay, that's going to be like the basic stock market time. But with extended trading hours and with futures, market is also open on Sunday. It opens at Sunday at 6 p.m. and is open until I believe Friday at around 6 p.m. as well too, Eastern time. Okay, so extended trading hour is going to show you the Sunday hours, which you need to see. Okay, if I turn off extended trading hours, okay, the chart is going to look a little different, and you're going to see little areas like this, okay, where you're going to see gaps in between certain spaces. But if I turn on electronic trading hours and I go back to the same place, I'm going to see price have a filled in area there. Okay, so that's why extending trading hours is extremely useful to use, and why you can't just live completely on your higher time frames. Okay, all your time frames are going to be useful. Okay, you got to use all your time frames. Got to. Okay, all your time frames are going to be important to use. They're all going to help you out, and it's about knowing when to use what, once again. Okay, so that's going to go ahead and be that. So you're going to go from your weekly to your daily to your 4-hour to your 15-minute. Okay, weekly, daily, 4-hour, 15-minute. Okay, that's how your futures flow needs to go. Do not just tunnel vision on the smaller time frames. Yes, the futures income is nice. Yes, you can scalp and make some money, but it's not just about that. It's going to be about the discipline. It's going to be about catching your nice big trades, okay? You don't want to be just trading for pennies, okay, especially on futures. This is why on futures, I recommend be on the live account, okay? Because when you're on the live account on futures, things are a lot different, okay? You can hold your trades overnight, okay? When you're on prop firm, you cannot hold your trades overnight, which hurts your profit significantly, okay? The extended trading hours time is going to be when a lot of price action decides to occur. So when you get a good entry and you see which way price is flowing in, you can make some nice money and turn a small account to a lot, okay? Fairly fast with futures. Now it's going to be a lot of power in your hand, okay? When it talks about futures, it pretty much just means make or break, okay? You can make or break all your profit, okay? So let's talk about some certain things when it comes to futures before we get into the chart. Let's talk about margin. So margin is going to be an important thing when it comes to the futures market. Margin is going to be the amount of money required in order to open a contract. So in order to outplay this, right, thank God we have the new micro futures accounts. So micro's futures accounts cost less than normal's futures contracts. So let's say you're trading the NASDAQ 100, also known as the NQ, okay, which mirrors the QQQ, okay, stock or ETF. So index. So NQ, right? Let's say it costs $1,000 to open up one contract of NQ. Okay. On most brokers, it'll cost you like at least $1,000 to open one contract of NQ. Thank God, though, we have something called the micros, which helps us trade more efficiently, and this way we can trim and get more value for what our account size is. So now we have micros. So now you could play something called MNQ. Okay. And instead of spending $1,000 on a contract, you can then spend $100 on a contract. Okay. And you could flip that fairly simply. Okay. Let's say you're on YM, okay, which mirrors the US 30. Okay. It might cost you $500 to open one contract. Okay. And if you're trading MYM, for example, it will go ahead and cost you just $50 to open one contract. Okay. And you could still make some great money. And instead of buying one contract of YM, you could buy multiple contracts of MYM and be in a much better position. Okay. So you can think about that. So the micro contracts are going to be new contracts. I believe they came out like 2021, something like that. Fairly new. Thank God. And now we have the ability to trade with less money. So even if you do have a big account, you could trade a bunch of micros and trim and trade how you want and hold your trade as long as you want.
And as well, when you trade the micros, they're going to have lower overnight margin. Okay, so OVM, overnight margin. Okay, so it might cost $50 to open a micro contract during the day, but if you want to hold it past 5 p.m. Eastern time, then the margin might go up to like $400 a contract. Okay, so you got to make sure you're having the overnight margin and the day margin if you want to hold overnight. Okay, so pay attention to that, and every broker is going to have its own different amounts. Okay, it's a lot of important things to know before we just jump into trading futures, because you can get what's called margin called, where if your account goes underneath the amount that required, let's say MYM, okay, let's say it requires at least $50 in your account. If your account goes underneath $50, let's say it goes to $48, it'll go ahead and just wipe all of that and put it straight at zero. Okay, and if your price action goes against you too fast, you might even owe the broker money sometimes. Okay, so you want to make sure that your dollar amount is a pretty good amount over the amount of margin. So if it requires $400 to hold overnight, then try and have at least like $800, $700 or something like that. Okay, this way you're going to have some wiggle room and things like that. So the things outside of futures are going to be really important too. And how long you hold the trade is also going to go ahead and be limited. So how long you hold the trade is going to be based on the certain month too. Okay, you can't sit there and hold futures forever because they do expire and have certain expiration months, which the broker will tell you a lot of the times. So now let's go ahead, and which is why you'll see on your broker sometimes it might ask you to roll over your contract. Okay, so once again, starting on your higher time frames is going to be our bread and butter. Okay, it's where we're going to succeed at. We want to see the higher time frame trend. Okay, let's talk about some logical things too as well before we jump into the chart fully. Okay, I want you guys to pay attention to this. This is going to be MYM, right? Look at how this chart trends. Okay, year after year, even with certain dips, we're trending in an upwards positive direction. Okay, we're trending once again in an upwards positive direction year after year after year after year after year after year. So personally, I don't think it's smart to trade futures to the downtrend. Okay, the Forex community has spread over to US traders, and now US traders think that they should be shorting a market that goes up year after year after year after year. There's also certain laws in place called the short sale restriction, okay, SSR. And the short sale restriction prevents stocks from just flash crashing to 0%. Because if they stock, because don't forget, definitely remember this, but don't forget, futures are just indexes. They're just a bunch of stocks put into one big giant conglomerate, and then you can trade it like that. Okay, that's all it is. So if stocks crash, futures will crash. Okay, that's just how it is. So you want the stocks to be up and afloat. And same thing for the US government. It's beneficial for the world, okay, the global economy, okay? The more money the US has, the more we can look better and help other countries out, etc. Okay? So, if the stock market goes within a positive upwards direction, right? If futures goes in an upwards direction, okay, that's going to incline more companies to be able to hire more employees, okay? And the more employees that are hired, the more taxes that are going to be paid. The more taxes that are being paid is going to equal a richer White House. A richer White House is going to give the country more credibility, recognition, and ability to do more things. Okay? So, there's logical reasons why we want the stock market to go in an upwards direction. Okay, logical reasons why you don't want the market to crash down. So don't fear crashes whenever you're trading. But in futures, I recommend to buy lows. Okay, there's going to be two things we're going to be looking for in futures. We want price to already, and let's talk about support or resistance. So support is going to be an area where price is bouncing in an upwards direction. Okay, so if you're on your higher time frame and you see price made a certain low going in an upwards direction, okay, that's going to indicate an area of support. Okay, it's going to indicate an area of support. Then the opposite of that is whenever you see price falling in a downwards direction. Okay,
whenever you see price falling in a downwards direction, then that's going to be called an area of resistance, indicating that sellers are coming into place. So resistance is going to be when price is falling in a downwards direction. And then we're going to have support when price is bouncing in an upwards direction. Okay. And that's just going to go ahead and be the difference between the two. So putting this into perspective, we have to go ahead and realize, like, okay, support and resistance correlate with each other. Market can only go in two directions. Okay. But I can see on my weekly time frame, year after year after year after year after year, market's going in an upwards direction. Okay. So my US futures traders, please do not have that Forex mindset. Okay. I want you guys to look at the Forex chart real quick. A lot more sideways. This is why Forex traders short. Okay. There's a reason why they short. Okay. Because you can get off with things like this a lot easier, a lot cleaner, and a lot better. Okay. This market is not meant to go in an uptrend. Okay. As we can see, futures goes in a consistent uptrend. Okay. Due to the fact that it's going to help the US in a lot more cases. Okay. So we have to keep that in mind. That's why price is going in upwards direction. So let's talk about once again how we can go ahead and trade. We want to be buying two things. Okay. You want to be buying when price makes an area of support. Okay. Because all your setups are going to look the same. Your setup should always look like a V. Okay. So market will always make the left side of the V, and we'll talk about this in a second. And then you're going to catch the remainder of the right side of the V, because price always wants to try and break all-time highs. So as we can see on the futures market here, we're always constantly making new all-time highs pretty much. Okay. And that's due to the fact that, once again, it's most beneficial for the world, the economy, and the global infrastructure of everything. Okay. So price is always going to be hunting towards all-time highs, which means price is always going to be hunting to go in an upwards direction. So even if price is in a downtrend, I personally don't like to short. I like to just wait for price to make a low, and then I'll go ahead and I'll take my trade. Okay. So let's talk about how you know when price is ready to make a sweep up. Okay. There's going to be two things we're going to be looking for. So you want price to be, once again, just bouncing at an area of resistance going in an upwards direction. Okay, and then you want to close at an area of resistance or support above current price. That's because price has an ability to reject at an area of resistance multiple times. Okay, and one day it might break, but you don't want to eat the reversal. Okay, you want to catch your formation and structure completion. Think of trading as a puzzle piece. Everything should click and form together. So resistance areas can short within a downwards direction twice. Okay, and then we're also going to go ahead and have an area here where resistance gets broken, turns into support, and then price goes in an upwards direction. Resistance here getting broken, turn into support. Okay, this is going to be another example of the V formation too. Okay, and in this instance here, you would have bought at this area of support here. Okay, and catch it up, because you know price wants to mirror or at least reach the area of resistance. You don't know if it wants to break out immediately. Okay, but price at least wants to go ahead and reach it, and that's what matters. Okay, catching your resistance gap fills. So let's go and let's keep talking about it here. So I like to go ahead and start on my weekly here, because it lets me know, like, okay, am I at all-time highs or not? Okay, because if I'm at all-time highs, then I know I'm going to be needing price to dip down, make a certain low, and then I'll be able to go ahead and catch my sweep in an upwards direction. Okay, so let's go to daily here. Okay, now I'd like to go ahead and wait for certain formations. Okay, so take an area like this on the daily. Okay, I see price made an area of support down here twice. Okay, and even if I wanted to go ahead and just take it up to like this area of resistance, you know, that would have been solid. And as you can see, just based off this tiny support here, went ahead and caught the whole gap fill, and this would have been around 669 points within a couple of days. And on futures, that's disgusting money. Okay, that money is nasty. So what I'm looking for, especially on my, so I like to see my weekly here, make sure I'm not at super all-time highs,
because I'm looking to long the market, okay? And I'm waiting for price to make a little base on the daily, okay? So I need price to make a little base. So right now I can see price making the left side of the V. Right now we're heading straight down. Okay, we're heading straight down, and then I need price to form a low, and then I'll be able to catch the right side of the V and catch it back up. Okay, so that's what we're going to be looking for. But in order to do this, we got to be patient. So right now I wouldn't short, okay, because people are going to be fiending to buy any low opportunity. So I'm going to wait for price to go ahead and create its low. Okay, I'm going to show you a good example of what that looks like. I'm going to go to my 4-hour again. Okay. When you start seeing price make that nice curl, especially with 4-hour closes, then that's when you know you're going to go ahead and catch your nice trade. Okay, take this little sweep curl up right here, right? Even if I decided to close the trade at this area of resistance up here, that's still a really nasty futures trade. Okay, this is 862 points. Okay, just catching the V. Okay, catching it to this area of resistance up here. Okay, and as you can see, price decided to go ahead and fill the V. Okay, and you're just going to go ahead and be able to farm money on the micros, farm money on whatever. Okay, let me go ahead and just log into the paper trade here and just show you how much this would have made, for example. Okay. Go ahead and close that. So boom, even right here, right? So let's say you opened a trade right here. Okay, and I like to play with like 100 tick stop loss. Let's say I'm trading YM. Okay. 100 tick stop loss, right? I'm risking $50, and my take profit would be this resistance all the way up here. Okay, 473 ticks. So I'm risking $50 to make 236. And as you can see, price decided to continue forward. So as soon as price starts to make that nice V, so I'm looking for multiple 4-hour candles, and then I'm waiting for price to sweep in a upwards direction. Okay, I'm waiting for price to sweep in an upwards direction. So I can see price making an upwards V, even if I entered right here on this candle, okay? Because I want price to go ahead and make the formation of the bottom for me. Okay, I don't know where price is going to bounce at. Okay, it's too many people try to predict the ultimate bottoms. Okay, but you know that price at least wants to try and mirror areas of resistance, okay, before it gets broken. So take advantage of the V. So even if you entered right here, right, you'd be able to enter right here. Okay, 100 tick stop loss. As you can see, stop loss just didn't get hit. And then we decided to go ahead and take profit all the way up here at this resistance of here, 484. Okay, and then you can go ahead and catch nasty trades over and over and over again, waiting for your V formation. Okay, so what I'm going to be waiting for is for price to make a certain low. I'm waiting for price to nosedive down. After price makes a low, okay, let's say maybe about this much on like the 4-hour at least, okay, then I'll be able to catch the remainder up until the previous resistance or support that it stopped at. Okay, and then I'm going to go ahead and close there. I'm not going to play for the breakout. Okay, I'm just going to go ahead and catch the V fill. All your trades should look like a V for the most part. Okay, so right here, I'm waiting for price to go in a downwards direction. Okay, I'm waiting for multiple 4-hour candles. I don't like to just go off of one 4-hour candle. I can't just see price make this one wick area here near this area of support and be like, oh yeah, this is going to be the best trade ever. Nah, I want to actually wait. This is where the 15 minutes is going to come in too. So I can see on this area here, I have a previous area of support over here, and then I have an area of support over here too. Okay, price going in an upwards direction, starting to curl. Okay, but I'm going to wait for more 4-hour candles. Okay, maybe even some more daily candles to form too. Okay, and then I'm going to go my 4-hour here or 15-minute. Let me find myself a good take profit. Okay, so take profit here, even if I want to close at like this resistance area up here. Okay, so let's say I get like one more 4-hour candle or something like that. Okay, I might be able to go ahead and take this V formation up until at least this area up here. Okay, and then I'm going to go ahead and put a 100 tick stop loss. Okay, and then I can see if this area actually wants to go ahead and fill and catch it up to this area of resistance either here, or I could try and catch it up to the, yeah, I mean, honestly, I wouldn't be greedy. Try not to be greedy when it comes to futures. Just take your nice trades and just wait for redips and just do it again.
Okay, because the greediness can really get you nipped in the butt. So I would really just take like your 15-minute take profits like this, catch your nice sweep, catch your nice V, close at this area of resistance up here. Boom, close out the area of resistance right there. Get on my 5-minute here, you're gonna see the resistance here. You know, price might want to mirror that, and then you can go ahead and close your trade up there. Okay, very simple, very easy, and just go ahead and take your money. Okay, so even if price is in a downtrend, okay, price still has to go up to come down, and price has a better chance of going in an upwards direction than it is just falling in a straight downward direction. Okay, especially when it comes to futures. Okay, use your higher time frame, look at your bias, and put everything into perspective. Does it make sense to short something that continuously goes up in an upward direction year after year after year after year, regardless of inflation or anything? And the answer logically would just go ahead and be no in every single scenario. Okay, so when you're reading your futures chart, it's really just about taking your time, getting in your bag, and really just making sure you understand and can read what you're looking at. Okay, it's about taking your time. And when you take your trades, you got to take your profit. Okay, you got to be closing at these areas of resistance or support above current price. You got to. Okay, I wouldn't hold past up here. Okay, we also have this take profit up here too as well. Okay, if you wanted to take something like to up here. Okay, and this would be for like a 1-to-1, and then price decides to continue to go up in an upwards direction over and over. This area of support could be a take profit as well too. Okay, and then that's the cool thing about futures. As each take profit gets hit, you can go ahead and keep dragging your stop loss if you want, or you can go ahead and set your final take profit at a certain area, have your stop loss, and just buy at certain logical areas and just pray that you win. Okay, because price most likely wants to reach these areas of resistance again. Okay, even if price wants to fall straight down from these, that's fine. At least it went ahead and touched it. That's okay. Okay, it's not just going up for no reason. It might want to go ahead and touch this. Okay, and that whole window of it going up is just money sitting there waiting to be farmed. So collect your income. Okay, whole sit there, whole bit of money just sitting there waiting to be collected. Okay, so sit there and collect your money. Okay, even at this area of support right here, because as we know, just like resistance can be broken, turn into support. Support can be broken, turn into resistance. Okay, so that's why a take profit right here would be reasonable as well too. So if price goes up, okay, let's say it does this, breaks this, okay, price might want to fall down here. Okay, or price might want to fall here. Okay, so that's why these are all going to be different take profits due to the fact that these are areas of resistances and supports above current price. And I can see price is trying to recover here. Okay, so you can see it on your smaller time frame. Price really trying to recover certain areas, and it's about making sure you know when to close. Knowing when to close is going to be the most imperative and important thing. The trend already started. Okay, the chances of the trend just reversing here super duper hard, it could be pretty low. Okay, so it at least go ahead and touch this resistance. If it breaks this, then try the support. If it breaks this, then try the resistance. And it'll keep trying each leg until it finds a place it might want to reverse at, find a super low, then break that previous high and do it over and over and over and over and over again every single year. Okay, so it's about playing logically. So if you're a futures trader, if you're going to trade some futures and you want to make some quick income, okay, because futures, you only got to deposit one time. Okay, it's about waiting for the right setups too. But after you deposit that one time, you can go ahead and you can get in your bag. Okay, you can run up your bag super duper duper hard. Okay, and it really just depends. Okay, so do some practice. Stackmode.net for all trading mentorship. If you guys have any questions, stay prayed to God and keep grinding. That's how you guys are going to be able to trade futures.
Class, we're going to be talking about value investing versus growth investing. We're investing for a reason. It's time to stop being broke. Being broke isn't cool. Late bills isn't cool. Debt isn't cool. And suffering isn't cool. If you want to start being broke, all right, start being lazy. Start not believing in your view. Start closing your trades early. Okay, start doing things like that if you want to stay broke. So let's talk about value investing versus growth investing and how we can actually have our money make some money. Let's jump into it. So an investment philosophy is a consistent overarching set of principles and beliefs that guide an investor's decision making process. and it dictates what to buy, and when to sell. Without a coherent philosophy, decisions become emotional and reactive. And the core tension in equity investing lies between intrinsic value, which is what a company is worth today, and future potential, which is what a company could be worth tomorrow. And by the end of this module, you guys are going to be able to understand how to articulate the foundational theories of value and growth investing, how to identify key financial metrics using each philosophy, and assess which approach aligns best with your personal financial goals and risk tolerance. And value investing is rooted in the principles laid out by Benjamin Graham. And it's often called just someone who's pretty good at investing, okay? And it's popularized by one of his most famous students, Warren Buffett. And the core of the idea is simple, and it's buying a dollar for 50 cents. So intrinsic value, right, IV. This is the estimated actual worth of a company, and it's calculated through fundamental analysis, which is analyzing assets, earnings, and cash flow. And value investors believe that the market price often deviates from this implied volatility and intrinsic value due to irrational investor behavior. Let's talk about margin of safety, MOS, the most critical concept. This is the difference between the stock's current market price and its estimated intrinsic value. And a high MOS provides a cushion against calculation errors, business downturns, and market volatility. And the business owner mentality. Value investors think of themselves as buying a part of a business, not just trading a stock ticket. And this leads to a long-term patient holding period. So Graham introduced the concept of Mr. Market, and it's a manic depressive business parser who shows up every day offering to buy or sell his shares at a wildly different price. A smart investor does not let Mr. Market's daily mood swings dictate their decisions. Don't let them come up to you and be like, you know what, I want to go ahead and just get into this because X, Y, and Z decisions. Make sure it's logical, okay? Don't just hop into it because of a FOMO candle, because of emotions. And remember, the compounding effect is what's going to get you guys to the profit that you want to be getting into. You got to stack up the cash, stack up the wins, keep investing in certain shares. Okay, so a smart investor, once again, does not let Mr. Market's daily mood swings dictate their decisions. They trade based off of logical and fundamental parameters, and instead use rationality to their advantage. And when buying, they're pessimistic. So buying when prices are low and selling when euphoria is in and the supply is super duper low. Okay. And that's gonna mean the demand is in, which is gonna make the prices high. So buy low, sell high. And the value of a buy. If a company has an intrinsic value estimated at $100 per share, a value investor will only consider buying if the market price is $60 or less, creating a margin of safety of over 40%. And the investor must be confident in the IV calculation in general. So formula, market price divided by the earnings per share, EPS. So the PE shows how much an investor is willing to pay for every dollar of a company's earnings. And value investors generally see stocks with a low PE ratio compared to historical averages and industry peers or the S&P 500. And a low PE suggests that the stock is currently cheap relative to its profitability. So for example, a PE of 8 means that it's going to take 8 years for the company to earn back your initial investment, assuming constant earnings, meaning that it's constantly making profit. So the price to book ratio, the PB, and the formula is going to be the market price per share divided by the book value per share. And the book value, which represents the shareholder equity, it represents the theoretical value left over if the company sold all its assets and paid all its liabilities. And the PB ratio is less than 1.0, and it indicates that the stock is selling for less than the liquidation value of its net assets, which is considered a classic deep value signal. While less common today, it's essential for financial and industrial sectors. And D, debt to equity, measures a company's leverage, and value investors prefer a low DE ratio, as high debt is going to be a major source of risk and can erode the margin of safety. So free cash flow, right? FCF. Free cash flow is the cash that a company generates after accounting for cash outflows to support operations and maintain its capital assets. Strong, consistent, and FCF is vital as it fuels dividends, stock buybacks, debt repayment, and the things that ultimately justify intrinsic value and the things that are going to cause a stock to go in an upwards direction. So pay attention to all these things, okay? Look at the ratios, see what's going to be worth investing into, and scan each of the fundamentals and know each of them things mean before you invest. Okay, you can see quality companies that are temporarily mispriced and not companies that are structurally flawed. Okay, because over time that'll lead into a downward decline of money for the most part. Okay, they're not helping anybody. They're not putting any value into society. They're not making people smile. So it's not going to be a worthwhile company. It's not going to be something that is going to put some future value. Okay, so there's no point in investing to things like that. We're here to make some cash. We're here to stack some cash. We got people to take care of, houses to buy, land to get. Okay, we got to be stacking this cash and getting to it, inshallah. So there's some pros. There's the lower downside risk. The margin of safety acts as a buffer. And by buying below the intrinsic value, the potential for further significant losses is theoretically reduced. And psychological calm. Value investing encourages patience and detachment from daily market noise, reducing emotional trading errors. So in dividend income, value stocks are often mature, and profitable companies return capital to shareholders via constant dividend payment. Why? Because the company's making so much money. They're going to be like, you know what? You guys can go and have some money back. Here you go. And that's what a dividend is. And patience is going to be required. All right. It can take years for the market to realize the stock's true value. And that's okay. Okay. Be patient. Keep stacking cash. Keep grinding hard. Keep waking up, praying to God, and putting your full force into whatever, your business, your work. Keep stacking cash. Okay. Keep going hard, trying to protect and provide for yourself and your family. Okay. Keep stacking cash. Stay down. Get into stack mode. Don't buy that whip just yet. Don't buy those clothes just yet. Okay. You don't got to fill up the cologne cabinet full of X, Y, and Z right now. Stay down. Okay. Take your time. Build real wealth. Okay. So you can take care of your family whenever it's time. Okay. You're going to be the one who can handle the hard times. Okay. Why? Because you were in stack mode. You didn't give up and you were staying down. And the value trap. This is the greatest risk. And a stock looks cheap, right? Low P and low PV, but it's cheap for a valid reason, such as a fatally flawed business model, disruptive technology, or poor management, and the value never materializes. And missing out on innovation. By focusing on established, mature businesses, value investors often overlook high growth companies that are changing the world. And the ideal value investor is patient, contrarian, analytical, and possesses strong emotional discipline. They dive deep on research and are comfortable standing alone against popular market sentiments. So foundation principles. Growth investing focuses on companies that exhibit above average rates of expansion and revenue and earnings, often driven by new technology, market expansion, or innovative business models. And the philosophy was philosophized by investors like T. Rowe Price and Philip Fisher. Okay? It has a focus on momentum. Growth investors prioritize future earnings and potential over current valuation metrics. They're willing to pay a high price today for the promise of massive earnings tomorrow. And disruptive innovation. Some key characteristics include a high rate of sales growth, a strong competitive advantage, a moat, and a rapidly expanding industry, and a focus on reinvesting all profits back into the business for continued scaling. Okay, and ignore current profitability. It's common for high growth companies to report low or negative earnings. Okay, just because they're getting their feet off the ground. Okay, they're letting the sales come in, letting the customers come in, doesn't mean that the company is not worth nothing. And thus a high PE ratio is going to be involved into that as they invest heavily into R&D, marketing, infrastructure, and trying to make the company bigger. So then their profit margin is going to be a lot bigger. Okay. And while a value investor seeks a stock trading at $60, that should be $100. A growth investor seeks a stock trading at $100 that they believe will be worth $500 in 5 years. Okay. They're concerned with the trajectory of the business, not its current snapshot. Is it going to be putting a smile on people's faces? Okay. That's going to be the number one telltale sign to know if a business is going to be successful or not. How much is it affecting people's lives? Okay. And a growth buy, let's talk about it. So let's say a software company is losing money today, has a negative EPS, but its recurring revenue is growing by 50% annually. A growth investor buys based on the expectation that once the company achieves critical mass and stops aggressively spending, the profits will be enormous and the stock price will multiply several times over. So focus. Investors primarily look at year-over-year revenue, growth, and earnings per share, the EPS growth. And consistent growth above 15 to 20% is often the benchmark for a true growth stock. And quarterly acceleration in these metrics is a major bullish signal. So let's talk about the law of large numbers. Growth investors must always assess how long a company can sustain high growth rates, as it becomes exponential harder as the company scales. And that's the law of large numbers. And we'll talk about the PE ratio. okay, divided by the annual EPS growth rate. That's a percentage. The PEG ratio attempts to harmonize PE and growth rate. And a PEG ratio of 1.0 or less is often considered a fair value for a growth stock. And it suggests that the price being paid is reasonable and relative to the expected growth. And if a stock has a PE of 30 and is growing earnings at 30%, then it has a PEG of 1.0. So high growth, recurring revenue. High growth software and subscription companies are highly valued for their predictable recurring revenue streams. Okay, for example, software as service or SaaS. And TAM. TAM is going to be the total potential size of the market and that the company is targeting. The bigger the TAM, the longer the company can maintain hyper growth, and investors seek companies with small current market penetration but colossal TAM. Okay, and TAM stands for total addressable market. It's a principle. Growth investors are fundamental, betting on future performance and disruptive power in an expanding market, looking to make money constantly. So, advantages: potential for explosive returns. The possibility of 5 or 10x returns in a shorter time frame is the primary draw, and compound growth is exponential. And exposure to innovation. Investors gain exposure to the companies driving technological change and societal evolution. And the simplicity of thesis. The core thesis is often easier to articulate, and this company is winning in a massive growing market. Okay. And the cons: extreme volatility. High expectations lead to steep sell-offs, and if the company misses even minor earnings targets, these stocks are vulnerable to economic downturns and interest rate hikes. And valuation risk. Paying a premium for growth means the investor must be right about both the growth rate and the sustainability. If growth slows, the stock can fall dramatically. And the lack of dividends. Growth companies typically reinvest all the cash flow, meaning that the investor receives no current income at all. So the ideal growth investor is risk tolerant, technological savvy, forward-looking, and comfortable with volatility. They seek to capitalize on the long-term trends and accept the risk that many investments will fail, provided the successful ones generate outsized returns. So, bridging the gap. The GARP philosophy, famously employed by Peter Lynch, it seeks to combine the best aspects of both disciplines. And a GARP investor looks for companies that are exhibiting consistent above average growth, but are not trading at exorbitant, speculative valuations are going to be involved in them. And a GARP criteria, it's really the best of both worlds. Okay. GARP, it stands for growth at reasonable price. A growth at reasonable price stock often has a PE ratio that is only slightly higher than the overall market, but its EPS growth rate is slightly higher, and it blends the safety of a modest valuation with the upside of strong business expansion. And the PEG ratio is the primary tool used by GARP investors. And the GARP investor profile, right? Consistent growth. It seeks stable, sustainable growth. For example, 10 to 20% per year, rather than volatile exponential growth. And the focus on quality. It prefers companies with strong balance sheets, high returns on equity, right? And strong free cash flow. And it's hallmarks of a fundamentally sound business. And risk mitigation. Okay, you can see things like the PE and PEG metrics, which you can use to evaluate and to avoid grossly overpriced stocks, thereby mitigating the risk inherent in pure growth investing. So you don't be buying things at all-time highs, stuff like that too. So insight. GARP is perhaps the most practical strategy, once again, growth at reasonable price for the average long-term investor, providing a path to the market and beating returns without taking on undue speculative risk for no reason at all. So choosing the right approach is less about what's right and what's wrong, and what about aligns with your personal goals. Are you a family? Are you a guy with someone with kids? Okay. Are you a woman with someone with kids? Are you by yourself? Okay. You just have a partner. Can you go a little bit more heavy with your investments? Are you trying to play it safer with maybe dividends? Okay. So let me know what you guys are doing in the comments below. So your time horizon, right? It's going to be 10 years if you're value investing, but you prioritize capital preservation. Your risk tolerance is going to be low to moderate, and you dislike volatility. And your goal is going to be to generate current income via dividends and stable compounded returns, investing in things like SPY, QQQ, and things like that, slow movers that are very consistent. And you enjoy deep analytical research into financial statements to figure out the best ratios to see what's going to pay you guys the most out. And consider growth investing if your time horizon is long and you're seeking to maximize capital appreciation. And then maybe you might want to go ahead and invest into some value stuff, dividends, after you get some day trading, futures profit, swing trading profit, whatever. And your risk tolerance is going to be higher in this scenario. And if you're comfortable with significant drawdowns, and your goal is to capture exponential returns from market disrupting businesses. and you're technological informed and enjoy following market trends and innovation. So have a diversified portfolio. Okay. I recommend you guys having a long-term portfolio and then you guys having a short-term portfolio. Okay. Also, because the taxes are going to be different too. If you're holding a trade for over 1 year, taxes are going to be subject to some long-term tax benefits versus the short-term tax benefits if you sell before a year. Okay. So decide what's best for you. Okay. Invest in a smart way. Keep this capital. We're building wealth for ourselves, our families, our loved ones, making sure everyone can be taken care of, making sure everyone can be protected and provided for, because we're being disciplined, because we're going hard, and because we're pushing forward. All right. Don't be in your head. Don't let anything stop you guys. Stay prayed up to God. Keep grinding and head over to stackmode.net if you want to learn how to be disciplined and how to invest. Catch you in the next one. Let's master technical analysis the easy way. Charts isn't going to be that difficult. And once you learn how to run chart, you know how to read everything. So I'm going to give you guys the best sauce and the best strategies in order to read this chart and make the crypto markets pretty simple to trade. So one, starting off on the main thing, you're going to be needing to use your higher time frames. So your time frame is going to depict on the amount of candlesticks and how much candlestick price action you're seeing. So if I'm on the daily time frame, for example, each one of these candlesticks will represent 1 day worth of price action. Okay. If I'm on the 4-hour time frame, each one of the candlesticks will represent 4 hours worth of price action. If I'm on the 1 minute, each one of these candlesticks will then represent 1 minute worth of price action. The reason why we're using higher time frames is because we want to be seeing the overall trend on the higher time frame scale. Okay, so year after year, and you have to understand that everything from the left that happens on the chart reacts with what we see to the right today. So everything correlates, everything works together, and we're going to be able to mash it all together. Okay, so now that we know that information, if we use our daily levels, okay, and we put the levels from the left to the right, we can go and put out some trades. Okay, so let's talk to you about some different models, some different stuff I'm going to talk about, and how we're going to be able to introduce them into making profitable trades on the chart. So areas of resistance. Okay, so when you see me mark areas of resistance, it's going to be an area where sellers are going to come in from. Okay, understand that the chart is a left to right chart. Okay, so price action, let's say price action started all the way over here. People are going to take profit eventually. People are going to want to make their money. They're going to want to sell. Okay, so whenever you see price have periods where price dips down after making a high, that's going to be called an area of resistance. Okay, so resistance is going to be an important key factor to knowing where, okay, this is where sellers came in. Okay, so opposite of resistance, there's going to be support. Support is going to be an area where price decides to bounce in an upwards direction from. Okay, so this is going to indicate an area where buyers step in. Okay, so buyers are going to be trying to buy here, so then price can go up in an upwards direction from here. Okay, buying is stepping in since price is going in an upwards direction. Okay, and then when you see price making sharp downturns, that's going to go ahead and signal an area of resistance. Okay, so both of these things are going to be extremely important to go ahead and keep note of. Okay, so resistance has to be broken in order for price to progress in an upwards direction. Okay, so we know the goal of the cryptocurrency market a lot of the times is for cryptocurrencies to go up in price. Okay, so people are trying to gain APY, annual percentage yield, percentages on their dollar. Okay, I know I definitely am. Okay, by buying and holding and investing in something with value. Okay, so when you do that, you're going to be able to progress a lot faster, inshallah. So noting that, we can determine that, okay, the goal of cryptocurrencies is to go up in a certain value. Okay, so if price starts at $100 1 year, maybe the next year, price might head over to $10,000. Okay, so let's go and let's check out the chart, for example. So if I check out Bitcoin, I can check price is currently at 113,104 as of right now today. Okay, so price is all the way up here. If I check 2 years ago or 3 years ago, I can see price all the way down here near the 15,000s area. Okay, so price is at 15,000 all the way down here. Okay, and price is now at 113,000 in just 3 years. Okay, price has increased that much value exponentially within an upwards direction. Okay, so now that we know that, okay, the goal of the tokens and cryptocurrencies are to go up over time, we can go ahead and put that and plot out some really solid good trades. Okay, so let's go and let's check it out. So back to the drawings here before we jump into the chart. Areas of resistance, once again, have to be passed in order for price to progress with an upwards direction. So resistances have to be broken and turn into support. And then price can go ahead and blast up in an upwards direction. Okay, so once again, resistance can be broken and turn into support. It's not going to happen every time, but when it does happen, that's going to be a really good solid way in order to play a pullback. So let's say price is currently above and it goes back down to an area of resistance, it can turn it into support. Okay, so then price can go ahead and sweep up and you're going to be able to buy a low at the right time. Okay, or you're going to see price decide to bounce at an area of support twice. Okay, so if price decides to hold an area of support twice, then that's also going to be a valid way in order to determine, okay, you know what, price wants to head up in an upwards direction. Okay, so it really just determines on what you're looking at, okay, and the certain type of trades. Okay, so even if price is still going up here, price makes an area of resistance right here. If it comes down, turns resistance into support, it'll go ahead and swoop up and show up. Let me show you an example of this on Bitcoin. So I'm on the daily time frame here. Let me go ahead and zoom in so I can see price decides to create an area of resistance here. Okay, the major area of resistance that there's always going to be is all-time highs. Okay, so all-time highs, also known as ATH, is going to be when price is at the highs. Okay, it can't go any further. Okay, and this is the furthest price that it's at. Okay, so it's when the highest area of resistance is created. Okay, and price is trying to break it in order to continue further. Okay, so check this area out here. So check out this area of resistance here. We'll go ahead and zoom in. So you can see that this is an area of resistance due to the fact that price wants to fall in a downwards direction, okay, from this area. So price decided to meet up with the top of this candlestick here and fall within a downwards direction. Okay, price went all the way up from this low. Okay, went all the way up from this low. Okay, two candlesticks bounce at the areas of support on the daily. Okay, 2 separate days. Price decided to bounce all the way up, stop here. Okay, once it stopped here, this price decided to get broken over here. Okay, so an area of resistance isn't going to keep getting tapped over and over again a lot of the times. Eventually, price is going to attempt to break the area of resistance, turn it into support. Okay, and then price is going to try and head up in an upwards direction. Or price is just going to break the area of resistance and just break out. Okay, and just head up in an upwards direction. Or price is going to head in the breakouts direction. Okay, it'll happen. It'll break out a tiny bit and then pull back all the way down. Okay, that's going to be called a fake out. Okay, in order to avoid fake outs, for breakouts, you're going to play break and retest. Okay, a lot of the times break and retest, you're not really going to get faked out. Okay, especially if you wait for your 4-hour close, which is when you're waiting for the time that you can see over here to the right. Okay, to finish. So let's say we entered at this black line. I would not enter at this candle here because it's in between the black line. And I would not enter at any candle that tests the black line. I would enter at a candle up here, okay, above the black line. So this way, if price decides to burst down below the black line, I'm not going to be upset that I lost. Okay, I'm going to go ahead and just take the closed candlestick, okay, and take the trade this way. This way I know that, okay, you know what, price might want to go ahead and sweep up. Okay, so the earliest entry might not always be the cleanest time to buy a lot of times. Sometimes it's better to just trade the confirm entry, okay, and just wait. So this right here would go ahead and be a good example, okay, of a close that I'd be waiting for. Yeah, and then my take profits, I'm going to go ahead and set it for either all-time highs, depending on what I'm playing. If I'm playing cryptocurrency or shares, I'm playing for all-time highs. Buying at dips, and I'm playing for all-time highs. Okay, I'm going to be waiting for price to sweep all the way up, okay, and to do its thing. Okay, so you're just waiting for price to do its thing. Okay, and once again, areas of resistance like these up here, okay, are going to be your take profits. If you're playing along and you're waiting for price to go up, okay, your areas of resistance are going to be your take profit. So up here's an area of resistance. Okay. Up here is an area of resistance. Okay. And both of these areas of resistance are going to go ahead and be able to be played. Okay. So make technical analysis simple when it comes to trading cryptocurrency. So I pray up to God. Keep grinding. And head over to Stackmode on it for all trading education. Peace.
You don't got to make trading too difficult. I'm going to show you guys an easy way how to identify trending stocks and how to catch good plays. So identifying higher lows and higher highs aren't going to require any indicators, just straight candlesticks and chart work. Let's jump into it. All right, here's going to be top to bottom how to find an options contract. So first thing I like to go ahead and do is open my trading view. I'm going to look to the very right, and I like to open up the screener. So depending on your certain account budget or size, let's say I'm playing with the $2,000 account, or if I'm playing with the $3,000 account or even a $1,000 account, right? I'll stick between like the 10 to 100 range, or even if I want to, I could come up here and edit it, and I could look at stocks that have the share price between 10 to maybe 150. Okay, and this way, you're going to be able to trade contracts that are within that range or within whatever account range that you're playing. If you're trading with 5 figures plus, then you could disable this and you could trade with everything. Okay. So you could come here, manual setup, and mark your parameters depending on your account size. So let's just say for this example here, I'll come manual setup, and we can do 10 to 100. Okay. Once again, if you wanted to change it, you definitely could. Change it here, 150. So I have access to all of these stocks on the list. So these are going to be all the stocks that are going to be relatively pretty good to play for a good budget within like 4 figures headed into early 5 figures, which I assume most of you are booting up at. Even if you are playing with like 5-6 figure account, these stocks, if you get some good plays, you could stack up some contracts, buy some far out contracts, hit some really good plays. So one, you're trading the United States stock market. So it's pretty much just meant to go in an upwards direction year after year after year due to multiple reasons. One, taxes. If these companies are able to hire more people, the government's able to garnish more wages for taxes. And the more taxes that are being able to be paid to the government, the richer the government will get. Okay. So as long as these companies are going up, the more profitable they're going to go ahead and be, and then the more they're going to be able to do for the United States government. So these companies and these stocks are meant to go in an upwards direction year after year after year. Take Exxon, for example, okay, the gas station. You can go ahead and see here, price headed in an upwards direction year after year after year after year after year. Okay, or this is an energy company. So constantly price decides to rise due to the fact that it's a valuable company that affects the world. Okay, it's very, very helpful. And one thing you're going to notice about the chart is that it doesn't just go up in a straight line or straight down. Price moves within staircase scenarios. So price is going to move like an upward stairs. So identifying that lets us know that we have to get in at certain times, and also lets us know that market trends. So let's identify what the trend is and how to see an upward trend versus a downward trend. So when you're trading the United States stock market, a lot of the times you're going to be trading upwards trends, and you're going to be trading what's called pullbacks. Okay. If market's meant to go up, then wait for market to come down, buy it, and then wait for it to go back up, and then catch your profit. Okay, reverse engineer it and really just have your psychology on point. So once again, if market is meant to go in an upwards direction, you're trading the United States stock market, you're trading options or shares, whatever, and it's meant to go up, then instead of buying when it's all the way up, wait for market to pull down, buy it then, and then take it back up. So it's that logical. Okay, don't make it difficult. The charts are not mumbo jumbo. You don't need any indicators. Disable all the indicators on your screen right now. Just keep it easy, keep it fresh, keep it clean. So boom, you could see price heading in an upwards direction year after year after year. And one thing too, you want to be looking at price on your higher time frames. Time frames you're going to be needing in order to find your setups a lot of the times. You're going to be needing your weekly time frame. You're going to be on that first. It's going to give you that full vision, so make sure you can see every piece of price action. You don't want to be trading stocks that aren't trendy, otherwise you're pretty much just going to be wasting your time. Then you're going to go ahead and scale down to your daily time frame afterwards too. Your daily time frame is going to give you a little closer view, and a lot of the times your daily is where you're going to find your take profit. Okay, and it's where you're going to determine whether or not price is ready for your entry. Okay, so your daily is going to be for your take profit identifications and your entries. Weekly is going to be for the full bird's eye view, making sure you're not trading anything that's horrible. Then after your daily, you're going to scale down to your 4 hour. Now there's a reason why you scale down to your 4 hour. The daily is one of my favorite time frames, but you do need your 4 hour. 4 hour is also one of my favorite time frames. And the reason why you need your 4 hour time frame is, check this out. If I'm on the daily time frame, I'm going to notice sometimes there's going to be little gaps in between the market. Okay, little gaps I'm going to be able to see here in between the market. But if I go on my 4 hour time frame, I'm going to be able to see price moving successively. Now, if you're still seeing gaps, what you're going to go ahead and need to do, if you're on TradingView or whatever brokerage you're looking at or trading on, you need to turn on your extended trading hours. If you're on TradingView, look in the bottom right and just turn on ETH and turn on extended trading hours real quick. Okay, this way you're going to be able to see every hour an ounce of price action, and you're not going to be able to see those little gaps. So after you're done with your weekly and your daily, make sure you scan your 4 hour time frame. From there, here's how I go ahead and find setups. I like to go ahead and scan my stock screener. I like to start on my weekly time frame, and I'm going to stay away from things that are near all-time highs. Okay, because I'm going to want price to be at a point where sellers have already sold and buyers are just now stepping in. I like to call it the V formation. So you're going to let sellers make the top left of the V. You're going to let early buyers make the bottom of the V. And then we're going to catch the rest of the V as confident, assured buyers. Okay, letting us know that the trend has swapped. We don't want to be buying falling knives, and we want to be buying when price is confirmed. In order to do that, make sure you're having at least 2-6 daily candles headed in an upwards direction, ideally that are going to be the same color, green, if you're using green and red candlesticks. Okay, whatever color you're using for buying, the more candlesticks you see going in upwards direction successively with the same color scheme, okay, is going to let you know the trend a lot of the times. And price moves in V formations. And what that means is, let's take this V formation here. Price decided to come up, make a sharp stop, and then price decided to fall downwards. So price made the top left of the V. That lets you know sellers stepped in here. This is going to be an area of resistance. After that, price fell down, made a bottom, made an area of support. That's going to let me know that buyers went ahead and stepped in. And price went ahead and filled in that whole area back to where sellers originally started selling, broke past it, and it's going to go ahead and try and make some new highs. Okay, fall down here, and then price will try and come back up, break that, and price will continue to zigzag, go up and down, and make staircase formations to new all-time highs over and over and over again. And that's how the trend works. Now, knowing when to get in, they're going to want to get on your weekly time frames and stay away from things that are, once again, at all-time highs. Price can pretty much only go down, find a low, and once it finds a good low, then you buy it and then take it back up. Okay, and ideally your take profit is always going to be where price originally fell down from. So even right here, let's say price decided to fall down from this area. Price trickled up, stopped right here, fell down, and made what's called a higher low. So this low right here is higher than this low down here. When you start seeing price making higher lows and what's called higher highs, which means that this high is higher than this high. Okay, when you start seeing price make higher lows, which means this low is higher than this low, and this low is higher than this low. When you start seeing price trend in a staircase like that, that's how you know you're heading in an upwards direction. Okay, so to find a good setup, okay, here's another one that I went ahead and marked as well too. My daily, I could see that price decided to fall downward from this area here. Price decided to make a heavy area of support, made a higher low off of that, I identified that, and price decided to went ahead and smash take profit within a couple of days. Okay. Within 6 days. So extremely, extremely simple when you're finding your setups. You want to buy when the buyers are buying. Okay, and if it took 6 days, try and buy these contracts. Ideally, if you're taking smaller take profit setups,
using your daily and your 4-hour. You can buy contracts as far as like 2 weeks out plus, at least try and be 2 weeks out. And then you can build your account from there. But having at least 2 weeks on your contracts gives time and price to fluctuate in case it does, or in case some news comes out or anything. But even an example here on Disney, could see price meeting up with this area of resistance. I marked this a couple of days ago, and you could see buyers fiending to have price trickle back up to this area. Even if you're a trend line type person, you could do that too. You could see a little retest off the trend line here, and price headed in an upwards direction as well too. Okay, and if you wanted to, you could play the remainder gap to the resistance if you wanted to. Okay, you could buy at least like 2 weeks out, could buy 17 days if you wanted to, and take it up here, catch a nice flip. November 12th. And then you could buy your contracts. You could buy like 2 weeks out, 15, 12, $3. So yeah, 188 to $3 there. And you'd be able to just flip your money consistently there, even if you went 10 days. You'd be able to catch your flip there as well too. So play market how you would like to be playing it. Even a scenario like here, I kind of like this maybe potentially. I like how price is making higher lows here. Confident in that. Looks like buying wants to step in here from this low to the new low. Go to my daily. We got multiple green daily candlesticks. So 4-hour, honestly, I might take this up to at least this resistance here. And then that might be a clean little trade as well too. Pep. So about like 2-3 weeks out. About 145 and take it up. Yep. So cool. That's how I make it simple. That's how you find options contracts. Just no fluff, no BS. Just straightforward price action, reading the candlestick chart, understanding buy zones and sell zones, and just really taking the trades that you need to be taking. And understanding when buyers are buying is really important. Say this, for example, I could tell buyers are buying here since I see higher lows are being made. And the more you live on TradingView all day, the better your eyeballs get, really. So chart time is really important. Okay, I could check here on the weekly, see prices started to fall from here. Get on my 4-hour. Price falling down from this area of resistance. I see this area of resistance before it here that happened on the 2nd. I like that. I'll even hop on my 1-hour with it. I have this area of resistance too. Okay, so even if I wanted to close on this 4th area here, could definitely do that. Yeah, these contracts are a little far actually. So 120 minimum. So yeah, you'd have to play for like up here. So it'd be worth it to just buy some months out. I'm sure these are probably cheap, yeah. And you could catch this flip if you want to and hold these for a minute. So yeah, all types of scenarios, different ways to grow your account. It's just choosing the most effective ways and staying patient. Okay, play the stocks that you know you're good at. Pick stocks that have good volume, and really just take your time with your setups. And yeah, that's how you find options trades. Head over to stackmode.net. I pray it helped. Peace.
I'm going to break down calls, puts, and even leaps so you guys can understand stock options in a way that makes sense, no confusion, and no headaches. So use call options when you think a stock is going to rise in an upwards direction because you want to lock in the cheaper price today and profit from the move up. A put option is going to be the opposite. It gives you the right to sell a stock at a certain price, and if you think the stock might fall, puts lets you profit from that drop or protect your portfolio from taking a hit. You can also do something called hedging, which is the main thing options was created for, in which you could place a bet in both directions. But here's where the beginners miss out. Leaps. These are long-term options, usually lasting 1 to 3 years, and they give you a lot more time, more flexibility, and less stress than those short-term weekly options that wipe people out. Let's go and let's talk about them, and let's jump into it. Inshallah. All right, so let's talk about what an options contract is in the first place. Okay, so we'll talk about the rights versus the obligations. So an option is a financial derivative contract, and it derives its value from an underlying asset like Apple or Tesla stock, okay, or Microsoft stock, or even stocks like Google, okay? And it gives the buyer the right, but not the obligation to buy or sell that specific asset at a specific price on or before a certain date. Okay. So let's say you bought a ticket for $100. Okay. Right. That's how much the actual options contract costed you. Okay. And then let's say now the concert were to sell out. Now tickets are going to be worth $500. Okay. If you had a call ticket, okay, because call contracts are going to be used whenever you think price is going to go in an upwards direction. Okay. So you would purchase a call contract. Okay. So that would give you $400 in profit. So if you bought it, okay, if you bought the tickets for $100 and sold them for $500, okay, that means price went in an upwards direction. Okay. Which means you would have bought a call contract. Okay. And that means you would have made $400 on that. Okay. So $400 profit would have been what you yielded without ever attending the concert, just because you were right on the fact that prices would have gotten more expensive over time. So if you believe that prices are going to go in an upwards direction and get higher over time and more expensive, then you're going to go ahead and purchase a calls contract. If you're betting that the price of a stock is going to go in a downwards direction, then what you're going to do is purchase a put contract. Okay. So if you think price is going to go in a downwards direction, you're going to buy a put. If you think price is going to go in an upwards direction, you're going to go ahead and buy a calls contract. Okay, let's head over to the next slide. So let's talk about the anatomy of a contract in the first place. Okay, the big three terms. Okay, so every single options trade has these three components. Okay, and you got to choose them wisely. Okay, one, your strike price. Okay, your strike price is going to be the specific price you agree to buy and sell the stock at. Okay. Then you're going to have your expiration date. Okay. So one of the most important things about options is going to be called the Greeks. Okay. And the Greeks are pretty much going to be time deterministic factors that determine how much profit, okay, your options contract is going to make, or how quickly you're going to lose profit. Because remember, on options, you're buying and getting paid for an educated guess. Okay. It's not fully ownership like buying 100 shares. Okay. You're buying the educated guess and getting paid off of that. Okay. So every educated guess is going to have an expiration date to it. Okay. There's going to be a date where it's like, okay, if you're not right by this time, then your contract is just going to go ahead and expire. Okay. Whether it be in the money or out of the money. Okay. In the money means that it'll expire and you would get paid. Okay, and out the money means that you would have lost money on your contract. Okay. And then premium. Premium is going to be the price that you pay for the options contract today. Okay, and to buy the contract, and this is going to be your maximum loss. So the cool thing about options is that your maximum loss is built into it. And on options too, you want to go ahead and try to multiply a lot of the numbers you see by 100. So you might see, let's say you have Apple. Okay, let's say you got Apple here. And let's say an Apple's contract cost 8.70. Okay. All options contracts, in order to get the premium price, okay, you need to multiply the number by 100. Okay. So 8.70 times 100 would equal $870. Okay. If a contract costed you 2.50, okay, is the premium, make sure you multiply that by 100. And a lot of times your broker will tell you how much it's going to cost too. Okay, that's going to mean the contract will cost you $250. Okay, so multiply a lot of the decimal numbers you see in the options world by 100 to get the correct US dollar amount of what you're looking at. Okay, and once again, your expiration dates are going to be really important too. Okay, your contracts don't last forever. So buying as much time on your contracts is going to be ideally the best thing to do and will keep a smile on your face. Okay, make sure you have time on your contracts. Try and stay away from things like 0 date expirations. Okay, 0 date to expire. Okay, if you also hear the term DTE, it stands for date to expire. Okay, so let's head over to the next slide, class. So let's talk about call options. Okay, call options mean that
price is headed in a bullish direction. Okay, and a bullish direction means an upward direction. Okay, so that means that you're betting on growth. Okay, you're taking an educated, speculated guess. Okay, that price is going to go in an upwards direction. So buying a call means that you profit when the stock goes in an upwards direction. Okay, so why do it? Okay, leverage. Okay, so leverage on options is the reason why people trade options in the first place. So options contract, one options contract, okay, equals 100 shares worth of power. Okay, so one contract, okay, equals 100 shares worth of buying power. Okay, so to buy 100 shares of a $200 stock, okay, that means it would cost you 20K. Okay, but to buy one call option of those controlling shares, it might cost you only 500 to 1,000. Okay, so this way you're getting the shares power, okay, just jumbled up in a one big contract derivative. And it's cheaper because it's not giving you actual ownership, but what you're getting paid based off of if this directional skill. Okay, so if you think that a company is going to drop one of the best products of all time, okay, and it's not at all-time highs yet, and you think price can go even further, okay, then you can go ahead and look to buying a call option. Okay, so if the stock soars, okay, your $500 could turn to $2,000 overnight, okay, giving you 300% gain. That's also the cool thing about options too. How much you lose is baked in. You know exactly how much you're going to lose maximum at all times. If you bought a contract for 5.00, okay, remember, times 100, okay, and that would go ahead and give us $500. Okay, if you bought a contract for $500, the max you could lose, okay, the max loss would go ahead and be $500. $500 would be the absolute max loss, okay? But guess what the max profit is? Infinity, okay? So that's the super duper cool thing about options. You can only lose what you purchased the contract for, but you can make infinite. Okay, so if you bought a contract for $500 and it crashed to zero, the stock, okay, you would still only lose $500. But if the stock soared all the way up to $10,000 a share, okay, you would make infinite profit. So that's why people trade options. Let's head over to the next slide. And the opposite and equal end of it is going to be the put options, okay? Just like things that go up have to come down, okay? Options are going to be the same way, okay? Calls is going to be for price going in an upwards direction. Puts is going to be for price going in a downwards direction, okay? And that means that you're betting on a crash, okay? You think that price is going to head in a downwards direction for a bit, okay? And buying a put means that you profit when the stock price goes in a downwards direction. So let's say a stock price was $40, okay? And you think price is going to go down to $35. Then in this instance, you would go ahead and purchase a put contract, okay? So puts are going to be used for two main reasons, okay? One, speculation. So if you think a company is failing and you want to profit from the crash or heading in a downwards direction, then a put options contract would go ahead and be your best case scenario for this, okay? And then hedging, okay? Very, very important too, okay? So insurance, let's say you own 100 shares of Apple, okay? But you're scared of a crash, okay? So you could go ahead and buy a put contract. So if Apple actually does drop, okay, the put contract makes you money, and then you could take that money and buy more shares if you'd want to, okay? So options was created so people can speculatively trade, okay, and hedge. And hedging means that you could trade at both directions during the same exact time, just to manage any type of balance or any type of other asset classes you have held. Okay, let's head over to the next slide. All right, so let's talk about the pricing trap, okay? So the times 100 multiplier, okay, it's very, very, very easy to understand, okay? Don't make it a trap, just understand it. Okay, just understand when you're looking at options contract, it can be a trap though if you think a contract costs like $2.50. You're like, oh, the options contract only costs $2. Like, no, it actually costs $250. Okay, if you see an options contract cost 10.00, that means that that contract has to be multiplied by 100. Okay, and that would go ahead and give you 1,000. Okay, even if it's a decimal. Okay, if you see a contract for 0.75, you still have to multiply that by 100, Okay, and that's going to go ahead and give you $75. Okay, if you have a contract for 3.35, multiply that times 100, and that's going to go and equal 335. Okay, you guys can either use your calculators or you can just look at the number with the decimal and just remove the decimal. Okay, just remove the decimal from your brain mentally, and that's going to go ahead and give you the actual number. Okay, so if something's 2.50, okay, just remove the decimal, 250. Okay, if something costs 7.40, just remove the decimal, it costs 740. Okay, so don't make the math too hard. Okay, and don't get psyched out. Okay, stay prayed up to God for wisdom and keep going, even when things get difficult. Let's head over to the next slide. So time is going to be the invisible enemy. Okay, so let's understand what's called theta. Okay, so theta is going to be really important. Okay, so options are going to be like melting ice cubes over time. Okay, and you got to get paid before the ice cube decides to get melted. Okay, and they're composed of two types of value. One, okay, it's going to be intrinsic value. Intrinsic value is going to be the real value. Okay, it's going to be the stock price. Okay, and then the strike price. And then you're going to have the extrinsic time value. Okay, which is going to be the hope value. Okay, and this decays every single day due to the fact that we are trading in melting ice cube. Okay, so as you get closer to expiration, the time value accelerates to 0. Okay, so if the stock doesn't move fast enough, you lose money, even if the stock price stays the same. So in order to outplay all of this and get around theta and make sure you guys profit, you want to try and focus on what's called leap contracts. Okay, leap contracts are going to be contracts that expire between 1 to 3 years. Okay, because you want to try and play your options like you're holding shares. Okay, you don't want to try and play your options real quick. No, because a lot of times you're going to lose like that, and it's not going to be worth your initial investment. It'd be worth it to go play futures if you're just going to play that short of expirations. Okay, try to buy 1 to 3 years out and catch big, giant, higher time frame setups. At the end of the video, I'm going to include some chart setups too, so we know when it's time to buy calls or puts. Okay, so trying to buy between 1 to 3 years out is really going to give your trade some time to cook, chef, before it just decides to melt completely and expires. Okay, so now contracts that are expiring later, okay, like 1 to 3 years, will be more expensive, but your theta is going to go ahead and be saved. Okay, because if you have a shorter time frame contract, your theta is going to be getting destroyed by that extrinsic time value that decays every single day a lot quicker. Okay, and that's really just not what you want ideally. So I'm trying to give you guys the easiest time possible. Okay, so try to focus on contracts that expire in about 1 to 3 years, and inshallah you'll have the easiest time trading options. Okay, also another thing with options too, try to buy the contract closest to current price. Okay, so if an options contract is costing, okay, or let's say the current share price, right, is $70 a share. Okay, you want to try, and you think price is going to go in an upwards direction. Okay, let's say you think price is going to go to 80. Okay, even though you think price is going to go to 80, the best contract to buy would go ahead and be a 71 call contract. Okay, a 71 call contract would be the best contract to buy. Okay, you want to try and just buy the number 1 up. Okay, so if the number is going to be current price is at 60, okay, and you think price is going to go down to 55, okay, the best contract to buy would be a 59 put. Okay, that would go ahead and be the best contract to buy. So even though we're going to close at 55, you still want to buy the number 1 below since you're buying a put, or the number 1 above if you're buying a call. It's going to give your contract the best value and move the best. So leaps, okay, long-term plays, okay, leaps, long-term equity anticipation securities are options that expire in over a year, okay, or a year. Okay, they have less decay on them, making the theta very low. Okay, you don't have to stress about little daily moves going through it for no reason. Okay, and stock replacements, it pretty much mimics owning the stock for a fraction of the price. Okay, and you guys are still going to be able to hit some great take profits. Okay, and tax benefits. So even on crypto and shares as well too, if trades are held for over a year, then you get a lot of favorable tax-free treatment. And there's a reason for this, okay? The markets are made to go in an upwards direction. So the more people they have invested, of course, there's going to go ahead and be tax benefits for that. They want as much money as they can parked into the markets, okay? Because that's how the U.S. economy decides to flow and the U.S. stock market flows in the first place. Let's head over to the next slide. Okay, so calls. That means you're going to purchase them if you think price is going to go in an upwards direction. Puts. That means you would purchase them if you think price is going to go in a downwards direction. Theta. That's going to be the time clock, okay? And it's going to be a big piece on the melting ice cube, okay? Treat your options contract like a melting ice cube every day. And you want to get the most deep freezed ice cube that you can. And you do that by purchasing a leap contract. A leap contract is a contract that expires in 1, 2, 3 years, okay? And your risk is going to be whatever you purchased. Okay, so if you purchase a contract for 5.00, okay, remember, and then we got to multiply that by 100, okay, or you could just remove the decimal and that'll give you the number. So 500. So if you purchase a contract for 500, let your contract either hit your take profit or your stop loss is going to be that 500, okay, and only invest what you can lose. Okay, 100% loss is going to be possible on your contracts. Okay, so try and use your whole contract as the stop loss and give yourself time and play for real take profits. The United States stock market is created to go up. As long as these companies, okay, have more money to hire people, okay, that's going to be more taxes that can be paid to the US government, okay? The more money that they get from stock market funding means the more properties they can build. The more properties that are built means the more property tax that has to be paid to the US government, okay? So as long as these companies in the stock market goes in an upwards direction, okay, and that these stocks are even moving, then the richer the US government will get. Let's go and let's jump into the chart, and I'm gonna talk to you guys when to know when to buy calls and when to buy puts real quick. Let's go. So when you are on the chart, you want to start doing your higher time frame top-down analysis, okay? So I'm gonna go ahead and start on my weekly time frame, and then from there, you want to go ahead and head over to your daily to your 4 hour, okay? So once again, we purchase call contracts if we think price is going to go in an upwards direction, and you're going to purchase put contracts if you think price is going to go in a downwards direction, okay? So I'm going to start on my weekly here. So if I'm going to purchase a call contract, then that means that price can't be at all-time highs because I'm expecting price to go in an upwards direction. So if I have area of resistance above current price, okay, then that's going to go ahead and give me a window to purchase a calls contract, okay? So understand that price a lot of the times will try and hunt an area of resistance above current price, especially after falling down. Market's going to work at higher lows in V's, okay? So we can see market decided to make a low down here and decided to incrementally keep staring up in an upwards direction, okay, over time, okay? And after I like to see market making a heavy area of support on my higher time frames, whether it be in my weekly, my daily, or my 4 hour, okay, I know that price always wants to try to recover where it fell down from originally. So I would go ahead and just take the trade up till there, okay? I would purchase a call contract since I think price is going to go in the upwards direction, okay? And I would buy a year or 2 out, okay? So I could buy January 2028 if I'm recording this in 2025, okay? And if I see the current price here is 183.38, I could buy a 185 contract. Since I'm going to be buying a calls contract, I'm going to buy the contract that's going to be one above the current price, okay? If I was going to buy a puts contract, okay, expecting price to go in a downwards direction, looks like this one hit take profit too. Okay, if I'm expecting price to head in downwards direction, then, you know, you could play, let's say I wanted to short till this area of resistance here. Okay, market's decided to fall right here. Let's say I'm expecting price to do something like that. Okay, if I want to short down to this area of resistance right here, okay, I would do the same thing. Options by like 1 to 2 years out. If I think price is going to go in a downwards direction, I'm going to look at current price, look at the number right below it. Okay, so in this case, if current price is 19.39,
then I would go ahead and buy the put. Okay, I would buy the put 18, and that would be the best contract to purchase if price is heading in a downward scenario. Okay, so that's it. Make option trading very, very simple. Don't make it too difficult. I have so much free content for you guys. Head over to stackmode.net to learn how to trade options. I'll catch you guys in the next one. Stay prayed up to God and keep grinding.
Hey, what's going on? We're going to be talking about the psychology of a crypto trader, how things go, and how we can manage our emotions and avoid FOMO. FOMO is going to be fear of missing out. And it's pretty much going to be like, say, for instance, a candle burst straight up, and you're going to be emotional. You're going to be excited to get in because you're going to be thinking money, 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 instead of thinking discipline, 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 discipline. So I'm going to be talking to you guys about how you can manage your emotions and turn those cringe emotions into discipline. So this is going to be a deep dive into the cognitive biases, emotional pitfalls, and some practical strategies we can do to maintaining mental resilience in volatile markets, such as the cryptocurrency one. Let's go. So the emotional roller coaster. The cryptocurrency market is a unique ecosystem, distinct from traditional finance, due to its 24/7 nature. So the stock market operates Monday through Friday, and same thing with Forex, okay? Forex and crypto, Forex, stocks, and futures, I meant to say, all operate Monday through Friday. Cryptocurrency operates 24/7. Okay, so whenever your levels get hit, as far as your take profit, say you're in a long trade, okay, and you're trying to close at an area of resistance above current price, okay, if take profit gets hit at 2 a.m. in the morning, you need to have your alerts set on your phone, okay? Your alerts are going to be a big use, okay? So what you can do is get on your phone, okay, or do it from your computer, whichever one, and just get the app of whatever brokerage you have, or get the TradingView app, okay, whichever one. Then from there, whatever stock that you're on, find the level that you want to close at, okay? You should know where you want to close at. You should know where you want to enter at, okay? And you should know where you want your stop loss to be, which is going to be a place where your trades is going to automatically close, okay? And you should know where you want to automatically close for a win as far as an exit. So if your take profit gets hit, you need to get up and close your trade, okay? You cannot be lazy when it comes to cryptocurrency. If you're deciding to play a 24/7 market, you need to be ready to 24/7 close your trades and manage your trade. Okay, so if you don't have limit orders set as far as stop loss orders and take profit orders set, then you need to make sure you're on top of it. Set your alerts and do what you need to do in order to succeed. So it's a lot different from the traditional finance system due to the fact that it's 24/7 once again. Has rapid price swings, and the influence of social media can make certain cryptocurrency coins or tokens or meme coins just skyrocket due to its popularity. And the more popularity something has, inshallah, a lot of the times the market cap is going to increase. Higher the market cap, people are going to trust it. Okay, the more trust something has, a lot of the times more value it's going to have because people are going to feel more comfortable with parking tons of money within there. Okay, don't go into a state of euphoria whenever you're trading too. So even if you're making large amounts of money, okay, you're seeing your bank account go from $100 to $1,000. Let's say you held the trade for a good while. Okay, you're like, whoa, cryptocurrency, you did yourself a nice withdrawal. Okay, put 30% away for taxes. Okay, every time you withdraw, put 30% away for taxes. Whatever your withdrawals amount is, put 30% away for taxes in some different bank account. Okay, really 50% of that in a whole other bank account. Keep breaking down your money like that. So this environment amplifies human emotions, turning every price chart into psychological battleground. And understanding the emotional psyche of the market is going to be the first step towards achieving a disciplined mindset. Okay. So euphoria is going to be a state you can get into, especially once you start making money, just like I explained. So euphoria can be a state of overconfidence when prices start to soar within an upwards direction, often leading to reckless decisions and over leveraging. And it's the moonshot mentality that precedes a sharp correction. Let's talk about anxiety and fear. The immediate reaction to a market downturn, it's a psychological response to losing money, often triggering panic selling. Okay, so if you see market dumping down and you're in a long position, relax. Okay. If you don't have your stop loss set, okay, just understand that, you know what, I'm risked in for this. Okay, make sure you have your risk management in place and understand that drawdown might be inevitable sometimes. Okay, you're never going to just enter in and always see profit. Sometimes it's going to be drawdown, but by the time you close your trade, it should be in profit. The trade is only over whenever you close. If you're in drawdown, that's fine. Okay, Make sure you mark your levels of support below current price or resistance, and tell yourself, you know what, okay, if price breaks these levels, I'm going to go ahead and close. Okay, don't panic though. And denial. Now, if price decides to break your levels, you have to close, because that can lead to denial. And that's the refusal to accept that the market's falling, which causes you to hold onto a losing position in the hope of a miraculous rebound, or hodling with no plan. Don't do that. Okay, that's trading out of desperation, not of a logistical plan, and which is going to lead you to a cycle of despair, which is something I put myself in when I was being ego-driven and not learning from my mistakes instantly. And that puts you in the final stage where people sell at the lowest point of the market. Let's say they're in a long position and market decides to dump. Okay, people are just selling way past their stop loss, selling at the lows, and just blowing up their account, all because of the fact that they were overconfident in the first place. Okay, let's say they had a nice winning streak, thinking they were the best trader of all time, started taking some losses, couldn't really handle the stop losses, started doubling down. That could lead you to denial. Okay, denial could make you double down, put on more size than originally needed, and then you could lead into a cycle of despair, blowing up your account. Okay, so don't do that. Stay disciplined. Only thing that should ever change is the contract amount. Your setup criteria should always stay the same, no matter what. It should always stay the same. So fear, uncertainty, and doubt. All right, God got you. You're gonna be cool. Okay, even if you go back to zero, you can run it up again. Okay, you're not trying to go back to zero, but understand you can run it up again. So it's a powerful psychological tactic used to spread negative information and create panic in the crypto world. Okay, fear, uncertainty, and doubt often come from the form of news, report, social media posts, or regulatory rumors that intentionally mislead. Okay, so if you ever see like the little posts like certain amount of money was wiped out within the crypto market today or stock market today, ignore it. Okay, market is going to go down. Market has to go down in order for it to bounce back up. Okay, it's not just going to go up in a straight direction forever. Okay, price might want to come back and retest at an area of resistance below current price and sweep up higher, breaking new highs. Okay, it has to create liquidity. It has to gain ammo in order to break up further. That's all price is doing when it's going down. You have to think of it. People are in from like $100 too. So if price is at $100,000 and it dips down to $70,000, that's just people taking profit from whoever's in at $100 a share or $100 at value, whatever you're in. Okay. And this manufactured fear can cause otherwise rational traders to sell their holdings, creating a self-fulfilling prophecy of a market crash. And the whole time it's not. It's just leading to a new low that people are going to go ahead and buy who actually understand the charts. And if you want to understand the charts more, head over to stackmode.net. So you can learn to differentiate legitimate concerns from baseless rumors, check multiple reliable sources, and question the motives behind sensational headlines. Now, if they said something like cryptocurrency is banned, okay, so that'd be really, really, really different. Okay, and stuff like that, where actual laws are in place, okay, then that news is different versus just like, oh, a good crypto market lost $3 billion in the market today. Market has to dip down. Okay, all this is people selling. So fear, uncertainty, and doubt exploits the human brain's natural aversion to risk, and we're wired to avoid danger, and a perceived threat to our finances can override logic. And fear, uncertainty, and doubt as a strategy. Large institutional players or manipulative groups can strategically release FUD to drive down prices, allowing them to accumulate assets at a lower cost. So once again, it's just people willing to just buy the low again. So for example, there's been a China ban rumor going around, and for example, people would say that China bans crypto. Okay, and despite being old news or a misinterpretation of the policy, these rumors repeatedly trigger sell-offs due to widespread fear, and traders who sell based on this FUD often miss out on the subsequent rebound and miss out on the lows. Okay, so do your research and read the chart. Okay, don't just go off of news. Read the chart. And FOMO is perhaps the most dangerous emotion for a crypto trader in the first place. It's the anxiety that an exciting or profitable event is happening somewhere else. And it's a feeling driven by the fear that you will miss out on a significant opportunity. In the trading, FOMO often leads into buying an asset at its peak, just as its price is about to correct. So a primary driver of FOMO is social proof. Okay, don't hop on a trade just because you see your friend hop on a trade. Do your research. Make sure it's something that you would get into. Make sure it's a trade you would make. And a primary driver of FOMO is when you see others celebrating their gains on social media. You feel a strong urge to join them, believing their success as a blueprint for your own. And the urgency trap. The feeling that you must act immediately, now, today. And the price chart shows a vertical ascent, creating a false sense of urgency, overriding the logical process of market analysis and risk assessment. So you don't got to trade every single day. You don't got to trade immediately. You can wait for a certain level that you want to. Get in there, do your thing, take your time, be patient. And scarcity. Okay. Now, Bitcoin, for example, is going to be a limited resource. Okay. So the idea that a particular asset is going to the moon and you need to get in before it's too late is going to be a powerful psychological trigger. Okay. So Bitcoin is going to be a good example of that. It's kind of like a gold or diamond. Okay. That's just digital. So that's all Bitcoin is. It's kind of like, yeah, digital gold and diamonds. And it's just a limited resource. Yeah. But certain other meme coins example might be trying to trigger a rally. And during a meme coin rally, a trader might see thousands of posts from different people. Sometimes people hack influencers. Sometimes people run ads that are paid ads, okay, in order to spread the meme coin, okay? And I've spoken with these individuals, okay? It's not something that you want to get into. Just invest with things that have a future, market cap, and companies involved into it. Try not to play meme coins. I don't recommend it at all. Okay. So with meme coins, the investors, you can also see a large percentage of the pool who's invested into it. Let's say the people who created the meme coin, they own 60% of it. So what they're going to do is get in at the bottom. And by the time the meme coin goes up, okay, by people getting in, by the time ads explode, by the time influencers start posting, etc., they're going to be up a crazy profit. Because remember, this is the left to right chart. So they're going to be in from the start, the jump. So since they're in from the jump and you get in at the highs, they're going to go ahead and sell. And since they own 60% of it, they're a whale. Okay, and what a whale is a shareholder with a lot of value. So since they own a large percentage of it, if they sell, it's going to go ahead and dump too. Okay, so by the time they make bread, and it's trading. So if someone's making money, someone's losing. And if someone's losing, someone's making money. So whoever got in at the highs, by the time they said that the meme coin would be decent, would go ahead and get what's called rug pulled and pulled back on. Okay, and the people who got it at the bottom, who created it, who own the majority of it, would go ahead and make money. So a trader might see thousands of posts from people, okay, trying to make it seem like the best investment of all time. And it's not. Okay, do your research on actual things that help the future out, that help people out, and try your best to invest into that. Not meme coins trying to make some quick bread. So loss aversion and sunk cost fallacy. So these are two cognitive biases that are often intertwined with each other. And loss aversion is the psychological tendency to prefer avoiding losses over acquiring equivalent gains. And for a trader, this means the pain of losing $1 is far greater than the pleasure of gaining $1. Okay, so you're not even feeling your wins, okay, but you just want to keep losing. Okay, so you want to keep losing due to the fact that you're not satisfied with how much you win. Okay, so sometimes you might make some money within the market, right? And I've had some traders be like, you know what, it's not enough, and keep trading, keep trading, keep trading. And then the loss comes and then they're super salty. It's like you were already up bread, but you just weren't satisfied with it. Okay, and the discipline and the consistency is what's going to get you to be satisfied with your P&L. If you don't like the numbers you're seeing right now, be consistent for a couple of months and they will change, inshallah. Okay, so the sunk cost fallacy is also the belief that you already have invested a certain amount of time, money, or effort into an asset, and you should continue to invest in it, even if the asset is clearly failing or not a productive asset. Okay, don't do that. Don't hodl. Invest into a position that you know is going to have some future value, and hold it until your take profits get hit. Once your take profits get hit, go ahead and close and have your stop loss set. No, you know what? If price decides to go to this level, I'm just out. And loss aversion in action. Holding on to a position for months or years, hoping for a return or break even, this prevents capital from being reallocated to a more profitable asset. Okay. So this money could be going into something that's profitable, something that's actually holding some future value and helping out in society and human beings. And you can go ahead and make some breakthrough there. Okay. So money is going to be available through the future. And sunk cost fallacy, let's talk about an example of it. So for example, let's say you were down 50%. Okay, and then you say, well, you know what? I'm already down 50%, so I might as well hold. Okay, I remember our first trade ever. Me and one other person I started to trade with, we making like 3 figures a day, like $500, $400, like our first trade, completely oversizing and stuff like that, just playing some SPY 0 to T. And I remember the one time we held our trade down to negative 100%. Okay, and if you're on options, you know that means the contract goes worthless. Okay. And when that happened, we were extremely shocked because we were just making good money. Yes, we didn't know how to withdraw and stuff like that. It wasn't on a logistical system. So of course the money just went to zero. Okay, so it went to negative 100% for contracts. And I remember I was outside getting some work done on my car and looking at the position, and it was like, okay, you know what, the money was already gone. So, and I remember seeing like, you know, I'm down, let me just keep holding in case it sweeps up. And little did I know it went to negative 100%. So that's not going to be the mentality. Okay, unless you size for that. Okay, let's say if you're on options, for example, the contract costs $70, you're okay with losing $70. Okay, then that's different. But if the contract is $300 and you only want to lose $70, and it's $70 stop loss gets hit and you don't close and then you lose $200, you're going to be mad, okay, or sad. Okay, don't let that happen. Just follow your rules. Okay, follow your rules. Follow your rules. Because this rational thinking ignores the money that's already gone and that's holding an unprofitable asset. Okay, and manage your emotions. Here's some practical strategies. Okay, pray to God you're on the charts clicking buttons and being able to make money on the screen. Okay, so be grateful and don't lose yourself. And combating emotional trading requires structured and disciplined approaches. It's not about eliminating your emotions. We're all human beings. Only God is perfect. But it's about controlling your emotions and preventing them from dictating your decisions. And here are proven strategies to build your mental resilience. So once again, pray to God and be thankful that you're able to make money on the charts in the first place. And then develop a trading plan. If you're a retest trader, play your retest parameters. If you're a breakout trader, play your breakout parameters. If you're a reversal trader, play your reversal parameters. Okay, do what you need to do. Trade how you want to trade. If you're a trend line trader, trade your trend lines. Okay, do what you need to do. Okay, once you find your profitable strategy, go ahead and stick to that. Okay, farm it, run up your bread, but stay consistent. Okay, don't oversize. And if you're futures and forex especially, you don't want to get what's called margin call. And that's when you have to have a certain amount of money in order to open a position in the first place. And if you don't have that money available, you can get what's called margin call. So be careful and set your stop losses, especially on forex and futures, because if you get margin called, you can definitely owe the broker money, and you're not trying to owe the broker money or go to court for no reason or worry about the law. Okay. And do your own research as well too before you hop into anything. Okay, because if you get in a trade because someone else said it'd be good, you're going to be upset at them. Okay, so you can only be upset at yourself. Okay, do what you need to do and get in what you believe in. And the 24/7 nature of crypto can be exhausting. So set alerts, use time to your advantage, and step away from the charts. Okay, go grind bread in real life, go grind your business, do whatever you need to do in order to get some more comfortable, so then you can put some more money back into your account. Inshallah. And the power of journaling and mindfulness. So a trading journal is a critical tool for self-awareness. And it's not just a record of your trades, but a log of your mental state, emotions, and the rationale behind each decision. Reviewing this journey and over time, day by day journal helps you identify recurring emotional patterns and correct them. Okay, or see positive behaviors. Okay, positive or negative behaviors, either one. So log your thoughts, log how the trade made you feel, log how much money you made, log how you were thinking, okay, log how you were feeling, okay, were you feeling happy, were you feeling sad, okay, were you feeling pretty neutral after the trade, okay, depend on however the trade went. Let me know in the comments below how trades normally go for you guys and how you like to structure your journal. So mindfulness and meditation. So these practices can train your brain to observe thoughts and feelings without immediately acting on them. Okay, this is why it's really important to wake up and pray to God. Okay, it's gonna bring a lot of gratitude, bring a lot of discipline, and just come on to the charts and come into the world with just a humble mindset. Okay, we can make 100 M's and we're still gonna come on and do the same thing every day and grind hard. Okay, like we have zero. Okay, we're still gonna be disciplined, still be hungry, and the only thing that's gonna ever change is our P&L. Okay, regular prayer and breathing can significantly improve your ability to stay calm and rational during market volatility. Okay, you can ask God for any assistance if you're feeling any type of anxiety, if you're questioning yourself, if you feel like it's not for you, you're good. Okay, God put trading in your brain for a reason. Okay, we're all blessed with intellect, just like Quran says, and you're gonna be fine. Relax, stay focused to the plan, and don't give up. Okay, let's talk about social media. Okay, detox from it. Okay, get off of social media. If you feel like it's ruining your brain, get off of it. If you post on social media, post and get off of it. Don't scroll. Don't sit there and look at this stuff. Okay, just post and get off of it. Okay, a lot of the times it can be nonsense. And only trade what you can afford to lose. Okay, this is the golden rule for a reason. Don't be trading with your rent money. No trading with grocery money. Okay, no trading with any money that we need to survive. Okay, because it's going to be horrific if you were to take a loss, you'd be sick. And question everything. Okay, be a skeptic. Question the narratives you see, the price action you observe, and most importantly, the emotions that you feel. A healthy dose of self-doubt can prevent irrational decisions. And celebrate your process, not just your gains. A positive reinforcement loop can be built by celebrating good decisions, following your plan, sticking to your stop loss, ignoring FUD regardless of the outcome, and pushing forward. Okay, ignore the FUD regardless of the outcome. No fear. Okay, no doubt. Just keep going. Keep going. Trust God and keep going. No fear and no doubt within your mind, your heart, your soul. Okay, just keep going. And the journey to becoming a successful crypto trader is really a psychological one. The technicals are going to be extremely easy. I have a lot of technical videos, or you guys can head over to Stackmode.net for all trading education. You guys can also get my free trading ebook, free course. Okay, it's going to be a lot of stuff you guys are going to be able to get there. And the market is a mirror. It's going to reflect your mental state. Okay, if you're an impatient person, it's going to show you. If you're not humble, it's going to show you. And by understanding and managing emotions like fear or doubt and FOMO and overexcitement, you transform yourself into a reactionary participant into a disciplined, strategic investor. And the ultimate goal is not to predict the market, but to master yourself. Stay prayed to God. Keep grinding. Catch you in the next one. Peace. Class, let's go and let's jump into why you have to be disciplined, especially if you're going to be on a funded account, on a prop firm account, or trying to get any type of withdrawal. And let me tell you guys something. There's been times where I've lost a withdrawal on day 4 out of 5 of my payout. Okay. Due to what? Due to me being undisciplined, due to me being greedy, due to me having too much ego. And I don't want you guys to go through the same things. Okay. There's no reason to be going through that. There's no reason to be that disgusting and sloppy. And I want you guys to learn to just be consistent. Okay. There's going to be a lot of cost that come when you trade without your rules, when you let your ego get to you, okay, when you don't humble yourself, okay, and there's a reason why God tells us to be humble and have humility, okay, because you can really destroy yourself. Even when you're running up that big bag, okay, I was excited, okay, running up that big bag, posting P&L on social media, and this was before I was even Stackmode Chris, okay, like super duper excited, overzealous, over trading, and guess what, destroyed it all, okay, ended up getting no payout and lost the account at day 4 out of 5 out of my withdrawal. Okay, what was I doing? Okay, and I was up way over the amount than needed to crash out the account. Okay, and it was just completely my fault. I realized I had too much ego. I needed to humble myself, and I realized that I just couldn't believe that I was wrong on that one trade, especially after one streaking to earn the account in the first place. And prop firm can kind of screw up your head and screw up your whole mental realizations. This is why I personally do recommend, even if you're on a prop firm account, even if you guys are good in getting withdrawals, okay, start a real account. Okay, do these 2 things. Take the prop firm profit, okay, and reinvest it into account A. This is going to be your long account. Okay, your long accounts are either going to include your cryptocurrencies, your stocks. Okay, make sure you guys are trying to buy shares. So this way, you guys' money is always going to be making you money. Okay, because don't forget, prop firms can shut down. Certain things like that are possible. Okay. So just make sure you guys are taking your time, putting everything into perspective, and really just reading through the lines of absolutely everything. Okay. So account B. Okay. Replicate whatever you're day trading on wherever you're day trading on your prop firm. So if you're day trading futures, for example, on prop firm, then start a real account and copy trade on there. Okay. The same trades that you do on your prop firm account, just do it on your live account, even if the size doesn't correlate. So this way you're always going to have your money in your hand. So even if the prop firm shuts down, whatever happens, whatever correlation decides to go within a downward spiral, okay, you're always going to have your income there on the side. So you got account A, always making you money. Your money's always making you money, okay, instead of indulging in consumerism, okay. A lot of reason why people can't pay their rent and stuff like that is because, one, they're not stacking up. And you can't only stack up. You got to make sure your money is being used as a tool. It's being utilized, okay. Then rent's not going to be nothing. Bills aren't going to be nothing. But you got to sacrifice. If you don't sacrifice, you won't get wealthy. Okay, and once again, getting wealthy is not for everybody, and that's okay. Okay, but if you're a person who wants to get wealthy, you have to learn how to sacrifice. If you don't do that, you'll never get to where you want to be. Okay, so when you have account B, make sure that you're keeping your profits in there, okay? use your prop firm account as your income engine. Keep your profits in account A and B and keep stocking it up. Keep stocking it up. If you get to the point where you do find consistency on the prop firm, okay, you do have discipline and you found yourself a consistent edge to where you can constantly withdraw, that's amazing. Okay, alhamdulillah. Now, account A and B, don't touch them. Okay, just keep funneling money into them. Keep funneling money into them. Keep going, keep going, keep going, keep going. Okay, until either the A, the prop firm shuts down, or B, you just want to get off a prop firm entirely and just start focusing on account B and playing with your leverage and not playing without any rules or anything like that. So you can really use prop firm to get ahead and generate some income. So discipline is going to be the gateway to success and capital in general. So proprietary trading firms are not testing a strategy. They get paid based off of knowing the fact that you're going to be someone who's not disciplined. Okay? So prop firms only make money whenever you lose. So once again, whenever I didn't get a withdrawal on day 4 out of 5, right? I couldn't believe that I was taking a loss, right? Prop firms will kind of gas your head up. You know, they'll give you the nice fancy certificate, you know, after you guys went through all that hard work. Okay, so you start feeling like a good trader. You might start thinking you're better than you even are. Okay, then from there, they gate your profit behind certain days. Okay, so this is going to be a psychological game they play, because don't forget, unlike brokers like Robinhood, Webull, etc., where you invest your money, okay, the brokers get paid off of whether you put the trade now. So whether you click sell or buy, they make money. So it doesn't matter. They're not really betting on whether or not you win or lose your trade. They don't care, because they already get their fees as soon as you click enter. Okay, they get their fees. And everyone pressing enter, the conglomerated fees turns into their capital and their income as a company. Okay, so a broker is a really good business to start, honestly, as long as you just set up the software and get all the approvals. It's a really, really, really strong business, since you just get paid based off of fees. Okay, you just need participants. So, but prop firms, for example, okay, prop firms, they only get paid when you buy an account. Okay, so they're going to psychologically change everything, and they might put into retrospect like it might be easy to go ahead and get a withdrawal, etc. But behind the thin lines, behind the challenge rules, etc., they're hoping that you fail. Okay, so winning 5 trades is not normally how it goes in order to get your money on a real account. Okay, and they know that, so they're trying to take advantage of giving you the quote unquote capital. Okay, even though it's really a tenth of that. Okay, say if you have a 50,000 account, it's really like a $5,000 account, especially with the drawdown, etc. Okay, so don't get tricked by the numbers. Don't get tricked by certain things that are just in your face. You got to really read between the lines. And the reason why a lot of prop firms get successful or enforce a little more rules, like having to send proof of you taking the trades and stuff like that, or breaking down your trades, stuff that you just don't really have to worry about on a real account. Okay, so if you want to trade prop firm, that's going to be you. But if you want to stay down, stack up your bread, run it up, and then invest, that's a highly recommended option. Okay, but if you master prop firm, you master the rules, and you found yourself able to get withdrawals consistently, use it as an engine to fund your real accounts. Okay, so preserve your capital, especially once you guys start winning. Certain prop firms like Top Step, for example, the drawdown likes to catch up with you. Okay, so even when you take a loss, you have to make sure that you're keeping everything inherently in perspective. Okay, keep up with your drawdown. It's not going to work like a normal account. And being a reliable steward of your money is going to come to whether or not you want your account to be alive. Okay, are you chasing money, or do you want your account to be alive? Okay, because if your account's alive, the money will always be there. Okay, I just checked my Webull portfolio today. You know, thank God, up a really nice percentage. Okay, entered and just been stacking up, not looking at it, investing over and over and over and over again. Okay, but you guys have to learn how to sacrifice, have to stay down. I've been wearing the same clothes every single day. Okay, haven't been buying anything new, just been paying bills, taking care of what I've needs to been doing. But I go look in the stash and I'm happy. I'm cheesing. Okay, so don't worry about whatever anyone has to say in real life. Okay, you know what your stash looks like. Okay, you can go pull out 100K, you can go pull out 10 bands whenever you want at any time needed. You can get up, you can go swap cribs whenever you want, anytime needed. It's not a lie anybody can tell you. Okay, you're good. So just focus on yourself. Focus on putting that money in the stash. Stay down. Okay, you don't need the newest phone. You don't need the newest shoes. You don't need the newest this, and that. Okay, right now you're probably broke. If you don't have at least 10K, you're broke. Okay, so you don't need to be buying none of that. Some of y'all have the newest phones and not 5,000 in the stash. And it's time to really change our mindset. Okay, because I noticed when I was silly spending, I sat back and realized, wow, if all of this was invested properly, I wouldn't even be having to work as significantly hard in the future. Say when you're 60 years old, you have $2 million in ETF account. That alone will give you 70K a year, and that's just $2 million. Okay, then you could have another M and some cryptocurrency generating you equity there. Okay, and that's by 60 years old. 60 years old is $3 million. Is not that much by 60 years old. Okay, that's many years. Okay, a lot of people become millionaires like 23 to 28. So it's a lot of years, a lot of time you have to stack up M's. Okay, so once you do that and you stay down and you invest, you'll never have to work again. Okay, you'll pretty much just be able to live for free. Investing is how you live for free. There's no such thing as free, but investing is how you live for free. Once your money is making you money infinitely, you live for free. Then you don't have to stress about anything. So it's about how you put in this mental perspective into your own account. And you got to just ask yourself, like, do you really want to be wealthy? Do you want to get to where you want to be? Because if you do, you're going to follow your rules. You're going to do what needs to be done. You're not going to be over trading. You're going to be trading between your risk parameters. Okay. And if you go over that, that's all you. You're just telling yourself that you don't want to get to where you want to be. So the discipline is really going to ensure that you stop yourself from destroying your account and just stop trading before you just hit the drawdown limit and you destroy your account without even realizing it, or you just blow a profit that you've been working really hard and consistently to grind. Okay, just because you have one bad day, that doesn't mean just crash out the whole account. You shouldn't be hitting maximum daily drawdown at all. Okay, take your one loss, hop off, plot an even cleaner setup, come back and get back in your bag. You're good. So true trading discipline, especially when it comes to futures, forex, etc., your mechanical execution is really going to need to be on point. Your technical analysis and the way that you fundamentally look at the chart, it has to be in a logical perspective, especially when you're trading stocks and crypto. Understand that's a left to right chart. Okay, just like us as human beings, we start from babies and we grow older. Okay, everything in the world works from left to right. Okay, everything has a start to finish. And understanding that, putting that into your technical analysis, you're going to understand, okay, this is why price is dipping here. This is why price is making a high here. It's finished at this point. It's going to go down and try and break that finish line again and continue, make a new finish line, okay, making new highs, etc. So have a really good fundamental, logical understanding of the chart before you even try to boot up even a prop firm account, okay, especially before you put your own money into a live broker. Okay, and don't forget too, prop firm accounts, you're still spending your own money. Okay, I know you guys are playing with the quote unquote like prop capital, but you're still swiping your card to buy the account. Okay, so all that money that you're using to swipe your card to buy the prop firm, you got to really ask yourself, like, okay, would this be more worthwhile in like an ETF or a profitable stock or something that's just going to passively make you money pretty easily, maybe like a long option? Okay, so ask yourself that before you make any decisions. So enter trades only when the exact setup becomes present to you as well too. Okay, if it's not the setup that you want, don't be taking that. Don't be fiending for money. Don't be desperate. Okay, relax. Okay, especially when it comes to the market, go work harder at your business, and you can't force trades. If you think you're going to force trades, and if you think you're going to be right at the market, okay, you'll learn. Okay, you'll learn that the market is right. And if you're wrong, you're just wrong. And you have to be okay with that. Okay. You'll plot on another trade, and I promise you guys, if you just stay disciplined, you keep studying the charts every single day, you'll start placing right trades consistently. Okay, stick to the course, even when it's hard, even when you're frustrated, you just crashed out, you just destroyed your setup, whatever. Okay, relax, you're good. I promise you, you're good. I've been through all of that, and I'm telling you guys, once you get to the other side of profitability, once you start just checking your account, cheesing, you just start seeing green, money making you money. Okay, it's a real blessing. Okay, it's a real blessing that God even put this in your mind. Okay, so you're good. Stick through it. I promise you. Just stay down, and I promise you, everything's gonna make sense in a couple of months. So trading without emotion. So think of that kind of like smart contract in the cryptocurrency world, right? That's like a machine without executing the code. So you can't really do that. You got to become a robot when it comes to trading and investing in general too. You got to become a robot. You can't be emotional. You can't be panicking when price is going up or down. Okay, and even when you are smiling at P&L, you can't be excited. You can't be quick to withdraw everything. You can't be like, I'm gonna just go withdraw everything and go ball out. Go buy a car, relax. Okay, that's your future money invest in for your family. Okay, you can make real deal plans with that. Go buy some land, go buy some houses. You can make real boss moves with that. Once you get your capital to a certain percentage, it's so easy to just turn your money into more money, whether doing a lucrative amount of things, whether it be real estate, stocks, stock options, shares, crypto, whatever. Okay, so take that prop firm account money and siphon that into certain long-term investments and you'll be good. And your plan is really going to dictate everything. Okay, your discipline is going to ensure that you follow that plan. Okay, once again, whether you're feeling like you want to do it or not, like if you want to take that FOMO trade, go ahead and do it. But if your portfolio isn't looking like how you want it to be at the end of the year, you can only be mad at yourself. Okay, you can only be upset at yourself. But if you're sticking to each setup over and over and over and over again, you'll get to where you want to be. Okay, that's the real difference between the people who are successful in this world and who aren't. Too many people are too focused on the emotions, like, oh, this is boring, this is whoop-de-whoop, this is etc. And that's why people just aren't anywhere. Okay, people don't know how to sacrifice. Okay, if you want to live in pleasure, if you want to live in leisure all the time, that's okay. You'll get that. You'll most likely have late bills. You'll most likely be driving a car that's not nice. Okay, and you just won't be doing the things that you want to be doing. But I promise you guys, if you sacrifice for a couple of years, you'll be living in extreme leisure. Extreme leisure. It doesn't even matter your income level too. You could be making 30K a year, 40K a year. If you're saving and you're investing constantly, stacking up every single dollar and using it as a tool, you'll be good. You'll be good. There's janitors who's retired as millionaires, okay, just by making the right decisions. It's all about decisions. Life is about decisions. And if you want to make the wrong ones, that's fine. But if you see someone flying down in their Rolls Royce, don't think that they got gifted that. No, I'm telling you, it's not many people who can give somebody a Rolls Royce. That person probably stayed down, stacked up for many years, many months, went through many struggles in order to get that. Okay. So make the choice. Do you want to be disciplined or not? So emotional trading is going to be your biggest threat. All right. If you want to be a pansy, that's fine. That's fine. But I'm telling you, if you want to come onto these markets, you have to be ironclad. You have to be structured. There's some serious people you guys are playing against. You guys are playing against people like me. You guys are also playing against other competitive players like Warren Buffett even. People who want it bad. And it's trading. Okay. Don't come on here thinking that it's about to be light. You're coming into the arena. Okay. Trading is very serious. Okay. It's called trading. This money isn't flying out of thin air. You're trading with somebody. Whoever's losing, you're taking their money from them. And when you lose, somebody's taking your money from you. Okay. You have to understand, why am I getting my money taken from me? Who's taking my money? What better players are taking my money? Whenever you're losing, someone is taking your money from you. I want you guys to really let that bake into your brain, especially my competitive people. Somebody's taking your money from you because they're more disciplined than you, because they're more patient than you. Are you good with that? I'm not. And that's why I had to humble myself real quick and get it in order, because I'm not good with people being ahead of me. Okay. I'm here to be the best. I'm here to win. And if you're here to win, it's time to be patient. It's time to be more disciplined than everybody. It's time to be more structured than everybody. Okay. While everyone is being loose and doing everything and being emotional, let them do that. Let them do that. Okay. But if you want to be pull up in your palace, pull up, driving whatever car that you want to drive, living how you want to live, eating what you want to eat, inshallah. Okay. It's because you sacrificed. You stayed ironclad. Okay. You weren't worried about the pleasure. You knew the pleasure would come later. So don't be revenge trading too. Okay. Some of you guys revenge trade because your mind goes into survival mode. Survival mode happens when you think you're about to just not eat, not have a roof over your head, etc. One, if you go into survival mode after you lost a trade, you're probably trading in a mode of desperation. Is this prop firm account like something that you're betting on? Okay. Right? Because you should be fine without, whether or not trading works. Okay. You should try to have income generated so that you can be fine until it gets to a point where trading can completely over dominate everything and by just your passive investments. Okay. Like ETFs, for example. Okay. Then that's fine. But until then, okay, you should be fine. Okay. Whether or not your trades work out, you should be fine. And if not, you're investing too much. You're investing way too much. And you're probably over leveraging as well too. So don't increase your position side after a loss too. Don't lose $500 on your account, right? And then put on $1,000 worth of size, trying to make that up, trying to make that loss back up, and then profit after that. Just stop. Okay. Come back to a completely fresh trade, completely new day, and start over again. And don't move your stop loss, okay? The automatic order that closes out your trade for a reason, don't move that. Keep that there. And don't exit prematurely, all right? God put this in your brain for a reason. Don't panic. Don't be closing that take profit too early, okay? Relax. Set your alerts and let take profit hit. If you close that take profit, if you close before take profit hits, okay, you're ruining your risk to reward. So if you're supposed to make $400 on that trade and then you only make $220, and then your next loss, you lose $310, okay, instead of you still having $90, right, instead you're just down, okay, you're down to $310 minus $220, instead you're just down, okay? So take your time, okay, and don't micromanage a trade that's moving in your favor, okay? Set your alerts, don't look at it, get up, go do something else, go get some more money. So having a funded trader mindset, focus on the process, prioritizing executing the plan amazingly every single day, okay? Study what you want to do, study how your setup should look, and get some data and evidence, especially month after month after month. You should understand how the market works, and results are going to be secondary. Consistency and execution is the only metric that matters to the firm, and you'll have a long-term view. A funded account is a career, not a single trade opportunity, and discipline smooths out the equity curve, turning random results into predictable income over months. Why? Because you're sticking to the same risk parameters. You're losing the same amount consistently. Okay, your wins are pretty much calculated, especially when it comes to futures and stuff like that. Okay, and don't worry about the risk. Okay, so don't worry about the risk. One, you have to know that not every trade that you're gonna win. Okay, so you can't just be thinking, what if I lose? What if I lose? What if I lose? Get that out of your head. Okay. But understand that you need to calculate your risk though, okay? In order to get that feeling out of your head, you're probably too leveraged in. You probably have too much money in a trade. And calculate your risk though, before calculating the potential profit. So instead of worrying about, oh, am I gonna lose? Am I gonna lose? Or worrying about how much I'm gonna make, how much I'm gonna make. Just calculate, okay, this is how much I'm gonna lose. If I lose, I'm okay with this. So even if the trade works out or not, you guys are gonna be okay. So discipline is your only true form of edge in risk management, all right? And discipline is really gonna be the separator between passing your test, okay? It's pretty simple to pass most of the prop firmer tests, okay? You can go ahead and just gain some consistent rules, and a lot of times you'll get your account. Now keeping the account, this is a completely different deviation. Keeping the account is a different ballgame. It's about staying on this course of action year after year after year after year after year, okay? Not a single ego-ridden day, okay? Mistakes just aren't gonna be tolerated for. And if certain mistakes are made, your account will be punished. So if you wanna keep the account, I really recommend you guys just pray to God, okay? Keep your ego in check, stay humble. Even when you guys start withdrawing big amounts, stay humble, stay humble, stay humble. It's really gonna help you guys just stay focused on the process. Okay, and don't look at your P&L too much. Don't be looking at your money too much. Just wake up every day and grind. Okay, don't look at your money too much. Wake up and grind. Just keep going. And funded traders understand that rules equals money. Inshallah. Okay, stay prayed up to God. Keep grinding. Head over to stackmode.net for all trading education. Peace. Class, it's time to get in your bag. Crypto's getting regulated. A bunch of laws are getting passed, and it's time to start stacking up. It's time to start staying down, putting every single dollar we can back into the market, whether that's shares, some cryptocurrency, some tokens, meme coin you believe in. Let's go and let's jump into what crypto regulation means for the future. So what is crypto regulation in the first place? Crypto regulation refers to the laws, rules, and the guidelines set by governments and financial authorities to oversee the use, trading, and creation of cryptocurrencies and blockchain technologies. And it aims to protect consumers from frauds and scams. So as cryptocurrency gets more regulated, as the time continues on, as the government becomes involved into it, the more people are going to be secure into investing into it, okay? And the more people investing into it equals the more money into the market. More money into the market equals new all-time highs, okay? So crypto regulation, just one. It means that it's making crypto safe, okay? It's making it regulated, and it's making it so market can be stable and prevents any type of money laundering activities going on or any type of illegal activities going on for the most part. And it varies globally, leading to regulatory arbitrage. So for example, in the early days,
Bitcoin was unregulated, which led to events like the Mt. Gox hack in 2014, where 850,000 Bitcoin were just lost, highlighting the need for oversight, security, safety, and for laws to be into place. Okay. The Bitcoin white paper as well too goes ahead and breaks down the future of Bitcoin, laws, regulation behind it, as well as the protocols. So some history of the crypto regulations. So cryptocurrency emerged with Bitcoin in 2009, and they originally operated in a regulatory vacuum. And over time, governments responded to risk and opportunities alike. And in 2013, the US FinCEN classifies crypto exchanges as money transmitters. And in 2017, China bans ICOs and crypto exchanges. So initial coin offerings and crypto exchanges. So crypto was not being supported within the China at the time. Okay, and then 2021, El Salvador adopts Bitcoin as a legal tender. Okay, so countries start adopting it, countries start buying it. US has been buying cryptocurrency. Other countries have been buying large amounts of cryptocurrency as well too, as of today's date. And 2023, 2024, 2025, EU enacts MiCA, and US faces SEC lawsuits against major exchanges. Okay, and in 2023, that caused Bitcoin to plummet for a bit, but a lot of the lawsuit stuff ended up getting passed. So God is good, bringing power back to the people's hands, making sure that we can control our money the way that we want to. And this evolution really shows a shift from ignorance to active engagement, balancing innovation with protection. So in 2013, for example, the FBI shut down the dark web's marketplace Silk Road, which primarily used Bitcoin for illegal transactions, spurring AML regulations. Okay, so just made people think that Bitcoin was only used for illegal transactions, stuff like that, which is definitely not the case. Okay, it's used to pay people all across the world for legal services that they've done, and just a good way for us to hold unlimited amounts of currencies without any type of centralized currency being able to shut it out. So the current regulatory landscape in the United States. So as of 2025, the US employs a patchwork of regulations from agencies like the SEC, CFTC, and the IRS. Okay. And the SEC, it treats most cryptos as securities if they pass the Howey test. Okay. So if you guys don't know what the SEC is, the SEC is the United States Security and Exchange Commissions. Okay. Securities and Exchange Commissions. So it's pretty much the independent agency that primarily controls everything regarding exchanges. Okay. So let's talk about the Howey test. Okay. So if you don't know what the Howey test is, the Howey test it's a test that the SEC created, and it was pretty much in a case in the Supreme Court that determines whether or not a transaction qualifies as an investment contract or not. Okay. So if it passes the Howey test, then the currency is going to go ahead and be able to be used as an investment portfolio. So yeah, it's going to be able to be classified as something like gold. Okay. So Bitcoin was able to pass the Howey test, and most cryptocurrencies were, and so they can be classified legitimately as actual investments. Okay. So the FTC, okay, FTC or CFTC, let's go and let's talk about what that stands for. So the CFTC, it initially allows spot and crypto assets to be registered and trade as actual commodities. Okay. So the CFTC is something that regulates certain cryptocurrencies, and it oversees Bitcoin and Ethereum as actual legitimate commodities that people can trade with their real money. And the IRS requires tax. So that's why tax is going to be being able to be implemented on these things, because things such as Bitcoin and Ethereum, such as the SFTC regulates Bitcoin and Ethereum as actual commodities. So they have to actually be required as tax. Since they passed the Howey test and they're legitimate actual things, the IRS is going to require tax reporting on crypto transactions via a 1099 form. And the recent approvals of Bitcoin and Ethereum spot ETFs mark progress toward mainstream adoption. So for example, SEC versus Ripple.
The 2023 ruling that XRP sales on exchanges aren't securities provided clarity, but left ambiguities on for other tokens. Okay. So upcoming regulations in the US, the Genius Act. So the Genius stablecoin bill is a key proposal for 2025, aiming to regulate stablecoins comprehensively. What a stablecoin is, let's say, for example, if you've heard of the coin USDC, that's going to be a stablecoin. That's going to reflect the US currency and the fiat currency of the United States economy. So the stablecoin is pretty much going to be like the stable dollar version of cryptocurrency that doesn't fluctuate all the time, like Bitcoin, Ethereum, and other ones do, Solana, etc. And that requires bank issued stablecoins backed by insurance deposits. Okay, so this way, stablecoins can actually be stable. Okay, so nothing can be rug pulled or anything like that because everything is actually insured, just like a stock market would be. So if you don't know how the stock market works before, it can actually be listed on the actual market itself. Someone has to buy all the shares. A private investor has to pretty much back it up. And it mandates transparency, audits, and one-on-one asset backing. And it prohibits CBDC without congressional approval. So the Genius Act, we're really waiting for it to get passed. And it's really going to go ahead and help cryptocurrency be even more legitimized, especially when people are able to trust things like stable coins and stuff like that. People are going to feel comfortable putting all their money into the stable coin, okay, without it worrying about fluctuation, okay? Or let's say you keep all your money in a traditional bank. If you were to try to get all of it out in cash, it just wouldn't be possible. Or if you try and withdraw a deposit out of it all at once, wouldn't be possible. Cryptocurrency, you could have however much you want of there. You can have however much of it as you want. And you can send however much of these you want at any time. No limitations. So that's going to be the pros for Bitcoin. And the Genius Act aligns with EU's MiCA for global convergence. So it has to align with every single economy that crypto is allowed in. And this act shifts from enforcement to clear rules, potentially boosting innovation. So let's talk about some USDC compliance. So Circle's USDC already adheres to similar standards, positioning it well under new laws. And the impact of US regulations on users. So new rules like the Genius Act will affect how individuals interact with cryptocurrency. It's going to enhance protections, reduce scam risk, but increase KYC requirements, which are pretty much going to mean that any brokers who are trying to let you trade crypto or crypto futures have to have regulatory laws, jurisdictions passed before they can actually have people trade on their brokerage. So making it very secure, making it really, really scam proof, and just making it extremely nice. Okay. So if you're wondering what KYC means, okay, KYC is know your customer. Okay. Know your customer requirements. And it simplifies tax reporting with Form 1099, but more transactions can be tracked. And easier access to staked ETFs for passive income, and some potential market volatility during transactions. And for everyday users, this means safer investments, but more compliance paperwork. Okay. So as the regulations continue to go, there's going to be more things to enforce when it comes to starting your own broker, trading on certain brokers and stuff, etc. But just know that everything's going to be very regulated, enforced, and safe, inshallah. So for example, some tax implications. If a user is selling Bitcoin for profit, they must report it. And new forms automate this, reducing errors but increasing IRS oversight. And the current regulatory landscape in the EU, okay, MiCA. MiCA stands for Markets in Crypto Assets and is the EU's comprehensive framework, and it's fully operational since December 2024. So fairly new as of this video dropping. So it classifies assets into ARTs, EMTs, and other crypto assets, and requires CASP to obtain authorization and publish white papers. And white papers are pretty much going to mean the law behind the cryptocurrency token, what it does, which is going to state the future of it and exactly how it operates, etc. And it focuses on consumer protection and prevents market abuse. And transitional periods vary for 12 months for Germany and, for example, none in Lithuania. We'll talk about Binance in the Europe region. So Binance obtained MiCA licenses in several countries, allowing continued operations with enhanced compliance. And some upcoming developments in the EU. In 2025, MiCA's transitional phase ends in many countries, with the full enforcement by 2026. And the end of transitions, December 2025 in some nations, and it aligns with global standards like the FSB recommendations, and potential extensions to DeFi and NFT spaces as well too. And the EBA now gains oversight for significant tokens, making everything regulatory safe and pretty much not controlled, but controlled in a sense to where scams and bad things can't go down as easily. And this will harmonize rules across the EU, reducing fragmentation. So for some stablecoin caps, EMTs face issuance limits if exceeding certain thresholds, affecting issues like Tether, for example. And the impact of EU regulations on users. MiCA provides legal certainty, but imposes stricter rules, and provides better fund safekeeping and transparency for its users. Higher entry barriers may limit service options, but the brokers that are going to be available, it's going to make it safe to trade on. And stablecoin users can benefit from some reserve requirements, and their easier cross-border access within the EU. And individuals will enjoy safer ecosystems, but may face increased fees from compliance costs. So, investor protection. If a platform fails, MiCA mandates client asset segregation, protecting user funds, unlike in the FTX collapse, for example. So, some global trends in the crypto regulation space. So, globally, 93% of SFB members plan new frameworks by 2025, focusing on same risk, same regulation. So, FATF, 75% jurisdictions are non-compliant with VA standards. Okay, so FATF stands for Financial Action Task Force, and it's an intergovernmental organization that's made to combat money laundering and just pretty much scamming in general. So yeah, they need to make sure that it's compliant. Everyone needs to make sure that it's compliant, just so it can't just be used for scams or rug pulls, okay? Because there's also going to be a deceptive side to human beings sometimes, sadly. And, you know, this is why we're trying to be just God-fearing righteous people. So that can be reduced. So thank God that all these regulations are in place. So certain things like scams and stuff like that aren't going to be as common. So some emphasis on the AML, CFT, and travel rule implementation. And stablecoins, regulations, and Singapore, etc., starting to spread across, making it a safe choice for people to keep their money in. Okay. So the US and the UK plans rules for stablecoins and staking in 2025 with the full regimen by 2026. So that's going to be for the UK. I'm not too sure about the US, but for the UK, they're looking into a stablecoin decentralized future as well too. So stablecoins, they're the focus of new regulations. Stablecoins are seen as bridges to traditional finance, hence heavily regulated. Promises behind it, okay? Because it's going to be the dollar, the stable dollar, unlike other cryptocurrencies, which are in an investing capital gain sense where people are trying to make money when it goes up. Stable coins are meant to do what it says, be stable, and they must maintain one-of-one backing with high-quality assets. And regular audits and transparency reports are going to be required. In the US, bank issued in EMT are its classifications and global limits on exposure for banks, 2% tier 1 capital. And this reduces systematic risk, but may limit innovation in algorithmic stablecoins. So for example, let's talk about the Terra USD collapse. So in 2022, UST DPEG led to $40 billion in losses, prompting stricter stablecoin rules worldwide. So after a lot of these crypto losses, crypto crashes, or crypto hacks or exploits, regulations get put into place and the whole system changes. And that's just how we have to learn as human beings, trial and error. Okay, only God is perfect. Sometimes things out. So AML, DeFi, and privacy concerns. So AML stands for anti-money laundering, and DeFi stands for decentralized finance. So anti-money laundering rules are tightening for crypto. So travel rule. Exchanges must share user data for transfers, and decentralized finance protocols may need to comply with know your customer laws. And the balance between privacy and security is coming into play. And non-compliance leads to bans in some jurisdiction because it can go down. They don't want people getting scammed, they don't want people getting rug pulled on, and they don't want a government that allows things like that. And for users, this means less anonymity, but safer ecosystems. So for example, the Tornado Cash sanctions. The US OFAC sanctioned the mixer in 2022, or laundering, highlighting decentralized finance risk. Okay, so if you guys don't know what the OFAC is, OFAC stands for the Office of Foreign Assets Control. Okay, so all of these are going to be just bodies of people just trying to protect money. Okay, trying to protect people from getting scammed and trying to protect people from losing money for no reason. So what it means for investors: regulation is going to bring more opportunities and challenges for investors. But more opportunities and the safer things get, more people are going to feel comfortable to invest into it once again, which means that more money is going to be put into the market. Okay, so institutional adoption via ETFs, exchange traded funds, and regulated products. Reduced fraud, increasing confidence, increasing more money flow being put into the markets. And clear tax rules when we're reporting, especially as we see companies buy crypto, government bodies buy crypto. It's going to become more regulated over time. And global convergence minimizes arbitrage risk. And investors should diversify and stay compliant to mitigate volatility. So ETF approvals, exchange traded funds. 2024 Bitcoin ETFs saw $10 billion in inflows, stabilizing process post approval. So what does it mean for everyday users? So for non-investors, regulations affect payments, remittances, and daily uses. So safer stablecoins for transactions. Okay, so people are going to feel more comfortable keeping large, heavy amounts of reserves in their stablecoin or in their wallet as well too. And mandatory know your customer rules are going to be put into place for wallets and exchanges. Then faster, cheaper cross-border payments under rules are going to be available. Potential restrictions in high-risk areas could be put into place, and users gain protection but may lose some privacy. And in developing countries, regulated stablecoins could reduce fees from 6% to under 1%. Making it an extremely good option to go ahead and send and exchange currency. So navigating the regulatory wave. So risk, overregulation could really stifle the innovation and cause certain market dips, because it's really taken away from the point that people want, is the power back to the people. But sometimes power in the people could be a little too much, and people don't do right by it. People can be taken advantage of, and that's not what you want. So opportunities. Mainstream adoption and new financial products could come into as things get more balanced, safe, and regulatory. And they advocate for fair rules, and you can stay informed via reading the white papers and just looking at reliable sources, checking out the news and stuff like that too, to see what's coming out with the crypto laws. And the future is regulated, but it seems promising, power back in the people's hands, and seems to be a place where we can still make some good income and show up. So EU leadership, for example, Micro positions EU as a hub that attracts firms like Coinbase expanding there. Okay. So in conclusion, crypto regulations are evolving rapidly in 2025, aiming for safety and growth in a positive direction. Some key takeaways. Okay. Understand that as stuff gets more regulatory, it might be more controlled, but it will definitely be safer. Stay focused to God, keep grinding. Head over to stackmode.net to learn how to trade cryptocurrency. Peace. Here's what a smart contract is, and here's how it applies to the cryptocurrency world. Let's go and let's jump into it. The fundamental concept. It's a digital agreement. At its core, a smart contract is a self-executing contract with the terms of agreement between the buyer and the seller being directly written into lines of code. The code and the agreements contained therein exist across a distributed, decentralized blockchain network. Decentralized means that it's pretty much just going to be a network with no middlemans involved. So say you start to send currency from one person to another, typically with the bank system, the bank would have the jurisdiction to confirm the transaction or decline it. On the blockchain system, transactions go from one person to another, and everything is autonomously done via the smart contract system. And this simple yet powerful mechanism removes the need for a central authority or intermediary to enforce the contract. Think of it as an if-then statement, but one that is enforced by a network of computers, and if X happened, then Y is automatically executed. And this logic is hard-coded and cannot be changed once deployed. For example, a simple smart contract might say, if a product arrives at the buyer's address, then release payment from the escrow account to the seller. And this transaction happens automatically and without any human intervention, contingent on verifiable data. So some key characteristics, why they matter. So the properties of smart contracts give them significant advantages over traditional contracts.
and these characteristics are fundamental to their value proposition. So they're smartless and trustless and transparent. Okay, so parties don't need to trust each other. They only need to trust the code. And the code is publicly visible on the blockchain, so anyone can audit it before engaging. And immutable. Once a smart contract is deployed on the blockchain like Ethereum, its code cannot be altered. And this ensures the integrity of the agreement and prevents tampering. So this prevents anything like from hacks, database stuff, everything works a lot differently due to the fact that everything is done by code. Okay. And it's autonomous. The smart contracts are designed to be self-sufficient, and once the conditions are met, they execute automatically without any human intervention, and they're essentially digital agents. And secure and enforceable. The cryptographic principles of the blockchain ensures that transactions are secure and the terms of the contract are enforced. It's computationally impossible to break the agreement. So how do they work? Here's a step-by-step breakdown. So understanding the flow is crucial to grasping the power of smart contracts. Here's a simplified view of the process from creation to execution. So step 1, coding the agreement. So a developer writes the terms of the contract in a programming language like Solidity for Ethereum, for example, and they define the rules, conditions, and actions of the contracts. So then they deploy it. The code is then compiled and deployed to a blockchain network, and this costs a small fee, also known as the gas fees. And this makes the contract code and public address public and immutable. In step 3, it awaits the execution. The smart contract now lives on the blockchain, and it passively awaiting an event or an input that triggers its logic. In step 4, say something triggers this event. A specific event such as receiving a certain amount of cryptocurrency or data from an oracle, also known as a data feed, it triggers the contract's logic, for example. And then step 5, autonomous execution. The code will then run automatically based on the if-then logic, just like in code, and it'll perform the predefined action, such as sending funds, issuing a token, or updating a record, depending on whatever was requested by the user. In a practical analogy, the vending machine. The best way to understand a smart contract is to compare it to a real-world vending machine, and the parallels are striking and make the concept very easy to grasp. Thank God. So you and the user, so you represent the counterparty in a transaction, and your money. Okay, so practical. So this is the currency that you send to the smart contract. Okay, and the vending machine. The vending machine is the smart contract itself. It's a pre-programmed autonomous machine. Okay, so think of the vending machine, okay, displaying out cryptocurrency snacks, okay, and controlling everything. So one vending machine controls all the cryptocurrency transactions, distributes everything, and controls all the funds and the money flow. So the if-then logic. So if you put $2, then the machine dispenses the soda can, for example. The machine will automatically perform the action without an intermediary, okay? So it's automatic, okay? It's no someone being like, okay, you want a soda? It's not the drive-through. Be like, can I get a soda? Yeah. And then if they don't have it, they don't have it. Okay, the vending machine, if it's right there and you put in that dollar, you're going to get what you want. And that's why cryptocurrency is so powerful, okay? It's really innovating the future, giving us our instantaneous dollar and giving power back to the people, okay? So the machine automatically performs the action without intermediaries, okay? If you try to pull out 100K from the bank, most of the time they won't have it. If you try to withdraw 100K crypto, it'll be pretty much instant, okay? So, inshallah. So it's a self-enforcing agreement. So you don't need to trust the human to give you your drink. You just trust the machine's code, and this is exactly how a smart contract works. So real-world use cases beyond cryptocurrency. So smart contracts are no longer a theoretical concept. They're being implemented across various industries to automate processes, reduce cost, and increase security. So finance, let's talk about DeFi, also known as decentralized finance. So smart contracts power decentralized finance, and they can be used for automated escrow services, lending protocols, and creating financial derivatives. For example, a loan contract that releases collateral if a user defaults on a payment. Okay, and let's talk about some supply chain management. Smart contracts can track goods from manufacturer to consumer, and when a product reaches a certain location, the contract can automatically release payment to a supplier, ensuring transparency and reducing fraud. In real estate, they can automate the transfer of property titles,
removing cumbersome paperwork and expensive intermediaries like lawyers and brokers. A contract could automatically transfer ownership once all conditions like payment are met. And healthcare are also beneficial here. Small contracts can also manage health data with heightened privacy. A patient can grant a specific doctor temporary access to their records via a smart contract that automatically revokes access after a set time, so they don't have unlimited access to the information. Voting systems. Secure and transparent voting can be implemented using smart contracts, and each vote is recorded as an immutable transaction on the blockchain, making it impossible to tamper with and allowing for a verifiable count. So advantages, the benefits of automation. So adopting smart contracts offers compelling benefits that address many of the inefficiencies of traditional banking systems. So efficiency and speed, this is going to be my favorite portion of cryptocurrency. I like how fast everything is. I like how you can get your money instantly. I like how you can withdraw. I like you send it to whoever you want, whenever you want, as quick as you want. Okay. And all you have to do is wait for it to get confirmed on the blockchain. Okay. Once this is confirmed, a lot of the time, it's going to go ahead and be on its way to the wallet. Okay. And once it's in the wallet, whoever has received the funds can go ahead and do whatever they want. Okay. Whether they want to go ahead and withdraw it to their bank account for fiat currency, or they even have what's called like Coinbase cards, for example, okay, where you can go ahead and spend your cryptocurrency on a card. Okay, so many different things you can go ahead and use in order to spend your cryptocurrency. It's a really beautiful time. God is great, and it's time to take advantage of the future. So smart contracts eliminate the need for manual paper-based processes and intermediaries, dramatically speeding up transactions and business operations. So if you're trying to send money from somebody in another country, say by PayPal example, sometimes the funds might get put on hold, okay? And sometimes that might affect you, okay? And the whole can be normal that they're trying to verify transactions and stuff. But cryptocurrency, say you have really tight bills to pay, okay? You got to pay it right now. Cryptocurrency, you're going to be able to get your whole funds amount, okay? And you can potentially pay it with your crypto card. Okay, so it can really help you and save you in situations where fiat currency isn't going to be the best of situations as far as certain hold times and wait times. With cryptocurrency, you can also get paid on the weekends too. With fiat currency, unless you do Zelle or Cash App or something like that, you're not going to get like a deposit really hitting your account. That's not Monday through Friday a lot of the times. Sometimes Saturday. Most of the time, most people, most banks, deposits will hit your account Monday through Friday. Okay. So security and trust as well too. The decentralized immutable nature of the blockchain protects against fraud and data manipulation. And once an agreement is coded, it's enforced by the network, not by a single party. And cost reduction. By removing middlemen like lawyers, banks, and brokers, smart contracts can significantly lower the cost of transactions. And we're talking about accuracy and transparency. Automated execution reduces human error, and the terms are publicly visible, and the outcome is verifiable by anyone on the network, creating a fully transparent system. So lots of uses with autonomous contracts, and under the cryptocurrency world has definitely been a big use to me, thank God. So limitations and challenges, the path ahead. So while powerful, smart contracts are not without their limitations, and it's important to understand that these challenges come with their own ballgame. So let's go and let's understand it. So they can come with bugs and vulnerabilities sometimes. Code is law. It's a double-edged sword. If there's a bug in the code, it's immutable. And what a bug is, it pretty much just means an error. It's immutable and malicious, okay, which means it can be susceptible to hackers, okay, which means people could potentially lose money, which is definitely bad. And actors and hackers can exploit it, leading to irreversible loss of funds. Famous examples include the DAO hack, for example. So legal uncertainty. The legal status of smart contracts is still evolving, okay? The SEC has definitely been working on stuff, and the future of cryptocurrency is looking bright, though. So, and can they be enforced without a traditional court of law? You know, the government, as of recent, as far as the United States, has been purchasing cryptocurrencies and stuff like that. So I do believe the future of cryptocurrency could be strong, inshallah. Some scalability issues. Many current blockchains like Ethereum can only process a limited number of transactions per second. This can lead to network congestions and high fees, making some smart contract applications pretty much impractical. And Oracle problem. Once again, these are things I think that can go away within the future, inshallah, especially as the networks decide to get bigger, more people collaborate on it, and the whole space just grows. An Oracle problem. Smart contracts can only access the data on the blockchain, and to interact with the real world, they need oracles. Secure third-party data feeds. And if the oracle is compromised, the entire contract can be compromised. Okay. So oracles are secure third-party data feeds. So the future of smart contracts. This technology is constantly evolving, and future developments are focused on addressing current limitations and expanding their capabilities. So some layer 2 solutions. Technologies like optimistic rollups and ZK rollups are being developed to improve scalability and reduce transaction costs on networks like Ethereum. And cross-chain functionality. As more blockchains decide to emerge, more people decide to innovate, smart contracts will be able to interact seamlessly across different networks, unlocking new possibilities. Okay, so God is good. Okay, creating a system in order for us to just trade all our currency all across the world simply and easily and show up. So self-evolving contracts. Researchers are exploring ways for contracts to adapt and upgrade themselves in a decentralized way to fix bugs and add new features. So always innovating, always working on it. And that's what smart contracts are. If you guys are struggling with trading, head over to stackmode.net. If you just want to learn how to trade cryptocurrency, stocks, futures, whatever. Or if you're just struggling with discipline, whatever, head over to stackmode.net. Stay prayed by God, keep grinding. I'll catch you in the next one. Peace. Hey, welcome to stackmode.net. There's 2 things I want to do. I want to put a smile on your face, and I want to help you make some money by trading. Okay. So here's an example of a trade that I gave in my Discord here. So all we're going to do is understand some logical processes here. I teach stocks, Forex, crypto, options, as well as futures. Okay. And trading each of them is going to be fairly similar, but different for each sector. So whatever you specialize in, I can help you. Let's say we're trading the stock market, for example. I know that stocks have an incentive to go in an upwards direction due to the fact that these companies employ people. Okay, these people then pay taxes to the government. Okay, so as long as these companies go upwards in an upwards direction, the richer they're going to get, which means they're going to expand further, which will lead to further opportunities to employ people. So let's say, for instance, I'm trading the stock market. I personally wouldn't short the stock market. I'm looking to play call options or buy shares, catching my V directional fill. So as you can see here, I have an area of resistance above current price here. And as you can see, I have just some empty space here, and price decided to blast straight through it and fill in this area. Let's talk about how I caught this setup here. So here I can identify 2 things. We're going to have areas of resistance. Areas of resistance are going to be areas where price decides to fall in a downwards direction. Okay. And then we're going to have areas of support. Support are going to be areas where price decides to bounce in a upwards direction. Okay. Using support and resistance together can lead to some very nice setups. So as you can see, market can only go in 2 directions, either up. Okay. And once again, if market's going to go from a upwards bounce direction, that's going to be called support. And if market's going to go in a downwards bounce direction, that's going to be called resistance. Okay. So let's understand some things. So resistance can be broken and turn into support. So here I have this area of resistance being created. As I can see, market's falling downward here. And once the area of resistance decided to get broken, it decided to turn into some support. And then price went in the upwards direction. Okay. And I know that price in the stock market at least wants to go to all-time highs. Okay. Same thing for cryptocurrency. There's tons of coders behind these tokens, tons of people putting in a lot of effort, wanting to see the token or the stock succeed. So of course the share price or token price wants to go in an upwards direction. So I play until areas of resistances for my take profit. So as you can see, resistance got broken here, turned into support, and then price would have met with the area of resistance and decided to do it again. Resistance got broken, turned into support, and then looks like price wants to keep going in an upwards direction. I try and make trading as easy and simple as possible for you guys. You guys see all the reviews from my students. I try and make it simple for you, and I adapt to your life. Okay, here's how the class system works. So 1, I offer 10 classes. Okay, these 10 classes can be stretchable however long that you want. Okay, it could be between 10 weeks. We could do 10 days or a class every 2 weeks. Whatever your schedule is, we're going to be flexible, and I'm going to maintain a optimal workflow for whatever you trade, your schedule, and what type of person you are. Okay, so I'm going to catch you guys in the free call. Go ahead and book the calendar. Stay prayed up to God. Keep grinding. And I'm going to catch you guys in the next one. Peace.
You cannot trade futures like a regular stock account. You're playing with leverage, and you gotta understand the deposit system. So think of initial margin as the VIP cover charge. It's the specific amount of cash you need to get past and open the trade. But once you're inside, the rules change completely. And that's where maintenance margin kicks in. And this is your lifeline, and it's your health bar. The second your account equity dips below this specific number, the broker doesn't ask nicely or care. They're going to forcibly close your position to stop them from losing money, and then you're going to be left with nothing. Or sometimes your account could go past your stop loss or liquidation amount, and your account could go into the negatives, making you owe money to the broker. So I'm going to show you how to calculate what margin is and understand. Let's head over to it, inshallah. All right, let's go and let's talk about futures trading margin. Okay, the deposit system of trading. So what is margin? So margin is not a fee. It's pretty much a good faith deposit. So say for instance, when you're signing up for a credit card, okay, sometimes the credit card company might ask for an initial deposit of like $100, but then the credit card would give you $500 worth of credit to spend. Futures works very similarly. So here's an analogy. So, or you could say you wanted to rent a super expensive console. Okay, you could put down a deposit to prove that you won't break it. And if you return it safe, okay, then you get the deposit back and you get to use the console. Okay, so futures is pretty much like a trading loan almost, but depends if you're using it for day or overnight trading. Okay, there's going to be two different costs. So if you want to hold the console overnight, it's going to be a different cost than it is for just using the console during the day. And futures contracts are huge. Okay, you don't need the full amount to use it during the day, but you're going to have to cough up more money if you want to use the console overnight. Okay, so let's learn the difference between the money you need to start initially and the money that you need to use futures contracts overnight. Let's jump into it. So let's talk about the power of leverage. So controlling big things with small amounts of money. So leverage allows you to control a massive contract value with a small account balance, okay, and the magic multiplier in it. Okay, so imagine having $1,000 but being able to buy $20,000 worth of Bitcoin futures. Okay, in that instance, the math would be a 20x leverage. Okay, and the catch. So it makes wins bigger, but it also makes losses happen quicker. So it's like driving a race car that goes super duper fast, okay? But if you crash, then it'll hurt way more than crashing like a bicycle, for example, okay? Because a bicycle, you're on it, you're going pretty slow, okay? But if you're driving super duper fast in like a SRT and you crash, then that could put your life at risk, okay? Just because the amount of speed and power that you're controlling, okay? So futures, yes, you can turn up an account, turn $50 and $10,000 to $10,000 or etc. Okay, whether you're trading crypto futures, normal futures, or whatever. Okay, but you can also quickly lose that $10,000 by making the wrong decisions. Okay, so leverage gives you a lot of power to turn up your account, but you can also turn down your account just as quickly if you're not disciplined. So initial margin, it's going to be really, really important. It's the minimum amount of cash that you must have in your account to open a new trade. Okay, so the math involved into it. It's usually a percentage of the total contract value. Okay, for example, like 5% or 10%. Okay, so if you have $4,000 in your account, but the initial margin is $5,000, okay, it wouldn't even let you trade. Okay, it would say access denied, and the trade would not be able to be entered down. Okay, but if you have $1,000 in your account, but the initial margin is 500, you would be able to open up a trade. But here's the catch. Okay, if your account goes beneath that $500, your account would be what's called liquidated. Okay, and when your account gets liquidated, then they take the remainder amount that's underneath the $500 and put your account to zero. And the dangerous part about it is that if price decides to clip past your stop loss or clip past underneath your initial margin value, okay, if you go underneath the initial margin value, your account could potentially go into negatives, okay, then you'll owe the broker money, etc. Okay, and they'll definitely be wanting that back, whether through suing you or whatever. Okay, so decide here, okay, what the initial margin is, and try to make sure your account has more value than that. Okay, you do not want to get liquidated for no reason. It's just a loss of currency pretty much for no reason. Okay, it's happened to me, okay, when I wasn't too sure what margin was when I first started trading futures. So it's not something I want you guys to go through. So the maintenance margin, okay, keep your account alive at a certain level. So the definition of maintenance margin, okay, it's the minimum amount of equity that you must maintain to keep the trade open after it starts. Okay, and lower limit, okay, this number is usually lower than the initial margin, okay, and daily fluctuations. So as your trade loses money, your account balance drops, okay, and you still must stay above this line. Okay, so keep in mind, even while you are in a trade, your account balance will fluctuate, and it still matters. If your account fluctuates underneath a certain amount that whatever you're trading requires, then your account will be liquidated. Okay, let's say you're trading the NASDAQ, okay, the NQ futures, okay, on Trader of 8 as of 2025. The day margin, I believe, is $1,000. Okay, so if you're in a trade, okay, and your account goes underneath $1,000, then your account has a potential chance to be liquidated. Okay, and they would just take all the money underneath that. Okay, and your account would be at zero. Okay, and you do not want that to happen. So futures, it's a lot of power in it, but you can also destroy your account just as quickly. So really will show you how disciplined you are. Okay, so keep your account above the margin amount, and also know that margin amounts can fluctuate too. So a lot of people, I'm not too sure, know this. So margin amounts fluctuate, especially on news dates. So dates like CPI, PPI, Consumer Price Index, certain rates. So you can check all the news out on sites like Forex Factory and stuff like that. But a lot of the times, and on certain brokers, margin can change. Overnight margin can change, especially depending on if there's news or not. Okay, so keep heed of that. Okay, pay attention to the margin at all times. I do not want you guys to get liquidated and lose money for no reason. Okay, we got too many things to hold down, too much business to handle. Okay, keep on top of your numbers. Let's head over to the next slide. So again, margin called. Okay, so when your account's on low fuel, it's on E. Okay, and if your account balance falls below the maintenance margin level, it's gone. Okay, they will take every dollar in your account, and it hurts. You do not want that to happen, because it's not even like you lost the trade and then you blew up your account. No, you didn't have your account at the certain threshold, and they took the rest of your dollars. But rightfully so, though. If you break the agreement, they'll take the rest of the money. Okay, if you agree to have $50 in your account in order to trade a micro contract, okay, and your account goes to $48, they're taking that. Okay, and your account's going right to zero or into the negatives. So keep heed. Okay, and the demand, the broker will demand you to pay or deposit more money immediately to bring the balance back up, because you lied to them. Okay, you broke the broker's heart. The broker was like, wow. Okay, and there's plenty of times. Okay, once again, I broke the broker's heart. Okay, I got liquidated a few times, especially very, very early in my futures career. Okay, didn't really understand margin, didn't understand overnight margin, especially tried to hold overnight. Okay, and then through that, I learned. Okay, and I'm grateful I get to come on here and let you guys know. Okay, because you do not want to get liquidated. And if you don't add the money instantly, the broker will forcibly close your account, close the trade, and really want their money back. Okay, so for example, if you borrowed a bike, okay, or if someone loaned you your car, okay, let's say you had a rental car, okay, and you said, all right, I'm gonna go ahead and give you $500 in order to drive the rental car, but you can't let the gas go below a quarter, otherwise the car will literally blow up. Okay, let's say you're driving the car, you're having a nice time, the gas is at like 2 quarters, you're not tripping, you know, you're still having a lax day, you're vibing out. Okay, the car is at a quarter. Okay, you're still vibing out, you're chill, you forget. Okay, You're not on top of your business. Okay. And then boom, you look at it, account car underneath a quarter, and then it blows up. Okay. So I blew up my account by looking at the trade profit numbers instead of looking at the actual margin numbers. Okay. A couple of times. So don't let that happen. Don't get too lost up in the charts, especially when your account's already on its last legs. Just, it's all right. Pray on it. Boss up, hustle up some new money on, okay, and put it back into your account. And then you guys can run it back up again. Don't try to trade on a quarter. Okay. Don't drive the car on a quarter. Don't do it. It'll blow up. Okay. If you know the margin amount is $600, don't try to trade with $670, trying to trade with the little $50 stop loss, because you're not taking things into account when you do that. You got to pay broker fees, and then there's going to be slippage on your stop loss, etc. A lot of other things that come into account while you're trying to micromanage every single number, trading out of desperation and survival mode. It'll really come bite you in the back. Okay, don't do that. I'm telling you, it's a lot of things that you might not realize. Okay, trading, hustle up, okay, boss up a bit, and then come on the charts. Okay, there's plenty of times I've had to take a step back. Okay, get right with God, get right with myself. Okay, have a new perspective on the charts, and came back way stronger. Okay, whether if I didn't like my results, or plenty of times where I was really, really happy with the money I was making in the market, and I had to just control myself. Okay, because I know what I did in the past. Okay, I would make a bunch of money from the market and then just blow it all up. Okay, so plenty of times in the market where I've had to make some good money from the market and pause, especially trading futures. Okay, I would hit like some really nasty trades and just pause. Okay, just watch the market for a couple of weeks, for a couple of days, and just being really patient on the charts with yourself and in life. It's really gonna help you. Okay, so even if you make a bunch of money from trading, don't feel bad if you want to just take a couple of days away from the charts. Okay, or if you want to just take a couple of weeks to just study the charts, see how price action moves, hold on to that money, reinvest that money, that's going to be fine. Okay, you're not in no race with nobody, you're not in no competition with nobody, you're in your bag. Okay, get in stack mode, stay down, okay, and figure out what works for you guys. Okay, once you start getting your criteria down as far as your entry criteria, things get a lot easier. But one thing you do not want to do is trade out of desperation. Okay, because if you do that, or try and trade when your account's on its last legs, when it comes to futures, options, everything else, you can kind of do that. You can throw in like your last bit of money, and especially on options, since the profit potential is unlimited and your account could potentially flip. But futures, do not play with your account like that, because then you're going to end up losing more money in the long run, paying off margin call fees. Okay, and I do not want that for you guys, inshallah. So let's head over to the next slide. So initial versus maintenance. Okay, here's a side-by-side comparison. So initial margin, okay, it's going to be at the very start. Okay, it's going to be the entry. Okay, and it's pretty much just going to be telling the broker, like, yeah, you know what, I have the money in order to be in this trade right now. Okay, so always keep extra money in your account. Never trade right at the limit. Okay, or a small win will blow your house down. Just please do not do that. Okay, don't do that. And then maintenance margin is going to be during the trade. Okay, so that's going to go ahead and be it. So some key takeaways. Okay, leverage. Okay, it's going to be really powerful, but can also be dangerous if you are not disciplined. Okay, do not lead with your flesh. Okay, pray to God for discipline and stay focused. Even when you start touching that good money, stay focused. Okay, and the initial margin is going to be your entry ticket. Okay, and the maintenance margin is your survival line. Okay, and liquidation, it happens when you run out of money. Okay, and you don't meet the maintenance margin. Okay, if they tell you, yo, we need $500 in order for you to have this trade open, and they don't care if you're in a trade, if your account goes underneath that $500, goodbye. Okay, you're not allowed to trade with this right now, and you owe us some money. Okay, so it's like that. Futures is very ruthless, very hardcore. The most hardcore instrument. Futures is the discipline instrument in itself. Okay. Shares, you can get rich by not looking at the charts. Plenty of millionaires created by people who just hold stocks. Plenty of millionaires by people who just hold cryptocurrency. But I don't believe there's any futures millionaires by anyone who doesn't look at the charts. Okay. It's not something you can just throw a bunch of money into and try and just make a bag. No, futures is very, very different. You have to know rules, have to play very intricately, and you have to just really just change yourself completely as a person. Okay, so stay safe, trade smart, and head over to Stackmode.net for all trading education. Stay prayerful to God and keep grinding. Peace. All right, so we're going to go ahead and talk about the bear market. Okay, so pretty much whenever cryptocurrency starts heading in a downtrend, okay, sometimes that's going to induce panicking. Okay, it can induce a couple of emotions, such as like panic selling. Okay, certain things, whether you want to feel like you might want to dump your entire portfolio, okay, because of how many negative trades that you've taken within a certain bear market cycle, right? Or if your portfolio's down, okay, but we don't want to do that. Okay, let's not think of the market that way. Let's think of the market logically. Okay, so just like we always cover and talk about, there's benefits to making sure that these markets go in upwards direction. Okay, cryptocurrency included. This is something that governments hold, many people hold, hedge funds hold, and just people with large quantities of money hold. Okay, so cryptocurrency, it's not going to be something that's going to be useless. Okay, it's going to be something that's going to be instructing and providing power back to us, the people. Okay, so it's something that people are investing into due to the fact that people can easily send money from one person to the other, okay, without having any bank intermediaries in the middle of it. Okay, so if you want to send a wire transfer, for example, okay, from $1 million from one person to another person in China, a lot of times that transaction might not easily go through, okay, without being first approved by the bank. Cryptocurrency removes the whole bank in the middle, okay, and works on its whole blockchain system, okay, letting people make their transactions on their own accord. So if someone wants to sell $1 million in cryptocurrency to a person in China, they can go ahead and do that and easily and instantly using the decentralized space. Okay, so let's jump into it. So cryptocurrency has many uses. If you see market going in a downtrend, all it is people selling as well too. Okay, just like we see this chart right here. Okay, this is a left to right chart. So if people got in at this low down here, okay, and market starts going in upwards direction, of course when market decides to fall down and correct, okay, people call it a bear market, but of course it's going to fall down and correct though. People got in way back here and they're going to go ahead and take profit. So when people are taking profit, getting their money out, that's going to cause the shares to fall down. Okay, so all the crypto supply will fall in a downwards direction the more people sell. Okay, so whenever we see market going in a downwards direction or a bear market, okay, that just means market's going in a downwards direction, which also means people are just selling. Okay, but these are going to be opportunities where market's also going to go on discount. Okay, so if something is $50 right now, okay, and it's something that you want, and then it goes on sale, and you see it on sale for $20, okay, you might even get two of those things, okay, due to the fact that it's on sale now. Okay, so think of crypto market dumps like that. Okay, think of things going on sale. Okay, market has to go up in order to come down. It can't just go up in a straight line forever. Okay, it has to work in a staircase formation. People have to buy, people have to sell. Hence why it's called trading. Okay, when you're winning, somebody's losing. When you're losing, somebody's winning. Okay, so let's cover the mindset and really just understand how we can prepare for when market's going into downtrends. Okay, so let's define the bear market and root causes. So bear market is generally defined as a decline of 20% or more, okay, from the recent highs, marked by widespread pessimism, low confidence, and a sustained decline in prices and trading volume. Okay, and key definitions. So the 20% rule. So why subjective? A 20% drop from the all-time highs signals market distress. And in crypto, drops of 70 to 85% on certain things like meme coins and stuff like that can be common during major bear cycles. So that's why you don't really play meme coins and things like that. It's not really worth it since they just don't have enough value, okay? And they can easily just go ahead and fall in opposite directions without much of a backbone behind it, okay? Versus something like Bitcoin,
where that's a lot less likely to happen. And the more actually it dips, the more people are going to buy. Okay, people are putting in $300 million orders plus, etc. Okay, anytime Bitcoin dips down. Okay, so it's way different. So it's going to be sometimes too where certain cryptos go cold, okay, and they start consolidating. So what consolidating means that it starts going in a sideways direction, okay, not much price action up or down, and you want to stay away from those. Okay, so you want to trade something that goes in upwards direction year after year and is gaining percentage year gain, okay, making your money more money, making it a stable investment. So watch what cryptos we invest in, okay, and primary catalyst, right? Let's talk about it. So some macroeconomic factors. So global inflation that can affect crypto prices, interest rate hikes by central banks, and traditional asset market declines often correlate with crypto downturns. Okay. Excessive leverage cleansing. Okay. Overly aggressive market buying. Okay, with borrowed funds. So there's going to be times where people can trade Bitcoin with borrowed funds, right? With something called leverage. So just like, futures, there's going to be things called crypto futures. Okay. And on crypto futures, you can trade with the same leveraged amount. Okay. And any leverage amount, depending on the broker, it goes up to like 500x and stuff like that. Okay. And sometimes when market decides to go down, okay, it creates instability. And bear markets, meaning markets going in a downwards direction, it purifies the market by liquidating these highly leveraged positions. Since the more leverage that you're playing with, the smaller that your stop loss is going to be. Okay, meaning that your trade has to close at a certain area automatically versus if you're playing with no leverage. Okay. So regulatory uncertainty. So major government crackdowns or unclear legal frameworks in key jurisdiction can trigger broad market fear and lack of trust within certain cryptocurrency markets. Okay, so we saw in 2022 COVID area during the SEC, okay, the government exchange for securities, okay, they were having some problems with the crypto sphere, but since then things have been passed, things have been regulated, and as we can see, crypto is now shooting into new highs constantly with tons of optimistic future ahead of it. Okay, and let's talk about project failure and exploits. So the collapse of large projects like major stablecoins or exchanges lead to contagion and a severe loss of investor trust. Okay, so if you see certain things like certain exchanges fall down, or certain brokers where a lot of people invest in just shut down randomly, that could put some fear into the market. More fear into the market, less people are going to be investing. Okay, but that's just things that can happen. But just like a bank, banks have random maintenance where you can't pull out your money. Okay, so anything has its cons, anything has its pros. Okay, only thing's perfect is God. Sometimes things are going to shut down, just is what it is. So psychological game, right? Conquering FUD. So investment success during a bear market is going to be 80% psychology. Okay. Really 80%. I'll say like 90% plus. Okay. Because you can have really the best levels on the screen. Okay. And I've done some tests with certain students. Okay. You can give somebody the best levels, but they don't close where they need to close. Okay. Due to the fact that their analogy or how they process it in their head might be completely different. Okay. So trading is really going to be psychology and how you look at the market. Okay. So mistake number one. Okay. So mistake number one that people make, this is the main reason why people will remain unprofitable, okay? Their stop losses are going to be too tight, okay? Way too tight, okay? Causing them to panic sell, okay? So selling assets at low prices locks in permanent losses. And the single best way to lose money in a bear market is to sell everything when despair is the highest, okay? Sometimes you got to sit and you got to hold through certain periods expecting price to sweep up. Now, I'm not saying hold every single trade, just certain past the worst dump of all time or past your stop loss. But if you have a calculated trade that you have planned and it starts going in the red, it's part of the game, okay? And the game is really about who can survive when market's in drawdown or your account is in drawdown, okay? And who can't, okay? Because whoever's going to sell all the positions when market's in drawdown for a loss, their account is never going to grow. Okay, you have to be able to sit there and stomach through it. There's times I've had tons of time. This is why time is going to be one of the biggest factors in trading. This is why crypto is really amazing. Okay, when you're trading cryptocurrency, you have time. Okay, cryptocurrency, as soon as you buy, you can hold it forever until the end of time. So you have time. So if you sell, okay, that's going to be on you. Okay, there's no time running behind you. As soon as you buy some spot cryptocurrency, okay, when you just buy crypto on a normal broker, okay, and you can just buy and hold without any leverage, okay, and no leverage buying cryptocurrency, just being the normal way, it's called spot. So when you do that, okay, you can decide like, okay, I'm going to sell in a couple of years. Okay. It's not as easy to do that with other instruments. Okay. Other instruments can be time gated, such as like futures, for example. Okay. Futures, each contracts, they have expiration dates. Okay. So things can be a little bit different. So let's talk about tactic number one, right? The zoom out. Okay. We got to zoom out. We got to get the whole long-term perspective. This is why we use our higher time frames. Okay. Time frames we're going to be using. Okay. Some great notes here. Time frames that we focus on. Weekly. Okay, we're going to use our weekly time frame. We want to see everything on the larger, higher time frame scale. Okay, after we check out our weekly, maybe for take profits. Okay, and take profit is where we close the trade out. Okay, say you got it at an area of support. Okay, and you close at an area of resistance above current price. You can go ahead and do that. Okay, so you're going to have the weekly. You're going to have the daily. Okay, and then you're gonna have your 4-hour time frame. Okay, then you're gonna have your 4-hour time frame. Okay, so using those time frames all together is really gonna help you put your trade into perspective and be like, okay, this is the type of setup I want to be taking from now on. Okay, and these are the type of trades that I just take. Okay, so that's what you want to focus on. Okay, weekly, daily, and the 4-hour. So let's talk about zooming out. So the HODL view. So we're going to focus on the long-term vision, okay, of 3 to 5 years plus. And all major crypto bear markets have been followed by new explosive bull market cycles. Okay, look at the monthly or the yearly charts. Okay, not the 5-minute charts. Okay, tactic number 2. Okay, reduce obsession. Okay, we should be grinding in real life, stacking up some bread, okay, putting some money away, okay, and just growing our capital in the real life so we have more money to come put into the markets. Okay, but constantly checking P&L, seeing how much money you're up and down, it's not what we want to do. Okay, focus on the charts. Okay, you could look at the charts, see where it's at, but even that, don't turn it into unhealthy obsession. Okay, take your time, check your charts out maybe once a day, a couple times a week. Okay, but don't sit there, stock on the position every minute. Okay, constantly checking the price feeds lead to anxiety, and they lead to impulsive behavior. So set clear rules and limits, and then step away from the daily chart fluctuations. So it's really about a battle of just you versus you at a certain point. So quote for perspective, right? Be fearful when others are greedy, and greedy when others are fearful. Okay, so when everyone's scared, price is going in a downwards direction. As soon as it starts making a curl on your weekly or daily, you can go ahead and get in, buy that, and then you buy the low where everyone's fearful. And then by the time it's at all-time highs, that's when you're going to start seeing the posts like, oh, everyone, and then everyone's going to start buying at all-time highs. Okay, it happens constantly every single cycle. So when we know how to sit through the bear market cycles and buy certain dips, we're going to be able to prepare and be a lot further ahead than other people due to the fact that we can analyze something so simple. Okay. So accumulation through DCA. So let's talk about DCA. So DCA stands for dollar cost averaging. Okay. So DCA, it's dollar cost averaging. What is that? Okay, it's one of the most powerful tools for risk mitigation and capital deployment in volatile bear markets. And it needs the need to time the bottom. Okay, and let's talk about the DCA mechanism. So fixed schedule. So investing a fixed dollar amount, let's say for example $100. Okay, at regular intervals, let's say weekly or monthly. Okay, that's going to be DCA. Okay, when you're just regularly putting away a certain amount of money, okay, that you can. Okay, pay your bills, get some groceries, and then you can invest. If you're going to say you're going to invest $1,000 in Bitcoin a month, okay, then go ahead and do that. Okay, if you can do more, then do more. But DCA means just take a percentage of your money, okay, break it down and put it into some cryptocurrency or whatever investment. Okay, I don't care if you get $10. Okay, go ahead and break it down, put 7 of it into crypto. Okay, just having that type of stack mode mindset is going to help you grow your currency and help you stack way faster. Okay, and your portfolio will flip in no time. And shalom. So reducing the timing risk. So, and also keep yourself broke. Okay, so if you keep yourself broke, it's a strategy I notice a lot of people do. Okay, it's something I definitely do. Okay, I don't keep any money in my checking account. Okay, after I pay my bills, I get my big lump of groceries. Okay, I do what I need to do. Okay, buy what I want to buy. And then from there, every dollar that I have the rest, okay, I'm going to pay my credit card. Okay, and then after that, I'm just going to invest. That's all I do. I put every single dollar into investments and I just keep myself broke. Okay, I pay my rent. I got groceries, so I'm not going to starve, thank God. Okay, and I did everything I need to do. So I'm good. So I can keep myself broke and I'm going to survive. Okay, so keeping yourself broke whole time you got money stacked away in investments is going to be a really good thing to do. Okay, just changing the whole mindset. Just, you know what? I don't need to go get this coffee today. I'm gonna bring some coffee from home. I'm gonna take this money and I'm gonna invest. Okay, so it's something personally my wife really helped me out with. Okay, just changing the whole mindset of everything. Okay, changing the whole mindset of everything and really understanding like, okay, you know what? Let's not eat out today. Let's stay down, groceries, and the rest of this money is investment money. Okay, because this stuff, it adds up quick. It's easy to spend $40 on a DoorDash meal, $50 on a DoorDash meal for 2 people, okay, quickly, okay? But $50 worth of groceries, it really goes a long way, okay? So it goes a much further way, okay? So it's about just staying down, making the right decisions, and then we can go ahead and ball later. Yeah, so the compounding effect, right? So this strategy becomes exponentially more effective when asset prices are depressed, okay? As your fixed investment buys a larger portion of the supply, okay? So when market is in a downtrend, okay, and market's about to make that curl in an upwards direction, okay, and then we have cash to just stack and throw in there, and you buy, okay, even if you don't have all the cash in the world to buy at the low, as it curls up, you can keep adding, okay, and that you hit your trade, okay, and it's just about mindset. Then from there, take that capital, and then you can go ahead and deploy more cash into there and just keep stacking your wins over time. Nice. So thriving the strategy. All right. So let's talk about some fundamentals there. So bear markets separate speculative noise from real technology. Okay. So this is the time to ignore hype, okay, and focus exclusively on fundamental analysis and your technical analysis. Okay. So when market's in a heavy downtrend, let's say there's a speech from a president or something like that that has dropped the market. Okay. We want to be looking once again on our weekly and daily time frames primarily, okay, and we're going to be looking for that V curl up, okay. We want market to make an area of support, okay, and then we want to see market start to curl up, either after a couple of days from the daily or a couple of weeks from the weekly. Preferably weekly curls are going to be really nice, okay, because that means price really wants to reverse. Okay, if you start seeing 2 weeks in a row, price action, price filling in the V, okay, a lot of the times that's going to be the setup you would like to take. Okay. So, and we're going to ask ourselves too, if something is going down, why is it going down? Okay, was there any bad news behind it? Okay, did something happen? Okay, and let's think about utilities and use cases. So does the token or protocol solve a genuine, tangible problem? So we'll talk about Solana, for example, okay? Solana, you need it to trade meme coins. Okay, so that point alone, Solana has value. Okay, if people want to create their own cryptocurrency coin, okay, they gotta generate some Solana first if they want to make their own meme coin. Okay, but then we'll take something like a random meme coin that's just a joke. Okay, it doesn't have any community behind it, no nothing. Okay, just a random meme coin. If it goes down to 0, okay, a lot of people wouldn't be surprised. Okay, because does it solve any genuine, tangible problems? But then you're going to have something like Ethereum, for example. And Ethereum was created due to the fact that Bitcoin is limited. Okay, so one day Bitcoin will be gone. So people still want to trade cryptocurrency, so that Ethereum was created. Okay, so Ethereum has its purpose there. And instead of using power to create it, like Bitcoin's using power to create it, Ethereum is created using computers and smart contracts. So it's a lot more power efficient for the earth and it's healthier. Okay, so Ethereum actually has real uses compared to certain other things like random just joke meme coins. Okay. So, because if something has a real use and it dips down, people are going to be hounding to buy that dip. Okay. The second something valuable dips, people are hounding, buying tons of it. Okay. The second Bitcoin dips, people putting in hundreds of millions of dollars worth of orders, whether it be governments, BlackRock, any type of companies, anybody. Okay. So, talk about the cryptocurrencies team. So is the development team public, experienced, and actively building during the bear market? Okay, and you could check certain GitHub commits too. So certain cryptocurrency coins, okay, even though they're dipping down, they're working on tons of stuff on the back end, okay, looking to progress the future forward. And the community and governance behind it. So does the project have a vibrant, resilient community and a clear decentralized government model? Okay, so just like Bitcoin has tons of community behind it. You got companies such as MicroStrategy, also known as MSTR, okay, big representative of Bitcoin, okay, things like that. Okay, and you also have, once again, governments, US government, other governments, etc., participating in buying Bitcoin and other tokens as well too. So the tokenomics of everything. Okay, so analyze the supply schedule, vesting periods, inflation and deflation mechanics, and allocation of the team versus the public. Okay, and blue chip versus speculative asset, right? So blue chip cryptocurrencies, they're going to be our big heavy hitters. Okay, our Bitcoins, our Ethereums, XRPs, etc. Okay, and these assets, they have the deepest liquidity. Okay, and liquidity is going to equal money. Okay, and money equals the amount of people. Okay, the more money something has, the more people are trading it. The more people are trading it, the higher liquidity it has. Okay, so liquidity is going to mean money. So they have the highest and deepest liquidity and have proven recovery patterns over multiple cycles. For example, Bitcoin's 80% drop in 2018, followed by a new all-time highs. Okay, so people, once again, if something's a valuable resource and it dips down, people are going to be hounding and fiending and hungry to buy the dips, because I know I definitely am. Okay, I just bought some Bitcoin today. Okay, so speculative meme coins. So assets with high returns during the bull run are often the first to lose all liquidity in a bear market, okay, making them highly dangerous accumulation targets. So focus on protocols with established ecosystems. Okay, for example, layer 1 networks and major DeFi apps. Okay, so let's get assets with high returns. Okay, during the bull run, the first to lose all liquidity in a bear market. Okay, so focus on protocols with established ecosystems, things that have been around for a couple of years, okay, and has some value. Something you can sleep on your investment. So that's one thing we want to think about in trading, you know? So sometimes we hop on the markets, we think about money. You know, that's the right mindset. We're trying to run up a bag, but sometimes we got to play it safe. So the safest trades, a lot of the times, what people don't know, the safest trades, a lot of the times, is what's going to make you the money. Okay, focusing on discipline, being as safe as you possibly can with your money inside of your account. A lot of the times that'll lead you to running up that big bag. Okay. So people are going to claim that market's going into a bear market when all it's doing is going in a downwards direction. Okay. It's people who think that market's going to run up infinitely, going up forever. It's extremely unreasonable. Okay. Market's going to obviously fall down, correct, even if it's a hard correction. You have to understand that there's people who've been invested in years, months, and many more days before you even thought about it or even got in. Okay, so we have to think about those players and how long they've been waiting to close. Okay, so that's why quote unquote bear markets happen. Okay, markets just selling off due to the fact that there's too much supply. Okay, people who got in way in the beginning of time are holding so much of it. They're like, all right, I'm going to take my money and do something with it. Okay, and hence, and then a succession of everyone doing it at the same time, okay, leads to a bear market, leading price to go in a downwards direction. So staking, okay. So we'll talk about this in a second, but understand that the goal is really to increase your total asset count while the prices are low. So this is why I really promote the V, okay? So market, it's gonna fall by itself, okay? Market's gonna do its thing, and the left side of the V is gonna be market falling. Now, once market makes a bottom of the V is when we wanna look for a setup, okay? Look on the weekly or the daily, look for the bottom of the V, and then catch the rest of the V gap fill. Okay, that's what you're going to be looking for. Okay, catching the rest of the V gap fill. So you want to buy something at a low ideally and catch a sweep up. Okay, buy something at a low and catch a sweep up. Okay, because if you buy something a lot of the times, okay, especially if you're like an options trade, if you buy something at super all-time highs, okay, you can expect to get pulled back on. Okay, but understand that, yeah, certain positioning, it really does matter, okay, especially if you're gonna buy certain things that you're not expecting to hold for years and years, is especially if you're trading something like leverage crypto. Okay, then we want to go ahead and think about that. Okay, so yield farming. Okay, so providing liquidity to decentralized exchanges to earn trading fees and governance token. Okay, so that's going to be one of the things that some people do too. Okay, and that's going to be something that's just involved, but we don't really have to worry about that. Okay, as well as staking and then stablecoin allocation too, allows you to earn low risk, low yield while maintaining purchasing power for potential market dips. Okay, so there's going to be certain things you can do. Yield farming, you can pretty much kind of like the bank, get APYs, annual percentage yields on your money. Okay, if you invest in a certain cryptocurrencies. Okay, so you can do that. That's a potential option. I don't really recommend that. Buying spot or just buying normally in a normal broker is going to be just a lot safer too. Okay, because certain of these yield farm coins can go down and then you're not going to get certain of your returns that you expect back. But some of them do provide nasty returns like 40% per year and things like that, okay, on your money. So yeah, that's some things in the cryptocurrency space. So, okay, and then but market will always recover. So even if market decides to go in a downtrend, okay, if something's a valuable asset, it's putting a smile on people's faces. Inshallah, if God wills, it'll hit a sweep back up. Okay, so following every 70%, right, major drawdown in Bitcoin, for example, people were thinking, oh, it's the end of the coin, it's the end, like it's over. And Bitcoin has not only recovered, but has gone on to achieve significantly higher all-time highs every single time. Okay, and the bear market is not the end. It's simply just the consolidation phase where people are just getting a opportunity to buy in. Okay, so it's just an opportunity. So bear markets are an opportunity, hence why a large amount of millionaires were made in the 2008 recession, for example. Okay, how were millionaires getting made in one of the worst times for people? Okay, but it was really just the worst time for people who weren't investing. Okay, if you were investing during that time, you would have been able to make some really, really, really great money. So yeah. So this is why we take advantage of any dips now. Okay, any dips, we're gonna go ahead and buy the lows, and then you can catch the whole sweep back up. So the bear market, it's just not the end. Okay, it's not the end, especially if something is valuable. Inshallah, you could expect to sweep up. So essential risk management and security. Okay, so self-custody is key. So let's talk about some crypto things right now. So let's talk about keeping our crypto safe. Okay, so keeping your crypto safe is gonna regard in a couple of things. So if you keep your crypto in a broker like Cash App or Coinbase, Kraken, or things like that, okay, they're safe. But if these brokers happen to shut down, then you lose access to your cryptocurrency, okay, or something like that. Okay, so you're not going to have access to certain things. Okay, so what you can do eventually, okay, you can keep it on a broker like these for now as you stack up, but I advise once you get past like 4 figures to the 5 figures range, then go ahead and start. You can still buy on these exchanges, is what they're still useful for. But after that, I recommend moving your coins to what's called a cold wallet. Okay, so you could either use it's going to be a hardware wallet where you can actually physically plug it into a computer and then you can get access to your crypto. So those can be destroyed. That's the only bad thing about that. So again, we talked about certain things like the guy clearing the landfill, okay, looking for his cryptocurrency. Okay, so things like that are going to come into play. So you can actually just use a seed phrase. There's going to be certain things like Phantom, okay, Phantom on the Apple App Store. It's really, really good. It's just going to be like a ghost icon, okay, with like some eyes. And there it's going to be backed up by a seed phrase. And the seed phrase is going to be a 12 to 24 word seed phrase. And you can go ahead and just either write it down on pieces of paper, email it to yourself with a secure key, and just keep the code, spread it out somewhere. Okay. So you can do things like that. Okay. So cool. So now we're gonna be good. Okay, so we're gonna focus on bear markets and we're gonna be waiting for curls. Okay, we're not gonna think of bear markets as bad. We're gonna eyeball them. We're gonna see opportunity in that. Okay, we're gonna see the good in it. All right. So cool. So that's gonna go ahead and be that. All right, this is gonna be the beginning side to just reading the crypto chart extremely easily and efficiently. Okay, so we're gonna go ahead and understand two things. Okay, one, higher time frames is gonna be everything. It's gonna be our bread and butter. Our daily time frame and our 4-hour time frame is what's gonna get us our profitable trades. Okay, we're gonna need to be able to see everything on the market. We're not gonna be able to tunnel vision on the smaller time frames. And we also need to put market with a logical perspective. Okay. So we have to add odd logic to the market, okay? And we have to understand that everything is from left to right, okay? So the fact that it's a left to right chart is gonna go ahead and explain areas like resistance, for example, okay? So take this whole area where price decided to create a top and then fall in a downwards direction, okay? Say this area here. And then the price decided to fall downward, okay? So that's gonna be due to the fact that price started way over here to the left, okay? So when it first came out, let's say Bitcoin, for example, okay? Price was relatively really low, okay? And then we could see price over time started to start coming up. The reason why price decided to sell heavily downward here is because people got in way over here, okay? They're up a lot of money, okay? So they're trying to take some profit. So that's the reason why resistance gets created. So if you ever see sharp areas where market decides to fall down, okay, say an area like this or an area like this, okay, and then you see price falling in a downwards direction, okay, you can go ahead and see that, okay, it's just people selling because this is a left to right chart. So applying logic to everything is really going to help us break it down, really understand what we're looking at, and putting everything into the perspective that we need to put in it, okay? And then after that, price isn't gonna always a lot of times crash down to zero, and it's gonna make what's called a higher low, okay? So when price is making higher lows, so this low, okay, was created here. So then this low, above it is then higher than the previous low, okay? Once you start seeing price make new higher lows, okay, you know you're going in an uptrend, okay? Price is going in an upwards direction. So the only reason price goes down is because people are selling, okay? That's it. So if you ever see price going in a downwards direction, that just means people are selling. That's it. And price is going to try and find a bottom, okay, and create a new higher low in order to bounce or create a new lower low, okay? So for instance, price had this ultimate low right here. Okay, I'm going to go ahead and zoom in, okay? I can see price decided to bounce at this area of support right here. Okay, you can see price create a support and then bounce in an upwards direction. Okay, and then we can go ahead and see here on the daily time frame, price decided to then make support right here too. Okay, price decided to make support right here too. So create a support right here, down here, and also create a support up here too. Okay, creating a higher low. So here's the original low, and then here's the higher low, okay? And whenever you start seeing that, that's how you know price is trending in a upwards direction, okay? So we got this low, this low, this low, okay? This low, this one, okay? And it just keeps going up in an upwards direction, okay? Then up here, okay? And then price continues to go up, okay? So analyze your chart, okay? Whenever you see higher lows getting made, you know price is going in an upwards direction, okay? Whenever you see lower highs getting made, then you know price is going in a downwards direction, okay? Say I had this high up here, okay? It's a super high. Then I have an even lower high right here, okay? Get on my 4-hour time frame. Okay. Actually, no, I'll start my daily here. Just because it's 2021. Anyways, the price started at resistance here. Okay, and then we made a lower high right here. Okay, and then an even lower high over here. So these are called lower highs. Okay, LH. So this high here, okay, this low is lower than this high. Okay, this low is lower than this high. Okay, lower highs. So that's how it works. And that's how you know if you're in a downtrend or if you're in an uptrend market. Okay, and once again, support is going to be an area where price decides to bounce within an upwards direction from. And support is going to be an area where price decides to bounce in a downwards direction from. Okay. Okay, so down here, it's going to go ahead and be support. Why? Because I can see it's an area where price decided to stop falling down from and then bounced. Okay, so anywhere price decides to create a low, bounce, that's going to be support. And anywhere price decides to create a high and fall down is going to be resistance. Okay, so putting these two together in a trading aspect is going to be really, really nice. So let's go over two things. So we know that price cannot go in an upwards direction until it passes an area of resistance or an area of support above current price. Okay. And also, support can be broken and turn into support. Or support can be broken and turn into resistance. Okay. Support can be broken, turn into resistance. Okay. So keep that in mind. Support, price broke down right here, and then turn into resistance. And then price decided to fall in a downward direction. Okay. So take your time and really analyze everything. And also know that resistance can be broken, turn into support. Okay. So take your time and put it all into perspective. Okay. So resistances can also mirror each other in short at the same place, or supports can mirror each other and bounce at the same place. Okay. That's going to be the models you're going to be looking for when it comes to trading. Okay. So I'm always going to start off on my daily time frame. Okay. The daily time frame is going to be my bread and butter. It's going to give me my eyes to absolutely everything, and it's going to help me see what I need to see. Okay. So boom, let's go. So all-time highs, right? Let's go and talk about all-time highs. All-time highs is the maximum height that price has reached. Okay, I like to go ahead and always put a level at all-time highs. Okay, just because I know that one day, inshallah, price is trying to break this price and go to a higher price. Why? Because I know that price is trying to always break resistances in order to continue in upward direction. And the reason why that's true is because people are investing into these tokens. So it's increasing the share price. People are believing in these tokens. Okay, certain projects are coming out. So more people are going to be investing into it, whether it be the ones who are already investing, putting more money into it, or new traders coming in since they see other people already believe in it and have some good returns from it as well too. So still starting off on the daily here. Like I told you, supports can mirror and resistances can mirror. Okay, so I'm going to go ahead and put a zone at the very top of all-time highs. Okay, right here, all-time highs. Okay. Price hasn't broken this high yet. Okay. So until price decides to try and come down to this major area of support, we'll see if it wants to hold. Okay. So if price breaks past this major area of support, then we could try maybe this area of support. Okay. Or this area of support. Okay. Go to my 4-hour time frame, make sure everything looks how it needs to look. I like this too over here. I can see that price has a whole another low over here. Okay. Boom, I see that price has an area of support over here too, which price decided to mirror over here
and do the same exact thing. Support and mirror, do the same exact thing. Okay, just make it simple. So once again, you do have the area of resistance up here too. Okay, also known as all-time highs. So we know that one day price is going to be chasing that area in order to break, okay, invalidate that level and go to a completely new and higher price. So I could either wait for price to come down to this area of support, okay, and then I'm going to be on my 4-hour time frame and wait for a close. So I'm never going to take the first candle that touches my lines, okay, whether it be a candlestick. Say I'm trying to play for reversal at this blue line down here, the first blue line at this area of support right here that matches with this area of support. Okay, say I'm trying to play at the same areas right here, right? If price gives me one wick and then breaks down, that's completely my fault. What I'm going to be waiting for is multiple candlesticks on the 4-hour time frame, okay, to be formed above the blue line. Okay, so I'm never going to take the first candlestick that's going to associate with whatever zone I'm looking for, whether it be resistance or support. Okay, I'm going to wait for the candlestick to form. Okay, make sure the traction is there, make sure people actually want to buy right there, and then go ahead and get in. Okay, so having a long-term mindset is really going to help you be a lot more patient. It's going to help you reformulate your plans, your strategies, and your ideas, and really just have a nice, healthy perspective of everything overall. Okay, and you know where you can intentionally, if you take profit out, if you want it for certain things too. So let's say you are in for a long, price decided to bounce at this area of support right here. Okay, price could easily try and come up to this area of resistance up here too. Okay. So let's go over another example here. So Ethereum. So let's check out Ethereum here. Once again, we're going to start off on our daily time frame. Let's go and let's get the full overview of everything. Okay, I can see that 2021 Ethereum was doing well. Okay, so I'm going to go and put a line at the previous highs. Okay, so we have this high in 2021, and then the high as of 2025 in August for Ethereum has been created. Okay, so here's how the spot dips. So we can see market dumping right now. Okay, and you're gonna go already see that. Okay, this is gonna be a good sign. You're gonna see one candlestick already bounce from a certain area. Then you're gonna see here's gonna be the sign where you know, like, okay, this might actually go somewhere. Okay, the second candlestick is gonna be the opposite color. Okay, the second candlestick is the opposite color, especially on the 4-hour or the daily or something. Okay, and then you know, like, okay, that's going to be a pretty safe area to go ahead and play. Okay, it's going to have verification. Okay, it's going to show you that there's multiple closes in price action. Okay, wanting to go ahead and be fulfilled there. Okay, so you can also just pay attention to certain supports too, and just see if price wants to go in a bullish area. And a lot of the reasons why I'm focused on upside and bullish scenarios is due to the fact that, once again, this is a left to right chart. Okay, so let's check this out for Solana here. So Solana came in contact with this support right here and this support right here, and then we this support down here. Okay, so I'm going to go to my 4-hour time frame to check it out. So we have one area of support that we can see price dumped past it, 2 areas of support, okay, and then price decided to dump past it, okay, and then another area of support right here. Okay, so we're trying to see if price wants to come down to these areas, but price ignored these 2 areas of support right here and just decided to bounce at this low right here. Okay, so let me go ahead and put this line down and then go to my daily time frame. See if I see anything to my left that's going to give me some significance to this. Okay, so price is sweeping heavily from there. So this is just going to be a new level of support here. Okay. So even if price were to go to the downtrend here, if you saw any areas of support or resistance be broken and do the opposite, then that's how you know it's a trend. So price broke through all the reversal lines, and then price just broke and retest, like I call it inverse break and retest, off one of the support lines, or support mirrored off one of the lines over here. Okay, support, support. Okay, support mirror.
And then once you see that, you're going to be like, okay, I'm going to be able to put some profitable trades together. Okay. It's about just having the consistency, the discipline behind the certain setups that you're marking every single day. So let's go XRP. So I'm going to for my daily here. I can see price decided to break below this price of action right here. Okay. Price created heavy support right here. Okay. And then price broke below it. Price below it again. And then it broke below it again. Okay. So that's 4 different times. So 1, 2, 3, 4. So say for instance you're a breakout trader, right? If you're a breakout trader and you try and just take it off the first candle handle hastily, you'll just lose money. Okay. So this is why it's really important to wait for a close, so you avoid candlesticks like this, okay, where it's gonna wick in between your entry, the type of setups that you want, and then it's gonna go ahead and just reverse the opposite direction that you don't want, okay, and that might frustrate you. So in order to avoid that type of loss, you could literally just wait for closes. And a lot of the time, if you get a close above your current zone, you'll be good. Okay. So let's go and let's pull up Doge here. Okay. Even same thing for Doge. Okay, if I go to my 4-hour, I can see that price decides to have multiple 4-hour candlesticks close here, and I can see we're curling up to this area of resistance here, and I can see that break and retest is being validated. So I have an area of support over here to the left. Okay, support got broken, and then price decided to pull it down and turn the area of resistance over there into support. And you can see price decided to quick break and retest right here too. Okay. And now price wants to stay near the same area and go up, okay, based off of the inversion. Okay, so resistance broken, turn it to support. So then price can go ahead and keep that ample levels value and continue an upward trend without dropping back to 0 every single time. So let's check out Link USD. So even this is going to be an example too. Okay. So with Link USD, we have the all-time highs up here being 53. Okay. Okay. So even if I'm waiting for a pullback, okay. So once again, below current price, you can either wait for A, resistance below current price to turn into support, like it's kind of done here. Area of resistance broken. And even right here with like one of the first projects here, okay. So you can go ahead and see that the Link USD project broke out of this level here, came down, and then created an area of support at this area here. Okay. Now if I get on my daily time frame here, another candlestick, and we'll see if we want to continue to close for a sweep up. Okay. We also have some more area of resistance too to the left. Okay. Which is also going to go ahead and validate this trade even more. Okay. So over here, area strong areas of resistance. Resistance broken. Then price created a new resistance after the breakout. And then price decided to come all the way down, turn resistance to support, and then bounce in an upwards direction. Okay. So let's go over Crow USD, for example, too. Okay. So even if I just wanted to play till this resistance up here, for example, okay, could be daily time frame, could zoom out. Okay, entry could be at this area of resistance here, okay, or it could be this area of support here. Okay, so there's gonna be the entry areas that are gonna be valid for us to go ahead and get in. Okay, so you could try this area of resistance here, area of support here, or this area of support here. Okay. And we can go down even further to this area of support too. Okay. And you're going to be just wanting bounces at these levels. Okay, and if price is showing you the bounces that you need to see, showing you daily closes, then a lot of the times you're going to go ahead and be good to get into the trade. Okay, take the whole sweep up. Okay, and whenever you do hit take profit, which let's go on and talk about take profit. So if you're a long trader expecting to make money by things going in upwards direction, okay, which a lot of the time companies are backed to promote things going in the upwards direction. So the market is trying to remain bullish a lot of the times. That's why when dips do happen, they're quickly bought up and market is right back to normal. Okay. So say I do have a area of resistance above here. Okay. Instead of predicting a certain low too, okay, if that didn't want to be done, you could also wait till the resistance be broken and turn it to support, and then you could take it up to the next level. Okay. So trend trading too is also going to be a really good way to make sure you're preserving your capital. Okay, not just necessarily losing any type of money for no reason. Okay. So trading with the trend is going to ensure consistency, your flow, and you're always going to be knowing what's going on. Okay, you're never going to be panicking when it comes to certain things happen in the market just because you have a good grasp of knowledge of what's happening. Okay. So even here too, check out this area of support here. Okay. And price decided today to pretty much mirror the same thing. Okay. So the area of resistance over there got broken here, turned into support. Okay, support got broken. Then price came up, and the support was able to be mirrored, and then we'll try and bounce again. Okay, take some off maybe. The area of resistance above current price, and then next area here, and then next area here. And it can also be an area of support above current price too, since support can be broken and turned into resistance. So same thing to the upside. Okay, support can run into, or yeah, price can run into an area of support above current price and turn that into an area of resistance. And we'll go over Bitcoin here. So I'm going to zoom all the way out. It's going to be one of the things I like to do too. Zooming all the way out is going to help me give me eyes I need to succeed. Okay, let me zoom in. I can see that this is pretty much at all-time highs. Okay, so when something's at all-time highs, nothing else can pretty much be done but sell. Okay, there's no other levels above for the most part. Okay, so just, yeah, if you're waiting on a trade, just go grind something else. Okay, don't sit there waiting on the chart all day. Set your alerts and go work on something else. Okay. All right. So yeah, so that'll be the full guide there. And Stackmode.net for all trading education. Separate to go. Keep grinding. Peace. All right, Stackmode Chris here, and this is going to be everything that I wish I knew when I started buying and selling stocks within the stock market. So it can seem daunting, but it's definitely a powerful way to build wealth over the long term. And it requires a lot of patience, humbling yourself, being close to God so you don't lose yourself or your sanity, and just being disciplined. So what exactly is a stock? A stock is also known as an equity, and it's a security that represents an ownership stake in a company. And when you buy a company's stock, you become a shareholder, and you own a tiny fraction of that business. And as a shareholder, you're going to be entitled to the portion of the company's earnings, okay, so the company's money they make, and assets, proportional to the number of shares that you own. Okay, so the more shares that you own of the company, the more piece of the pie you'll have. The primary goal of most stock investors is to profit from the appreciation of their shares over time as the company grows and becomes more valuable. So imagine this, for example. So if I have a pie, okay, let's say the pie is called Stackmode pies, okay? So Stackmode pies, the name is going to be the stock, okay? Whatever the name is the stock, okay? So stock is essentially the name, okay? Say I own 50% of Stackmode pies and I own 5 million shares, okay? So shares are going to be the percentage ownership, okay? And then there's going to go ahead and be directional bias. So if I said I was going to hand out 4 slices of pie today and I was correct, then that's going to pretty much be an options contract. Okay, a stock options contract. So options contract, you're getting paid to pretty much predict price within a good time manner. Okay, so that's the difference between all of them. So for example, imagine a company, okay, Stackmode network. Let's say we decide to sell 100,000 shares to the public, for example. And if you buy 100 of those shares, okay, you'll then own 0.1% of the company. And if the company's value grows from 10 million to 20 million, your shares value will likely double as well. So having an investor's mindset is going to be extremely important. Don't hop on the market thinking that it's a quick money grab, thinking that it's a quick get rich scheme. No, it's going to require discipline, day after day after day after day after day after day after day, repetition, not giving up, feeling like a failure. Okay, so many times where I just felt like I just wasn't for me, felt like I wanted to stop and was just feeling unmotivated, but I kept pushing through. I knew there was an end goal to it. And now, alhamdulillah, we're seeing green profits. Okay, so having an investor's mindset, having a resilient mindset is going to be extremely, extremely important. You've got to be patient. Okay, always be working on some other business or something like that while you're in a trade. Okay, you can't sit there having anxiety about the trade all day. You can't put yourself in lock. Okay, you got to keep going, keep flowing, keep building the wealth. Okay, inshallah. So investing is not about getting rich quick at all. It's about building wealth patiently and systematically and logically. And the biggest enemy to a new investor is often just their own emotions. Okay. So key principles of the mindset, long-term perspective. And think of terms and years, not days or weeks. Short-term market fluctuations are normal and often unpredictable. And true, wealth is truly built over decades, not quarters. Even if you run up $8 million, for example, in 2 years, okay, if you're not disciplined, if you're not structured, you don't know how to continuously win trades. Let's say you hit a couple meme coin plays, right? If you don't know how to continuously win trades, put the money away for taxes, budget, reinvest, you could end up definitely destroying that. Okay, you could destroy any amount of money by being undisciplined. Okay, so have a long-term perspective on it and avoid emotional decisions. Do not panic sell when the market drops. So the left to right chart. Okay, if the stock market or crypto market goes down, understand that inshallah, especially if it has value or something called market cap. Okay, market cap is going to show you the number of how valuable a company is. Okay, so if something has a high market cap, okay, and certain things occur on all of them, then you know it's also going to be something that you want to be looking at too. Okay, so a lot of the high market cap stuff can have decent volatility, okay, and embrace that. Okay, the market's going to go up and down, and volatility is a natural part of the investing landscape. And you can view market downturns as potential opportunities to buy quality assets at a discount, also known as the dip. Okay, so if the dip is happening fast, people think price action is just willy-willy. Okay, so if you see your 4-hour candlesticks curling upward, daily candlesticks curling upward with closes, you know that you might have find the low. Make your take profit in an area of resistance or support above current price. Okay, and just take your time. Okay, so taking my take profit is something that I wish I stuck to. I would hit take profit, but sometimes I would get greedy, hold past it, okay, or try and make 10 bands in a day instead of being happy with the 900 that I just made. Okay, I've had instances like that too. Okay, so it's about instances of being grateful, and this is why just reading the wisdom that God has left here for us, Quran, you know, etc. So it's really just gonna help us put everything together and lock it all down. Understand, like, okay, I can't just be playing with my money emotionally. I actually got real people to protect and provide for. I gotta be serious with my trading. I gotta be serious with my money. Okay, and trade with this mindset. Never trade with the mindset of, oh, I'm trying to make some money. Not trade with the mindset of, I'm not gonna lose money on this trade. Okay, and do your own research. Okay, never blindly follow a stock tip from a friend. Instagram, okay, there was times where I traded in a group of friends. That was before I even started mentoring on YouTube. Okay, I started off mentoring a group of friends, okay, and then they told me that I should start taking it on the internet. Okay, but that's how it started at first. Okay, started helping people get funded. Okay, after I figured out how to get funded and stuff like that. Okay, but trading with friends sometimes can lead to bad decisions if you don't do your own research. Okay, because no one is perfect, only God is perfect. So sometimes, like, especially if they're not studying more than you, okay, just try and stay in your own lane and your bag and your investor. Okay, study from your mentor, okay, and just stay locked in with your mentor and focus on the charts, okay? So God got you, okay? Find yourself a good mentor that you can trust, okay? And just trust your vision and your view, okay? Don't be arguing with anybody who doesn't believe in your view. So understand what you're investing in. So fundamental investing concepts. So to navigate the market, let's understand the language of it before we're just on here lost. Here's some of the most critical terms and concepts you'll encounter on your journey here a lot. So stocks, once again, stocks represent ownership in a company. They're higher risk but higher potential return, and you can participate in the company's growth. So if you catch a good company at the low, let's say you catch it at $32 a share or something like that, okay? And then price decides to go to $100 a share, okay? You would make a large percentage gain on your money, okay? Why? Because $32 a share went to $100 a share, okay? That's a 68-point jump, if I'm not mistaken, okay? So it's a lot of points, a lot of percentage gains to go and be paid off of. So with stocks, you get paid as price decides to go in whatever favorite direction you purchased it in. Okay, whether be it you're wanting it to go up or down with the options contract, for example. So bonds are debt and stocks are equity. So bonds, they represent a loan to a company or government, and they're lower risk but lower potential return. And you receive fixed interest payments over time. And think of it as being a bank for the company. So let's talk about market capitalization, a very, 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 very popular term. Market cap is the total value of a company's outstanding shares, and it's a simple way to gauge a company's size. So a large cap is going to be anything over 10 billion, mid cap is 2 billion to 10 billion, and small cap is generally considered below 2 billion. Okay, so small caps can be high risk, high reward because no one's really found them yet. But if you catch a small cap and it turns into a large cap, you'll be rolling in some dough, inshallah. Okay, mid caps, they have some higher growth potential. Okay, but they can also be more volatile since it doesn't have the most value. Okay, and large caps generally more stable. They do have a lot of volume though, so if price wants to correct, it'll definitely correct. So if it wants to dip down hard, it'll do that. So the art of research, okay, fundamental research versus technical analysis research. There was times where I only traded earnings, for example, okay, and I would just do research on the company, on the earnings, and that's fundamental analysis, okay, and then I started just trading with the charts, okay, and that's technical analysis, okay, and both are going to be needed to mesh together the ultimate plan, trust me. So fundamental analysis, let's talk about what it is. So this approach is a company's intrinsic value, and you'll analyze its financial health, management, market share, and competitive landscape. Okay. And you're looking for a stock whose price is below its true value, believing that it's going to rise over time by helping people in the future, okay, and putting smile on people's faces, inshallah. So some key metrics: the price to earnings ratio, also known as the PE ratio, okay, earnings per share, and return on equity, also known as ROE. These numbers tell a story about a company's profitability and their valuation. So for a PE ratio example, if a company's stock is trading at $50 per share and its EPS is $2.50, the PE ratio is $50 divided by $2.50, and that equals 20. And a low PE might suggest a stock that is undervalued, but it could also signal poor growth prospects, and it's a key piece of a larger puzzle. Put together what you wish. And technical analysis. This approach ignores a company's fundamentals and instead focuses on chart patterns, such as waiting for support to be broken, turn into resistance, or resistance being broken, turn into support. Okay. So instead of focusing on chart patterns, fundamentally, you could focus on chart patterns technically. Okay, and that's technical analysis. Okay, so technical analysis involves chart patterns, trading volume, studying the market momentum, and how the candles are moving. And technical analysis believe that all relevant information is already reflected in the stock's price. Okay. And the golden rule, diversification. Okay. And I also wish I was just saving way more money too. I would buy a bunch of Bitcoin, but then I would always just sell it. And I was like, dang, okay, everything that I've been buying and selling for the past 3 years, if I would have just held it, okay, then I'd be very, very up. But I'm glad I didn't do that because I get to teach this lesson here today. Okay, so the golden rule, diversification. So one of the most important lessons is to never put all your eggs in one basket. Okay, so don't just put all your P&L into just one share play. Okay, diversify a little bit, maybe like 1, 2, 3 plays at max. That's crypto and stocks included. Okay, 1 to 3 digital plays max. And diversification is the strategy of spreading your investments across different assets to mitigate risk. And when one investment performs poorly, another may be doing well, helping to balance your portfolio's overall return. So I hope you invest across industries. Don't just invest in tech, consider healthcare, consumer goods, energy, and finance. Different sectors react differently to economic cycles. Okay, so as of 2025, when this is coming out, we're in like the AI cycle. Okay, so AI stocks, for example, are super popular. Okay, or crypto brokers. Okay, anything allowing people to trade cryptocurrency, it's going to be popular too. So invest globally. Okay, the US stock market is not the only one. Consider international stocks to capitalize on global growth and reduce country-specific risk if you want. And use ETFs and mutual funds. Okay, these are powerful tools for instant diversification. An exchange traded fund, an ETF. That's a basket of securities you can buy and sell or an exchange, just like a regular stock. An S&P 500 ETF, for example, gives you an instant ownership in the 500 largest US companies. Okay. And mutual funds, a fund managed by a professional, which pools money from many different investors in a variety of assets. So here's some common mistakes I knew. So chasing hot stocks, okay? So especially after I made my first couple of bands with like C3 AI, say seeing that, okay, making my first like flip like that, okay, I was just like, okay, whoa, trading can be super duper popular. But then after that, I ended up losing profit just buying some stupid stocks that didn't end up going anywhere. So be careful chasing hot stocks. So stocks that are currently making headlines or being heavily promoted are often already way overpriced, and the smart money has already made their move to go ahead and exit. Because remember, it's a left to right chart. So it's about who sees it first. And inshallah, I want you guys to see it instantly. And market timing. It's nearly impossible to consistently predict the market's short-term movements. And trying to buy at the absolute bottom and sell at the absolute top is a fool's errand. And time in the market is far more important than timing in the market. So ignoring your plan can sabotage you too. Many investors or traders have a solid plan. You know what you want to do. You know what your criteria consists of, but are you following it? Okay. Panic and greed could really lead you to abandon your trade, okay, or even frustration. Just why am I not winning the trade? Not accepting the fact that you lost instead of sticking to your clean setup criteria. Okay. If you're struggling, head over to Stackmode.net, but I really do assure you play break and retest. Okay, you could wait for support to be broken, turn into resistance, or you can wait for resistance to be broken, turn into support. Okay. And that's it. Just keep it simple. Okay. Don't destroy yourself over the charts. Please keep it simple. Set a strategy. Okay. Stick to it, regardless of the market noise or whatever's happening. And investing money you can't afford to lose. Never invest your emergency fund or money you need in the next few years. The stock market is for long-term capital that you're comfortable seeing fluctuate. Okay. So opening a brokerage account. A brokerage account is a financial account where you can buy and sell stocks and other securities. Okay, you can't just go to the company and buy shares. You got to go to the broker to facilitate the transaction for you. Okay, so brokers, you can check about their fees, see about their rules, see how their support is. Okay, and then you're going to be able to get a card. Okay, certain of them, like Robinhood, for example, offer a card where you can go ahead and use your day trading profits or whatever profits that you make from the market and withdraw straight on the card. So whatever broker that you want to use, go ahead and use that. Okay. So open your broker. You can start small. Okay. Don't just dump all your money. Okay. Take your time. Make sure you know what trades you want to invest to and do your research. Okay. Even if it's worth it to spend your money on education, mentorship first, and then come into the market. Okay. This way you're not going to have to get your education by just losing over and over again. Okay. So dollar cost averaging, okay, so the most powerful strategy for beginners. And instead of trying to time the market, you just invest a fixed amount of money at regular intervals. Okay, and this ensures you buy more shares when prices are low and fewer when they're high, averaging out your costs over time. Okay, so make sure you guys know where you're purchasing. Okay, if you're not purchasing at the right time, that could really jurisdict your trade and really just sabotage certain things that you need. Okay, so focus on ETFs and mutual funds. So for your first few years, you can focus on a core portfolio of low-cost index funds or ETFs. Okay, that's going to be something to diversify too, especially as you're learning the market. So if you're new into the market, you still don't understand certain day trading while you're getting educated and stuff like that, ETFs can be something that you can look into as well too. Okay, so I wish I looked into more long-term stuff when I first started trading instead of just worrying about the instantaneous profit of like 0 DTE options. Okay, so look at long-term stuff, because a lot of the time while you're learning the markets, you can still make money in these long-term plays, and your money a lot of the times is going to be a lot safer versus you just trying to throw yourself head into 0 DTE or something like that, or futures, and then losing everything. Okay, so that's where I wish I corrected myself. Okay, so start now. Okay, there's going to be no time limit, okay, to when you can start or end trading. Okay, you can trade until you pass away. Okay, and you can start trading right now, any age, any time. Just start now. Okay, know yourself. Okay, this is why being with God is going to be really important. Already becoming humbled is going to be really important. Okay, you can't be coming with ego. Can't be coming with thinking that you're bigger than the charts. You can't be thinking that you're right and the charts is wrong. Okay, and use the right tools. Okay, TradingView, big tool. Come for mentorship. Okay, I offer a free call where you guys can learn how to trade as well too, and then I'll put a trading plan together. Okay, and patience. Okay, be patient. Even if you're making $10 from the market, okay, stack that up. Okay, and after you withdraw, so whatever amount of money that you withdraw, let's say you make $10. Okay, I like to leave 50% in my account of whatever I made, so I would only put $5 in my account. After that, 30% of whatever I withdrew needs to go to taxes. And that's how I break down my money. So I hope this presentation helped. Stay prayed to God. Keep grinding. I'll catch you guys in the next one. Hey class, today we're going to be talking about exactly what a hard fork is within the decentralized finance space. Let's go and let's jump into it. So, code, consensus, and chains. And at its simplest, a fork in the blockchain technology refers to a change in the network protocol. This change usually involves updating the software used by nodes to validate transactions and blocks. A key distinction must be made between a simple software fork, and that's copying open source code, and a protocol fork, which changes the consensus rules. So, a software fork, code-based copy. So the definition of a software fork is it copies an open source code base, for example, Bitcoin Core, to start a new, often compatible project. And the impact of it does not affect the original blockchain's history or consensus rules. It creates a new independent project. And for an example, Litecoin. It was originally a fork of the Bitcoin code base, but now it operates on its own chain. Let's talk about a protocol fork. Consensus change. And the definitions of a protocol fork is it modifies the rules that govern which blocks and transactions are considered valid on a single blockchain. And the impact of it directly affect the chain's integrity, leading to a split in the network's block history. And the outcome of it is it requires all participating nodes to update their software to maintain network harmony. And the core difference lies in the shared history. A protocol fork shares the entire history up to the point of divergence. So, the critical distinction. Let's talk about soft forks versus hard forks. So understanding the difference in compatibility is paramount to grasping blockchain evolution. And this dictates whether the upgrade creates one chain or two chains. So a hard fork, non-backward compatible. So as far as a rule change, it introduces new rules that are incompatible with the old software. And the mandate of it, all nodes must upgrade and old nodes will reject blocks created by new nodes. Okay, so all nodes must upgrade. The old nodes will reject blocks created by any new nodes. And the outcome, if the community is divided, which is gonna be caused by lack of 100% adoption, the chain will then split permanently into two separate blockchain, A and B, each with its own currency. And as far as the hard fork, the non-backward compatible system, both chains share this same history up until the block of the fork. And let's talk about soft fork. Soft forks are gonna be backwards compatible. And the rule change implemented into it is that it tightens existing rules, making a previously valid block invalid under the new rules. And mandate,
Only a majority of nodes need to upgrade, and all nodes will still accept blocks from new nodes because the new blocks satisfy the old and stricter new rules. And the outcome of it, the network effectively remains one chain, and the old chain slowly dies out as the new blocks are not recognized by the majority, forcing compliance into it. For an example, Bitcoin SegWit, and SegWit stands for Segregated Witness, and that was a classic soft fork implementation. So a lot of these things that we do know were actually fork implementations that just stuck around. So let's talk about this case study here. Bitcoin Cash, for example. Bitcoin Cash, also known as BCH, okay, the scaling schism. So the split that created Bitcoin Cash, BCH, on August 1st, 2017, it's the most famous example of a contentious hard fork rooted entirely in a debate over scalability. And the problem is Bitcoin block size. The original Bitcoin protocol restricted the block size to 1 megabyte, limiting transaction throughput to about 7 transactions per second. Okay, transaction per second can also be abbreviated as TPS, which led to high fees, also known as gas. So the term gas equals fees, leading to high fees and slow confirmation times. So that was way too slow. Okay, wasn't quick enough, and it had to get quicker. So the division, the two scaling facilities, so core devs at Bitcoin, preferred off-chain solutions like SegWit, also known as the soft fork system, and Lightning Network. Okay, BCH proponents preferred on-chain scaling via an immediate increase in the block size limit. And the outcome, a permanent split occurred. Since changing the 1 megabyte limit was non-backwards compatible, the minority group implemented a hard fork to increase the limit to 8 megabytes, later to 32 megabytes. Okay, so as technology increases and technology gets more powerful, the whole decentralized space changes. And it results in two chains, Bitcoin, also known as BTC, and Bitcoin Cash, which is going to stand for BCH, and the technical impact between the two. The hard fork ensured that any node running old Bitcoin software would consider BCH blocks, which were greater than 1 megabyte and invalid, physically separating the two chains and their histories post-fork. So let's talk about case study number 2, the Ethereum Classic, the ETC, the ethical split. So the Ethereum fork that created Ethereum Classic, ETC, on July 20th, that occurred in 2016, it was not about scaling, but about philosophy and dealing with an economic exploit. So let's talk about the DAO incident here. So the DAO incident, which occurred in June 2016, and a decentralized autonomous organization, also known as a DAO, is built on Ethereum, and it suffered a hack/exploit. So people got into it, breached the database, and it drained roughly $50 million worth of Ethereum at the time, okay, worth of Ether, due to a vulnerability in its smart contract code. So the smart contracts are going to be the autonomous system that controls the whole decentralized system. So in a centralized system, banks control everything. They can confirm whether or not transactions go through or not, and they control the reserves. Within the whole smart contract decentralized blockchain system, everything is done autonomously on a smart contract system, kind of like a vending machine. So, but hackers were able to get into that due to the fact that the security system was a lot weaker about 10 years ago from this video dropping, and it's only increasing as developers, AI, and coders notice more exploits and prevent them. Alhamdulillah, God is good. So, proposed solutions. The Ethereum community largely voted to implement a hard fork to roll back the chain history and return the stolen funds to their original owners. Okay, so they were able to roll back the history and roll back people's funds back to them. So extremely nice. God is good. So the principle of it, code is law. A minority group of community members rejected the fork on the basis of immutability and the code is law principle, arguing that interfering with the chain, even due to undo a theft, set a dangerous precedent. And we'll talk about the split. The majority moved to the chain, called Ethereum, ETH, and the minority remained on the original unforked chain, which was renamed Ethereum Classic, also known as ETC, preserving the hack history. So, this case illustrates that hard forks are not just technical. They often involve deep ethical and philosophical debates about decentralized governance and immutability. And once again, the decentralized space is going to involve no superpowers. Everything's going to be done by pretty much AI, computers, and smart contracts.
So why hard fork? Let's talk about the rationale and objectives of it. So while often continuous, hard forks are sometimes necessary for the survival or significant evolution of a decentralized protocol. They're generally triggered by three main factors. Let's talk about the first one. So they introduce new incompatible features, okay? And when major changes are needed that fundamentally alter the way transactions or blocks are structured, for example, changing the hashing algorithm, introducing a new scripting language, or integrating privacy features, the old software simply cannot interpret the new data structure. So number two, fixing critical security bugs, extremely important to keep our money safe, okay? Inshallah. So if a critical vulnerability is found that could compromise the entire network, causing a catastrophic bug, a scheduled hard fork might be the fastest way to implement a necessary fix that prevents further exploitation, often involving a protocol reset so people can get their money back if anything was lost in the first place. And they reverse malicious transactions. Controversial, okay, but could be necessary in certain cases where, once again, people are trying to take people's money unfairly. And as seen with the Ethereum ETC, Ethereum Classic, a fork can be used to bail out a network after a significant loss of funds, effectively rewriting the history of the chain to reverse the malicious transfer. And this always raises governance questions because, you know, people can just reset and roll back transactions. But if it's used in a responsible way, I can see how it could be safe. But then again, would this be centralized? Let me know in the comments below. So hard forks that are planned and implemented with full community backing, like Monaro's regular updates, are often called non-contentious hard forks. So implications for users, exchanges, and developers. A contentious hard fork like Bitcoin or Bitcoin Cash, it has massive downstream effects on the ecosystem, requiring coordination across various entities. And the user impact of it, free coins and confusion. So coin duplication. Holders of the original coin automatically receive an equal amount of the new coin on the new chain. So for example, Bitcoin holders got BCH. And wallet management. Users must ensure their wallets support coin splitting and replay protection to safely access the new coins without losing the old ones. And market volatility can also be a factor. The value of both coins often experiences extreme volatility immediately post-fork as markets decide which chain to support. And the impact of the ecosystem, let's talk about the exchanges and developers. So exchange listing. Exchanges, which is pretty much places where crypto tokens and stocks can be listed, exchanges must decide whether to list a new coin, requiring significant technical work to ensure stability and implement deposit, also known as withdrawal infrastructure, okay? And replay protection. Developers must implement measures to prevent a transaction validated on one chain from being replayed and validated on the other, and that's crucial for security purposes. And development resources. The talent pool is going to be split, potentially weakening the development resources and future progress of the original chain in the first place. So, hard forks, while disruptive, they represent the ultimate form of decentralized governance, and they're the mechanism by which communities can execute fundamental disagreement, allowing different ideological and technical visions to coexist. So, some key takeaways. A hard fork is a non-backwards compatible protocol that change based on the results, and it results in a permanent chain split unless 100% of the community upgrades. And they're often driven by three factors. 1, feature upgrades. 2, security fixes. And philosophical disagreements. Okay, for example, scaling or immutability. And some key examples of a hard fork are Bitcoin Cash, okay, over scalability, and Ethereum Classic over immutability, following the decentralized autonomous organizational hack. And they forced the entire ecosystem, users, developers, miners, exchanges to make a binary choice and adapt to a new reality and choose what's best for them. Stay prayed to God, keep grinding, head over to stackmode.net for all trading education. I'll teach you how to trade cryptocurrency. Peace. All right, I'm going to give you guys a quick introduction to DeFi and yield farming, decentralized finance, also known as DeFi, and I'm sure you've heard of DeFi if you're involved in the cryptocurrency or NFT space. DeFi is going to go ahead and be the space to where you can send currency without a middleman involved. So if you decide to send $1 billion from one person to the next, say you're in the US and they're in China, okay, you can send it with cryptocurrency with no delay.
if you're using a wire transfer system or a bank system, they can approve whether or not they want that transaction to go through. And if they think it's fraud or too large of a transaction, they can definitely decline it. Okay. And DeFi definitely moves away from the traditional banks to blockchain-based protocols. And yield farming is a key strategy within DeFi that allows users to earn rewards by providing liquidity to these protocols. And DeFi eliminates intermediaries using smart contracts on blockchains like Ethereum. So smart contracts are going to be the autonomous processes used in order for contracts to automatically process without an approval yes or no process. And yield farming emerged in 2020 with protocols like Compound, offering high APYs to attract liquidity. If you don't know what APYs is, it stands for annual percentage yields. So that means that you're trying to make money year after year by just holding it in one place. So let's say, for instance, you make $100,000, okay, and you put $50,000 into a bank account, right? You let it sit there for a year, okay? Depending on your APY percentage, let's say it's a 0.5 APY percentage, 0.5, okay? The next year, that $50,000 might turn into 50,500. Okay, so then you profited $500 just by holding your money in there, depending on the API percentage. Okay, and in DeFi, yield farming APIs can range from 5% to over 100%, but risk like volatility. So, could be a good passive investment opportunity in order to potentially gain some income. So let's keep jumping into it. Let's keep learning about it. And don't forget that everything that you do trading wise can involve risk. So make sure you guys stand prayerful to God, be humble, and don't lose yourself. Don't lose your sanity. Even if you take a risk and it doesn't go well, you're going to be straight. Run it back up again. Come back harder. Learn from your mistakes and run it back again. And what is yield farming in the first place? Yield farming is known as liquidity mining. Okay, so that's pretty much money mining. And it involves lending or staking cryptocurrencies, assets in DeFi protocols, such as Ethereum, for example. Okay, because it's going to involve staking. And staking is going to involve cryptocurrencies like Ethereum, for example, created by smart contracts. And it's going to go ahead and be staked instead of mined with POWs or power like Bitcoin is. Okay. So it doesn't do that in order to earn rewards. Okay. And it involves lending or staking instead of POWs. And typically they're coming in the form of additional tokens. Users provide liquidity to decentralized exchanges, also known as DEXs. Okay, so if you ever see the term DEXs, stands for decentralized exchanges or lending platforms, and receive governance tokens or interest as compensation. Let's talk about the core mechanisms of yield farming in the first place. They're deposit tokens into a liquidity pool, and you can earn fees from trades plus reward tokens. Okay, so once again, you can earn fees from trades plus reward tokens. Okay. And compounding. Farmers often reinvest rewards to maximize yields. So when you make some money, put it right back into the market, okay, to maximize yields, creating exponential growth potential and always having wealth being generated for you. And platforms. Popular in 2025 include Uniswap, Aave, and newer trends like Solana-based protocols. And note, yields are not guaranteed and can fluctuate based on market conditions. And in essence, yield farming turns idle crypto holdings into productive assets. And similar to farming crops, where you plant seeds, also known as liquidity, and harvest yields rewards. And history of yield farming. Yield farming burst onto the scene during the DeFi summer of 2020. Fueled by high token rewards and low interest rates in traditional finance, it has evolved significantly by 2025, with more sustainable models emerging. So as of 2020, Compound introduces comp token rewards, sparking the yield farming boom, and that's when people really started doing it. And as of 2021 and 2022, explosion on Ethereum came into play, and people really started heavily trading it. Then multi-chain expansion to Binance Smart Chain and Polygon came out for lower fees, as well as Coinbase and stuff like that. So big brokers started implementing their own networks in order for people to trade and buy the cryptocurrencies. And in 2023, 2024, the focus on risk mitigation, post-hacks like at the Ronin Bridge, leading to insured farming options. So this is bringing regulation to the crypto options. So once you guys start seeing insured stuff coming out, regulated laws, government bodies being involved, okay, that's how you know cryptocurrency is going to be heading into a positive space, inshallah. Why? Because it's going to be regulated, and that means it's going to be safe.
no scams, and there's going to be laws protecting me and you. So anyone who wants to invest, there's going to be certain laws preventing a lot of things and preventing brokers from just taking your money. And there's going to be confirmations within every transaction too. Okay, so things can also be traced. And it gives you integration with real world assets as of 2025, also known as RWAs, and new AI optimized strategies for better profitability. So some people like to trade with AI bots. I don't recommend that. Recommend you guys do your research, your own trading, but as certain things do progress, there's going to be different programs coming out over the future. And AI may not just be used just to plot out trades, it might be used to create certain programs like watch lists or stuff like that, and include on apps and stuff. So it's also a beautiful time. Alhamdulillah. So in 2020, for example, SushiSwap forked Uniswap and offered higher yields to suck liquidity away, demonstrating the competitive nature of yield farming. So they offered higher yields. They offered more money, APY, per year. So let's say, for example, Uniswap offered 6%. Okay, SushiSwap came out, and let's say, for example, they dropped 30% APY. Everyone's like, whoa, 30% return on my money per year. Let me go ahead and get in that. Okay, and that's going to go ahead and demonstrate the competitive nature of yield farming and the different tokens. So let's talk about how it works. Yield farming operates through smart contracts that automate reward distribution. Those smart contracts is, once again, the autonomous process that controls the whole cryptocurrency flow. Here's a detailed breakdown. And step 1, choose a breakdown and choose a protocol. Select a DEX like Uniswap or a lending platform like Aave, for example, and provide liquidity. Deposit equals value of 2 tokens, for example, Ethereum and USDC, into a pool. Then you can receive LP tokens. Get liquidity provider tokens representing your share. And stake form. Stake LP tokens. Stake them in a farming contract to earn reward tokens. And step 5, harvest and compound. Claim rewards and reinvest for higher APY. And this process can be automated with tools like Yearn.finance in 2025, which optimizes yields across protocols. So once again, AI is being used in order to automate certain things within the trading space and not just plot out trades, for example. But some key components of yield farming. Let's understand the building blocks, and they're crucial for successful farming. So liquidity pools. So shared pots of tokens that facilitate trades on the DEXs, and LP tokens. LP tokens are proof of your contribution to the pool, and they're used for staking. Let's talk about reward tokens. Reward tokens are governance or utility tokens distributed to incentivize liquidity. And APY stands for annual percentage yield or rate. APY or APR, very similar. Okay. Even if you just see that on your banks or something like that, that's what it stands for. Annual yield percentage or annual yield rate. And it measures potential returns, often inflated by token emissions. And automated market makers, AMS, algorithms like constant product formula that determine the prices. Okay, once again, AI is also assisting with how the flow of the market is going to be changing. Okay, so in Uniswap v3, you provide liquidity and concentrated ranges for higher efficiency, potentially boosting the annual percentage yield from 10 to 50% on volatile pairs. So yes, there's a potential that it could not work out, but if you can get 50% returns on your money, then that's something that people are willing to give a big opportunity to and try. So some strategies for yield farming. To maximize profits, farmers employ various strategies, adapting to market conditions in the current years. So make sure you have a basic strategy. Single pool farming for stablecoins to minimize risk. And you can have layered farming. Stake LP tokens in multiple protocols for compounded rewards. Okay. And flash loan farming. That's also going to be a play too. It's where you use borrowed funds for short-term, high-yield opportunities. Be careful whenever you're using margin, okay, or leverage, or any type of borrowed funds. Okay, be very, very careful. Make sure you guys are doing your research, have a solid plan strategy, and make sure you have something to maximize your risk. And risk averse. It's where you farm on assured platforms like Nexus Mutual to cover impermanent loss. And AI optimize. You can use bots in 2025 to auto switch pools based on real-time APY. And advanced farmers monitor the TVL, token emissions, and whale movements for edge. Okay, so let's talk about what TVL is. Okay, so TVL stands for total value locked. That's a crucial metric in the cryptocurrency world. and it reflects the total US dollar asset staked on a blockchain or decentralized application, also known as the DApp. Okay. And whale movements as well too. So what a whale is pretty much someone with just a whole bunch of money who's making one big giant trade or who's moving the market. Okay, just someone who has a big share or percentage of whatever token, stock, or whatever. That's what a whale is. Okay, so if you see someone put like a $5 million on a cryptocurrency play or something like that, for instance, and it's not even that popular, they would be a whale. So whoever owns the large majority would be a whale. So some risk involved in yield farming. While lucrative, yield farming carries significant risks that can wipe out capital. And permanent loss. Loss from price divergence in liquidity pools, potentially exceeding rewards. Let's talk about smart contract vulnerabilities. Hacks like the 2022 Nomad Bridge example exploited to $190 million in losses. So as time goes over, security is increasing. Laws are getting passed, so things are going to be more regulated. So a lot of things are coming into infrastructure in order to prevent big exploits and big losses from happening. Let's talk about market volatility. Volatility is how fast and quickly the market's moving. Okay, that's pretty much what volatility means when you see that in the trading space. Tokens prices can crash quickly, okay, devaluing your rewards, aka, for example, a Luna collapse, okay, where people think it's going to be the best play of all time. And then once a continuous amount of people start selling or a whale sells, people might follow along, thus crashing. Okay, once a large percentage of the holders start selling, a lot of people might follow along, devaluing the rewards and devaluing the token, thus making price fall down. And high gas fees. Okay, gas equals fees. Okay, you ever heard of gas in the cryptocurrency space? Pretty much just mean fees. And there are sometimes high gas fees on Ethereum, and fees can eat into your profit. So if you made $500, you know what I'm saying, you don't want your fees to be $70. You know, this way you're only getting $430. You want your bread. You want a lot of your bread. But sometimes high gas fees can really eat into your bread. And they're mitigated by L2s like optimism, but we're still going to be careful. God, let us hop on the charts and make some bread by clicking buttons and holding. So we're cool. And sometimes there can be some regulatory risk. And in 2025, increasing scrutiny from SEC and DeFi fields. Okay, but stuff is trying. Certain laws are still working on getting passed, and the government is still just structuring out how they want cryptocurrency to legally be applied. So for example, if you provide 1,000 Ethereum and 1,000 USDC, and Ethereum price doubles, you might face a 5 to 25% impermanent loss compared to the holding. Okay. So profitability analysis. Is yield farming profitable in the first place? Let me know if you guys are profiting in the comments down below. And it depends on your strategy, timing, and risk tolerance. In 2025, the average APIs are 5 to 20%, down from 2020's highs, but still beat traditional savings accounts that offer like 1 to 3% at most, honestly. A lot of the times on most standard bank accounts, at least in America, from what I've seen in pros. They can offer some potential high returns on your money. Once again, 5 to 20% added to your yearly money. Okay, that could stack up over time, especially if it's a savings stash that you guys don't touch. If you're just in stack mode, you're staying down, putting the bread away, letting it make itself. Okay, you're really going to be able to make some profitable plays. So it can be huge for building passive income, letting your money make its money while you grow, grind, and get some more money. Inshallah. So that's ultimate stack mode. And there's also community governance perks too. So the more percentage that you own or have, there's going to be a lot of community benefits, and a lot of community stuff just in the cryptocurrency space that can be pretty cool if you're interested. Let's talk about the cons. Not everything's peaches and creams and roses. So sometimes there can be high risk, and high risk require constant monitoring. And there's going to be tax complexities on the rewards sometimes, depending on how much you withdraw when you get paid, and depending if there's long-term tax benefits or not. Okay. And that's if you hold the trade for over 1 year. Okay. Factors. The bull markets boost profitability and bear markets reduce it. Okay, so just like traditional stock markets, it works the same for the most part. And real data. As of 2025, stablecoin farms yield 4 to 8%, and volatile pairs are 5 to 15% APY. Okay, So stable coins, you can still make some good bread. It's still a higher APY, still a way higher annual yield percentage than a lot of bank accounts. Okay, 4 to 8% is still extremely strong. Okay, and it's also going to be a consistent way to make your bread. Okay, it's not about making bread now. It's about making your bread and make bread over the years. Okay, get rich slow and it'll happen quickly, inshallah. Okay, keep praying, keep grinding, keep staying down, keep stacking up. Okay, stay down. And volatile pairs like 15 to 50% can give you a good return too. But if they last a long time, it's going to be the good question. Okay, sometimes they can involve big crashes. So just be careful. And I'd advise you guys invest in something stable. Whether you're buying stocks, cryptocurrency, or whatever, something stable is always going to be where it's at. And net profitability, okay, the reward plus fees, okay, minus gas plus impermanent loss plus opportunity cost, okay. So real world examples and case studies. Let's examine practical cases to illustrate yield farming in action. So case 1, AV lending. Deposit USDC and earn 5% APY plus AV tokens. Okay, so double benefits. Okay. And case number 2, pancake swap on BSC. You can farm cake on BNB, BUSD, LP, yielding 20% APY as of 2025. And case number 3, Yearn.finance vaults. Auto compounding strategies averaging 10 to 15% returns. Once again, some AI trading coming into play and lots of new strategies and companies implementing new ways of success or failure, inshallah. So success stories, early comp farmers. In 2020, early compound farmers earned thousands in comp tokens, which peaked at 900 during its peak. So that let people turn $10,000 of investments, for example, into millions of dollars. Okay. And some failure stories, like I said. Okay. So it's whatever God wills. Okay. It's not everything's always going to be peaches and cream. So in 2021, a bank run cost tightened to drop to 0, wiping out billions in total value and farmer funds. Okay. So just sending people's bread straight to a billion. Okay. Straight to oblivion. Okay. Straight down. Okay. So careful what you're investing in. Make sure you guys are investing in something safe, consistent, and strong that has some future value. So let's talk about yield farming versus staking versus RWAs. So I'm going to compare yield farming to alternatives for a balanced view. So yield farming versus staking. Staking is simpler and lower risk. So for example, ETH is staking at 4%, but there's lower rewards than farming 10 to 30%. So yield farming versus RWAs, also known as real world assets, like tokenized bonds that offer stable 5 to 7% yields with less crypto volatility. Okay, so there's more consistent bread over time to just go ahead and invest in. And when to choose farming for high risk tolerance and active management. Hybrid approaches like farming RWAs combine stability and high yields, so that could be a good option too. So determine what's going to be best for your bank account, your pockets, and do what you do. Do what God has planned for you. And I'm just giving you guys all the education so you can go take this and figure out what you want to invest and trade in. So tools and best practices for yield farming. To succeed, you got to use the right tools and follow the best practices. So you can go ahead and use certain wallets like your MetaMask or Wallet Connect for secure interactions, keeping track of everything, all your transactions, and keeping track of your percentage gains, etc. And analytics, DeFi, Llama, or Zapper, you can go ahead and track your annual percentage yields and your TVL, okay? Your total value locked. Okay, so TVL once again stands for total value locked. And security, you can use hardware wallets, audit protocols to avoid rug pulls. Okay. So use a hardware wallet, okay, because you're not going to be feeding to pull your bread out and go invest into something else quickly, okay? And avoid rug pulls, okay? Avoid Instagram meme coins, avoid Twitter meme coins, okay? Avoid anything that you just see and shiny eye syndrome. Do your research, do detailed research on it. See if there's any other big whales, okay? Investing into it, okay? Check out the TA, the technical analysis, okay? Check out the chart, see how it's looking. Is it at a low? Does it have upside? Okay, do your analytical research, okay? Before you hop into any type of trade, don't just take anyone else's word and take a loss for no reason. And the future of yield farming, or even take a win for no reason, because then you're not going to know why you won, you're not going to understand the structure. And say, for instance, God forbid that person were to stop posting or whatever, how are you going to make bread for yourself? So get self-sufficient. And as DeFi matures, yield farming is shifting towards sustainability and integration. And by 2030, as a prediction, DeFi can manage 1 trillion with farming and corporations, including NFTs and AI. Okay, both very, very two strong sectors within the future that we've seen in the last couple of years as of this recording in 2025. So if you're watching this in the future, let me know how progressed AI is. I'm here. And cross-chain. Bridges like the wormhole enable multi-chain farming. And there's also sustainable models. Move from inflationary tokens to profit sharing. And regulatory clarity in 2025, which means laws being passed and stuff like that, could boost adoption, making it even more profitable for compliant users, people who are just trying to be law-abiding citizens and just invest. In conclusion, is yield farming really profitable in the first place? Yes, all forms of trading can be profitable. Okay, if God puts a form of trading in your face, okay, or in your brain, if you do that, some people are millionaires off crypto. Some people are millionaires off Forex. Some people are millionaires off options. Some people are more millions off futures. Okay, different sectors you could trade. Trade what you want to do. Okay, and yield farming can definitely be profitable in any year. Okay, and it offers returns far above traditional finance, but it's not for everyone due to high risk. And success requires education, strategy, caution, and most importantly, prayer to God. Okay, humble yourself. Even when you touch that big bag, okay, just like the story of Benjamin, don't go blow it. Okay, don't go blowing that big bag. Don't go think you're mighty. Don't go think you're the best trader of all time. Be thankful, reinvest, pay your taxes, come back stronger. Okay, never think you're on top of the world. Just keep going, keep staying hungry. And you'll be profitable if you manage your risk. Okay, don't be putting all your bread into it, expecting to get some yield returns. No, pay your bills, take care of yourself, and then come back and diversify and stay informed as well too. And if you're always risk averse or expected guaranteed returns, then I don't know if you're going to be ready for trading. Okay, you can't be ready to always think that you're going to win. Okay, and you can't be expecting that you're never going to lose. Okay, you have to be okay with losing, and you have to be okay with putting some risk down on the table. Okay, do your research. Okay, paper trade, and never invest with more than you can infuse. Okay, or lose. So pay your rent, go get some groceries, do what you need to do, and then go ahead and invest and stay down. And you should be investing more than you're spending to the most part. Okay, stay down. All right, love you guys so much. Stay prayed up to God. Keep grinding. Catch you in the next one. Peace.
Quantitative tightening has officially ended, and trust me, this changes everything for investors. For the past few years, the Fed has been draining money out of the system, shrinking its balance sheet and putting pressure on stocks, real estate, and even crypto. But now, that pressure valve just opened, liquidity is flowing back in, and whenever liquidity comes back, asset prices don't just react, they move. But here's the truth that nobody tells you. The end of quantitative tightening doesn't automatically mean a bull run. It does mean volatility though. It means opportunity, and it means that the smart money is already positioning while everyone else is still confused about what quantitative tightening even is. So what does this shift actually signal for you? Expect easier borrowing, potentially higher stock valuations, stronger risk-on sentiment, and most importantly, a window of time where early positioning matters more than ever. So let's figure out how we can plant our seeds, what quantitative tightening even is, and how we can learn how to invest. Inshallah. Let's go. Quantitative tightening has ended. All right, let's go on this breakdown how it's going to affect investors and the future of everything. So what was quantitative tightening in the first place? So quantitative tightening is the reverse money printer. Okay, so you know quantitative easing, right? QE. And that's when the Fed prints money to buy bonds. Quantitative tightening is going to be the exact opposite of that. Okay, for the last few years, the Federal Reserve has been destroying money to fight inflation. Okay, printing more constantly over and over and over and over and over again. Okay, and the mechanism. Okay, so it's when they let bonds that they own expire and don't replace them. Okay, and the result of that is cash disappearing from the economy. Okay, and the goal of it all is to slow the economy down to stop prices from rising. Okay, so quantitative easing is turning the water hose on to fill the pool. Okay, and quantitative tightening is sticking a vacuum in the pool and sucking the water out. Okay, so let's head over to the next slide. So the Fed cannot suck money out forever, or the system would go ahead and just break completely. Okay, so they're stopping or tapering quantitative tightening because inflation is cooling. Okay, the job is pretty much mostly done. And let's talk about the liquidity risk too. If reserves get too low, then banks will start to fail. Okay, and that cannot happen. The whole United States economy and infrastructure is based off of banks, companies, and money flowing through business owners. Okay, an economic slowdown, okay, they don't want to cause a massive recession for pretty much no reason. Okay, so the danger zone. So imagine breaking a car too slow it down. Okay, and if you keep holding the brake after the car stops, you don't move. Okay, but if you brake too hard, you skid and crash. Okay, so right now the Fed is releasing the brake. Okay, that's all it is. So imagine braking a car to slow it down. Okay, if you keep holding the brake after the car stops, you don't move. Okay, and if you brake too hard, you skid and crash. So right now, all the Fed is doing is releasing the brake. Okay, that's it. All right, into the market. Okay, because money's no longer being deleted pretty much. Okay, so liquidity is the lifeblood of the market. It's easily how money moves around. Okay, and risk on. So historically, the end of tightening is a green light for risk assets. Okay, letting us know that there's going to be more money circulating in the economy, giving us a higher chance for our assets to head in an upwards direction, since A, more people will be investing into something with value, okay, or B, people will have more money to purchase things with value. So valuations. So with less pressure rates on PE ratios, okay, stock prices can expand and head in an upwards direction. Okay, and tech and growth. High growth companies like tech or AI companies usually benefit the most when money becomes easier. Okay, because then they're going to have more money to invest back into their company and circulating instead of having to be tight and restrictive with the advancements and innovations, especially tech and AI companies, because the whole point of tech and AI companies is to profit off of future innovation and psychology involved into it, right? Investors then stop fearing the Fed and start fearing missing out. Okay, they're like, hold on, quantitative tightening is, hold on, it's pause. What we got to do is put some risk on, put some money down on the table before market heads up to all-time highs without us. Okay, so when the Fed was selling, okay, you sold. Okay, so now the Fed is stopping. Okay, so the headwind is gone. Okay, the headwind is gone. Make your decisions, plant your seeds for your asset classes. Okay, so you don't have to struggle in the future. Okay, the market can do two things: go up and go down. It goes up and it goes down. That's it. Okay, you're not playing an intricate math problem that you have to solve every day. All you have to do, for the most part, is invest in something that has future value and hold and be disciplined with your money. Okay, fight your flesh. You can't be indulgent in things that you want to buy every single other day. Okay, stay down. Should be putting majority of your money away into asset classes. Okay, I'm not saying don't enjoy life. We are here only once. You know what I'm saying? Enjoy life, do your little thing. Okay, get you some little food, buy you some little clothes, live your life, do your thing. But it can't be that week after week after week after week after week. A lot of the time, you should just be staying down, planting your seeds for your family. All right, so over to the next slide. Supply and demand. So during quantitative tightening, the Fed was a massive seller or non-buyer of bonds. Okay, and this forced interest rates up. So quantitative tightening ending leads to less supply of bonds flooding the market. Okay, and bond prices should stabilize or go in an upwards direction. Okay, and yields should stabilize or go down. Okay, so the real world effect of everything is that mortgage rates are tied to bond yields. Okay, if quantitative tightening ends and yields drop, then mortgage rates could finally come down, making real estate and real life a lot more affordable. Okay, so the fact that quantitative tightening is being ended is a really, really good sign for the future of the economy. Okay, and this is really going to help the housing market, get a lot of people off the streets, okay, and really just help a lot of people out in the world, making life more affordable again. Okay, because we shouldn't be stressed out every single day, you know, just trying to live our life, especially when we're already grinding hard. So let's go over to the next slide. Okay, the biggest risk of stopping quantitative tightening too early is that inflation has a chance to creep and come back up, God forbid. Okay, so the mistake that happened in the 1970s, for example, right? The Fed stopped fighting inflation too soon, and it came back double the strength, ready to bite everything in the tail. Okay, banks crashed, companies crashed, CEOs crashed. A lot of CEOs and a lot of companies ended up selling their companies to other major companies to make up for the fact that they couldn't keep up with that recession crash. Okay, and the market bubble. So if market ends up going up too fast, okay, it creates a bubble that might pop later, okay? It might pop later super duper hard, and the economy will face its consequences for that. So the currency risk, okay, the dollar might weaken if they print too much, okay? If it's too much of something, it's no longer valuable, okay? If something is everywhere, it's not valuable, okay? So just think of it logically. If something is everywhere, it's not valuable, okay? But if something is scarce, it's rare, okay, it's valuable, okay? So, though we aren't printing, okay, just stop the shredding, okay? So watch the CPI, Consumer Price Index reports. That's going to be one of the most important reports that come out. That's going to determine how cryptocurrency and the stock market wants to move, okay? And if inflation ticks up, the Fed might have to restart quantitative tightening, and that would be super duper bad for stocks. So cash yields might peak, okay? Try to lock in rates or move your cash to assets, okay? Keeping your cash in that asset river, especially if the dollar weakens, then that means assets are going to become more valuable, okay? Because people have to have some type of value in something, okay? So once again, if cash gets weaker, then assets become more valuable, okay? And the quality growth of everything. So look for companies with low debt that grow regardless of the economy, okay? And it might be a good time to buy bonds before yields drop as well too, if you'd like, okay? So review your cash position too, okay? See how much cash you have and see what you can plant within your asset classes, okay? Don't be scared of the market anymore, and keep an eye on inflation data is ending, okay? Money is back, okay? It's trying to get healthier. It's trying to flow back into the markets properly, okay? And liquidity stabilizes, which is really, really good for the market, letting us know that there's going to be more money available, which means more money could be flowing into asset classes such as the stock market or the crypto market, okay? And this gives us a chance for rates to likely stabilize or drop, okay? And risk shifts from the Fed fear to inflation watch, okay? So stay invested, stay alert, keep up with the reports, stay prayed up to God, keep grinding. Make sure you guys aren't buying any assets at all-time highs, okay? I don't even care if it's real estate, okay? Even if it has nothing to do with the charts. Don't buy any assets at all-time highs, okay? Wait for the dip, buy, and catch the V sweep up, okay? Stay prayed up to God, keep grinding, and head over to stackmode.net if you guys want to learn how to invest. Peace. Class, let's go and let's jump straight into it. Today we're going to be talking about mastering financial analysis, and this is going to be the beginner's guide. So what is a financial statement analysis? Financial statement analysis is going to be the process of reviewing and evaluating a company's past and present financial reports, the three statements, to make better economic decisions. And then it involves calculating key ratios and comparing data over time against competitors. So we want to be making sure we know how to read how much is a company making, does it have a lot of debt, and are we going to be able to profit off the company due to the fact that they're putting a smile on people's faces and it's a profitable company, which is going to affect the future, and is it a company that's hiring people and nonstop making profit, okay? Because that's going to let us know that the share price has an incentive to increase. So it's going to be a comprehensive course on analyzing a company's financial health. Let's understand that the financial statements are going to be the bedrock of intelligent investing, effective management, and sound business decisions. Whether you're an aspiring investor, a business student, or a founder, these skills are going to be fundamental and imperative. So let's take a look at past performance. So you got to look at past performance to identify trends, growth rates, and recurring issues with the company. And comparative analysis, benchmarking the company against its closest competitors, peer group, or industry averages. Okay, see how it's faring up. If it's a tech company, see how it's faring up against other tech companies. If it's a healthcare company, see how it's doing against other healthcare companies. Okay, and do it like that. And forecasting, using historical data and current trends to project future financial performance. So it allows us to answer certain critical questions about a business. Once again, how much money are they making, and are they in debt? It's pretty much going to be the two main questions that's going to let us know if something's going to be a good investment or not. So the income statement, profit and loss, and measuring performance. So the income statement is also known as the profit and loss statement, and it measures a company's financial performance over a specific period of time, for example, quarter or a year, and it shows how revenue is transformed into net income. And the core structure, a journey to profit.
The statement is constructed like a ladder and subsequently deducting expenses from revenue to arrive at different levels of profitability. And the revenue sales. Revenue is going to be the total amount of money that's generated from the sale of goods or services. And this is going to be the starting point. And the first thing we want to look at is the company making money in the first place. Let's check the cost of goods, COGS. The direct cost attributable to the production of goods or services sold. And this includes raw materials and direct labor. And gross profit. Gross profit is the revenue minus the cost of goods sold. And this metric shows a company's ability to manage its production cost. And operating expense, OPEX, the costs not directly tied to the production and primarily selling, general and administrative, SG&A, and research development. And operating income, this is earnings before interest and tax, and this represents the profit generated from the core business operations. And let's talk about net income. Net income is going to be the bottom line. And net income is going to be the operating income minus interest expense and taxes. And this is the profit available to shareholders. So the key income statements, ratios. How to analyze the P&L effectively, you got to use margins to see what percentage of the revenue remains at certain profit levels. And gross profit margin is calculated by dividing the gross profit by revenue. And a higher gross profit margin indicates better efficiency in production, which means they can go ahead and scale the business up while still bringing in profit. Okay. So the balance sheet, the accounting equation. So the balance sheet provides a snapshot of a company's assets, liabilities, and the owner's equity at a specific point in time. And it's based on the fundamental accounting equation, which must always hold true. So the foundation assets, okay? Assets equals liabilities plus equity, okay? So this equation dictates that everything a company owns, its assets, must have been financed either by debt or by owner's contributions, which is gonna be the equity. So assets, they're going to be whatever the company owns. Assets are anything of economic value that can be used to produce goods or services. And current assets, they're expected to be converted to cash within 1 year. For example, cash, accounts receivable, and inventory. And non-current assets. Long-term items are not easily converted to cash. Property, plant, equipment, and intangible assets. And liabilities, they're going to be what the company owes. Liabilities represent the company's obligation to external parties. So current liabilities, obligations due within 1 year, for example, accounts payable and short-term debt. And non-current liabilities, obligations due beyond 1 year, for example, long-term bonds and deferred tax liabilities. And section 3, the shareholder's equity, okay, and that's the owner's claim. And equity is the residual, equity is the residual claim on the assets after all liabilities have been paid off. And it includes common stock and retained earnings, which is cumulative net income minus the dividends paid. So that's how you get that equation too. And so let's talk about tracking real cash. The cash flow statement is often considered the most reliable statement because it bypasses non-cash entries like depreciation and crucials found in the P&L and balance sheet, and it shows the net change in a company's cash balance over a certain period of time. So the 3 core activities, OIF, the CFS is divided into 3 sections that explain where cash was generated or spent. So 1, the cash flow from operations, CFO. This section starts with net income from the P&L and adjusts it for non-cash expenses and changes in working capital accounts. This tells you the actual cash generated by the company's normal business activities. So the key adjustment, adding back depreciation and amortization, which is pretty much going to break down expenses on the P&L, but do not involve an actual cash outflow. And working capital changes. Changes in accounts like inventory, accounts payable, and accounts receivable are adjusted here to reflect real cash movements. And cash flow from investing, CFI. This tracks cash used for investments in long-term assets or revenues from selling them. And the largest item here is usually capital expenditures, CapEx, which is the cash spent on maintaining or expanding PP&E. Okay, so interpreting CFI. So a negative CFI, right, which is going to be the cash outflow, is often a sign of a growing, healthy company that's investing heavily in its future by purchasing equipment or new facilities, looking to scale its business outcome and business income by putting all the profit back into the business pretty much. And a large positive CFI may indicate a company is selling off core assets, which can definitely be a red flag, okay? Which means they're going broke. So if a company's going broke, that's not a good sign. And it's a good sign that the stock might actually crash within a negative direction. So check a look for that. So turning data into insights. Ratios allow us to standardize financial data across companies of different sizes and asset-specific aspects of their health. Most notably liquidity, which is the short term, and solvency, which is the long term. And liquidity ratios, can we pay the bills? These ratios measure a company's ability to cover its short-term obligation using its short-term assets. Generally, a higher ratio is better, but industry context is crucial. So it's current ratio. The most common liquidity metric is it compares a company's total current assets, which is its cash, receivables, and inventory, against its current liabilities, which is its payables, short-term debt, etc. And the ratio below, let's say $1, is usually a 1 sign. And the current ratio is calculated by dividing current assets by current liabilities. So, quick ratio, the asset test ratio. A stricter test of liquidity, excluding inventory from current assets, as inventory can be slow to convert to cash. And this ratio focuses only on the most liquid assets. And the quick ratio is calculated by subtracting inventory from current assets, then dividing the result by current liabilities. So, solvency ratios, long-term survival. Solvency ratios gauge a company's ability to meet its long-term debt obligations, and whether it is financially sustainable. Excessive debt can cripple a business during economic downturns. So debt to equity ratios, DE. It compares the amount of debt financing to the amount of owner investing financing, and a high ratio indicates a company is highly leveraged. And the debt to equity ratio is going to be calculated by dividing total liabilities by the total shareholder equity. Let's talk about the interest cover ratio. It measures the company's ability to cover its interest payments using its operated earnings, the EBIT, and the interest coverage is calculated by dividing EBIT by interest expense. And a ratio of $1.5, for example, or higher is generally considered safe, but the higher is going to be better. So putting it all together, let's talk beyond the numbers. While the financial statements provide the objective data, a world-class analyst always incorporates qualitative analysis to provide context and foresight. And let's talk about the qualitative factors, the moat. These are non-numerical factors that determine the longevity and strength of a company's competitive advantage, its economic moat, and management quality. It assesses the track record and reputation of the executive team and asks, do they make rational capital allocation decisions? Are they investing their profit properly? Okay, and asking those questions is going to be a good thing to know before we just put money into an investment. And do an industry analysis. Is the industry growing or is it shrinking? Okay, tech industry as of currently in the 20th century has just been booming, for example. And what are the key competitive dynamics? Okay, is there any threat of new entrants? And what's the pricing power of it? Okay, and competitive position. Does the company have a sustainable edge? Okay, patents, brand recognition, low cost reduction, and how many smiles does it put on people's faces? And the small summary of the three statements. Okay, the three financial statements. Okay, one, your income statements. That's going to be the performance over a period, and it focuses on the profitability. Okay, for example, margins, how much money a company's making. And the balance sheet, it's going to focus on its assets, liabilities, and equity at a point in time, and it focuses on resources. And then we have the cash flow statement. It tracks cash movements over a certain period, and it focuses on liquidity and funding activities. Okay, so look at all of them. Okay, so your goal is to cross-reference the three statements. For example, if the net income, okay, is high, but the cash flow from operations is low, it suggests that the company is booking sales but not collecting cash. That's a critical finding, okay, meaning that it's sinking. Okay, so figure out what you guys want to invest in. Okay, stay prayed to God, keep grinding, and head over to Stackmode.net to learn how to trade and invest. Peace.
The real danger in the options trading space isn't the market, it's the people jumping into it with zero understanding. And options can either be one of the smartest tools in your trading toolkit or one of the fastest ways to blow up an account. And the difference comes down to one thing, knowing what game you're actually playing. Most people think that options are some get rich quick button. They might see a clip on TikTok, hear someone brag about a 300% gain, or see something on Twitter, and suddenly they're buying weekly calls or puts like it's a lottery ticket. And that's exactly why they lose. Options aren't risky by nature, but they're risky when you don't respect how they work. Let's go and let's talk about and see if options are too risky, and let's talk about the difference between a gambler and a proper trader. Inshallah. Alright, let's go and let's talk about the truth. So is options trading truly too risky? This is the prevailing myth in finance, is that options is just strictly gambling. So with options, it's a little bit different. So let's go and let's break it down. So on options, you make money based off of time. So there's going to be two directions you can either buy based off of. You're either going to buy calls, which is when you're waiting for a price to go in an upwards direction, or you can go ahead and purchase some puts, which is when you're going to be waiting for price to go in a downwards direction. Okay. Now on options, you get paid based off of predictions. So let's say for current example, a share price is at $50, right? So let's say you opened a stock and it's at $50 right now. If you think it's going to go up to, let's say, $55, okay, then you would go ahead and purchase a calls contract since you think price is going to go in an upwards direction. Let's say the share price is $50 and you think price is going to go down to $40. In that instance, you would go ahead and play a puts contract since you think price is going to be going in a downwards direction. Okay, so speculation is what they're mainly going to be used for. When speculation means that you're getting paid based off of directional bias. Okay, also hedging too. So since options contracts aren't pure ownership, you're getting paid based off time, and if your time prediction is right within a certain time period, then you'll get paid depending based off of that. So on options, you want to a lot of the times too have some time on your contracts. Once again, that's going to be one of the most important things that separates it from gambling versus actual trading. Okay, so your time matters a lot. There's going to be things called Greeks. You're going to have your delta, gamma, theta, and those determine how your profit moves. Okay, the more time that you have on your options contract, the more it's going to kind of pseudo play as a actual real investment. Okay, but if you have your options contract expiring tomorrow, the chances of a certain number hitting could be very, very skeptical. But if you have your options contract expiring in a couple of years, the chances of it hitting could be very, very likely. So it can be gambling if you make it, but it can also be a really, really good way to keep your money, let your money flow within the market and dominate the instrument by just taking advantage of the time on your contracts. So let's talk about if there are insurance policies on your portfolio, and let's go ahead and explore the mechanics of risk versus reward on options. Also, one thing on options too, options you can make infinite profit. Okay, so your profit that you can make is infinite, but your risk is going to be set. So if you pay $200 for an options contract, the max you could lose is going to be $200. Okay, but the max you could win is going to be infinite. Okay, so that's the big advantage of options too. So let's go. So just like we talked about in the last slide, what is an option in the first place? An option is a contract, not an asset itself. It derives its value from an underlying asset, stock, ETF, or index. So a call option, right? It gives you the right, but not the obligation, to buy shares at a specific price by a specific date. Okay, so if you think price is going to go in an upwards direction, then you're going to go ahead and purchase a call options contract. Okay, calls, think of picking up the phone. What do you do when you pick up the phone? Okay, you call. Okay, and then we're going to have the puts to the right. Think of putting the phone down. Okay, so call, pick the phone up, puts, put the phone down. Okay, so puts give you the right, but not the obligation, to sell shares at a specific price by a specific date. So calls is if you're betting on the price going in an upwards direction, and puts is going to be if you think price is going to go within a downwards direction. Okay, the United States stock market though is made to go up year after year after year after year. There's also laws in place such as the short sale restriction law, which kind of prevents and helps things from crashing down to zero very, very quickly. So a lot of the times on options, you might be better off playing calls since it's going to go ahead and be on the actual investor side as well too. And the double-edged sword, let's go and talk about leverage. So options provide leverage, and one standard contract controls 100 shares of stock. And this is where the risk and reward are amplified. So scenario, right? Let's say stock XYZ is at $100. So the stock investor, let's say they buy 100 shares, right? So if the stock price is at $100, in order to buy 100 shares, that would cost $10,000. Okay. And an options trader, let's say they buy one call contract, okay, with a $5 premium. So let's talk about the decimal numbers on options too. So if you ever see an options contract, let's say 2.50, you always want to multiply every options contract by 100 to get the real dollar value. Okay, so 2.50 times 100 is going to go ahead and be 250. If an options contract is 14.20, okay, we're going to multiply that by 100. That's going to equal 1420. Okay, just make it super easy. Okay, whatever you guys see, you multiply that by 100. So let's say the stock price is, or let's say the options contract is 5.70. Okay, then multiply that by 100. It's going to go ahead and be 570. And that's how you're going to go ahead and get the share price for that. Okay, so if the stock goes to $110 and you have a calls contract, then that would be a 200% return. Okay. But if you have it on shares, then that would be a 10% return. Okay. Let's just say that, for example. So if the stock stays at $100, the stock investor loses nothing. And the options trader would lose 100% of their $500 because the contract expires worthless. Okay. So if your contract doesn't move the amount of ticks that you think it's going to move within that time period, then the options contract could very, very easily expire worthless, and you would see it at a negative 100%. But when you're buying things like shares, you're actually having the actual investment and you have the ownership power within your account forever until you decide to close. And why is it risky in the first place? So options aren't inherently risky. So gambling behavior is risky, and most retail traders fail due to two specific factors, right? Let's talk about time decay, data. So options have an expiration date. Every day that passes, the contract loses value if the stock doesn't move, and stock owners can wait forever. Option owners are also fighting the clock. So a good way to counter this, though, if you do want to play some options or you see some good plays, try and play what's called leaps if possible. Okay. Leaps are going to be contracts that you're holding for like 1 to 2 years out. Okay. Try to stay away from like 0 DTEs and things like that, and use your options as a seed to plant for the future. Okay, if you're buying contracts like 1 to 2 years out, and let's say the share price is at $50, right? Once again. So if share price is at $50 and your take profit, you think it's going to go up to $60, okay? The best contract to buy would be a $51 call. Okay, and you might ask me, Chris, why would we not buy the $60 call if that's our take profit? Because on options, once again, you get paid based off of prediction, and there's going to be bonus points on option. So if the share price is at 50 and you buy $51 call, but your take profit's at 60, that's going to be a lot of bonus points versus just buying the take profit 60 contract, because then your contract wouldn't really start juicing and making good money until it gets hit. So if you buy a number before your take profit, you're going to get a bunch of extra bonus points, and it's going to hit really, really hard. Now let's talk about buying out the money, right? Try not to do that. Try not to buy cheap contracts. Also, don't forget that it's called trading. When you're winning, somebody else is losing. When you're losing, somebody else is winning. So beginners buy cheap, unrealistic contracts hoping for a lottery win, and these have a low probability of profit. And consistent losses of small amounts add up to account blowups for sure. So don't just buy any random contract thinking it's going to hit. Try and buy 1 to 2 years out, and whatever the current price is, try and buy one above if you're going to purchase a call. Okay, so if the share price is at $50, try and buy a $51 call contract. Okay, if the share price is at $50, you think price is going to go down, try and buy a $49 put contract. Okay, play it like that, buy 1 to 2 years out. The chances of you losing is going to be really, really low. And using options for safety. So professional traders use options to reduce risk, not just to speculate. So the cover call income. So let's say you own 100 shares, right? You sell a call option against them, and you collect the cash premium instantly. This lowers your break-even price on the stock, and this is safer than just owning the stock. Okay. So whenever you have enough shares of a certain stock, you're going to be able to actually sell the options contracts. Okay, and then you're going to have protective puts as insurance. Let's say you own 100 shares and you're worried about a crash, then you would buy a put option. If the stock crashes to 0, which most of the time, if it's a half decent investment, it won't, then you have the right to sell it at the strike price, and you've captured maximum loss, protecting you on really both sides and just giving you a lot more leverage on your account to manage and maneuver your money exactly how you just want. So covered calls and selling options is something you can also look into. I'm going to be dropping a video on that very, very soon as well, inshallah. But before that, let's talk about it. So let's talk about selling versus buying the premium. So the house usually wins in options, and the house is going to be the options contract seller. So the options contract seller is pretty much wanting you to do some insane decision. Okay, they want you to make the most dumb decision of all time, and then they're going to get paid off of it. So that's not what you want. You don't want to get taken advantage of, so you need to outplay them. Okay, so the statistical edge. So approximately 70 to 80% of options expire worthless. Therefore, buyers have unlimited profit potential, but a low probability of success. But if you want to see a lot more successful wins within your options trading portfolio, I recommend you guys focus on contracts 1 to 2 years out. And once again, wherever the current strike price is, buy one above or below that number in order to have that consistent value. Okay, that way you're pretty much gonna trick it into almost a shares type of play. okay, but you're getting the options profit. Okay, focus on time and stay near the current price. And sellers have capped profit potential, but have a high probability of success, okay, due to the fact that they know people are going to make some uneducated, silly decisions and destroy their account. So don't let it happen to you, inshallah. So conclusion. So risky trading usually involves buying short-term options, right? Like 0 DTEs, weeklies, etc. And conservative trading involves selling options or using spreads or buying contracts within 1 to 2 years out to define your risk in every single scenario. Really just protect your money, okay? You're not on this earth working hard for no reason. Don't go burn your money down to the ground making dumb decisions, okay? You got it. So if you're not focused on your take profit, options can definitely be a problem. If you get reversed on certain areas, the Greeks are going to really hit you extremely hard. And it's things that's happened to me. There's been times where I've been up at almost $1,000 in a day, come back later on due to the fact that I was playing 0 DTEs, come back to negatives, okay? So it's not things like that I want you guys to go through. It's extremely toll taxing on your mental when you guys are trading, and it can bring a lot of anxiety on your next trade, and I don't want you guys to go through that. So understand that they're going to be too risky if they're going to be treated like lottery tickets. So if you're buying weekly out the money calls, 0 DTE without risk management, expect those results. But they're not too risky if they're used for hedging, income generation, or if you're buying leaps, which are going to be contracts that are 1 to 2 years out. Okay, so the danger really lies in the trader, not the trade. Okay, so control your flesh, be disciplined, don't make dumb decisions, stay prayed up to God, keep grinding, protect and provide for your family, and catch you on the next one. Okay, so let's talk about how to research stocks. The best stocks to go ahead and invest in are going to be the ones that have some future value. So anything where people are going to be helped within the future, and anything that's going to put a smile on people's face, ideally, is going to be a good stock. Okay, so anything that's helping the most people, it's going to be something that's going to be the most valuable. So this is going to be a step-by-step guide to analyzing certain stocks that are going to be profitable. Let's go and let's jump into it. So why does research matter in the first place? Okay, so this goes further than speculation. So researching a stock is the cornerstone of successful investing in the first place. It allows you to move beyond speculation and base your decisions on a company's real value, rather than on market hype, such as like Instagram hype, Twitter hype, or anything like that, or a rumor, okay? And a disciplined research process helps you understand what you own, okay, and how you're gonna manage your risk. So managing your risk is pretty much gonna mean how much money you're gonna be saving, okay? How you're distributing your money, okay, and how much money you're going to be risking per trade. Okay, so that's what managing your risk is going to mean. And it's going to identify true long-term opportunities by, once again, making sure we're investing in companies that have future value invested into it. So anything that's putting a smile on people's faces, anything that's helping people, inshallah, year after year, should go ahead and be beating earnings, okay, because it's going to be making money. Okay, anything that's putting a smile on people's faces, for the most part, is going to be making money. Okay. And then when companies are making money, stock value decides to go up. And since as shareholders, we're pretty much going to be company holders, at the bottom value here, we're going to be in, let's say we get in right here, and then we can go ahead and exit at the top, right? Because we went ahead and got in before price decided to pump up super duper hard, because we did our research before, for example. So informed decisions are going to help us out. Research gives you the data needed to assess a company's health and future potential, reducing reliance on guesswork. And without research, you're simply gambling. So risk management. By understanding a company's fundamentals, you can identify potential red flags and avoid overvalue or unstable investments. It helps you quantify your risk exposure. And proper analysis helps you find stocks that are undervalued by the market, providing the opportunity for long-term growth and capital appreciation. So depending on whatever time period you're in, okay, let's say as of 2025, AI is super duper popular. Okay, so a lot of companies dealing with AI when it comes to chips, like NVIDIA, for example, are going to go ahead and be extremely popular. Okay, so whatever time you're watching this in, okay, relate it to the current sector. Okay, whatever is popular within your current sector, see what companies are advancing the future forward, and go ahead and invest into that. Make sure you're doing your TA, your technical analysis, and read the charts. Okay, try and buy certain areas that are going to
involve dips, and make sure there's some resistance above current price so you know price is something to hunt for. And keep your risk management in place. By understanding a company's fundamentals in the first place, you can identify potential red flags and avoid overvalued or unstable investments. Even if a chart is looking pretty good, if a company's fundamentals aren't good, then the company just won't work out, or a lot of the times the trades won't work out how you want them to. And it's going to help you quantify your risk exposure. So, identifying the value. Proper analysis is going to help you find stocks that are undervalued. Once again, okay, so finding undervalued stocks is going to mean that, okay, I'm going to be able to catch this low, and I'm going to be able to catch the whole sweep up into the highs before it starts getting popular, okay? But be careful when you're doing this. Don't invest into things that don't have any value, okay? And don't invest in any meme coins or any meme stocks, okay? A lot of the times things like that are not undervalued. They're valued low for a reason, and they only burst a couple times a season due to just certain events that most likely won't happen again. So a guiding compass. So in volatile market conditions, your research is going to serve as a compass, and it allows you to stay the course and avoid making emotional, fear-driven decisions within the market that could plummet your account entirely. Okay, so make sure you do your research and understand why you're getting into the trade. Make sure the technicals and the fundamentals behind the trade make sense. So, fundamental analysis. Let's talk about core financials. So, fundamental analysis is the process of measuring a company's intrinsic value by examining its financials. Okay, so you're going to see if the company is making money or if it's losing money. Okay, and you can also determine if it's profitable regarding its economic factors. So if a company is like, you know what, we're banned in all countries besides this country, that's an economic factor that could potentially drive the price in a downwards direction due to the fact that that's less sales being available, since that's less volume available to clients, since countries are being banned, okay? And it's going to help you determine if a stock is a good long-term investment by looking at a company's financial health and not just its current price. And key financial metrics. So let's take a look at the PE ratio, a common valuation metric that compares a company's share price to its earnings per share. A high PE, and that means price to earnings, okay? Price to earnings, PE, price to earnings ratio can indicate a stock whether or not it's overvalued or has a high growth expectation, while the low price to earnings value may suggest that it's undervalued, okay? And EPS stands for earnings per share, and it's a company's profit allocated to each outstanding share. And rising EPS is a sign of profitable and a growing business. And it's a key indicator of a company's profitability. And revenue growth. It measures how quickly a company's sales are affecting the company's revenue, okay, in an increasing manner. And consistent revenue growth is a sign of a healthy and expanding business, indicating strong demand for its product or services. And ROE stands for return on equity, also known as ROE. And it's a measure of financial performance calculated by dividing net income by shareholders' equity. Okay. So ROE reveals how much of a profit a company generates with the money shareholders have invested. And a high ROE generally indicates efficient management. And this ratio indicates how much debt a company is using to finance its assets relative to the value of shareholders. Okay, and that's going to be called the debt to equity ratio. Okay, so the debt to equity ratio is going to indicate how much of a debt a company is using to finance its assets relative to the value of shareholders' equity. Okay, and a high D ratio can indicate high financial risk. So charting the course, technical analysis, also known as TA, it's reading the charts. Okay, study the charts, understand the charts before you even put a dollar into the market. Okay, understand support. Support is going to be a low area where buyers are going to step in, price is going to potentially push in upwards direction from there, and resistance is going to be an area where sellers step in and price should head in a downwards direction from there. And technical analysis is the study of past market data. This is a left to right chart we're going to be reading, so anything that happened to the left is going to be relevant to the right. So it's the study of past market data, primarily price and volume, to forecast the future price movements. It's based on the idea that market prices reflect all relative information and that trends and patterns tend to repeat, which is extremely true. And while it's not a standalone solution, it can help you with the timing with your entry and exit points. Okay, so once again, understand how to read areas of support and resistance, and head over to Stackmode.net if you don't understand yet. So as far as reading the price chart, you can use the candlestick charts on like TradingView, your broker or whatever, to visualize certain stock prices movements. Okay, see where the current price is and make sure that you're either buying at a price below current price, catching a sweep up, or if you buy, let's say for instance, you buy at a resistance breakout area. Okay, either wait for a 4-hour close or wait for that resistance to be broken and turn it to support. Okay, have a strict criteria that you play, and if you figure out certain things that help you out, like moving averages, RSI, MACD, and certain things like that, that can help you read the trend if it helps you personally. So qualitative analysis, the intelligible factors. Okay, intangible. Qualitative analysis involves evaluating a company's intangible factors that are not found on a financial statement. This is more often subjective, but it's just as critical to understanding a company's long-term potential, and this is where you assess the business as a living entity, not just as a set of numbers. So check out its management teams, okay, and see if there's any, I'm going to go ahead and add this too, okay, investors slash collaborators. Okay, so check out the management team, assess the leadership experience, okay, see the vision of the company, and check out the company's track record. Sometimes a company could just be gifted a lot of money, but then not be putting in enough work, and then over time, the company starts to go down and plummet. So make sure it has a strong ethical management team with a proven history of execution that can navigate a company through difficult times, and look for past successes and how have they handled previous challenges. So competitive advantage, also known as moat. And it's what makes the company difficult to compete with, okay? What gives this company the competitive advantage over other companies? Say brokers, for example. Okay, Robinhood, okay, Hood versus like Charles Schwab, okay? So Robinhood, they have like a card, for example. Okay, Robinhood has a card. They also have instant transfer, so you can connect your debit card to instant transfer instead of waiting for a couple of days. It's easy to operate, has a cool UI. Okay, a lot of advantages over Schwab, and that's why Robinhood is just starting to blow up. Okay, so for example, like that, how is the stock beating the other stocks? What's the point of this company? And how is it helping people better than other companies? So this moat could be a powerful brand like Apple, for example, okay, a unique patent, and economies of scale like Walmart, or network effects like Facebook. And the wider the moat, the more durable the business, okay? So Apple, they have Face ID, they have unique phones. Walmart's an extremely big retail store. They sell absolutely everything, okay? Compared to like Kroger, you know, sells more stuff than that. And they also have like car repair and stuff like that too, and oil changes, etc. And Facebook is also connected with Instagram, so it's trying to just be, you know, more than a certain social media. So industry trends in market position. And is the company in a growing industry? That's going to be a big thing, okay? Is the company growing? Okay, if the company isn't growing or it's not in a growing industry, kind of just forget about it, okay? Is it a leader or is it a follower? And is the company in a declining industry that may struggle no matter how well that is managed, while the leader in a growing market has a tailwind at its back? So Robinhood, you know, trading is becoming exceedingly popular, okay? Crypto laws are getting passed, so broker cryptos or brokers that host cryptocurrency are starting to go up on the stock market as of like 2025, for example, due to the fact that it's in a growing industry. Okay, same thing with AI stocks, for example, past couple of years as of 2025. Okay, so whatever time frame or year that you're in, play and do your analysis based off of that. So reading financial statements, we'll restart. So financial statements here. So they're the ultimate source of truth about a company's performance. And you must know how to read and interpret the three main statements to truly understand a business's health. So income statement. So the income statement, it shows a company's revenues, expenses, and net profit over a period. Okay. So it's going to show you pretty much the time over a quarter or year. And the balance sheet, it provides a snapshot of a company's financial position at a single point in time. And it lists its assets, liabilities, and shareholder equity. And it tells you what the company owns and owes. And a healthy balance sheet shows more assets than liabilities. And cash flow statements. It details how a company generates and uses cash. And it's often considered the most important statement, as cash is the lifeblood of a business, and it can reveal if a company's profiles or profits are real, or just accounting entries. And pay attention to cash from operations, which should ideally be positive and growing over time. So, valuation methods, and what's it worth in the first place? So once you've done your research, you've got to determine if the stock's current price is fair, undervalued, or overvalued. And this is where you use valuation methods to track everything. So check out the price to earnings ratio, and as discussed, it's a simple comparison tool to value a company against its peers or its own historical average. Okay, so you can normally check at the bottom of your broker, trading view, and stuff like that. You can go ahead and see the company's earnings, and you can see whether or not the earnings are going to be positive and they're being beat, companies making money, okay, or if the earnings aren't being met to their expectations, okay, and the company is not making money consistently, okay. So that's going to go ahead and determine a lot of the future growth. And earnings rates can change. The company could drop a really good product and then the earnings just start being positive and the company could take a huge turnaround. Okay, so it really just depends. So let's talk about some red flags. So your research isn't complete until you look for potential problems in a trade. Okay, see what can go wrong. Okay, see what any type of weak points the stock has. And a single red flag can negate all other positive indicators. And check out if there's any insider selling. So while it's not always a negative, a significant amount of insider selling, okay, and that means executives are selling off their stock, that can be a signal that the company's leadership lacks confidence in its future. So if you start seeing that shareholders, okay, people who own the company, okay, and stuff like that start selling their shares within large flows, okay, which means like all together and stuff like that, that could indicate that they might mean that the future, or at least briefly, the future may not be too strong, okay, but not every time. They could also be taking profits, okay, and high debt. So a company with high debt load and low cash flow may be at risk during an economic downturn, causing it to crash significantly harder than certain other things. And other stocks too, like let's say Apple, for example. Apple goes through a lot of stuff with their iPhones, okay, causing their stock to crash and go down sometimes, okay, and that's because of legal and regulatory issues. Same thing with like Tesla, for example, okay, sometimes Tesla's going through legal stuff and regulatory issues, and that can make price decide to go down. So check for any ongoing or past lawsuits. A lot of times TradingView will update you with the current news, see if there's any fines going on, okay, because if the company's owed a large amount of money, that could mean that they have to pay a larger back, which means their investment time could be a bad time to invest, okay? Or regulatory actions that could impact the company's reputation or profitability. And the frequent share dilution. If a company is frequently issuing new shares, it can dilute the value of your existing shares. So putting it all together. So a truly comprehensive stock analysis combines all of these approaches into a single cohesive view. Fundamental analysis tells you the what, okay, see what sector you're getting invested in, okay, see how it's going to affect the future, and see how it helps people, okay. If the company can help people, okay, it's in a good sector, it has a place in the future, then the stock can go ahead and be decent, okay. So Robinhood is giving people easy access in order to trade cryptocurrencies, okay. That's definitely putting a smile on people's faces, okay. It's also providing things like credit cards, okay, so it's providing funding, okay. That's also something else that's putting a smile on people's faces, okay. So that's why Robinhood, as of recently, has just been blasting. Okay, certain stocks like Palantir are trying to innovate technology using AI, for example. Okay, so AI is trying to advance the future forward by having things being done autonomously. So AI stocks, as of 2025, have been a popular option as well. So investing in the future, getting ahead of the curve, is going to be a good way to make some money. So qualitative analysis, it explains the why and the competitive advantages and management that will drive the future of the company and drive the future performance. A technical analysis tells you the when and the best time to enter or exit a trade based on market momentum. And by using this holistic approach, you can make confident, data-driven decisions that will serve you well over the long term. And remember, the goal is to not predict the future, but to understand the present and make informed decisions based on facts, not on speculation. Okay, so do some strong research, make sure you're buying at clean, crispy levels, and then go ahead and take your trade based off of certain things that you believe in. Okay, so that's going to go ahead and be that.
Future trading can be a little tricky if you let it be. You only want to buy when buyers are buying. Try not to ever buy when sellers are selling. In this video, I'm going to teach you guys exactly how to trade pullbacks and how to buy when the buyers are buying and what to identify and look for. Let's go and let's jump into it, inshallah. All right, so here's going to be buying at the right time. You want to buy after sellers are done selling. So sellers need to sell first, and you want to buy when buyers are buying. If you buy when sellers are selling, you're going to go ahead and just get destroyed. Okay, if you're looking to buy at the right time, we have to wait for pullback. We have to wait for price to form an area of support. Okay, so playing pullbacks is going to be really, really important. And here's going to be the things we have to look at. Okay, one, you need to make sure that you're trading in a trending market. So if we're going to trade pullbacks, which is just price coming down, lower, and then going back up. That's all it is. So if price goes up, comes down, and then goes back up, that's a pullback. So you want to get on your weekly time frame ideally, or be on your higher time frames, such as your weekly, daily, or your monthly. And then we need to analyze the full chart. So I'm going to start off on my weekly here and get the full bird's eye view of absolutely everything. So I can see here on my weekly that price decides to trend upwards year after year after year after year, no matter what. Okay. We're still ending up at new all-time highs, regardless of how many dips that it's made. Now, the way that price works within a staircase manner. And in order for price to progress, it has to make higher lows. So that means that the new low that price just made is going to go ahead and be higher than the previous low that it made. If that's happening, then that means price is trending within an upwards direction. Okay. And you need to buy when price makes these areas of supports, also known as the higher lows. Okay, so I'm going to break down how we can time and what we're looking for. So you want to buy when market is down, so then you can profit on the sweep up. Once again, buy when market is down, so you can profit on the sweep up. So in order to do that, you have to be trading something that's trending in an upwards direction anyways. Okay, so get on your higher time frame, start off on your weekly, and look at absolutely everything. So my weekly here, I can peep. We have this low starting from 2020. Okay, and I can see here, we have not stepped back here since. And I'm on my weekly here. So I can start marking from the bottom of this low. And I'm going to go through and mark all the higher lows up until current price, just to show you that price is trending. So I can start seeing price trending in upwards direction after it hit this 21,000 area here. Then price bounced super duper heavy. Okay, made another higher low here near this 26,000 area. Price came up, topped out right here. Okay, when price tops out, all it is making the left side of the V. Then once price makes support, it's making the bottom of the V. Our job is to catch the right side of the V.
So even right here, you could see price come up, top out at this area, and then come down. After it come down, stopped right here, then bottomed up. Okay, price stopped up here. Price came down, and then bounced up, stopped right here, came down. Okay, so this is going to be a whole area in itself. Got price coming up here. Looks like price stopped towards this top, bottomed out right here, and then kept going. Right here, came up, stopped at this red candlestick, pulled down, made a low right here. Stopped up here, pulled down, made a new low right here. Okay, then over here, price decides to get underneath the lows. Okay, made a higher low right here. So even though we fell all the way down right here, it's still higher than this low right here. Okay, so that's good. So this higher low is still valid. Price was deciding to come in the cut here. Decided to bounce at the same area twice. We just still see price just trending, doing his thing. Try to make a low here. Kept trending up, kept trending up. Price came down. Okay. And this low is still higher than this low here. So we're still in an uptrend, regardless of how hard we're dipping. We're still in an overall uptrend. This low right here. This low right here. Low right here. We can see price heading in upwards direction. Okay. Now, what is price hunting? Price is hunting these areas here. These areas of resistance. These are going to be the areas that price are hunting. Price can't make new all-time highs unless price breaks previous areas of resistances. So after market decides to pull back, okay, your take profit, ideally, a lot of the times is going to be an area of resistance above current price or an area of support above current price. So you want to wait for price to pull back, wait for sellers to stop selling. And once you've identified sellers have stopped selling, which you'll see, and a good indicator to know that sellers have stopped selling is going to be on either your daily or your 4-hour candlestick. After you see a candlestick make an abrupt stop on your daily and 4-hour, pay attention to the next candlesticks. If you're looking for a long trade, if price action decides to randomly stop in the bottom, and then you start seeing multiple green candlesticks going in upwards direction, then you know buyers are going to be buying. And ideally, you're going to be looking for around 2 to 6 daily or 4-hour candlesticks after an area of support was created. If you see 2 to 6 daily or 4-hour candlesticks going in an upwards direction after it makes an area of support, then that's how you know it's going to be true. Okay, and you want to be looking on your daily or your 4-hour. And you're going to be looking for 2 to 6. So even take this low right here, for example. Price decided to make this super low right here. Okay, and so here's the super cool thing. Market does all the work for you. You don't got to do too much. You just got to chill. Be patient. Okay. Pray to God and just live your life. So boom. Market made the left side of the V for us right here. Market came down. Sellers were selling. Boom. Made an abrupt stop. Okay. And here's how you know if it's true. The candlesticks afterward were multiple green candlesticks. So after that abrupt stop, I have 1, 2, 3, 4. Okay. So I went 4 green candlesticks on my 4-hour here. Okay. And then even on my daily, I would have had 2 green candlesticks. So at the bottom, and then I had 1, and then I could have entered on this candlestick here and caught the rest of the resistance fill. So let market make the left side of the V. Let market make the bottom of the V. And you could see if the bottom of the V is real, knowing and seeing what candlestick come afterward. Okay, take this example. You see price trending in a higher low scenario here. You see this low right here. Okay, price bottomed out. I'm on my daily candlestick right here. Okay, I'm on my daily. After it bottomed out right here, I'm looking for 2 to 6 candlesticks, either on my daily or my 4-hour, So I can see price made the left side of the V up here. It's about patience. It's really about patience. Market decided to come up, top out right here, and then fell all the way down right here. This is how I know that the bottom is real. Okay, I paid attention to the candlesticks afterward. Okay, so after this bottom got created here, and sellers were done selling, you could see 1, 2, 3, 4. Okay, 4 candlesticks, and as soon as we got to like this upwards direction, I would have liked that. So I probably would have entered around like right here. Stop loss below the daily candlestick supports. And then take profit at previous resistance from where price decided to fall down from. Okay. Because I could see price already made the ultimate support, and all I did was catch the higher low entry. So let's go and let's do a fresh example here and see if I can find the setup. So I'm going to pull up the micro Bitcoin. Let me analyze from start to finish. So I'm going to get on my weekly time frame here. Okay, great looking thing I'm looking at here, because we're not at all-time highs. So that's why it's a great looking thing. If you're at all-time highs, you can't long. Okay, you cannot long at all-time highs. Don't do it. Okay, because price always wants to be chasing an area of resistance above current price. That's going to give a reason for buyers to step in. If there's no resistance above current price, there's no reasons for buyers to step in. So only play pullbacks, okay? Because then you're going to be buying when buyers step in. It's going to be extremely, extremely simple. So buy after sellers have sold. So I can see here from all-time highs, heavy aggressive selling has been coming into place these last couple of weeks. Okay, extreme selling to the downside. We met up near this area of support here. Okay, met up near this area of support here, and we're gonna go ahead and see what this is gonna entail. So on my weekly here, we have a red candlestick. Get on my daily here. So on my daily here, start seeing price try to curl up, but it's a lot of mixed match candlesticks. A lot of green, red, green, red, green, red, not the same color. Okay, if these were just straight green candlesticks for the most part, heading in upwards direction, then it'd be a lot more definitive. But in this case here, it's very, very spotty, not direct big candles. Right after like this low, for example, okay, heavy green candles, 1, 2, 3, 4 heavy green candles. Even after this one, kind of, we had a heavy green candle here, had to run one. But then after this higher low, straight green candles. This one here, we hit this low, and then a green candle, then a red candle, a green candle, and then kind of a doji, and then a red candle. So this one, I don't believe is fully ready yet. We could see this could be a higher low in the formation, and then we could see if maybe this low wants to hold or something. This low right here. Price seems to be trying to find itself some support here. Okay. So this is why we scale down to our smaller time frames, just to see things a little closer. So we're gonna go ahead and have this. We have this super low here. We got a higher low than that. So as you can see from this higher low, the V did get filled in from right here. So that's really good. So we'll see about this V. All right, because we're looking for a setup right now. So on the 4-hour here, I see price. I actually like this a lot, honestly. Even if I don't take it to all the way up there, this area of resistance will be fine. Same thing with this area here. Okay. Even if I wanted to just take it to this one up here, that'd be fine. So I like this a lot, actually. This is what I've analyzed. Is price making higher lows recently? Yes. Bottom, up, pause, down. Okay, and the pause that it made down is higher than the previous pause. So this high is higher than this low. Higher lows mean staircase trending in upwards direction. Okay, and we're buying after sellers sold. We're buying after all-time highs dump. So I like this a lot. Okay, I see higher lows being in place, and I think this is a new low being in place. Why? Because I have one area of support here. And guess what? I also have a whole nother candlestick. It has me so excited right now. Boom. Whole nother candlestick. Boom. And I'm on my 4 hour here. Here we have 1, 2, 3, 4. 4 green candles headed in an upwards direction. So get on my daily here. I could wait for one more daily candlestick to be green. Like if this daily candlestick closes green, then I would feel comfortable for sure taking it up to maybe like at least this resistance up here. Honestly, I won't be scary. Play big, take profits. I would at least take it up to this resistance up here for sure. So I need at least one more. I'm gonna be patient though. Patience is everything. Don't just get in and be like, oh, higher lows, because sometimes your lower time frames could be your worst enemy. So on my 4 hour, do I like it? Yes. But we don't tunnel vision. You know what I'm saying? We need the real thing in life. So boom. Have this super low being made, higher low being made, and then another higher low being made. Okay. So I have 4 green candlesticks on the 4 hour. I like it a lot. Okay. I'm going to decide I'm going to close all the way up here at these 2 areas of resistances. Right here. This is where I want to close. Okay. This is the strong area of resistance. You see how price marked it and hit it twice? Definitely not for no reason. So strong area of resistance, price has beef with. So what I'm going to go ahead and do is you can either do this too. But yeah, you can analyze your higher lows. And I can get on my 15-minute here. Four-hour. Okay, so either going to be looking for like a tiny little 4-hour wick. Okay, because right now the 4-hour candlestick is red. So right now selling is in place. Okay, so I only want to buy when it's buying. Okay, so right now it's making a little mini V. So I believe this is the top of the V right here that it's making with these 2 resistances. Let's get on to the 15-minute. You see these 2? Okay. So you want to remember, you do not want to buy when price is selling. So you would not buy right now on the 15-minute and the 4-hour. Price is heading in a downwards direction. But overall, we're in an uptrend. Okay, but you want to be buying at the right time, though, is the thing. You want to be buying at the right time. So right now, sellers are in place, but overall, buyers are in place. Okay, so to get that specific entry, you can scale down to your 15-minute, be like, okay, I could see these 2 areas of resistances. That's why price is falling down. Once you start seeing green candlesticks, or once you start seeing a green candlestick on your 4-hour or your 15-minute, then a lot of times that's how you know buying will be ready. But right now it's falling down from an area of resistance. I need to wait for these, wait for this candlestick to go from red to green to show me that buying is real again. Okay. I do not want to buy when selling is occurring if I'm trying to buy a pullback. That's just not what I want to do. It's not what you're going to be looking for. It's called a pullback for a reason, because you're expecting it to go back up and it's just pulling down for a second. So right here, sellers are in place. Red candlestick. Price is heading down even on the 15-minute. Okay, now if I'm on my 4-hour and I get a red to green candlestick, then I would feel a lot more comfortable with going ahead and to enter. Because price might want to honestly fall down a little bit lower. I could get a little bit lower entry and save myself on some drawdown. But if this red candlestick were to go from red to green, that means buyers were to go ahead and be in place. And then from there, I should be able to go ahead and you can have your target all the way up there, for example. And then, you know, you could do your stop loss under here. And this would be, give me about a 1 to 3. Okay. So this would be about a 1 to 3 here. Extremely profitable trade. Really nice trade. So catching your setups is about taking your time, really. It's about just seeing what you need to see. So I'll do one more setup here. So I head on my weekly. And I'll mark out all-time highs, because this is going to be the most obvious place that we've recently fell from. So I'm on my weekly. Okay, not quite all-time highs. It's going to be over here. It's exactly what we get on the weekly. You want to zoom all the way out, see all the price action you can. That's going to be all-time highs. Then from there, I'm going to go ahead and put a line down at this new area of resistance here. Okay, the area of resistance where we're recently falling down from. I could see price making higher lows. Price has a super low here. And I could see higher lows being put in over time, which means that we are headed in a upwards direction. Okay, we're trying to get up here to all-time highs. So this is what I analyze here on my weekly. So on my weekly right here, the current candlestick is red. So we would not be buying right now. Okay, we would not be buying right now because we're currently selling at the moment. So we want to see if there's any reason why. Yep, I can see exactly why we are selling. So try and analyze why price is doing it, what it's doing. It's price doesn't just do stuff randomly a lot of the times. As you can see on the weekly, I have this area of resistance here. You'll be able to see it a little clearly on the daily. This area of resistance is linked to this new area of resistance that just got created. So that's why price is falling in a downwards direction, logically. Now let me head over to my daily here. I'm going to be able to see the curl a little bit closer here on the daily. Okay, price at the area of resistance that it matched with over here. Okay, price did some break and retest. Price came down and then wicked back up to the specific black line and then tanked down. Okay, so this is a very, very nice area of resistance that price likes. So we need to get back to this area though. So now this is so simple. It's the easiest way to play pullbacks. Just wait for sellers to sell first. So you can see that's why sellers are selling. Price at an area of resistance. So right now sellers are selling straight red candlesticks on my daily time frame with it right now. I'm waiting for price to bottom out. Okay, and this is the easiest way to not get faked out. So people got faked out on this candlestick, for example. And let me head over my 4-hour. Okay, so this candlestick right here, people bought this. And price decided to wake up, and people probably thought they caught the ultimate bottom. You never want to try and catch the ultimate. Okay, you want to catch the high or low entry. So check it out by staircase. You see how this low's here? And then you have low. Then you have this low. If I zoom in, I have this low. This low. This low. This one. Okay. So we could see price dumping in and making each of the higher lows. Go ahead and start it from all the way over here. Got price all the way down here. Support. Higher low. Another higher low. Price continues to just go in an upwards direction. Okay, we got these areas of support here. Mixed with this one. Mixed with this. Trending. All we're doing is buying the bottom, higher, low entry. Exactly, yes sir. That's all we got to do. Just buy the bottom entry. See how these two supports over here are correlated with each other? Very, very cool. Let's check this out. Check out this higher low right here with the recent higher low that we just did. And then we're still trending in the upwards direction here. I'm on my 4-hour right now with it. You can see we came down a little bit. Still, this low is higher than this low. And then we decided to trend up again and continue the higher lows. As you can see, we're filling in multiple V's. Each one of these pullbacks are a trade. Each one of these pullbacks are a trade. Boom. Pullback. Pullback. And it's the same parameters every time too. No. So boom, pullback. So now we just need price to bottom out at an area. And we need 2 to 6 green candlesticks. And once I start seeing that and price filling in the right side with some green candlesticks going up, I'll catch the right bottom. Okay. But right now, I'm going to wait. I'm going to wait. People probably got burned right here with these candlesticks. Yep. But if you get on your daily here, we only have 1 candlestick. So this is why you need your daily. This is why I say 2 to 6. So that's why your daily and your 4-hour is really important. You can't just tunnel vision on your 4-hour. You need 2 to 6 candlesticks on your daily and or your 4-hour. Okay, so right here, it was only what, one green candlestick on the daily probably, and then another one open red. So if we have one green candlestick on the daily and another one open green and we're heading in an upwards direction, I'm taking that. Stop loss below the lows, taking it to the highs. Gotcha. So a lot of the times I'm overnighting. So I'm always overnighting actually. So each one of the setups I'm overnighting because I can just focus on my higher time frames, which is the real bread and butter. And yeah, and that makes it really, really easy. And that's going to be how you can play pullbacks.
So what's the difference between major, minor, and exotic Forex pairs? Let's go on and jump into a class. So an introduction to the Forex market. So the foreign exchange, also known as the Forex market, is the largest financial market in the world, with the daily trading volume exceeding 7.5 trillion as of 2022. So this is a pretty recent study. It operates 24 hours a day, 5 days a week across major financial centers like London, New York, Tokyo, and Sydney. And it's a decentralized market where currencies are traded over the counter. And it involves speculation on currency, and speculation is going to pretty much mean to where traders can get paid based off of directional bias on currency value fluctuations driven by economic, political, and geopolitical events. And participants include banks, corporations, governments, hedge funds, and retail traders, which are just single individuals. So let's go on and jump into the classifications of the currency pairs, their characteristics, and how they impact the trading strategies. Let's go. So what are currency pairs? In Forex trading, currencies are always traded in pairs because you're essentially buying one currency while selling another. The first currency is the base. So let's say, for example, USD, okay? And the second one is the quote currency. So the first one here is going to go ahead and be the base. So USD before the slash is going to be the base currency. And the second one, okay, is going to be the quote currency. So let's say Euro. Okay, so let's say you were trading USD Euro. The first term, USD, is going to be your base. And then the second one is going to be your quote. So an example, for example, here in Euro USD, then Euro will be the base and USD would be the quote. And if the pair is at 1.10, it means 1 euro buys 1.10 US dollars. And currency pairs reflect the relative value and are influenced by interest rates, inflation, and economic data releases like GDP and employment reports. And understanding pairs is crucial for risk management and profit potential in trading. So for example, if you believe that the euro will strengthen against the US dollar, you go long on Euro USD. Conversely, if you think it'll weaken, then you'll go short, okay? And long means price is going to go in an upwards direction that you speculate, and going short means that you think price is going to go in a downwards direction. So that's some categories of the currency pairs. Forex pairs are categorized into 3 main types, okay? Based on liquidity, trading volume, and the economics involved: majors, minors, and exotics. So majors, they're mostly traded and involve the USD and major economies. And minors, they cross pairs without USD and still for major economies. And exotics involve emerging or smaller economies. And these categories help traders choose pairs based on their risk tolerance and strategy. So major pairs, here's the definition. Major currency pairs are the most liquid and widely traded in the Forex market. They always include the US dollar paired with another currency from a major global economy. And majors account for about 85% of the daily Forex volume. And the US dollar dominance due to the US economy size and the dollar's role as the world's reserve currency. And high trading volume leads to tighter spreads, okay, which means you're going to be hit with less fees whenever you do close or sell off your trades, and better execution, which means you're going to go ahead and get filled. So when you click buy, you're going to go ahead and be entered in the trade, or sell, you're going to go ahead and be exited out the trade. And major pairs are traded heavily during the overlapping sessions like London session or New York session. And New York session is from like 9:30 a.m. to 4 p.m. Eastern time, okay? And in between that, London session overlaps. So London session ends at 11 a.m. But due to the fact that New York session opens at 9:30 a.m., there's going to be time where New York session and London session are going to go ahead and overlap. And major pairs are going to be ideal for beginners due to their predictability and abundant market analysis available with so much data And we know this is a left to right chart. That's just how it works. So examples of major pairs. Here are the 7 most common major pairs. Euro USD. So Euro/US dollar is the most traded pair globally, has the most volume, has the most money running through it, and has the most people trading it. So USD JPY stands for US dollar and Japanese yen, and it's known for carry trades. GBP/USD, that stands for British pound. So GBP stands for British pound. Okay. /US dollar is volatile due to the UK politics. So the United Kingdom politics really affect the pair GBP/USD. And USD/CHF, okay, US dollar/Swiss franc, it's a safe haven pair. And Australian dollar/US dollar, okay, it's commodity driven. And USD/CAD, US dollar/Canadian dollar, it's oil influenced. Okay. And New Zealand dollar/US dollar, it's very agricultural focused. And detailed example, so Euro USD, it's influenced by ECB and Fed policies. And for instance, if the Fed raises rates, USD strengthens, pushing Euro USD downwards. So some characteristics of major pairs. Majors exhibit specific traits that make them attractive. Okay, so high liquidity. Major pairs is really going to be a spot where trades are going to be able to take place quickly. So if you click buy, you click sell. Since there's so much liquidity, aka people trading or money being flowed into it, when you click these buttons, you should be filled pretty quickly. Okay, so high liquidity. They're easy to enter and exit positions without price slippage. Okay, and more stable. Okay, but can spike on news like non-farm payrolls. And tight spreads, often around 0.5 to 2 pips, reducing the trading cost. And there's going to be abundant information on major pairs, extensive coverage, a lot of government information, economic information, etc., affecting the price. And there's going to be extensive coverage from sources like Bloomberg and Reuters, for example, and different correlations. They often move in tandem with the stock markets or bonds. And these characteristics allow for scalping, day trading, or long-term position holding. And advantages of trading the major pairs. The pros include some lower risk due to the stability and liquidity. They can be cost effective, they have minimal spreads and commissions, diverse strategies are going to be able to play within them. They're suitable for technical and fundamental analysis, so when you put news and charts together and your TA together, technical analysis, then it could be a really good way to make some money, inshallah. But not without risk, be careful. And global impact, you can react to worldwide events providing opportunities. So for example, during the COVID-19 pandemic, majors like USD JPY saw safe haven flows, creating a predictable trend. And so disadvantages of trading major pairs. So some cons to consider. Lower profit potential. Less volatility means smaller price swings. And high competition. Crowded trades can lead to reversals, and new sensitivity and sudden announcements can cause whipsaws. For example, in 2016, Brexit, okay, which was something that involved the European Union, it caused GBP, okay, which is the British pound, US dollar/US dollar, to drop 10% in one day, catching many traders off guard. So even if you were in a good position, due to the fact that you're trading something that's based off of economic news, can still be subject to certain drops or certain uprises. So be careful. Make sure you have your stop loss set, and make sure you're trading within your risk parameters. Trade within 1 to 10% of your account. So the definition of minor pairs are going to be known as cross pairs, and they consist of 2 major currencies, but exclude the US dollar. They represent about 10 to 15% of the Forex volume and are traded between major economies, and they're derived from majors. For example, European/GBP is influenced by European USD, and GBP/USD reflects regional economic dynamics without USD influence. And USD stands for, once again, US dollar. That's going to be the fiat currency used in the United States. And they're more active during European or Asian sessions. And miners often offer diversification from USD-centric trades. And some examples of minor pairs. Some common miners include Euro/GBP. Now remember, minor pairs do not include US. Okay, so minor pairs are going to be Euro GBP, Euro AUD, which is going to be for Euro Australian dollar, GBP JPY, that's for British pound Japanese yen, AUD JPY, Australian dollar Japanese yen, Euro CHF, that's Euro Swiss franc. Okay, so CHF equals Swiss franc. Okay. And euro GBP is euro British pound. And then we're going to have CAD JPY. CAD is Canadian. And JPY is Japanese yen. So for example, with GBP slash JPY, known as the guppy, it's volatile due to the carry trade interest rate differentials. So some characteristics of minor pairs. So minor pairs have moderate liquidity, less than majors, but sufficient for most traders. And they have higher volatility. They have more price swings than majors due to the fact of certain parameters. They also have wider spreads. It can consist of typically 2 to 5 pips. Okay, so low liquidity is also going to lead to wider spreads. So be wary of that too. And they have a regional focus, influenced by local news. For example, European data for European pairs and correlations, often inversely related to US dollar strength. And they're suitable for intermediate traders seeking more movement. And pros and cons of minor pairs. Advantages: higher volatility for profits, bigger moves in shorter times, and they're used for diversification too. So you can avoid the USD exposure. Let's say the US economy is going through something, then you can trade minor pairs. Some disadvantages: they have higher cost and wider spreads eat into the profits. So let's say you made $200, okay, on your trade, the spreads would go ahead and make it like 184, for example, okay? So this way you're going to be down like $16, something like that, okay? So they also have increased risk too. They're more unpredictable during off hours as well. And during 2022 for inflation, for example, Euro slash GBP fluctuated wildly on the ECB versus BOE policies. So once again, any big economic news that occurs is going to go ahead and affect the price. So be wary, have your stop loss set. Stop loss is going to be an automatic order that cancels out your trade for you, so you guys don't lose money for no reason. So exotic pairs, here's the definition of that. Exotic pairs are a major currency, usually USD, with a currency from an emerging market or smaller economy. And they normally have low trading volume, making up less than 5% of the market. And emerging economies like Brazil, South Africa, and Turkey are going to be involved. And they have high sensitivity to local events like elections or commodity prices. And they're traded sporadically, with liquidity peaks in specific time zones. And exotics are for experienced traders who are willing to take higher risk, who believe in the future of a certain country, for example, or smaller companies' progression. So some examples of exotic pairs: you're going to have USD slash TRY. That's going to be USD slash Turkish lira, okay, for Turkey. So USD slash MXN, USD slash Mexican peso, so the US dollar and the Mexican peso. USD slash ZAR, the US dollar slash South African rand. Okay, it's going to be South Africa's currency. Euro slash Turkish lira, so the European Union currency can be traded with the Turkish currency. And USD slash THB, the US dollar and the Thai currency, the baht. So THB is going to be representing Thai's currency for the baht. And USD SGD, okay? That's going to be for the Singapore dollar, okay? So SGD is going to be Singapore dollar. So for example, USD TRY, it's highly volatile due to the Turkish inflation and constant political instability. And certain other countries too that have not a stable government can be subject to certain volatile price action fluctuations, so be careful. So some characteristics of exotic pairs. So some distinct features, class. They normally have low liquidity and they're prone to slippage and gaps. And they have a high volatility, and large swings can happen depending on the news. And that can be a good thing or a bad thing, because they can throw off your technical analysis depending on just certain events. And they have a huge spread when it comes to fees, and they have up to spreads of around 10 to 50 or more, okay? Which could mean that if you make like $200, you could be getting like $100 back, depending on the certain amount of spreads. So be careful. And local influences, commodity and politics dominate, okay? And certain governments are going to be corrupt. And higher swap rates, overnight costs can be significant. And this requires deep research into an emerging economy and see if they're actually improving. And some pros and cons of exotic pairs. Advantages: they have high profit potential, and volatility allows big gains. And unique opportunities, okay, less crowded markets. And some disadvantages: they have high risk and sudden devaluations possible. They can be expensive, as wide spreads and low liquidity can make certain things not work out. And limited data can be harder to analyze too. And the 2023 USD/ZAR surged hard due to the fact that South Africa decided to invest heavily within energy business. Okay, so surge hard due to the South African energy crisis. So if you make a good investment and the economy starts improving, you could potentially make some good profit based off of that. So the key differences. So comparing the three. So liquidity, majors are going to have the most, then minors, and then exotics are going to have the least. And volatility, exotics are going to have the most due to the fact that they're going to be the most unstable, then minors, and then majors are going to be the most stable. And spreads, majors are going to have tight spreads, so you're going to get most of your money. Minors and exotics have wide spreads. And trading volume is high for majors, low for exotics, due to the fact that majors are more trusted, more news, more data, and risk levels are low for majors and high for exotics. And you could choose based on your experience and goals. And once again, I'm not saying one is better than the other, just do your research before you trade. And liquidity explained. Liquidity refers to how easily you can buy and sell without affecting the price. And majors have extreme liquidity with minimal slippage. And minors can be good but thin out after off hours. And exotics can be poor, leading to higher costs due to the fact that slippages can be destroying you. So I would think different about trying to swing trade or trying to day trade exotics, I would maybe swing trade. And during low liquidity, exotic pairs like USD TRY can gap up like 100 pips on news. So be careful. And volatility explained. Volatility measures price fluctuations in the magnitude. So majors have an average daily range of around 50 to 100 pips. Minors move around 100 to 200 pips with more opportunities, and exotics can move 200 plus pips with high risk to reward. Not saying one is better than the other, do your research. And use tools like ATR, average true range, to measure if you want. And here's what spreads are. Spreads are going to be the difference between the bid and the ask prices. A lot of the time, the ask prices is what you're going to be buying at, and the bid prices is what you're going to be selling at. And majors have a 0.1 to 1 pip on average. Minors have 1 to 3 pips, and exotics have 5 to 20 pips or more. And a 10 pip spread on exotics means you start 10 pips in the red. And trading strategies for each. Tailoring strategies. Majors, okay? You trend and follow. Following the trend is really going to depict what you want to do on the majors, okay? And news trading. And minors, they can carry the trades and have different range bound systems. And exotics, okay? They have fundamental analysis and different long-term holding. And always use stop losses and position sizing. And some real-world examples. Applying concepts. So major. European/USD. During the 2022 Fed hikes, the USD strengthened. And minor. GBP/JPY in 2023, volatility from BOJ, policy shifts. And for exotic, USD/MXN during the US-Mexico trade talks, swings on tariffs. Okay. So different examples like that can be used. So for example, for a major pair, in this scenario, let's say you're trading USD/JPY during a risk-off event. Japan's yen is a safe haven, and in 2022 market crash, the USD/JPY dropped from 1112 to 101 as the yen strengthened. And the strategy, short USD/JPY on the stock market decline, and you ended up outcome with profitable low spreads, since it's a major pair. And exotic pairs risk. Let's say you're trading USD TRY during a Turkish lira crisis. Okay, may God bless. Okay, in 2018, let's say TRY depreciated 40% against USD due to inflation and politics going on. And strategy, then you could long USD TRY if you wanted to, but wide spreads cost extra. And with high rewards but overnight swaps, eroded the gains. Okay, so exotic pairs, even if you make a really good trade, fees, spreads, and stuff like that could just wipe away the money that you make. And the whole purpose of putting on a good trade. So in conclusion, major, minor, and exotic pairs is the key to successful forex trading. And it starts with majors, you can graduate to minors, and approach your exotics cost sheets. You can practice on demo accounts and stay informed with economic calendars. Stay prayed up to God, keep grinding. Put any comments below. I'll catch you guys in the next one. Head over to Stackmode.net if you want to trade forex or anything trading related. Peace.
Yo! Back. Another episode of Coop Talk. Chilling out right now. I pray you guys are doing well. We're going to talk about the trade journal. Make sure you guys get you one. It's important. It's imperative for success
You got to know what type of trade you're even looking for before you even enter in. You got to know where you're going to close. You got to know why and where you're entering. Why and where you're entering is a really key and imperative part to being successful on the market. Okay, you can't just buy to buy. Whether it being a technical decision, whether, let's say, price is in an uptrend, right, for an example, and you see price making higher lows, you're going to want to go ahead and close at an area of resistance where price decided to fall downwards from. Okay, and if you see higher lows being made, then you can go ahead and assume an uptrend is in motion. Okay, so if an uptrend is in motion, you would take your uptrend, you would take your long setup, okay, since you think market's going to go in an upwards direction. Breaking it down logically, okay, breaking down each trade, why you're getting in, how you're going to get in, okay, whether be it you're on futures, make sure you have enough margin so you don't accidentally blow your account and you owe the broker money and stuff like that. Make sure on options that you have enough capital before you get into the trade, and make sure you know what broker you're going to be using, stuff like that, etc. Don't hop in a rush state like, oh, market just opened, let me go ahead and hop in, and you're trying to decide if you're going to use one broker today or the other because you got money in both, and making just bad decisions. Okay, please write them down. Write them down. Okay, write down your steps that you take before you enter a trade. Okay, if you're going to take a long setup, you see higher lows forming, write down the setup criteria. 1, on your higher time frames, is market at all-time highs. Okay, if not, okay, ask yourself, is market in a pullback formation? Is market making higher lows? Does market have room and buying pressure to go back in an upwards direction? Write that all down in your journal, especially if you're a beginner trader. Breaking down all of your notes and understanding the perspective of why you're getting into the trade really helps you at first. Okay, it really, really, really helps you at first, and you got to progress in certain ways, and in order to do that, you have to break it down. You have to break it down. So, talk about stop loss. Write down every single time that you set a stop loss, write down why you're going to close at that area. If you're taking a long setup and your stop loss is at an area of support, okay, talk about if that area of support gets invalidated, then what's the next plan? What's the next stock that you're going to go ahead and trade? Okay, what's the next type of setup? Or you're going to go ahead and be patient and wait for a reset, wait for market to reset and catch a new trade if that old one didn't work out. Okay, it's really important to be patient, and writing it down and strategically formulating your plan is what's going to give you the advantage versus other traders. People hear the term trading and forget that you're competing against other people. When you're trading money with another person, which means that when you're winning, somebody else is losing, and when you're losing, somebody else is winning. Okay, so it's really important to be making the correct and right decisions, and your discipline and your structure is what's going to keep you profitable. You got to wake up, pray to God, work out Monday through Friday, because you can't be having cortisol, anxiety. You can't be going through certain phases of desperation while you're on the charts, because it will hold you back. And these are things that held me back in the past before I was able to conquer it, thank God. So I don't want you guys to go through those hard issues of, oh man, I got to pay for this. Let me go ahead and over leverage just so I can hit this trade. Or I just lost a whole bunch of money. Let me go ahead and double my leverage so I can make it all back. There's no such thing as making it all back in the trading world. Once the money is gone, it's gone. Okay, now if you grow your account to a bigger size, amazing. But don't think, oh, I got to put on a trade to make this back. Don't ever think that way. And write down in your journal your risk management parameters. Write down, okay, I'm going to be risking 1 to 10% of my account per trade. If I'm risking 5% of my account per trade, that's 25 trades before I blow my account. That's a lot of room to work with. Okay, it's a lot of room to work with, and taking your time. Don't get in other people's bag. Just stay focused on your journey. Stay focused on your journey. Write down your profits. Don't look at my profits. Don't look at the next person's profits and try to compare. Stay focused on your portfolio, on your account, and your journal is really going to be like your personal story. Okay, and I promise you, there's really times I look back on my old journals and it's cute. It's really amazing, and I thank God I've been able to come so far. A lot of the goals that I would write down in the past have been achieved, and I'm really looking forward to filling up a new journal, taking my plans and trades a lot more serious, and just getting some good trades out for you guys, really, especially. That's definitely what I care about for sure. I definitely want to get some good trades out for you guys. You guys can head over to stackmode.net if you want to catch my trades with me. But putting out some good winners as of 2025. So 2026, looking forward for an even better year, inshallah. So definitely trying to push it harder, be more disciplined, be more structured in every single way. I never want you guys to think I'm just yelling at you guys. I'm also talking to myself when I make these videos too, because it's important. Now, the reason why journaling really helps too, especially in the beginning, even if you're extremely advanced, still do it. It doesn't matter if it's a physical journal as well too. It doesn't have to be a physical journal. You could do it on Discord, Notion, tons of other apps and stuff like that too. You guys can use TradeZella, etc. to track your trades, track your progress. A lot of brokers track your progress too, but it really helps when you write your own emotional notes in between your journal, because you're going to be a lot more emotionally attached to your trades, to your portfolio, and that's going to help you not crash out and make decisions that you wouldn't be proud of. You know what I'm saying? So when you write down in your journal, I will not fail. I will not overtrade. I will take my setup, and this is why I'm entering this setup. You're going to be a lot more inclined to take the proper kinds of setups over and over and over and over again. I promise you. Okay? I promise you. Create your own personal story with this. Build yourself. Develop yourself. Level up. Okay? If you play video games, I really recommend you guys quit. Once again, I'm not speaking from a place of perfection. Only God is perfect. I used to play video games. So use your journal and write your own notes. Level up your own character. You got your own stats to work on. Okay? See how disciplined you could be. See how consistent you could be. And use your P&L as an equity curve to see how much improvement that you've been making. All the old stats, forget about them. They're in the past. They're all in the past. All the old stats are now irrelevant. It's time to go hard. Create a whole new, fresh journey. Leave all the old losses in the past. Stop looking back. Okay? Look back, repent to God if you need to, if you made a horrible mistake. But otherwise, if you just lost some money on the charts, don't look back. Understand why you lost the money. Study even harder. Grind even harder. More hours on TradingView. More hours studying the free course on Stackmode.net. Watching the free videos. Tons of education. I have a free book for you guys too. So just get yourself in order when it comes to these markets. It's so much money to be made, and it's so much money to flow. Once again, I always talk about the asset river, and I always want you guys' money to be flowing within the asset river. I want you guys to be abundant. I want you to be able to protect and provide for your families. And I want you to be able to live a nice, great life, really. I don't want you guys to be struggling when you don't have to. And I want you guys to be able to get to the point where your whole mindset is just focused on God and just being disciplined. And that hunger, it's really, really going to help when you're tracking everything down, whether it be it on a spreadsheet, personal journal, Discord, Notion, whatever. Track it down. It helps a lot. Okay? You guys are amazing. I love you guys so much. Head over to stackmode.net for all trading education. I'm going to catch you guys in the next one. Peace.
Let's go ahead and let's talk about what a stock is. So don't go buy at nonsense and invest. This is probably why you're broke in the first place right now. Invest your money into things that are going to go ahead and turn your money into more money. If you want to stop being broke, if you want to stop being poor, if you want to stop having low bills and debt, start using your money to turn it into more money. If you want to be foolish and be a consumer, that's fine. Choose your pick. But life is only getting more expensive, so choose what you want to be on. Okay? Do you want to be someone who's providing, who's succeeding, and is going to be self-sustainable? Or if you want to be someone who's just not self-sustainable, no money in your bank account, and no wealth built or left for anybody around you. It's your choice. So invest. If not, up to you. But here's what a stock is in the first place. So a stock is owning a piece of the company, okay? So instead of buying the actual product itself, buy the stock, okay? A stock is gonna go ahead and give you a part ownership of that corporation. And that money is gonna go ahead and make you more money by buying and holding. So the reason why people even start the stock market in the first place is due to the fact that, or put their company on the stock market, is due to the fact that they wanna raise funds for their company, okay? More funds raised, which means more parts, materials, etc., can be put into the business, okay? And when that happens, that means the business could potentially get bigger, okay? And make more money, grow potential wealth, okay? And the bigger the company gets, the more you'll get rewarded for that, because since you're a part holder, the share price will go up, okay? So the share price is gonna be the price that pretty much just depicts its number value. And as the share price increases, let's say you bought in at a $39 share price, for example. If it went up to $100, okay, you would make a certain percentage gain depending on how many shares that you have, okay? So a stock is formally called a share, and each share represents a tiny fraction of the company's assets and earnings. And the company divides its total value into millions of these individual shares. And why the price moves in the first place? So the stock price change based on supply and demand. And when more people want to buy, okay, that means demand is higher than the supply. Then the price goes in an upwards direction, okay? And this demand is driven by expectations of the company's future profits. So the reason why it's going up is becoming more scarce, okay? So people who already have it or people who are buying into it are either going to be buying at the highs, or if you got into it at the lows, you're going to be holding onto it. And since the company is getting value, you're going to go ahead and be able to make some money based off of that. So why do companies go for public in the first place? Okay, the IPO. So first of all, companies go public due to the fact that it helps raise capital. Okay, once again, more research development funds, more material funds, etc., can be garnered by just putting your company on the stock market. So the primary reason is to generate large amounts of cash for company growth. So it helps you fund research and development, pay off existing company debt, and to expand operations globally. And the money raised does not have to be paid back, unlike a loan. And the initial public offering, the first time a private company sells shares to the public. So before a stock market company can be available to the public, it has to first go through a private investor, okay? So someone on the back end has to purchase all the shares, okay? They have to purchase all of it, and then it can go ahead and be available into the company. And after the IPO, the shares trade on an exchange, okay? Also known as the New York Stock Exchange, the NASDAQ, S&P 500, etc. And the secondary market is where everyday investors buy and sell to each other, okay? And this is going to be available on your brokers like Webull, Robinhood, and just the stocks you're going to be able to purchase on your phone. So a reason why investing is going to be so powerful is when it gives you your time back, okay? You can go and put your time into working harder at your business, working harder to developing yourself, okay? Stop being a consumer. Stop spending all this unnecessary money on shoes you can't even afford right now, okay? Some of y'all can't even buy the items that you own twice. If you own items that you can't buy twice, okay, that's not a good look. Okay, it's time to either A, run it up again, or you just have more stuff in like liabilities than assets. And the liability is something that's not making you any capital. It's just something you just spent money on. Okay, so don't make foolish decisions. Okay, stay down. Some people don't know how to stay down, and then people wonder why they're broke. They wonder why they're poor. They wonder why they don't get anywhere, and it's because people don't know how to stay down. Once people start learning how to stay down, they'll stop being broke, okay? And once they realize, okay, my money's a tool. Instead of me being a pansy animal and investing in somebody else's company who just dropped the product to me, instead of me putting money in their pocket, let me put money in my own pocket. Let me invest. Let me build myself up. But some people aren't ready for that, okay? Some people are just always going to be slaves, okay? They're going to be broke slaves. But if you don't want to be a broke slave, you need to start investing. Okay, if you don't want to be someone who's controlled by just wages and everything, let your money make some money. Okay, God gives us a really beautiful opportunity in order to do that. But if you want to spend your money on nonsense and then not invest, that's going to be fine, because the people who are investing are making substantial income. Okay, I don't want you guys to be broke anymore. So keep investing, keep going, keep building that stash. So, stock terminologies, ticker symbol. The short, unique abbreviation used to identify a stock on an exchange, okay? That's gonna be the ticker symbol. You're gonna have Apple, okay, AAPL. You got Tesla, TSLA. Google, GOOG, also known as GOOGL. Okay, you're gonna have certain other companies as well too. They're gonna be tradable on the stock market. Okay, and when you're gonna be able to invest in them, you can trade a couple of things. Either A, you can buy shares, which pretty much just give you a piece of the pie. Okay, depending on how many shares that you do own. Okay, so shares equal ownership. The reason why I like shares too, I recommend you guys have 2 accounts, okay, or 2 portfolios. One for day trading, okay? Whether you're day trading penny stocks or trading stock options, which is where you get paid based off of just directional bias, where you can trade in upwards direction or downwards direction, okay? So instead of having ownership, you're getting paid based off of your correct analysis pretty much with options. So you can either trade stock options or buy shares, or I like to personally do both. Okay, I like to take my options profit and reinvest it back into shares. Okay. So reinvesting your money, it's a cycle. Your money should be a wheel. It should be a wheel. I'm starting to really understand how everything comes into place. It should be a wheel. The reason why people are broke, the reason why people go down bad is because they don't put their money in a wheel. They don't put it in any type of water. They don't let it flow, and they're not letting their money do anything. Okay. So if you don't invest, you're going to be broke. So voting rights. Owners of common stock typically get 1 vote per share on a major company decisions. Okay. So the more shares that you have too, and especially people who own a large amount of shares, have a lot of jurisdiction when it comes to the company heads and as well as the votes. So the votes go towards who's going to run the company. Okay. And this is going to be a really big thing. Okay. When it comes to certain stock ETFs, exchange traded funds, say you invested like $2 million, right, into an ETF, and you could easily make $70,000 a year just based off investing that $2 million, which you could still withdraw at any time, right? But since you have $2 million in there, you could easily make $70K a year. Okay, you're gonna be able to make $70,000 a year, okay, just by having $2 million invested, okay? And you could live off that for the rest of your life, pretty much. So even if you touch $2 million, you could pretty much never go broke. Okay, going broke is really how you maneuver your money. Okay, I've really been staying down these past few months and just been running up a big bag. Alhamdulillah. Okay, so stay down. When you stay down, you don't buy what you don't need to be buying. When you should start investing, stacking up that money, it runs up quick. Okay, everyone should have at least $10,000. Okay, and if not, it's time to grind. It's time to pray and grind. Okay, but try to get to at least $10,000 in your bank account, in your brokerage account, and in your crypto account if possible. Okay, just spread across. So 2 ways to invest your profits. Okay, you're going to get paid based off of capital gains, and that's when you're pretty much just right. Okay, if you know that something's going to go ahead and go in an upwards direction, let's say you found a really good company that you just believe in, let's say Stackmode, right? Let's say the Stackmode company, let's say I opened it, boom, for example, okay, and let's say it went up. Okay, if I got in at the lows at $2 a share, and then price went up to $100 a share, boom, I would go ahead and make some profit based off of that. Okay, so whatever the profit is, you can throw it into a stock calculator, okay, which will go ahead and show you how much profit you're going to go ahead and make too. So this is just getting paid based off of appreciation, okay, which pretty much just means you're getting paid as the stock goes in an upwards direction, as the share price increases, and as the future value increases. And it's making money when you sell a stock for a higher price than you paid for it. So if you bought it at 40 and then you sell it at 100, that's profit. If you bought it at 20, you sell it at 80, that's profit. If you bought it at 10, you sell it at 25, that's profit. Okay. And this is the most common and largest source of return for high growth stocks. And then you can also get paid in something called dividends. Okay. Dividends are going to be a really, really solid way to go ahead and generate income, especially once you have enough money invested into it, where you can receive regular cash payments from the company's profits. Okay. So if you, once again, if you have like $2 million invested into an ETF, okay, you can easily make $70K a year in returns. Okay. For example. So if you invest your money into the right places, you can never go broke. Okay. And they're often reinvested to buy more shares, utilizing compound growth. So you get paid based off of the shares and you're getting paid based off of the dividends. So if you invest in certain things, you're going to be in an extremely good position, inshallah. And the goal is to find companies whose value will grow over time. So some takeaways. So when you own shares, understand that you're going to be the owner. Okay. You can hold shares for 30 years if that's what you want to do. And I actually encourage you guys to hold shares for over 1 year if possible. Okay, when you hold shares for over 1 year, you're actually subject to a lot of long-term tax benefits. And it's going to be really, really good for your portfolio. And you guys are going to get, once again, a lot of benefits for just holding a trade for over a year. Now, when it comes to day trading, okay, the short-term capital gains tax is going to be a little more intense, but this is why you're taking that profit and reinvesting into something that's going to make you more money, because that way taxes, inshallah, especially when you're making good trades, it should go ahead and all cycle out with each other, as long as your money is always being thrown in the hamster wheel. And the secondary market, okay, secondary market is where you trade with other investors, not directly with the company after the IPO. Okay, and the secondary market is going to be the market that we normally trade, that we're able to go ahead and buy shares, buy options, etc. on. And take a look at the business. The stock price follows the success of the company right behind it. And investing is owning a slice of the company's growth and the economy's growth. Okay, make wise decisions, spend, invest. Okay, if you're noticing yourself, you can never afford your bills. Okay, you're spending too much money. Take a look at your bank statements. What are you buying? Okay, take a look at everything that you're wasting your money on. What can be reduced? Are you eating out too much? Okay, if you're eating out too much, it's time to start buying groceries. Okay, the technology that you have, dumb it down. You can't afford it right now. Okay, some of you guys have just things that you just shouldn't have, you know, priorities. And priorities are the reason why people don't get rich, you know. And not everyone is meant to get rich. I'm starting to realize that. Some people are meant to stay exactly where they are. Not everyone is meant to get wealthy, but if you're interested in getting wealthy, you got to learn to sacrifice. That's going to be one of the main things I can go ahead and tell you. If you're anyone interested in getting wealthy, putting yourself in a better position, putting your family in a better position, you got to sacrifice. Okay. Once again, not everyone is meant to be rich and wealthy. Okay. Not everyone is going to get there, and that's fine. But if you want to get there, sacrifice, stay down where everyone else is out doing nonsense. You have that fun later on. Okay, when you're secure, you're going to be balling, hooping, not stressing. Bills overly paid, stash overly healthy, in stack mode. Okay, while people are out and then they come back home and then they start stressing about bills and stuff like that, letting that real life hit them. And then that's why people go run to things like alcohol, drugs, etc. and stuff like that, because their life just isn't together. So just get your life together. Get your life together. Let your money make some more money and just start living a way better life. All right. Love you guys so much. Head over to stackmode.net for all trading education. I'll catch you in the next one. Stay prayed up to God. Keep grinding.
Bitcoin mining is the network's backbone, and it's not just about earning crypto, it's how Bitcoin is created in the first place. Miners use powerful computers to solve the puzzles. They secure the blockchain with an immutable new block each time, and this process is the global security system that prevents double spending and fraud, and it verifies all transactions across thousands of independent computers, replacing a central authority. Without miners, Bitcoin wouldn't even exist, and it would collapse. But with them, it's become one of the most secure financial systems on Earth, powering the trust and transparency of decentralized money. Let's go and let's talk about how Bitcoins are created and why the government owns it. Inshallah, if God wills. Let's go. So, class, welcome. Let's go and let's talk about how Bitcoin is created in the first place. So Bitcoin is generated by mining it. Okay, Bitcoins don't just spawn out of thin air. And as you know, Bitcoin is also a limited cryptocurrency. So other cryptocurrencies for the most part are going to be infinite, but Bitcoin is actually going to have a limited amount of currency. Okay, there's only 21 million Bitcoins that exist. Okay, and each one of them is created by getting mined. So what happens is a computer, okay, and the computer is obviously powered by resources. Okay, so certain countries take more power than others to create certain Bitcoins. Okay, so if you're in a country that charges a lot for power, then you'd be paying more on your electricity bill in order to mine the cryptocurrency. Okay, and what you would need is a super powerful computer with a graphics card that can handle the Bitcoin mining. Okay, so what a graphics card is, it's a piece of the computer that's external. Not all computers have external graphics cards. Some have inbuilt graphics cards, which is why they're slower than others. But what you need is a really powerful computer. And then from there, you'll be able to load up the Bitcoin mining software and it can go ahead and get created. We're going to talk into the technicals, exactly how everything works. Bitcoin mining is super duper cool. You might even want to do it and see if this is a good way that you guys might want to generate some income, depending on what country you're in as well too. You'll be able to save a lot of money on power, and you could potentially mine yourself or create yourself a Bitcoin for way less than buying it. So let's jump into it, class.
So what is mining even in the first place? Mining is not digging dirt. Bitcoin miners aren't digging into the ground with actual pickaxes, digging into the dirt, looking for resources. No. Okay, so what it is computers mining Bitcoin via a software. Okay, and the job is to secure the network and process transactions. Okay, so it secures the network by making everything decentralized. So in a traditional bank system, let's say you wanted to send a wire transfer, for example, right? The bank would be able to decide whether yes or no if the transaction wanted to go ahead and get approved or declined. Within a decentralized network, such as sending Bitcoin, things like that don't occur. Since everything is done by smart contracts, okay, everything is autonomous and automatic, done by computers, okay? And that's what Bitcoin mining comes into place too. Even creating Bitcoin, instead of just clicking print on the dollar like they do with fiat currency, Bitcoin actually has to go through a whole process in order for a Satoshi to be created in the first place. Okay. So Bitcoin mining helps keep Bitcoin decentralized. The reason why the US dollar fails is because they just go up to the printer and click print. Okay. There's no real strategical process that goes from start to finish for the most part that keeps its base value cooked in. Yes, you can just print more dollars, but that would inflate the other ones. Since there's a finite amount of cryptocurrency, there has to be a secure process in place in order for it to be created, for it to be fair for everybody. And mining is the way it's done. Let's keep going. So think of the blockchain network as a public notebook. So you might have heard of what the blockchain network is. So the blockchain network is pretty much a public copy of everything that's been done. Every transaction that's been created, every Bitcoin that's been mined, and every transaction that's happened. Okay. So the blockchain is pretty much going to be a verifiable place to where you can see if your transactions were even completed as well. Okay. So within the blockchain, you'll be able to put in your, let's say, address. Let's say you did a transaction. You could copy that transaction address, put it onto the blockchain or some type of blockchain checker, and you could see if there were any confirmations. Okay. Confirmations are pretty much going to go ahead and let you know when your transaction is ready to be completed. Okay. Either the money has been sent over and it's about to hit somebody's wallet. Okay. Or it's on the way to hit your wallet. Okay. Depending on the situation. So the blockchain is a public notebook that everyone has a copy of. And mining is the process of adding a new page, okay, which is a new block to this notebook. So page 1, right? Let's say Alice sent some money to Bob. Okay, let's say they sent 5 Bitcoin. You're going to be able to see that. Okay, you'll be able to see the Bitcoin addresses, etc. And you'll be able to see when the transaction was sent, how much Bitcoin or how much cryptocurrency was sent. And you'll be able to see the miners working on certain things as well too. Okay, you'll be able to see when Bitcoin transactions have been implemented and grounded into the blockchain. Whether a big whale is buying or selling, the blockchain shows us everything. Okay, keeping cryptocurrency really, really safe. So proof of work. So once again, Bitcoin, it's not created like the dollar. You don't just go up to the printer and click on print over and over and over again. It's created by POWs, also known as proof of work. So to add a page to the notebook, computers must solve a super hard math puzzle that requires a pretty powerful computer as well too. So make sure you guys have a good graphics card inside of your computer before you think of doing anything like that. Okay. So to add a page to the notebook, you got to have a super powerful computer, and then the computer has to do calculations and try to guess the number. Okay. So imagine guessing a number between 1 and 1 trillion. Okay. You have to guess randomly. So computers then make trillions of guesses per second to find the random number, okay, which is going to be the hash. Okay. So that's how the proof of work works. And that's pretty much all the work that the computer is doing. The computer is constantly running calculations, trying to find and guess the correct numbers in order to generate a Bitcoin. Okay. And that takes a lot of power, a lot of resources. So make sure you guys are watching your energy bill before you think about getting into this. So this is exactly what I mean. You need a powerful computer. Okay. Your computer has to be good. It can't be a weak computer. Okay. So understand that you cannot mine Bitcoin from your laptop. Okay. You cannot mine Bitcoin on a laptop anymore. Okay. So these with, you know what I'm saying, with the screen, a little keyboard, not cutting it if you want to mine Bitcoin. Okay. Get yourself a real strong desktop with a real graphics card before mining Bitcoin even crosses into your brain. Okay. So you need specialized machines called ASICs. An ASIC stands for an application specific integrated circuit.
And they do one thing: guess numbers for Bitcoin. Okay, they're loud, hot, and they use a lot of electricity. Okay, so before you guys think about just putting it into your room, keep all of this into play. Okay, keep all of this into play. Same for Airbnb owners as well too. If you guys have Airbnbs, what people are doing is signing up for Airbnbs and mining Bitcoin at Airbnbs in order to save money on power bills and stuff like that. Or people are also even moving to other countries in order to save on power bills too, so they can mine Bitcoin for a lot cheaper. So keep all of these things into play and understand that the future is really changing a lot. People are starting to get a lot more equipped and doing a lot more strategical moves to mine all the Bitcoin as possible before it goes away. So what's the point of this? Like, why do it in the first place? So the reward, right? The winner who solves the puzzle first gets paid in brand new Bitcoin. Okay, a brand new Bitcoin. So Bitcoin is created by whoever has the best computer, right, and is solving the most problems. Okay, the more computers you have solving more problems, okay, the more Bitcoin that you're going to accumulate in the first place. Okay, so it's going to be either one computer or a whole room full of computers. Okay, and what they're doing math. Okay, 2 plus 2 equals, okay, and then whichever one of the computers can find the hidden number, okay, goes ahead and generates the Bitcoin. Okay, after you find the random number, or one of the computers generates it and finds the right calculations, then a hash is going to go ahead and get created. Okay, then from there, you're going to go ahead and get paid within your Bitcoin. And you keep doing that, keep doing that. Now, the computers do have a high chance, once again, to consume a lot of power, which means that the resources inside of the computer, processor, graphics card, RAM, etc., have a high chance to go out and combust. So before you think about doing this, make sure you guys have some money to the side to pay your bills, maintain everything. So I don't want you guys going broke to do this. But this is how Bitcoin is created by computers solving complex math, looking for a specific number. And once again, the more you have, the more Bitcoin you'll be able to generate. Since the more computers you have, inshallah, if God wills, the quicker you'll be able to look for hash codes, and the quicker those computers will be able to solve different types of calculations. So what's the point of this? Why is it essential for security in the first place? So it's costly to cheat, right? So to fake a transaction, you need more computer power than all other miners combined, making it pretty much obsolete, not even worth it, and not even worth the while. So immutable. So once a block is buried under other blocks, it's mathematically impossible to change it, because the way that Bitcoin works is that the computer is hunting for hidden numbers. Okay, it's hunting for random numbers and it's trying to guess the correct numbers. So the chances of it being faked or created within a false context would pretty much be almost impossible. Okay, since there's so many numbers and it's looking to guess the correct one, and it's decentralized. So no single boss controls the ledger. So no people can just be like, you know what, we're going to decline this transaction. We're going to approve this transaction. Oh, you want to send $10,000 to somebody in another country? You know what? We're going to go ahead and decline this and shut down your bank. Okay, that's happened to people. Okay, and that's not fair. It's not fair. There might be money you might need to send to somebody in another country to help send your family some money, to help pay your employees or whatever. Cryptocurrency is such a beautiful blessing on this earth. God is the greatest, you know? Is being able to send $1 million to somebody the next day, boom, just like that, snap of a finger, and nothing is even remotely concerning. Okay, it's beautiful. We want to be focusing on buying as much cryptocurrency as possible, guys. Focus on it. Okay, focus on it. So no single boss controls the ledger, guys. It's decentralized. We're all in this together as a family, and thousands of miners protect it together. Okay, the cryptocurrency community is really a family. They just want people to send money and collect their money freely, without any restraints, without any cringe blockages or anything like that, without any 3 a.m. shutdowns. They just want people to send their money borderless all around the world and spend their money all around the world. God is the greatest. You know, to be able to live in this type of time period where we can have this type of decentralization, it's really a blessing. Okay, take advantage of this time period, guys, and let's keep learning about cryptocurrency. So let's talk about the wall of energy. What is this? Okay, so it's a feature, not a bug. So people complain about energy use, but that energy is a wall protecting the money. So you have to understand that the printers, okay, if they just keep printing the dollars, inflation is going to continue to increase. Okay, which is why the US government, for example, is running to cryptocurrency to kind of save its tail. So energy equals real world cost. Okay, you can't really fake that. When that mean power bill gets sent over to you, you got to pay that. It just is what it is. Okay, it's kind of hard to dodge that because it costs real actual money, electricity to mine, and you need an actual account too. You can't just be like a fake person. You got to actually go sign up for the power account, put your card on there, etc. So because it costs real money, electricity to mine, you're incentivized to play by the rules, keeping it safe and free though for everybody. Okay, free for everybody to jump in, I'll say. Okay, because some things are going to be gate kept through certain other things, but as far as just the freedom to start, anybody can start. Okay, you might just need the ASICs computer, pay for the energy, but as far as just the freedom to start, anybody can start. So if you cheat, you waste electricity and you lose money. Okay, so it's pretty much not going to be worth it at all, because the point of this is to gain some Bitcoin. So inshallah, you can maybe see some profit. So keep everything stable and keep everything well-rounded. Make sure you have everything planned before you just start trying to do anything. Okay, so let's talk about the life cycle, right? So a broadcast. So if you send one Bitcoin to a friend, the network is going to hear it. Okay, the blockchain is going to see it. You could see if the transactions were completed via what's called confirmations. Okay, so compete. Miners then race to solve the math puzzle, the hash, to box up transactions. Okay, and then verify. The winner shows their proof and everyone checks it instantly. And this keeps it secure. Okay, this page is glued to the notebook forever, also called the blockchain, and then the miner decides to go ahead and get paid. So that is the full 1, 2, 3, 4 cycle of how Bitcoin mining actually occurs. Okay, so the computers are looking to solve the hash puzzle. Okay, after the computer solves the hash puzzle, then the miner will go ahead and get paid in Bitcoin, inshallah, if God wills. So keep it simple. All right, y'all. Happy Bitcoin mining. I pray you guys do well. If you want to go set up a rig or set up your own basement, do it. Okay, be ready to pay that electricity bill, but I believe in you guys. If you're interested in Bitcoin mining, head over to stackmode.net for all trading education, and I'll teach you guys and we can talk about absolutely whatever. Stay prayed up to God, keep grinding, and I'll catch you in the next one. Peace.
You might think that inflation is a normal part of life, but the reality is that your purchasing power is silently being stolen from you every single day by the very institutions claiming to protect it. Central banks have the power to print infinite amounts of currency at the push of a button, which dilutes your savings and forces you to work harder just to stay in the same place. They control the supply, so they control the value, and Bitcoin completely flips this power dynamic on its head. It's the only asset in human history with strictly finite supply that cannot be altered by any government or chairman. There is no backdoor and there is no print button because the code is absolute. And while fiat currency relies on trust in politicians, Bitcoin relies on mathematical verification, and it's created by actual power and resources. This is not just about digital currency or making a quick trade. This is about the separation of money and state and ownership. In this video, I'm going to show you exactly how Bitcoin renders the central banking model obsolete and why it's the ultimate hedge against the system designed to devalue your life's work. Let's dive in. Let's go and let's jump to how central banks hold a monopoly on the money supply. So as you know, things have to be systematically processed when it comes to central banks of systematic formations, such as wire transfers or direct deposit, for instance. Certain things have to hit on certain days and certain time frames due to the fact that approvals have to be made by the centralized banks. Now, when we're trading cryptocurrency, you're working in the decentralized world. Everything is way different. Okay, everything is based off the peer-to-peer transaction system. Everything works off of smart, autonomous contracts. So whenever transactions are sent over, pretty much computers do all the processing. When you send a wire transfer over to somebody or even to yourself to another bank, the bank has the ability to approve or decline that. Cryptocurrency puts the freedom back in the people's hands. And let's go and let's jump into how all this works and why central banks really don't like this. Let's talk about the loss of monopoly. So central banks manage the economy by printing money, which is quantitative easing or pretty much restricting it. And Bitcoin supply is fixed at 21 million. So it having that fixed statistic baked into it, one, not only makes it more scarce, but it's going to have a more baseline stability cooked into it, and inflation is going to be a lot more manageable. When it comes to fiat currency, you can pretty much print infinite dollars nonstop. That's you might see things from 10 years ago might cost completely differently from today, since more money has been printed over the years have gone over. Okay. And the competitor.
So for the first time, citizens now have a viable opt-out option. So if a central bank debases its currency due to inflation, people can flee to things like Bitcoin, and this forces central banks to be more disciplined, limiting their power. So you might have seen things recently, as of 2025 when this video is coming out. Banks are now starting to incorporate certain things like Ethereum, XRP, and Bitcoin systems within their system, since they know that people are now looking towards cryptocurrency to manage their money or even hold their savings. So instead of getting 2% or 3% APY stands for annual percentage yield, people rather go put their money into a cryptocurrency and let their money grow faster at a rapid rate. And not only that, it's going to be a lot more manageable too. If you go to the bank, if you have 10 bands, you go pull up on the bank, a lot of the times you're not going to be able to pull that out right away. You might have to come back tomorrow, the next day, because the bank has your money pretty much invested. Okay, so if our money's parked in the bank, it's going to be their money too. It's being used. That's why certain things like Zelle have withdrawn deposit amounts, because they don't want people just pretty much managing their currency how they want. Cryptocurrency takes that all the way. If you want to send $1 million today and tomorrow, you can do that. With the normal traditional central bank based off of fiat currency, they're not going to let you do that, since that puts too much freedom in people's hands, and a lot of business moves can be made a lot quicker. So instead of the banks having the power, now people have the ability to build certain things like banks, their own hedge fund systems, and their own funds, etc. So now people have the ability to have some more individualization for their family even as well too, versus having to run to the banks every single time. So back in the day, people would have to keep all their cash in the banks for the most part. Okay, things aren't like that today. Now you have the ability to even keep your cryptocurrency on something small like a USB drive. Okay, so keeping it extremely decentralized, and the IRS can't get to your USB drive unless they raid your house and find it or things like that. Okay, so no more having random money put out of your account, or even if you get sued, for example, they can go into your bank accounts and clear you out. If you have your money parked in cryptocurrency, that's money that they can't touch, and it's pretty much digital cash that nobody really knows that exists. So let's talk about the threat of censorship resistance. The modern banking system is used as a tool for geopolitical control and surveillance. Big on surveillance. They want to see every dollar that's coming in and out. A lot of things have been changing recently too, since 2020 plus. As far as cash, for example, you can't really use cash to get certain things. Like a lot of realtors and realtor companies won't accept cash for certain down payments, since you can't really prove that you're a real legitimate person and where that money's actually coming from. Okay, so central banks want to make sure everything is controlled, and pretty much don't want you to have freedom for certain ways that benefit them every single time. Certain ways it does protect society, but for the most part, things aren't always fair and realistic, because it is the world. So if somebody's working hard at their lawn mowing business and they've been stacking up cash, okay, their money shouldn't be obsolete. So now you have things like cryptocurrency where you're going to be able to put that, send that over to your bank account, and then you could file your taxes and do things a little bit more legitimately there, versus just having random cash come out of thin air and then you deposit it and they're like, well, where's this coming from? Okay, so your cryptocurrency can be baked in and a little more hidden, and it'll help you out in a lot of ways too. And Bitcoin is really a neutral, permissionless network, and it helps you bypass sanctions. Systems like SWIFT allow the US to cut off nations or individuals from global finance. And Bitcoin operates on the peer-to-peer network, just like we talked about in the previous slide. Meaning if you want to send $1,000 to somebody in Africa, you can instantly do that within the next couple of minutes if you wanted to. Okay, if you want to do that via PayPal or the traditional bank system, it's going to be a lot more difficult. They're going to put some type of hold on it, have to verify your transaction, and it's going to be just a lot more difficult overall, making financial blockages significantly harder to enforce. And financial privacy is going to be a big factor as well too. So Bitcoin is going to be pseudo-anonymous. Central banks and governments prefer total visibility due to the fact that KYC laws are in place, know your customer, and AML, to track taxation for the most part. So pretty much just the government wants their piece of the pie when it comes to any type of currency. So a decentralized ledger obscures the identity layer that they rely on. So certain things like the SEC were fighting with Bitcoin legislators, etc., and that led to certain dips. But now the US government and other governments have started holding the currency themselves, and certain laws have been getting passed. So central banks are trying to gain control, but for the most part, Bitcoin at the core forefront of it is still peer-to-peer and a currency based off of freedom.
So we'll jump into the neutralization of interest rates. Interest rates are going to be the steering wheel of the economy, and Bitcoin creates a parallel system that doesn't respond to that steering wheel. And the liquidity trap. When the Fed lowers the rates to stimulate the economy, they want people to spend pretty much. So if people instead borrow cheap fiat to buy Bitcoin, which is a store of value since especially it has a limited cap, giving it scarcity, which is immediately going to give it value, the stimulus leaks out of the real economy and into crypto assets because people are starting to wake up as well. And broker and transition mechanisms are going to come into place. If a significant portion of the economy uses Bitcoin for settlement, central bank decisions, which involves raising or lowering rates, affect fewer people, rendering the central bank increasingly irrelevant. So it's like trying to slow down a car by pressing the brakes, but the car has decoupled from the wheels. Okay. So Bitcoin's coming in to solve a lot of problems, especially now since people are starting to be more open to international travel too, and living in certain other countries, especially US citizens. And you're gonna, instead of have to go through certain transfers for your US currency, you can easily just keep everything in cryptocurrency and spend that all over the world simply, instead of having to go through that headache of a transfer system. And let's talk about CBDCs, the counter move, and what are they doing about it? So they're copying tech, but keeping the control, and enter the central bank digital currencies, and it's programmable money. So unlike Bitcoin, CBDCs are centralized, and governments could theoretically program money to expire, which forces spending, and restrict what you can buy with carbon limits or freeze accounts instantly. And definitely total surveillance is going to come into place too. So a CBDC ledger would give the state a real-time view of every single transaction in the economy, eliminating the concept of cash-like privacy entirely. And they market CBDCs as safe, convenient Bitcoin, but the reality is that it's the exact opposite of Bitcoin ethos of decentralization. So keeping the freedom in the people's hands is really the main point of crypto. Yes, there's money involved, but honestly, you can make way better profit doing other things, such as like trading futures, for example. Even if you trade crypto futures, that's gonna be way more profitable than holding and keeping spot. But as far as you holding your Bitcoin, your cryptocurrency, you're really doing it for your ownership and your assets. Okay, having ownership, especially in something that helps the future, is what's going to help you prepare your forward and keep your money in that constant cycle. So instead of you being on the hamster wheel, put your money on the hamster wheel. Have everything flow. Okay, so after you get that big bag from futures, let's say for example, you know to go ahead and throw it into Bitcoin, which consistently makes profit year after year after year after year. So instead of you having to hustle and bustle forever, you could maybe sit down and chill because you have enough money from hustling, bustling, stacked in your investments, and then your wheel will be spinning forever. Okay, so if you decide to use your fiat currency and throw it into something that's gonna help your money flow into the hamster wheel, inshallah, you'll have a lot easier time. So they try and stop everything, just like they try and stop certain herbs as well too. They can't stop the Bitcoin network itself since it's distributed globally, and they target the entry and exit points and targeting on ramps. So regulators pressure banks to not do business with crypto exchanges, even though they're starting to do it anyways, because they know people have to sign up for their banks, otherwise they're going to crumble. So if you can't transfer fiat to an exchange, it becomes very difficult to buy Bitcoin. And let's talk about some regulation by enforcement. So instead of creating clear laws, agencies like the SEC sue crypto projects to drain their resources and create uncertainty, driving innovation offshore. But thank God, it's been a lot of righteousness going on. Certain people have been getting freed from jail, such as like the Binance creator and Bybit and stuff like that has been starting to get back on the United States soil. So a couple of years ago, around 2022, 2021, they started locking people up for enforcing certain cryptos or creating certain crypto brokers such as Binance and stuff like that. Thank God certain people have been freed, and just really things have been changing, and the crypto future is starting to look bright, especially since the US government now owns hundreds of millions of dollars worth it. That's really, really a solid and good factor, letting us know that, okay, the US doesn't want to fall behind since other countries also own hundreds of millions of dollars worth it too. Okay, so instead of being stubborn, the US is now actually turning on their brain, and that's leading crypto to future all-time highs, since the US dollar is the global currency of the world. But we never know, within a couple of decades, could be Bitcoin. So a lot of things are changing, exciting time in the world, and central banks are pretty much on a game theory buy. They can't end Bitcoin. The network is way too resilient and distributed, so they're pretty much trying to conform because they know people are starting to wake up. The righteousness is starting to oversee the darkness in the world for sure. People are starting to care about their health, want freedom for their money. And people might have family in other countries too. And you can easily help out your family in other countries with cryptocurrency. Once again, not as easy to do that if you're sending straight fiat in any country you're in. And they can't ignore it. Okay, it's sucking liquidity out of the fiat system. People are no longer keeping their money stacked inside of savings accounts, getting that 2%, 3% APY that most banks take advantage of in order to make profit. People are now just taking that money and putting it right into cryptocurrency. Even the same thing with credit too. A lot of people are starting to wake up when it comes to credit. Instead of balling out, just buying things, people are now taking that, either they're investing it, all of it, into some kind of business and buying cryptocurrency, buying any type of shares that they can too with the cash that you can extract from the credit card if you can't extract the whole thing. So the likely outcome of everything, integration, and that's been slowly happening. A lot of banks are starting to finally realize, and as we start seeing more younger people get into CEO level positions, I can see things change as well too, inshallah, especially as Trump come into office. The crypto support has definitely been in significant rise. So banks will eventually have to custody Bitcoin and treat it as a reserve asset, just like gold, because they know people aren't going to be going for anything else. Okay, people are now more open to leaving the US more than ever. So now the US is very desperate to make the right decisions to keep people here and keep America going forward. So this fundamentally changes how the global monetary system operates in the long run. And a really small percentage of the world only owns Bitcoin. So don't think that you're too late. You're really, really early, and there's a limited amount. Okay, you don't want Bitcoin to be mined up and be like, oh man, I wish I bought Bitcoin in 2025. You don't want to be doing that. Okay, I don't care if you got $5 in your account right now. You don't need to be buying nothing. Go buy some Bitcoin. Okay, live off the credit card, spend all your cash on assets, and watch how your life change. Wake up, pray to God, take care of your family, stay down, and get in stack mode. Let me catch you on the next one.
Cool. So yeah, let's go over some 930 setup. Let's go and let's check it out here. Okay, so we had Uber. See, price went up here on Friday. Had a 4-hour close above it. Okay, so that's extremely nice. I think we might definitely push up to this area of resistance up here. Okay. So with this area here, okay, this was cool. Could see price here. Decided to pass this 930 area of resistance here. Okay, 930 resistance. Price even retested off of it here. We could see on the 5-minute, we had one of these candles here. Okay, price retested off of it. I believe we're definitely going to go ahead and try and fill up to the next area of resistance at the very top here. Okay. So very extremely easy here. Okay, this is going to be like a day trading setup. We're holding these trades for like a couple of days. Okay, we're still going to buy like weeks, months out just for the contract and just in case. Well, a lot of the times these will hit take profit within a couple of days or weeks. Okay. So indicators, we're going to start off with the market open maker. Okay. And we're just focusing on these 930 levels. Okay. That's what really we're going to be focusing on. So got a 930 level right here. Okay. Another one right here. And one up here, if I'm not mistaken. One down here. Okay. So all of these levels here are going to be 930 levels. Right here. And right here. Okay. Then I can go to my 4-hour time frame. Okay. And that's why we lock the lines. But if I wanted to, I could definitely wait for price to pull back to any one of these levels. Okay. And see if price will go ahead and give me a buy entry. Okay, so I just look below current price. Okay, set all the 930 entries that I saw. Okay, and if I see price come to this level, give me a bounce up. Okay, that'll potentially be a valid entry. Okay, same thing with this entry here. Could potentially be valid. Same thing down here, could potentially be valid. Okay, and if you get a 4-hour close and a sweep up from these areas, then that's definitely going to go ahead and be that. Okay, so just be aware before you just instantly buy. Don't just buy the first wick. Okay, make sure you take your time. Be like, okay, I know what I'm doing. I know what I'm buying. I know what I'm looking at. Okay, so your 930 levels are really going to show you everything that you need to see. Okay. So let's go over another 930 example here. And this is really going to help you trade with the trend, whether it is a pullback scenario or an above current price scenario. Okay, so let's take this stock for example here, bam. So I'll go to my 30-minute time frame, look above current price. And let me go ahead and just start marking out areas where I see 930 reactions. So I'm gonna take my line here and mark it at the 930 reaction here too. I'm gonna put one above current price at this 930 level here, and this one up here as well. Okay, as well as this 930 up here. Okay, all the reactions I'm gonna go ahead and put in, just so we know where price is heavily reacting off of the most, as these are going to be the highest volume levels, and volume is going to be the amount of people that are trading. Okay, so when 930, which is when the stock market opens, okay, hits, the bell rings, people are going to be frantic, okay, putting in trades and stuff like that. Everyone's excited. So wherever market decides to open up from these levels are going to be really important. So that's a really good way to find the best pullback levels, see how price wants to react. Okay, so just going from left to right. Okay, even checking out this area here at 930, for example. Okay, if I wanted to, from there, I could easily go to like my 15-minute or 5-minute time frame. Okay, wait for price to break and retest from any of these levels above. Yeah. Okay, so if I see break and retest on any of these levels, I can easily go ahead and take the trade from these 930 levels. Okay, resistance right here. 930 resistance up here, 930 right here, 930 right here. That's going to show you where the best levels are. It's going to be extreme cheat code. It's going to make it simple. Let's go over another example here. All right, we have MDLZ. So let me go to my 30. Okay. And just check it out. Okay. Ideally, I like to start off with my daily too. Make sure I see the full price action. So I can see a super low was created at the bottom down here. I can see price wants to try and meet this resistance up here that came in July. Okay, so maybe on my 4-hour too, see everything closer perspective. And the resistance up here. Okay, sometimes the daily can not show you everything you need to see. And then let me go to my 30-minute time frame, and we can go ahead and find pullback levels or price levels above current price in order to trade like a direction flow. Okay, so right here, it's gonna be pullback level there. Okay, wherever these green lines are on my screen is gonna be exactly where markets decide to open up. So we have a level here, got a level here. Okay, as we can see, the 930 levels are correlating with each other. We got one here. And then this one is going to line up with this one. Okay, and then this one is going to line up with this one. Okay, so it's always going to line up for the most part too. And the more taps that you see in a certain area, the more probable of an area it is that you should be playing there. Okay, even 930 area right here. 930 area right here. Okay. Finding the key levels here, taking our time. Okay, and that's all below current price. Okay, so as price goes into price, if I see price pull back to any of these levels, give me a 4-hour close, then I'm gonna be cool to go ahead and take it. That's the whole sweep back up. Okay, if it breaks this level, it's okay. You could try this one. If it breaks this one, that's fine. You could try this one. Okay, as soon as you get your 4-hour close though, you know you're gonna be good to go ahead and kiss the sweep, inshallah. And above current price too. So it's going to be trading with the trend. It's going to be a simple way to make profit as well too. Okay. So you can get on your 30-minute time frame, look for areas of resistance. For example, if I'm taking it long, above current price, can wait for it to get above current price and take this area of resistance right here and turn it to support and just take it back up, okay, from the original breakout. So you don't have to take the original breakout, okay, let price break out, do its thing. Wherever the breakout closes from, price has a chance to retrace, turn the resistance to support. If it does that and you get a 4-hour close, go ahead and get in. And that's a good trade as well, trading with the trend. It's very safe. So let me see here. You can get in here too. And you can get in up here. Okay. So any of these levels of resistance or even support above current price are going to be good levels to go ahead and look for a break and retest. Okay. So even levels of support can go ahead and be mirrored too. So even if price were to go up past this level of support, okay, it can kind of inverse retest and mirror that level of support and go up too. Okay. So that's also going to be part of the breakout model. Okay. And certain things with high liquidity are going to have a little cleaner levels, okay, compared to smaller stocks, but even smaller stocks, you're still going to be able to find good trades. Okay. So for instance, a price break and retest here, to take it up to the next level up here. You could just keep going, doing all your levels and just playing your chart like a staircase. So that's pretty much all it is. It's just a big giant staircase. We'll check out Wells Fargo, for example. Hop on my daily. I can see that we're all-time highs. We can't touch this. Okay, there's nothing we can do here. Okay, personally, right now. Okay, we can't trade a resistance breakout. It's at all-time highs. So what we have to do is wait for price to come back down so we can buy it back up. So here's how to find the pullback level. So now that I see the data on my daily and see what's going on, let me go down to my 30-minute. So I'm on my 30-minute time frame. And I'm going to look below current price logically. I want price to touch one of the levels below current price and sweep back up. Okay. So that's going to be the goal and objective. So let me go ahead and get the line tool here. Okay. And I can go ahead and put the prices down at the 930 doubles. So let me go ahead and put a line price here, line price here, down here. And I can go ahead and see the prices of the lines completely to the far right in black. Okay, so if price comes down to any of these levels, gives me a 4-hour close and bounce, I'm gonna be good, inshallah. Okay. It's about taking the right trades, okay, taking informed trades. Okay, this is gonna be a low right here too. Okay, and you can see some of these lows are going to mirror each other. Okay, this low is matched with another low over here to the right. Okay, and then we have this resistance up here too, which matters. Okay, and then down here, boom, area of support down there too. Have another one too. Just mark out your clean levels, okay? You don't gotta make it difficult. Just play what needs to be played. Okay, so if price comes down to any of these levels, it gives me a 4-hour close, I'm not gonna play the first tap. Okay, if price comes down to any of these levels, gives me a 4-hour close, I'm gonna be good to go ahead and take the pull back up, okay, confidently. Okay, these are 930 levels where market wants to open up at, okay, and just burst in upwards direction a lot of the times. So a lot of the times market will mirror what it's done in the past. So it could definitely do it again for sure. So we'll go over PayPal here. I'll start off on my daily time frame, get the bigger picture. I can see price made this low right here. I can see price at least wants to come test this resistance area up here. Okay, so I'll get on my 30-minute time frame. Okay, and I'll look for a pullback area to see if we can go ahead and catch it back up to this area of resistance right here. So we get on my 15-minute or my 30. I'll do the 15 for this example. Yeah, and I'm going to go ahead and look at the key areas. Okay, I have this area right here. 930 is clean. Keep finding the best areas, all I'm focused on. Okay, right here. That's the ultimate low that was created. Okay. You can also lock your lines too if you notice your lines moving too much. Okay, up here. Price decided to short downward. Even up here. I shorted downward. Okay, and as you can see, a lot of these are just correlating. A lot of these lines of levels are correlating with each other. Yeah, a lot of these 930 levels are going to be solid. Yeah, we can definitely trust a lot of these levels for sure. Okay, so that's going to go ahead and be PayPal. So I can go ahead and see this area here, this area of resistance clearly above me. Okay, I can wait for price to either break here, retest off of this area, or I can try this area up here. Okay. Or if it doesn't work here, I could try this area here. So it's all about patience. Like, you can win the trade if you truly want to. It's just about waiting to see, like, okay, will my trade do what I need it to do? Okay, and even for a pullback level, if I see price try to dump down to here, okay, turn this area of support into resistance and then fall down, which it could potentially do, and meet up with this low, then that's going to be in probability too. So bread is everywhere. Bread is all over the place. It's just depending on how patient you want to be, what type of setups you take. And just because there's bread everywhere doesn't mean you should be taking a short and then taking a long and then taking a short and then taking a long. Like, your trade frequency and how much money exposure you have in the market is going to depict like how profitable you are really. So it's like, yeah, you can see everything, but just take the trades as data. So yeah, if you see a profitable trade, you can either take it as data or take it. But if you take it, I advise you stick to that model. Okay, so if this is break and retest and you're a break and retest trader, you see support getting broken, turn into resistance, then okay, it could be potentially a decent trade down to the next level. Okay, but if you're a breakout trader, this is something that might not work out for you, okay, depending on certain situations and your criteria, for example. Okay, but you do have a 4-hour close underneath the level, so even a breakout trader here would potentially be able to take this too. Okay, so focus on your criteria, focus how you trade. Okay, and it's not always going to work on all markets. Like, Forex made shorting really popular because the chart is a lot more sideways. But when it comes to stocks of crypto, stock pretty much just goes up in straight line over the years, okay, in the long-term scenario. So it's a lot different, but both the technicals and all technicals work on all charts. So that's the cool thing. So once you learn once, you can apply it to any market that you understand or want to get into. So we'll talk about Cisco here. Okay, we'll restart from scratch. So Cisco here, I can easily just see, okay. So I know on the stock market too, price is trying to go in an upwards direction, and crypto, because people are working hard to increase the value of their company or make cryptocurrency more useful, whether it be just innovating new technologies or etc. Okay, so they want their value and their shares to go up, so they get paid more on dividends and stuff like that, and share exits. So even the normal workers, like for Nvidia, for example, a lot of people who just worked in Nvidia past 10 years just became millionaires because they were able to retire early because the company blew up. Okay, so if you work for a company and it blows up and they give you shares, it's going to be a really good way to retire early. So it's showing you that trading is going to be a really quick way if you want to retire early, as long as you invest your money correctly, you get in at certain lows, and you invest in the future. Okay. So know that price is always going to try and chase resistances for the most part. Always, always, always. Okay, because it's trying to break out into new highs. Okay, people are trying to get paid more for their shares, so price is trying to chase new highs. Okay, and the richest traders are going to be the U.S. stock market traders, so it's one of the most important markets. Okay, so price is always chasing higher resistances, always. Okay, it's always looking to break into new all-time highs for the most part. No company wants their stock to be going down. It's not beneficial for them. Okay, so I'm going to go ahead and start off my 30-minute here. I'll go my 15 here. And I'll look below current price and above. We'll do both. Okay. So for this candle here, it's 930 candle. I'll put go and delete everything. Put this level here. Get back on my daily. You can see price wants to at least come up here. So price is always going to be hunting either an area of resistance above current price, or if an area of resistance is too far, like all the way up here, Okay, it's still going to be aiming for all-time highs ultimately, but depending on your expiration dates and something like that, okay, then closing in an area of support above current price is going to be solid too, because we know that just like we saw, support can be broken and turned into support. So put everything logically, put it together like a puzzle piece. So if I get on my 15-minute here, let's see the structure and everything closely. You can see price wants to bounce from this low here. Okay. Price bounce from this low here. Price bounce from this low here. All I got to do is focus on 930 levels. I don't really have to focus on anything else. Okay, as far as the stock market. Okay. And this level 2. Okay. And then a lot of these levels too are going to be related to each other. So a lot of the times you'll see a lot of levels working at the same areas over and over again. Okay. And right here. All right, boom. So let's say we have all these levels, for example, okay, that I think are going to be solid, good levels. Okay. And this level here. Okay, let's say I go to the far right, Cisco. Okay, I can go ahead and just see certain things. Okay. So I know that price is trying to at least chase this resistance up here. I can go to my 30-minute and see everything cleanly. Okay, I can just wait for either a pullback or resistance breakout how I want. Okay, I can see at this level I already got a pullback. So price decided to fall all the way down, come up, and then pull back to this level right here. Okay, and we just did all the 930 levels. Okay, then it's not okay. This level is important. So if I wanted to, really, I could delete this one. And because we have all the data to the left verifying that this low is valid, okay, and I have a 4-hour close verifying that the pullback is valid, I can easily go ahead and take this up to the next area, like up here, for example, okay, and see if this area up here wants to turn it into resistance. Okay, so you can use certain different scenarios to make bread, just about thinking how logically you want to play. Okay, it's a big puzzle piece, and if you play logically, there's going to be money everywhere. Okay, which is why people just make money by just buying and holding. Okay, it truly can be that simple. So let me check out here. Okay. Even right here on Pfizer, okay, I expect price to come up to this area of resistance up here. Okay. I'm sure I could go to the left and find some good levels of reasons why. Price wants to react the way it does. So we have a low right here. I have one right here. We have another one down here. Okay, go ahead and go to my current price. Okay. So I know if price pulls back to any of these black lines, okay, it's going to be effective for me to go ahead and get in at those positions. 930 low right here too. Okay. The further we go back, the more data we're going to collect. See if everything that we're doing makes sense and correlates. Got one up here. Got one here. All right, and then we go ahead and go to my current price. And guess what? So you can see here that this line that I just went ahead and drew from all the way to the left correlates. Okay, so correlates with this line right here, verifying this low with a push up here. Okay, so on Pfizer here, this trade goes ahead and makes sense too. Okay, you can easily go ahead and potentially take it up to the next black line up here. Okay, so many different ways you can go ahead and take a trade. Okay, many different formations, and it's just going to depend on what way you're looking at the market and how you want to take your setups. Okay, so let me take you through another example here. So let me go ahead and pull up a high liquidity stock. We'll go over NVIDIA, for example. Let me start off on my daily. Okay, logically thinking, I know that the stock market wants to go up. So my take profit is going to be these all-time highs up here, for example. Okay, let me go to my 15-minute time frame. Let me go ahead and start marking my levels. So I'll do levels below current price and above current price. So I got support below current price right here. And you can see which direction these 930 candles are moving in by just seeing how the flow works. So if you clearly see a top resistance wick and then price falling down, then you know price reacted off of the top resistance wick here, not the bottom. Okay, so just check out the flow. You can easily see which direction the price is moving in. Okay, we got a 930 level here. Got one up here. We got one up here. And let's say we got one here. Yeah. It's precision scrolling. And it's taking our time on these setups. Yeah, 930 resistance right there too. 930 support. Price shorted down from here. 930 support here. Okay, and you see everything correlating as well too. 930 support here too. Then we got some down here. Okay, and then once you have your levels, you're good. Okay, you have your data here. You know how to play your reactions. You know what you're looking for. You're not going to be playing without any data or information on your screen. You know exactly what you're going to be looking for. So let's say price decided to go in upwards direction here. Price went up right here. And then we got right here too. These are going to be all the best levels. Anything with the 930 reaction is going to be the best level supply. Okay, let's say we stop there. So I can go to my 4-hour time frame here, just analyze everything. Okay, I can still see that price wants to go ahead and try and at least touch the black line all the way up here. Okay, and as we can see, we got price shorting at this black line here, but we do have a pullback at this level here that did work. So if price pulls back, holds this level here, could potentially be good. Okay, take this up, point there. Okay, maybe break and retest here, potentially break and retest here. Okay, or price can potentially short from these areas too. Okay, resistance mirrors, and these are going to be the cleanest levels to play a lot of the times. So it's about taking your time, analyzing what works, analyzing the cleanest levels, and playing with potentially just needs to be played. Okay, so even right here, we have this area of resistance. So right here. Okay, so yeah, price reacting with this area of resistance too. So break and retest can happen at any of these areas. Okay, and a lot of these areas are going to be about 1 point per. Okay, so it's going to be good money even if you day trade just these small zones in between. Okay, so break and retest, they should work all between these areas, and it's going to be an easier way to just catch your day trade flow. Okay, so if you want to make some money multiple times during the week, okay, just boot up your account, mark out all your levels, and then you can catch your flow. Okay, be responsible with your trades. Okay, and be ready to just close relatively quickly. You can't really cook your trades like this, especially when you're trading on a smaller time frame basis. So even right here, let me go ahead and do all the levels. Starting off on Walmart here, get on my daily. Okay, this price actually already hit all-time highs here. So let's find a pullback level. Okay, that's good. So we know that price wants to at least touch this resistance up here. Okay, so let's find a pullback level below current price. So let me get on my 15-minute time frame. Just pay attention to the dotted line here. Okay, and I'm looking at all levels below current price. So we got this level down here, 930. Got some 930 support down here. Some more 930 support here. Got down here. Okay. Just about marking the best levels that we can find here. One right here. Got one right here. Down here. Okay. This is the bottom wick because price is going up. This is the top wick because you can see price going down afterward. Okay, read the flow. That's how you can determine what candlestick it is. And sometimes it can be easier to detect than others, but for the most part, you're going to be able to get it. In here. Okay. Zooming out. Then we got this area here too. Okay. So just finding the best areas below current price, waiting for price to give us a 4-hour close and pull back to these areas. This area down here. And up here. Here. Okay. And now you have the cleanest levels. Okay, so you can see here in Walmart, if I get on my 4-hour time frame, you can see all the areas where price wants to dip down to. Okay, so if price comes down to any of these areas below current price, it gives me a 4-hour close, I'm going to be good. Okay, I can clearly see that price wants to short down to this level here too. So even if I wanted to take a short, I can clearly see that price wants to short down to this level here on the black. Okay, it's already more than halfway done, and yeah, price definitely wants to make its way here. Okay. And then after price gets here, if it decides to want to bounce here, it's going to be another question. Okay. If it decides to break this level, even after a small bounce, that's fine. You try this level. Try this one. Okay, try this one. Okay, you'll know the pullback area as long as you have your levels down. Then you can go ahead and buy months out, buy some years out, catch the whole sweep back up. Okay, that's going to be a lot more profitable than just catching a tiny burst move. Okay, you know exactly where you're trying to buy. Go grind real life, stay down. Okay, keep grinding bread, keep putting that bread away, and then when the play comes, you can catch the whole move. You can buy the contract that you want, and your money's going to be able to 10x. Okay. So once you have your levels here, just be grateful for bear markets too. If markets ever dipping down, have all your levels placed down. Okay, especially on the stock market, you can take serious advantage of the 930 manipulation, and you can see the best levels. And go ahead and buy a certain amount of shares, or buy months out or years out for options and stuff like that. And just let your bread make bread. Okay, catch the whole sweeps back up. So this is going to be one of the best ways to do it, and to see which levels are going to be clean to play to the downside. Yeah. So if price is going to the downside and you're like, okay, where's the bottom? So these are going to be potential bottoms, and wait for your 4-hour close. Don't buy on the first wick. Buying on the first wick can really get you destroyed, and you might get irritated. Okay. So just don't get irritated and stick to a plan that's logical. So even for Apple here, I can see it bursting all the way up. Even if I wanted to take a pullback trade, I could easily go ahead and do something like this. Mark this level here. This one here. This one here. This one here. Okay, all the data is going to be here for us, okay? Literally all the data is here for us. Everything that we need. Okay, 930 level right here too. Another one right here. All the information that we need. Every ounce of it. on the screen. Okay, all the levels that we need right here. Price decided to bounce upward. Okay, sometimes price is going to go ahead and mirror certain transactions. Okay, price decided to short from here twice. Okay, so resistance once and then resistance twice. So sometimes 930 is just going to mirror a level that happened to the left. Okay, right here, price decided to bounce upward. Price decided to short. Actually, no, price decided to long. Okay, it's about just being precise with what we're looking at. Right here. And then right here. Yeah, a lot of times if there's a lot of lines in one area too, that area could be potential good zone as well too. Okay, potentially right here. Potentially right here. Okay, right here. Okay, so cool. Yeah, these are going to be just the cleanest levels I can find here. Okay. So then from there, I'm going to be able to go to my 4-hour time frame. Okay, and I can look below current price. Okay, if I see price pull back to any of these levels and give me a 4-hour pullback, then I know, okay, inshallah, I'm going to go ahead and be able to get in and catch the whole sweep back up. Okay, so I'm only looking at 930 levels personally, waiting for pullbacks and catching the whole sweep back up. Okay, so that's how you trade if you see something bursting up. Okay, and don't buy things when they're overextended. Okay, wait for price to come back to these levels and catch it back up. Promise you, it's going to be a lot more worth it on your risk to reward and on your P&L. Okay. Class, let's get into stack mode. Let's talk about 401ks and Roth IRAs. Let's put that money to the side and let our money grow into more money. Inshallah. Let's jump into it. Let's talk about how. So we're going to be understanding the fundamentals of retirement accounts and how they function. And we're going to talk about the difference between a 401k and a Roth IRA, the difference between their rules, the benefits of them, and the tax implications. And we're going to talk about some real-world strategies to maximize returns and employer benefits, and develop a step-by-step plan to begin investment for retirement with confidence. So what is a 401k in general? Okay. So a 401k is an employer-sponsored plan that allows employees to invest a portion of their paycheck before taxes. So say you're about to get paid $1,000, right, to your bank account. Instead, a portion of that, let's say $200 of it, would go into the 401k, okay, which is going to be a place where your money can turn into more money, okay? So again, a 401k is an employee-sponsored plan that allows employees to invest a portion of their paycheck before taxes, and is designed to grow your wealth until retirement, helping you build financial independence over time. Imagine you earn $50,000 a year and decide to contribute 6% of your income. That's $3,000 annually going towards your future. If an employee matches 50% of that, you're getting an extra $1,500 for free. So understanding the Roth IRA in general. The Roth IRA is a personal retirement account funded with after-tax money, and it gives you the gift of a tax-free growth and tax-free withdrawals and retirement, extreme advantage. So instead of losing, let's say you had, so taxes go by brackets, right? So taxes go by brackets. So the more money you make, the more you're gonna get taxed, okay? So let's say you're about to withdraw, let's say you have 500,000, right? And your 401k, say you have a really good paying job, right? Say you've been putting a really, really good chunk of your percentage income into the Roth IRA, right? Let's just say hypothetically, okay? Then, and I know certain things are capped at 8K a year, okay? So a lot of them, you can only deposit 8K a year and stuff like that for certain of them. But let's just say, for example, for $500,000, let's say you're about to withdraw that, okay? Then you would have to pay 40% on that normally, okay? And that's just 37%. Around 37% of that if you are about to withdraw like 500K, for example, okay? So, but if you make a lower amount and you withdraw a lower amount, then you're gonna pay like taxes. But still, you don't want to pay any taxes at all if possible. You want to try and get as much money as possible, especially if it's from your work check. So yeah. So you can withdraw contributions, not earnings, anytime without penalty. Okay, because from our job we already lose taxes or money from taxes anyways. So building a solid retirement plan. So focus on clarity. Okay. Small, consistent actions lead to major outcomes. Keep stacking up cash. It's the whole reason why I'm Stackmode Chris. I want to teach you guys, one, how to keep God first. Make sure you guys are praying. Make sure you guys are staying humble. And make sure you guys understand that you don't need too much. Okay, especially not right now. Okay, there's going to be times where you're going to have time to pop it. Okay, if you want to know what popping it is, there's going to be times where you're going to be able to buy the cars you want. Okay, you can buy the houses you want. Okay, you can get the clothes you want. Okay, inshallah, if God wills. But we got to make sure that we're investing first. Put that money to the side. Don't go buy the Jordans and the cars, the houses, and the clothes now. Invest into something that's going to make your money turn into more money. Okay, so put some money to the side. Okay, instead of getting the whole check from your job, put some more into your 401k. Okay, put some to your Roth IRA. Put some aside. Stack it up. Let your money turn into more money. Money's a tool. I cannot stress that enough. Money's a tool. Don't be too attached to it. Even if you go flat zero, God got you. All right, keep praying, stay consistent, can run it back up again, and don't give up. Promise you, I've gone flat zero plenty of times. Okay, trusted God, stuck to the process, and ran it up. Okay, gone flat broke, in debt, was managed to clear it. Okay, and just keep grinding. Okay, wake up, keep praying to God. Wake up, keep stacking up that cash. Okay, and I've learned from those lessons. Okay, learned to live way below my needs. Only groceries. I don't eat out anymore. I don't buy clothes every day anymore. Okay, I'm not buying steaks like that anymore. Okay, I'm in stack mode. Okay, I'm praying to God, I'm working out. Okay, I'm not going outside if I don't have to. And I'm working hard. I'm mastering my craft. When I'm getting paid, I'm putting most of the money away. I'm investing. Okay, being grateful for the opportunity that God gave us. Okay, and our body can only take so much. So let your money turn into more money so you can enjoy life. All right, take care of your mental health, enjoy a trip with your family, enjoy a trip with your wife, your husband, and do what you need to do. Stay consistent and stay praying up to God and just keep grinding. I'm telling you guys, it's gonna pay off. When you save the money and you put it away, act like you're broke, okay, but have it all invested. Okay, I'm telling you, if you act like you're broke and you just invest, it's gonna be amazing for your mental health. It's gonna make you stay consistent. It's gonna keep you hungry. It's gonna make you a dog, okay? You're going to keep going hard at your craft. You're going to want it bad. You're going to be asking God for help in each and every scenario. Okay? Stay consistent. Put the money away, invest it, act like it doesn't even exist. And I promise you, you're going to be able to run up that big bag. Inshallah, you're going to be able to take care of your whole family. Inshallah, stay consistent. Okay? Stay out the bar. Stay out the club. Okay? Don't be doing things you don't need to be doing. Stay away from people who aren't being consistent. And keep going. You got people to take care of. I promise you. You're going to be feeling like the one when it's all said and done. Stay down. It's going to all make sense. Whatever you're doing, stay down with it. And it's going to make sense. And then I promise you it's going to make sense in the end. Stay down with it. So I don't care if you guys have $50 right now. Okay. Put 25 of it away and stay down. Okay. Live off the other $25. Stop spending the whole check. When you get paid, put it away. If you make $1,000, right, a check, pay your bills, okay? Take care of your groceries, take care of who needs to be taken care of, your kids, your people, husband, wife, whatever. Do what you need to do, okay? After that, right, make sure it's straight things you guys need to be taken care of. Nothing but bills. If it's not bills, forget it. If it's not bills, you don't need to be spending money on it. Take care of your bills, take care of your groceries, and then invest. You gotta act like you're broke. Stay down. Okay? Invest right now. If you got $5, invest $4 and stay down with that $1 until you run it back up. Okay? It's the mentality. And even once you start touching 6 figures, 7 figures, 8 figures, 9 figures, you're gonna be in that stack mode mentality. You're gonna wake up, pray, go work out. Put that money in the stash. Even if you make 50 grand, they're gonna go ahead and put 45 of it away. Live off the 5 grand, okay? Stay in stack mode. It's gonna make you guys stay consistent, and it's fun. Because you can go to the stash and go pull an M out at any time. Stay down. You could wear the same fit every single day. You could drive a beater car if you want. But you know what you have in the stash. Don't let anyone break you guys down. You guys are good. Okay? Wake up, pray to God, and stay humble. Stay humble. Keep grinding. If you're not where you want to be, understand it's a marathon. You're not going to get it overnight. It's not going to happen overnight. There's plenty of times I've been grinding 18-hour days thinking things weren't going to work out. And I'm telling you guys, if you pray to God and you keep going, there's a great chance that you're going to get what you want. Inshallah. It's good for you. All right? God's the best of planners. Just keep going. Keep going hard. Stay down. Even if you see your portfolio on the reds right now, stay down. Okay? Ask yourself, if this is a good investment, okay? If this is something I want to be invested in, okay? And just don't give up. Okay? Don't give up. Stay consistent. I don't care if it's your 401k, your Roth IRA, or individual portfolio. Stay prayed to God. Keep grinding. Review your portfolio and just don't give up. I'm telling you, it's all going to play out in the end. Stay consistent. Peace. All right, let's talk about what liquidity is in crypto. Let's make it easy. Liquidity refers to the ease to which an asset can be bought or sold in a market without significantly affecting its price. And in crypto, it's critical due to the market's volatility and decentralized nature. Volatility means quick price action. Crypto is always going 24/7, so the market never slows down. There's going to be spikes that can happen in the middle of the night while you might be asleep, stuff like that. And it's also decentralized, meaning that everything is done on the peer-to-peer transaction system. Okay, and there's going to be no middlemen involved, no banks involved, and no one to approve whether or not yes or no the transaction is going to go through. Just as soon as it goes through, everything's automatically done via the smart contracts, and then the cryptocurrency can be sent from one party to the other very, very successfully, inshallah. So trading volume. Higher volume indicates better liquidity, okay, and volume is pretty much going to indicate money. Okay, so the higher volume something has, the more money something has, which is going to equal the more people playing it a lot of the times. And major coins like Bitcoin and Ethereum are more liquid than small cap tokens due to the fact that they have more money involved in them since more people trade them, and there's going to be big companies, governments, and hedge funds putting money into it. Okay, big whales. Whales are going to be people who have large amounts of money, and when you have whales investing into something, something's going to have way more liquidity than other things, depending on how popular it is and how heavily invested something is into. And centralized, it's going to be Binance, and something decentralized is something like Uniswap, and the type of exchanges impact the liquidity. For example, Bitcoin on Binance has a high liquidity due to its large order book, allowing large trades with minimal price impact. So why does liquidity matter in the first place? Liquidity affects trading efficiency, cost, and strategy. Low liquidity can lead to significant price swings and higher cost. Price stability. High liquidity reduces volatility for large trades, meaning that if someone puts on a long, prices are going to burst into oblivion, or if someone puts in a sell, prices are going to dump down into the ground. Okay. And execution speed. Liquid markets allow for faster trade execution. Since there's going to be more people trading, there's going to be more of that asset, whatever you're trying to trade, available. Okay, so the more volume means the quicker you're going to be able to get filled, and the faster you're going to be able to trade. And lower cost. Tight bid. Okay, a lot of the time the bid is going to be what you sell at, and the ask is going to be what you buy at a lot of the times. Tight bid and ask spreads in liquid markets reduce trading fees. Okay, so you want your bid and ask spreads to be as close as possible. Okay, you don't want your bid to be way like lower than your ask and stuff like that, vice versa. Okay, because you don't want to buy something with a high ask and then you try to sell it and then the bid is super duper low because there's not enough liquidity. Okay. And risk management. Liquidity ensures that you can exit your positions quickly. So I'm not too sure if you've entered into something with low liquidity, but if you ever tried to sell and price is just pausing, not selling, not doing what you want it to do, that's most likely because the liquidity is low. Okay. So when you're trading things with high liquidity, you get to avoid that and you get to really just trade how you want quickly and almost instantaneously. For example, Bitcoin versus a low cap token. Trading 100K of Bitcoin on Coinbase has minimal price impact, okay, because there's so many people with millions of dollars worth of Bitcoin. While the same trade in a low cap token on a DEX might move the price 10%, Okay, because you're going to be a lot of the liquidity, you're going to be a lot of the volume, you're going to have a lot of the money controlled in it, you're going to be one of the largest investors. So what you do can move the market. Okay, but when you invest in things with high volume, okay, it's not going to have big impact because as it's going to be other whales too. So understanding slippage in the first place. Slippage is the difference between the expected price of a trade and the actual executed price, often due to low liquidity or market volatility. And what impacts slippage? Large orders in low liquidity markets cause significant slippage. Okay, so that means that when you try to sell, there's going to be no one to fill you. Say you buy like 60% of a random coin, who are you going to sell it to? You own majority of it. Okay, so it can be a little difficult sometimes when you own a majority of it. And yeah, timing. Slippage increases during volatile periods, like the news events. Okay, and order types. Market orders face more slippage than limit orders, and you could still own, like, it's a little bit different between the stock, okay, because there's going to be a lot of legal processes and stuff in place to have shareholders buy like all the stocks on the back end and stuff like that. I'm going to make sure I detail how stock shares work and stuff like that more in depth again and again. But cryptocurrency, you can pretty much be centralized by owning a large percentage of it and just being a large investor. Okay. And automated market makers, AMMS, like Uniswap, can calculate slippage based on the pool swap. So on Uniswap, swapping $10,000 in a small pool might cause 5% slippage, meaning you get 5% less value than expected in the first place. And how does liquidity affect slippage? Liquidity and slippage are inversely related, and higher liquidity means lower slippage due to the fact that there's more orders. Okay, so when there's more orders, there's going to be less slippage. Okay, liquidity pools and DeFi, larger pools. Okay, USDT, Ethereum, for example, they have lower slippage. Okay, due to the fact that they're very popular. Market participation. More traders increase liquidity, which stabilizes prices. In thin markets, low liquidity tokens can see 20% plus slippage on moderate trades. Okay, due to the fact that there's not enough orders, once again. And a 1 million USDC ETH pool on Uniswap has low slippage, okay, for a $1,000 trade. But a 10K pool for a small token might see 10% slippage, okay? Which means you're gonna go ahead and receive less money when you sell, and yeah, it's pretty much what it's gonna mean. And factors influencing crypto liquidity. Several factors determine liquidity in crypto markets, impacting strategies. So think of slippage kind of like fees. So exchange type. Centralized exchanges often have higher liquidity than DEXs, and high market cap coins often attract more traders due to the fact that people know it's going to be a solid value investment, okay, and they can go ahead and get some APY, some annual percentage yield returns on their dollar, which means that year after year they expect their dollar to go ahead and increase by just buying and holding in something with value. And trading volume. Higher volume correlates with better liquidity as well too. And market maker activity. Bots and institutions provide liquidity on major platforms, which help move the market. And 24/7 is how the crypto market moves. And the markets enhance liquidity, but they vary by region. For instance, Binance's Bitcoin USDT pair has a high liquidity due to its global user base and market maker activity. And let's talk about managing slippage in trading. Traders can minimize slippage through strategic approaches and tools. Using limit orders. Limit orders specify your price to unavoid expected limits, and with limit orders, you won't get your price filled until price comes in contact wherever you have your limit order. Check the liquidity. Review order books or pool sizes before trading and check out the volume. Make sure it's decent. Okay, don't be trading small stuff and then you have a large percentage of it you try to sell and then you can't get out. That goes for the same thing with options too. And smaller trades. Break large orders into smaller chunks to reduce the price impact. Okay. And timing. Trade during high volume periods to leverage better liquidity. And on an example, on PancakeSwap, setting a 0.5% slippage tolerance for a $500 trade ensures you don't lose more than $2.50 to slippage. So some tools for assessing liquidity. You can use CoinMarketCap, CoinGecko, okay, to check the trading volume and the market depth. TradingView shows you as well too, whatever you want to use. Check out the order book. Platforms like Binance show you the bid-ask spreads and what whales are doing and stuff like that too. You're going to be able to see some programs where you can check to see how large amounts of money are flowing in whatever token that you're researching. And the DeFi Pulse. It tracks liquidity in DeFi protocols, as well as DEX analytics, like Dune analytics to show pool liquidity. Okay. And we're not going to make that. Forget that. And Dune analytics can reveal a Uniswap's pool liquidity depth, helping you predict slippage for a $10,000 trade, for example. So low liquidity tokens on Uniswap saw 20% slippage during hype-driven trading, costing trader thousands of dollars in fees kind of for no reason. And high liquidity during the 2023 rally allowed $1 million in trade with 0.1% slippage, showcasing centralized exchange efficiency. So things with higher market caps, okay, are going to go ahead and have less slippage a lot of the times since there's enough orders, value, and enough back end, okay? And liquidity in central versus decentralized exchanges. Centralized and decentralized exchanges handle liquidity different, impacting slippages. CEX, this is centralized, is high liquidity via order books and market makers, okay? For example, Kraken's BTC / USDT pair, okay, or ETH / USDT, okay, something like that. And a DEX. And liquidity pools vary by size, and they have small pools to increase slippage. And trade-offs. CEXs offer lower slippage, but they require trust, and DEXs are trustless, but riskier for low liquidity tokens. For example, $50,000 on Binance has less slippage than a small Uniswap pool. So monitor the volume, use stop loss limits so you know when it's time to close your trades. Make sure you're doing your research on what you're investing into, okay? Batch your trades, split large orders to minimize price impact, okay? And for instance, splitting a $100,000 trade into 10 $10,000 trades on Uniswap can reduce the slippage from 5% to 1%, for example. So little tools and tricks you can use to go ahead and reduce your slippage fees. And exercises for understanding liquidity and slippage. You can check the BTC USDT liquidity on Binance, okay, for 30 minutes, okay? Just study the charts, okay? You can simulate a $1,000 trade on a DEX and calculate the slippage. And you can analyze the low liquidity tokens, order book on CoinGecko as well too. And go ahead and check out the trading forums, Reddit and stuff like that, and just do your research. And comment below, how have liquidity and slippage affected your trades? Did you lose any money to it? Talk to me about it in the comments below. What strategies do you also want me to cover? Head over to stackmode.net. Catch you guys in the next one. Stay prayed up to God. Keep grounding. Catch you in the next one. Peace. So, psychology, it matters. You can have the best levels on the chart and still mess up a trade, okay? How you're thinking about the charts, the long-term perspective, okay, that you need to have whenever you're trading is going to affect whether or not that you're going to be profitable. If you have an instantaneous mindset thinking that you need to make some money every single day, okay, on the market, you're most likely going to lose, okay? You got to understand that you don't have to trade every single day. You don't have to take 10 trades in a single day, okay? You can have a long-term perspective. Understand that you're in the market to trade year after year after year after year after year. Okay, some of you, if you want to do this until you die, if this is what you say you really want to do, then this is what you need to be doing. Okay, so go ahead and do that. So emotional control. So fear of missing out, FOMO, greed, and revenge trading are the greatest account destroyers. A successful trader replaces impulsive reactions with measured responses based on probabilities. Okay, capital preservation. Keep your money in your account, okay? Save up your money. There's gonna be certain things down the line, okay? Certain things that might come up that you have to pay for, okay? And invest your money into certain long-term positions so your money is always gonna be making you money, okay? So when your money's always making you money, you're gonna always be in a good position in order to keep investing and keep getting to where you need to be. So the primary goal of every trade is to survive. Profit is gonna be secondary, okay? You should be focusing on the trades that you're taking where your account is gonna be alive. Okay, take the trades where you're not going to lose money, okay? Not focusing always when you're going to win money,
Okay, if you take the trades focusing on how you're not going to lose, if you take the trades that are going to be probable, having a long-term perspective on the market, okay, investing in things with good future value, then you're pretty much never going to lose, inshallah. Okay, but if you're fiending, okay, for every trade, being hasteful, okay, not taking it serious, okay, over trading, oversizing, you're going to blow your account, okay, and you're going to get the results that I used to be getting when I used to have so much ego, so much pride. I put myself into debt, okay, made myself struggle, made myself go through a lot of hardship, a lot of losses due to the fact of I was just being an idiot, okay. And I thank God that I was able to get better, and I just pray and try and get better every single day, okay? Because losing capital like that is not okay, okay? It's pretty easy to grow your account, okay? Especially once you get the real solid grasp of the market, you understand how you should be implementing your trades, you know what type of setups you're looking for, you know how much you should be risking, okay? And if you want to learn all of that, head over to stackmode.net and I can teach you the same things, okay? And just like I've taught many of my students, you can check the reviews out as well too, real proof. Alhamdulillah. But just putting all of that into perspective is really going to let you know, like, okay, I have to succeed. I have to go hard no matter whatever's in my brain. Okay. No matter how many times I blow my account up, I have to run it back up and keep trying again. But you don't want to keep blowing up your account. Just stop the things that you're doing. Okay. If you have too much ego, if you have too much pride, whenever you take a loss, humble yourself to God. Okay. Get down on your hands and knees and really feel that. Okay. Humble yourself and be grateful to the Creator. Okay. Because doing that is going to help you come onto the charts with a lot more humble mindset. And protecting your capital through strict risk limits is the foundation upon which consistency is built. And the illusion of riches, okay? One, the internet can be capped. Sometimes people that you see on the internet with certain things, it could be through fraud, stuff can be rented, okay? So don't believe everything that you see on the internet, okay? I'm not here to flex. I want to just educate you guys. Sometimes I might post a little stuff here and there, but I'm a purely educational channel, okay? So trading is a skill required time and deliberate practicing, okay? It's plenty of times, even to this day, still on the charts, at least 4 to 8 hours a day, okay? Still, to this day, okay? It probably will be, inshallah, for the rest of my life, but especially when I was first starting doing 24-hour plus sessions on the start, just studying, okay, on the chart, just 24 hours a day, okay? Week after week after week, month after month after month. Okay, it took like 2 years to really get a good solid grasp of the market. Okay, so keep going. It's going to require time, and think of the get rich slow process. You have to be in it for the love of the game. This is why I'm an educator, okay, because I really love this. I want to understand everything about it. I'm not just here for money. Okay, I understand that trading is not a lottery ticket, and everything within the finance world, it has a logistical process behind it. Okay, you can't be expecting quick, massive returns instantly. Grow your account via discipline, being consistent, okay, and keep grinding. And massive returns can sometimes lead to oversized risk and inevitable burnout. Okay, focus on the process and fall in love with the game. Don't get focused on the money. Okay, and when you get focused on the game and the process and the discipline, the money is going to go ahead and come. Okay, I promise you guys, inshallah. So, discipline, adhering to the system. So have a strict trading plan. A trading plan is your non-negotiable set of rules and must define specific entry criteria, profit targets, and most crucially, your absolute exit trade strategy for losing a trade. Trading without a plan is going to be gambling. Okay, if you want to go throw dice in the casino, go ahead and go do that. It's haram. God says don't do that for a reason. But okay, if you want to just continue to not get to where you want to be, okay, if you want to continue to fall downwards in negative directions, okay, keep gambling, keep trading without a plan, keep trading without logic, okay, keep failing yourself. And make sure you're having some predefined risk installed too, okay? You should be risking 1 to 10% of your account per trade, okay? Never try and go any more than that, okay? And discipline dictates that position sizing is determined by the stop loss distance, not emotional conviction. And this ensures that no single loss can critically damage your equity. And patience and timing, it's gonna be extremely imperative. God tells us to be patient for a reason, okay? The market gives the best opportunities to those who wait. Disciplined traders wait for A+ setups that meet all the criteria. I like to wait for S+ setups, stack mode setups, okay? Resisting the urge to enter early or chase moves. And time spent waiting is capital protected, okay? So, keep trading between 1 to 10% of your account, okay? Even if you trade with 10% of your account, it would take you 10 trades in order to blow your account, okay? So whatever percentage that you guys like, use that,
Okay. So consistency, repeating positive behavior. So let's talk about execution and fidelity. No deviations. Consistency means executing your trading plan 100% of the time, regardless of whether the last trade won or lost. Okay, is a 60% win strategy. Okay, percentage equals money on. Okay, percentage equals money. So that's why I have this here. And requiring 100% consistent execution to deliver its expected outcome. Okay, if you're a break and retest trader, you're going to be waiting for resistance to be broken and turn into support. That's just what you do. You're going to stick to that. Okay, and don't change it up. Okay, stick to what you know. Journal your trades. Okay, I'm dropping the Stackmode app soon, so you guys are going to be able to journal your trades there. Do it on Discord, Notion, wherever you feel needed. So journal documents why you took the trade, your emotional state, and whether you adhere to the plan. And it's a feedback loop, and you can't improve what you do not accurately measure. And this is critical for objectivity and allowing the edge to play out. Your strategy provides a statistical edge over a large sample size. Okay, for example, over 100 trades, see how things are playing out. And consistency ensures that you capture the statistical advantage. And inconsistency destroys the sample and invalidates your entire system. Okay, and warning, the inconsistent trader. The inconsistent trader moves their stop loss. Okay, you don't need to be doing that. Sizes up after a win and trades not in the plan. Okay, they cannot analyze their performance and they attribute wins to skill and loses to bad luck. Okay, which is not happening. Okay, and the results are purely just random noise and occasional. Okay, so your wins are going to be coming to the fact that your skill comes from your consistency. Okay, but you can't just be on the 1 minute scalping thinking that you're playing a mini game and making some money. Okay, and analyze your performance, see how you're working out, and see how much money you're making year after year. That's really just going to be the best performance measure in everything. Okay, see how much you're understanding and see if you're repeating the same things. So the power of the compound returns. Small, consistent gains protected by strict discipline are reinvested and generate exponentially larger returns over time. Focus on the percentage gain, not the dollar amount to leverage its power. Okay, focus on the long-term vision of the market whenever you're grinding. Okay, and trading longevity. Discipline ensures that you survive market volatility and drawdowns, and consistency ensures that your account grows. And the combination guarantees that you stay in the game for decades, which is the only way to achieve financial freedom through trading. Okay, building real wealth, no scam, no lies, building real wealth, and consistent versus volatile growth. Okay, consistent trader, making 5% a month, for example. Okay, month 6, you'd be at $13,401. Okay, that's $3,000, $401 in profit. Okay, by month 12, okay, a year in, you'd be up $17,958. That's $7,000, $958 in profit. Okay, and a volatile trader. Okay, let's say they start with $10,000. Okay, then they go down to $9,850. Okay, then they go down to $7,500. Okay, and you could still come back, but volatility and large drawdowns can destroy your capital, and consistency guarantees the compounding edge works. So make sure you're losing a consistent amount. Okay, and be careful. Okay, if you're going in a downward spiral, don't try and oversize and add more money to your trades trying to make it all back. Consistently build your way back up, and you have to earn your position sizes. So the tale of two trades, let's check it out. So the disciplined trader. Okay, so the disciplined trader waited 3 hours for the stock to pull back to their EMA, for example. Okay, their A+ setup. Okay, or S+ setup. They waited for resistance to be broken, turn it to support. Risk management. Okay, their position size risk to exactly 1 to 10% of their capital. Their stop loss is placed, which is an order that's going to automatically close their trades, defined at a technical level, and then they're going to have action. The trade move against her. Okay, hitting the stop loss, and then they accept the small loss without emotion. Okay, knowing they're going to come on, plot an even better trade, and see if they're going to win the next time. Okay, and 1 to 10% of her loss is gone. The account is still intact and ready for the next setup, having executed the plan amazingly. So whether you take a loss, even if you didn't make money, okay, if you stuck to your trading plan, that's going to be a win. Okay, let's go over the emotional trader. Okay, they chased the price 5% after it broke out, convinced it couldn't stop. Okay, that's FOMO. FOMO, getting in at the very highs
Then they get whooped back on. They use maximum leverage. Why? Because they were probably already in drawdown and trying to make some money back. Okay. And no stop loss planning to see what happens, since they just made a quick emotional decision. Okay. So never have fear of missing out. Plot your trades, and don't worry about someone else's setup. That wherever that trade you're looking at is someone else's setup they're waiting for. Wait for God's plan for you. And action. The trade reverses quickly because when they bought at the all-time highs and putting him down 15% and moves his stop further out, okay, dragging a stop loss, hoping for a return, revenge trading, okay, causing a 25% loss, okay, and then they'll panic sell, critically damaging your account and confidence and making it feel like trading's a scam, the market's a scam, overall, due to the fact that you just made an emotional decision. So don't ruin your perception of the market based off of just a couple of things, okay? Stay consistent. And the value isn't in the result of a single trade, but the fidelity of the execution. And the formula recapped, okay? So discipline, okay, plus consistency is gonna equal profit, okay? Focus on the process and the profits will follow, inshallah. Trading success is gonna be built daily. It's not gonna be found instantly. It's gonna take time. Okay. Stay productive, God, keep grinding, and head over to stackmode.net. Catch you guys in the next one. Peace. What's going on, class? Today we're going to be talking about layer 0 protocols. Let's go and let's jump straight into it. So what is layer 0 in the first place? Layer 0 is the underlying infrastructure that connects and supports different blockchains, also known as layer 1s. So the foundation. So layer 0 is like the internet protocol. It's like the IP address, but for blockchains. And it provides the base layer for communication and security. And layer 1 protocols, like Bitcoin or Ethereum, are built on top of the network provided by layer 0. And enabling interoperability. It solves the walled garden problems where chains cannot talk to each other. And it allows for trustless transfer of value and data across different chains. And it's key for realizing the vision of a connected multi-chain future. So this way, cryptocurrency, the whole infrastructure, whenever money is being sent within the network, everything can be securely done. And shared security. It allows for smaller, less established chains to borrow security from the robust layer 0 network. And it reduces the cost and complexity of launching a new secure chain, and is vital for the stability of niche decentralized applications. So, Polkadot, it's the relay chain, the central hub of the Polkadot network. It handles the finality and consensus for the entire network, and it does not process user transactions like token transfers. And it maintains security by coordinating all connected chains. And layer 1s, parachains, they're independent application-specific blockchains, and these are the layer 1s that process transactions, okay, for DeFi, gaming, and identity, and they rent a slot on the relay chain for shared security, and they can have unique governance models and features, and Polkadot uses shared security and a centralized relay chain approach. So let's talk about Cosmos, also known as Atom. So the SDK and Tendermint. They're tools that let developers launch independent blockchains easily. And Cosmos SDK is a modular framework for building application-specific chains. And the Tendermint, it provides the consensus engine for instant finality and security. And it allows chains to be launched in weeks, not months. And IBC stands for Inter-Blockchain Communication, and it's the standard for chain-to-chain message passing. And it allows sovereign chains to connect and exchange tokens and data. So it's going to be a big link for everything. And each chain manages its own security and validators. And IBC, Inter-Blockchain Communication, is the fundamental layer 0 protocol for communication. And Cosmos uses sovereign security and a decentralized hub and spoke model. So the blockchain layer stack. Let's talk about layer 2s. And the purpose of layer 2s is to scale a single layer 1, okay? And examples are Arbitrum, Optimism rollups, and they improve transaction speed and lower fees by bundling transactions off of the chain. And layer 1s, purpose of layer 1s are going to be to execute and implement finality via smart contracts. Smart contracts are going to be the autonomous contracts that let the cryptocurrency space pretty much operate. Okay, so when you have smart contracts implemented, no middleman is going to be involved. So take a normal bank account system, for example, you would have to have a bank intermediary to confirm transactions or decline the transactions. Okay, but we can go ahead and bypass that by using smart contracts in the cryptocurrency sphere. So this is why the decentralized finance system and the whole blockchain sphere is extremely popular in the first place. It brings a lot of power back to the people, and people are going to be in an effective way to where they can go ahead and just transfer money. Say someone is completely out of in a different country, for example, you'd be able to go ahead and send them however much money you want to, whenever you want to, and it would go ahead and hit their account within their crypto wallet within a couple of minutes or hours. Okay. So, but using the traditional fiat bank systems, say you try to send, 1,000 USD to somebody in, let's say, Thailand using bot. Okay, there's going to be fees behind that, etc. Okay, but cryptocurrency, there's going to be fees. Okay, gas, also known as the fees, and those are just going to be tiny network fees involved to just send your money from one place to another. Sometimes they could stack up depending if you're sending a large amount, but a lot of times if you're sending a large amount, the fees realistically aren't going to matter too much depending on what network you send them off of too. So that's also going to be a big factor too. And let's talk about layer zeros. The purpose of layer zeros affect interoperability and provide a network setup. And examples of layer zeros are going to be Polkadot, Cosmos, and they allow layer ones to communicate and share security, forming a network of chains. And the future is going to be all interconnected. And layer zero is going to be the foundation of everything. So think about a house, okay? What's below a house, especially that's tall? A lot of the time it's going to be pillars. It'll be connected to some mountains. Okay, a lot of the times the house before it's built, it's going to have a B structured on a base. Okay, and layer zero is going to be the base. And layer zero connects all the building blocks of Web3. So the whole cryptocurrency sphere, okay? And it moves beyond single isolated chains. And the interoperability race. Polkadot and Cosmos represent two of the leading distinct architectural approaches to this critical problem. And layer zero enables a seamless, cohesive, decentralized internet. So within the layer zero functionalities, okay, we have to understand that, okay, it's used to connect all of the blocks within Web3, okay? And it's gonna be a hub. It's gonna connect the separate layer one blockchains that would otherwise operate in silos. And developers can also build custom blockchains like layer ones, tailored to specific use cases, using the tools, consensus mechanisms, or security provided by the layer zero. And layer zero offers a shared security model where multiple chains can inherit the security of the base layer's validators or consensus mechanisms. And some layer zero protocols focus on ensuring data availability for transactions, allowing layer one chains to process transactions efficiently without storing all data on the chain. So Polkadot, for example, uses a relay chain, okay, for layer zero to connect multiple parachains, which are layer ones, enabling interoperability and shared security. And developers can create custom blockchains, parachains, tailored to specific needs like DeFi or gaming. Okay, so like a token like DOT. Okay, and the token would be DOT. So that's just how layer zero works within the cryptocurrency space. Okay, and just think of layer zero as the internet's core infrastructure. Okay, think of it as the cables, okay, the base to a house, the routers and the protocols. And think of layer ones as the websites or the apps. Okay, like Google or Amazon. And layer two is the tools that optimize those websites, like content delivery networks. And layer zero makes it possible for websites to exist and communicate, even if they're built zero and built differently. And here's why layer zero even matters in the first place. As blockchain adoption grows, the need for scalable, interoperable, and customizable solutions become critical. And layer zero protocols address the limitations of isolated layer one blockchains, enabling more connected and efficient decentralized ecosystem. And they're particularly relevant for DeFi, NFTs, gaming, and other applications requiring cross-chain functionality or high throughput. Okay, and if you want to learn more about layer zeros or cryptocurrency in general, head over to stackmode.net. Stay prayed up to God, keep grinding. Catch you guys in the next one. Peace. I'm going to go ahead and break it down and make it easy. So what exactly is trading volume in the first place? So volume is pretty much going to be the amount of people and the amount of money being flowed into a cryptocurrency token, stock, or whatever. So whenever you hear the term volume, just think about the amount of money that's being flowed into or out of something, as well as the amount of people that's trading it. So it's a fundamental metric that represents the total number of units of a cryptocurrency, for example, in this case, that have been traded over a specific period. And it's a simple yet profound measure of market activity and liquidity. And think of it as the heartbeat of the market. And a high volume indicates a strong, healthy pulse, while low volume can signal a weakening or stagnant market, and encompasses both buy and sell orders that have been executed, reflecting the total flow of capital into and out of a particular asset. So let's talk about the total transacted value. So volume is often reported in both the base currency, for example, Bitcoin, Ethereum, for example, and the quote currency, aka USD, USDT. A volume of 10,000 Ethereum on a given day means that 10,000 Ethereum coins were exchanged between buyers and sellers. There's also going to be time-specific measurements involved too, and volume is always measured over a defined time frame, such as 24 hours, 1 week, or even a single minute. And this temporal context is vital for analysis, as a sudden spike in a 15-minute period can signify certain sudden movements within price, even if the daily volume remains average. So if you see a bunch of volume coming in within like a 15-minute time period, then you know lots of flow coming in. Maybe a whale might be purchasing, okay, somebody putting in a large amount of orders, okay, or a large amount of orders being flowed into a specific direction. Okay, that's going to be volume. Whenever you see price action being flowed into, whether it be it on the flow chart or via the order book, okay, you're going to be able to see all the transactions happening, and the more transactions you see, the higher the volume. So let's talk about liquidity indicator. So a high trading volume is a direct proxy for liquidity. An asset with high liquidity is easy to buy or sell without causing significant change in its price. And this is crucial for large-scale traders and institutions who need to enter or exit positions without a large price impact, also known as slippage. So slippage is pretty much where you're not going to be getting all the money that you're intending to receive. So say you sell for a profit of $500, okay, you're expecting to get all that $500. But depending on your broker, depending on the fees, also known as gas, etc., stuff like that, okay, then you're going to be able to calculate the amount of slippage that you may have to pay for. Okay, and slippage is pretty much going to associate itself with fees. So slippage, say you make $500, okay, you might withdraw $480, okay, due to the fact that the other $20 would have to go to the slippage. Okay, so that's slippage, for example. So why is volume crucial in the first place? So for crypto traders, volume isn't just a number. It's a validation signal that confirms the strength of a price move. So for instance, if you see on the order flow chart or the flow chart in general, and you're intending to play within a bullish direction, right? You're intending to long the market, and you start seeing a bunch of buying coming in, then you could kind of put together with your technical analysis along with the flow chart. Okay, if you start seeing volume, especially buying volume coming in, then you can go ahead and be like, all right, you know what, I might be right, and go ahead and take a trade based off of that. So it can be some good validation to come in because you're going to see other people making trades. Okay, so it's going to be a level maybe everyone might be waiting for. And if you see a bunch of volume price coming in in your intended direction, then it could mean that that's a good level and you're most likely right. So price increase or decrease is far more meaningful when it's accompanied by high volume. Without this confirmation, a price change could be fluke or the result of a single large transaction, also known as a pump. So that can be unsustainable, and certain high volume tokens grow year after year after year after year. But if you just see a bunch of selling coming in, for example, on like a meme coin stock, then that's what certain coins, like such as the pump and dump or rug pull coins, that's where those terms come from. Okay, so volume gives us a window into the market consensus and what's going on. So give us an example here. So the bull trap. So imagine Bitcoin price rises 5% in 1 hour, but the trading volume was unusually low for that time of day. A savvy trader would be cautious, and this low volume price surge could be a bull trap, and a false signal is designed to lure buyers before the price collapses. The lack of the significant volume indicates that not many people are participating in this price move, suggesting it lacks genuine market support. So volume can help you with confirming certain price trends. Okay, so a strong upward trend is going to be confirmed by increasing volume on up days and decreasing volume on down days. And this shows that the buying pressure is strong and consistent. Conversely, a downtrend is confirmed by high volume during price drops, indicating strong selling pressure, for example. So volume can also help you identify reversals. So when a market has been in a long downtrend, a sudden spike in volume as the price starts to rise can signal a potential reversal. And this is often the first sign of institutional or smart money entering the market, absorbing all of the selling pressure. And it can help you validate breakouts too. This is also going to be something I've talked about quite a bit on my channel as well too. When it comes to breakouts or certain levels, confirming it with volume, confirming it using the order flow chart is really going to go ahead and help you out. Okay, you can also look at your order book, tape, whatever you want to look at, and volume can help you validate breakouts. And a breakout is going to be when price moves outside of a defined resistance or support level, and a breakout with high volume, which means a bunch of people are intending to trade in that place too. So a breakout with high volume is considered a genuine sustainable move, while a low volume breakout is often considered a fake out or a false breakout, likely to reverse quickly. So if you don't see tape going crazy, order flow going crazy, whenever price hits a certain breakout level, it's most likely not going to happen. Okay, so that's one of the main things that people use in order to trade breakout levels. So analyzing volume in practice. So understanding trading volume isn't just looking at a single number. It's about interpreting its relationship with price and other technical indicators. And traders often use visual tools like volume bars on a chart to identify patterns and anomalies. And this allows them to see how volume is distributed across different price levels and time frames. So volume profile. Volume profile is an advanced tool that shows the total volume traded at each specific price level rather than over a period. And it helps identify areas of strong support and resistance where a lot of trading activity has occurred. Okay, so it's going to be a bunch of lines, and it's going to be showing you longer lines, okay, and short lines where there's low volumes. Okay, so in the volume profile, if you turn it on, trading view, wherever you want to turn it on, it doesn't matter. Okay, the shorter lines that you see, it's going to indicate low volume. When you see those long giant lines on the volume profile, that's going to indicate high volume. A lot of people are trying to get it right there. Okay, it's a very probable area, and it's a successful area. So on balance volume, OBV, it's a technical indicator that adds or subtracts daily volume based on whether the price has moved up or down. And a rising OBV alongside a stagnant price can signal hidden accumulation by large players, and that's a bullish sign. And volume price divergence. This is a powerful signal. If an asset's price is making new highs but the volume is declining, it's a bearish divergence, suggesting that the uptrend is losing steam, people are selling off, and a reversal may be near. The opposite is true for a bullish divergence. So for example, here's how to use divergence to predict a reversal in hindsight, inshallah. So a trader notices that Ethereum's price has been steadily climbing for weeks, right? Or, you know, we'll say Stackmode stock. So a trader notices that the Stackmode stock has been steadily climbing for weeks, reaching new all-time highs. Let's say the Stackmode stock is at $800 a share, okay? However, they observe that the daily trading volume has been consistently lower with each new high. Okay, so investors are starting to sell off. So the trader then recognizes this volume price divergence, okay, and anticipates that the upward momentum is weakening and that they might decide to reduce their position as well. Okay, just like the big investors, they're starting to slow down their positions, trim off, okay, sell off. No one's about to hold infinitely, okay, take off some money. And they also might decide to reduce their position or set a tight stop loss order or trailing stop loss order, correctly anticipating a potential price correction. Okay, so if you're anticipating that Stackmode stock has hit the top and that volume is deciding to slow down, aka meaning that buying is slowing down, okay, so volume can increase to the selling side, okay, and then you could go ahead and trim off your stock, trail your stop, and do what you need to do depending on your certain parameters. So you should know your entry, exit, take profit, and stop loss before you put a single dime into the market. Don't do anything related to gambling. Make sure you're extremely informed of what you're doing. So the dangers of playing things with low volume. One, slippage. Okay, trading things with low volume, you could potentially buy all the crypto coins. If you have enough money, you could definitely buy like all of a meme coin or something like that. And if people aren't investing to it, it's going to be hard to sell off their remaining shares, and it's going to be a lot of slippage involved in that too. So low volume, you might not get your orders filled. And trading in a low volume market carries significant risk. And a lack of liquidity can make it difficult to enter as well too. So not only can it make it difficult to exit, like I just spoke about, but even to enter. So you might be like, why am I not getting filled? AKA, like, why am I putting my money in and I'm not getting my asset? Okay, that's because there's not a lot of orders available. So volume is going to be a good thing to look at before we throw our money at something, okay? Because you might buy all of something and you might not be able to trade. Say stock options, for example. You can buy all of a stock options contract, and if there's not enough volume, there's going to be almost no one to sell it to, okay? And you're going to be stuck with contracts. So something that I've gone through before, okay? And I then had to understand that's why people buy shares. So there's going to be times where you buy shares, and there's going to be time where you trade options, for example, okay? So try to trade things with high and decent volume. So let's talk about slippage in the first place. Let me break it down. So slippage in a low volume environment, placing a large market can eat up all the available orders on the order book at a certain price level, forcing your trade to be executed at a worse, higher price, okay? And this difference is slippage, okay? So pretty much you're gonna be paying more money for something. So you're gonna be losing money at the end of the day, and that's not what we want. So slippage is going to be a frustrating thing, and to avoid it, try to play things with decent or high volume. So price manipulation. A single large buy order in a low volume market can cause a massive price spike. So once again, the rug pull scam, for example, or pump and dumps, okay? People have Discord chats, okay? They run ads, they do whatever. And then from there, they own a large majority of the meme coin, for example. Okay, let's say they own 70% of it. And these are things you can go and check on certain brokers as well too, where you can see who owns a percentage of a lot of the meme coins. So let's say they got it at the bottom, okay? And they own 70% of it. So they own majority of the volume. It's already not worth anything. So they own majority of the volume. So they start posting ads, they start paying influencers, maybe hacking influencers, doing what they need to do. Okay, it starts getting some popularity. People start investing into it, thinking that they're about to make some big money in something that has no future context, isn't helping anybody, isn't putting a smile on anyone's face. But for some people, they want to come into the market thinking that it's a get rich quick scheme, and you're going to go ahead and get your bread snatched just like that. So while people are fiending, excited, thinking that they're about to make some money, the people who created the meme coin are in at the bottom, hold 70% of the share. And by the time it starts getting popular, by the time people start investing in, it starts going in an upwards direction, they're going to go ahead and take that profit. Their profit's going to be disgusting because they already have a large majority of it. And it's kind of like a reversal IPO. So if this is like how the stock market works, let me go ahead and break it down. So before the stock market can even hit the public, someone has to buy all of the shares in private. And crypto is subject to a lot of manipulation because you don't have to do that. Okay, so the creator can be a participant. And same thing for the normal stock market too, but it's a lot less manipulation involved because someone has to buy all the shares prior to it being available to the public. So you can't get robbed as easily as you can someone just creating a meme coin and saying it's going to be the best thing of all time. So be careful following anybody too. All right, be careful following anybody. We're all human beings. Okay, a lot of people are flawed. I'm flawed. Okay, so whenever people are trying to prospect something, study it. Okay, see if it's putting a smile on people's face, see if it's making money. Okay, if it's not something that's going to be here for decade after decade, something that's bringing future value, something that's progressing the world, whether it be at a human level or at a physical level, okay, or transactional level, just forget it. It's not worth it. Okay, investing in Pepe, the fraud coin, is not going to make you a billionaire. Okay, there are billionaires from people who trade United States stock market, who trade consistently, who trade at a disciplined high level. Okay, so when you're trading sheep coin on Phantom, expecting to make some M's, and then you come to me saying, Chris, I'm trying to make some M's trading meme coins, I'm gonna yell at you. Okay, there's no billionaires trading meme coins. You invest in things that have value. Okay, even when I was horrible, I was still able to make money due to the fact that I was investing with things that have value. Okay, there's millionaires who don't even look at the chart due to the fact that they plant their money into things that have value. Okay, instead of spending it at the store, okay, spending it on unnecessary things, you invest, stay down, let your money make your money, and then you can live in overly leisure. Okay, making money in your sleep, making it when you're waking up, making it while you're eating, making it while you're making money. Okay, so put all this together into your trading plan. So technical analysis, right? Technical analysis relies on a broad market participation. In low volume assets, chart patterns and indicators can often be unreliable because the chart is going to be so skewed. A lot of the time in a low volume environment, the market's not even going to look how a high volume market would look. Okay, the candlesticks are going to be all skewed, it's going to be all over the place, and it's going to be something you just don't even really want to be touching for the most part. And they can easily be distorted by a few individuals, which is why sometimes you'll see huge, giant, like 1 minute candles, or candles that just don't really make sense, for example, especially with something that has no earnings involved. So stay away from certain manipulation, don't get robbed, okay? And it's a general rule of thumb to avoid trading assets with extremely low volume. And unless you have a deep understanding of the market and its participants, then high volume is going to really provide a more stable and predictable environment for trading. You could still try to catch something at its lows if it has future value, okay? I'm not saying you can't catch something at the low and catch the whole sweep up. Okay, I really pray you catch that move. But don't be buying sheep coin and thinking that it's going to be the best thing of all time and be profitable. Okay, don't try to compare it to something like Bitcoin or Ethereum that has real world uses. Okay. So trading volume is not just an extra data point. It's a critical component of any comprehensive data strategy, and it acts as a powerful confirmation tool, helping to distinguish between the genuine market trends and false signals. And by incorporating volume analysis into your decision making, you can enhance your ability to identify strong trends, spot reversals, and avoid risky low liquidity assets and taking unnecessary trades you don't need to be taking. I don't want you guys to be losing money unnecessarily like I went through for a long time. Okay, I want you guys to just start off profitable. And it's really refreshing. It's a real blessing to start off my students and they don't even lose money. Okay, my students, they start off, instantly start making money, alhamdulillah. Okay, so do your research, get educated before you put a dime into the market. Okay, and you're gonna save yourself from a lot of struggle. So always check your volume alongside your price action. Okay, look for high volume to confirm breakouts and strong trends. Be wary of low volume price surges. Okay, that can indicate certain things like rug pulls, for example. If you just see like one giant order coming out of nowhere and then the whole market moves, be careful about stuff like that. Okay, low volume stuff can be subject to manipulation. Say for futures, for example, if you're trading crude oil, let me tell you guys about a story. Okay, on my futures account, okay, was growing it very consistently. And I've always been good at making money within the market, but one thing I was horrible at was keeping the money within the market. Okay, my first couple of trades I've ever taken were $600 trades and stuff like that. Didn't withdraw, didn't know what I was doing. Always been good at making bands within the market. Was always horrible at keeping the money or consistently growing it. Okay, and that's what I realized. I had to humble myself, you know, really had to turn to God. I had a lot of ego problems. Okay, I never thought it was enough. Even when I would make $100, $1,000, anything like that, didn't think it was enough. Was always just chasing that M, always chasing the billion, always thinking of the next thing instead of just being focused on my discipline, my process, my consistency. Okay, and then starting 2025, 2024 as well too, just had an extremely consistent year. Focused on a lot of day trading and once again, just making really good money. Okay, but then really had to just think about something. You know, there's people who are once again millionaires without even looking at the charts. So I had to understand that trading is really about a long-term perspective. It's about planning in the future. It's about holding these trades for years and years and years on ends. And there's a reason why there's tax benefits for holding trades for years and years on ends too. Now, day trading is still amazing. I still love day trading. I still love taking like a couple week swings and stuff like that. Still give signals for that. Okay, but instead of me taking that bread, right, instead of me taking that money and going on vacation like I was doing, instead of me taking that money and stupidly going to LV instead of it buying shoes, stupid things like that, right, I could have been reinvesting. Okay, and by that time, and by this time, could have easily been a millionaire. Okay, so this is the whole point of why I created Stackmode. Okay, because I realized if you don't stay down, if you don't hold yourself back from certain things, put yourself in position to be a boss. Okay, and a boss is really staying down and grinding. You don't get that bag and go blow it. You get that bag, you stay down. You don't even think about it. Keep it in the stash and you keep working. You keep praying, you keep working. Okay, I was a kid, was very foolish. Okay, and God humbled me many times, and I'm very thankful because I got to come back stronger and I was able to make the money back 10x. Okay, and was able to keep my account healthy. And now that I know how to grow my account, it's really nice to see my students growing their account, coming back to me with results. Okay, so I just know that my struggle is not for nothing. So thank God. And avoid assets that have consistently low volume, guys. Okay, don't want you guys losing your money. Okay, I know you guys work hard Okay, frustrating days, frustrating nights. Okay, just keep going, keep pushing, keep investing, keep staying down. I promise you, you're gonna catch the right play. Okay, stay prayed up to God, keep grinding. Head over to Stackmode.net for all trading education. I'll catch you in the next one. Class, let's go and let's talk about fundamental analysis, what it is, and how you guys can use your outside of chart skills to make profitable trades. So you can see, is the company going to be futurely effective? Is it something that's going to advance society, put some smile on people's faces? And these are all going to be questions that we're going to need to ask before we even look at the chart as well too. Okay, so let's jump into it. Let's see if the company makes some money. Let's determine the fundamentals before we put down some size. Let's go. So what is fundamental analysis? FA, the core definition and the goal. Fundamental analysis is a methodology used to evaluate a security's intrinsic value by examining related economic, industry, and financial factors. And the core idea is to determine if a company's stock is truly worth its current price, whether we're looking at the real business behind the ticker symbol. And the goal is simple: find stocks that are trading for less than the calculated intrinsic value. And this is the margin of safety. So we assess everything that could affect the company's value, from the strength of its balance sheet to the quality of its management team. Everything that's going to be extremely important to take a look at, okay? Because this is all going to be affecting future growth, okay? You want to be investing in a stock that's going to be making money, okay? Because if it's making money and it's profitable, then inshallah it's going to be in a much better position to go in an upwards direction than a company that's not making money, okay? Because then they're going to take their shareholder profit, put it back into the company, and they're going to be paying out higher dividends, which are going to be payments that stocks give if they're making good money to their shareholders. Okay, so if the dividends are increasing, not getting cut, then that means that the company's also going to be making money. So a lot of good things we can look at too to see if a company's profitable or not. Now let's talk about fundamental analysis versus technical analysis. So the difference in focus between the two. Technical analysis focuses on price and volume movements on the candlestick chart, still extremely important to know. And it studies charts and patterns to predict future price direction, and it assumes all fundamentals are already priced into the stock. In fundamental analysis, it focuses on value, and it studies the financial health and futures earning power of the business. It assumes the market can be wrong in the short term, creating opportunities. Let's talk about the two main pillars. So 1, quantitative factors, the numbers. Revenue, profit, assets, debt, and key financial ratios derived from financial statements can all be used to see if a company's making some money or not. And this is going to be the bedrock of our analysis. And some qualitative factors, the intangibles, management competence, industry standing, brand loyalty, patents, and competitive advantages, right? The economic moat are all going to be things we can take a look at as well too to determine if a company is going to be worth investing into or not. So the top-down approach, right? Let's talk about the EIC analysis. So before diving into a single company, let's understand the environment that it's operating in the first place. Let's take a look at the economy, then the industry, then finally the company EIC. So let's talk about the E, economic analysis, right? The macro. So understanding the national and global economic landscape is going to be crucial as it dictates the environment for all businesses. And a rising tide lifts all boats, but a recession sinks many. Now let's talk about GDP. GDP stands for gross domestic product, and it measures the total output of goods and services. And a high GDP growth generally suggests strong corporate earnings, okay? Which means that it's exporting and putting out a large amount of goods, which means people are buying, okay? So interest rates, they're set by central bank, and their higher rates set could increase the cost of borrowing for companies, affecting debt costs, and consumers, affecting the spending power of the company, okay? So if the interest rates are higher for borrowers, that means that more of the company's money has to go into paying off debt versus growing the company, okay? Which could lead to slower stock progression. Keep that in mind. Inflation. Inflation is the rate at which prices rise. High inflation can squeeze profit margins if a company cannot pass on increased costs to its customers. And the unemployment rate, a key indicator of consumer health. Low unemployment usually means that companies are hiring more and more and more and more, and they have enough money to even hire new people. Let's talk about some industry analysis, right? MISO. Some industries offer better long-term prospects than others. You want to invest in companies that are favorable, growing, or defensible sectors. And you want to look at the industry life cycle. Is the industry in the growth stage? Does it have high potential? Okay. Or is it in the mature stage? Is it already super duper stable and a competitive competitor? And adjust your expectations accordingly. Take a look at its competitive structure. How intense is the rivalry? Does it have low competition? Because low competition allows for higher profit margins. And high competition, like airlines, for example, often means thinner margins because there's so many companies that do the same exact thing. And bargaining power. Do suppliers or customers have high bargaining power? High customer power, for example, a few big retailers can force prices down, harming the company. So for example, the tech industry is currently in a growth phase, okay, while the tobacco industry is in a decline. Thank God. Okay, people are starting to get healthy, change their ways, and the crypto industry, for example, is also on an uprise as of when I'm dropping this video. So depending on the time era, invest based on that. That's also going to be taking a look at your fundamental analysis, looking at what time period you're in and making your decisions based off of that. So the company analysis. This is going to be the final deep dive stage where we look directly at the individual's business health, operations, and future prospects. This is going to lead us directly to the financial statements. And let's talk about the competitive moat. What makes this company hard to replicate? Is it a powerful brand, network effects, or patents? And this creates pricing power. And let's take a look at the financial health. And we must verify their ability to generate profit and cash, manage debt, and efficiently use shareholding capital. This is the heart of quantitative analysis. And operational efficiency. Are they managing their inventory and accounts receivable effectively? High efficiency often translates to higher profitability. So the three pillars. Let's decode financial statements. So these three documents, released quarterly and annually, are going to be the company's report card. Okay, remember back in school when you guys were scared of showing your mom your report card, for example. Okay, companies can sometimes be nervous to show earnings, especially if they're not putting out good profit. So that's why you might see a company put out bad earnings, but it might follow up with a video or display of what the company holds for the future to save the shareholders and to make the current people holding the stock, even if it dumps down, invested so they can trust the future. So let's talk about the income statement, right? So what does it show? It shows profitability over a period of time. For example, 1 quarter or 1 year. And it details revenue, cost, and ultimately the net income, okay, which is going to be the profit. And the revenue, right? The total sales from goods or services. And the growth here is going to be critical. Okay, you want your companies that you're investing into to be making money. So the gross profit, the revenue minus cost of goods and sold, and this shows how profitable the core product is. And operating income is profit after deducting operating expenses like salaries, rent, R&D, and this indicates core business performance. And the net income, right, the bottom line, what's left for shareholders after all expenses, interest, and taxes. And the balance sheet. So what does it show? A snapshot of a company's assets, liabilities, and shareholder equity at a single point in time, and it must always balance. All right, let's talk about the accounting equation, right? So assets equal liabilities plus equity. So assets, it's what the company owns. It's its cash, inventory, property, plant, and equipment. And liabilities, right? It's what the company owes. It's accounts payable, short and long-term debt, and watch for companies with high debt. And equity, this residual claim shareholders have on assets after liabilities are paid. And the cash flow statement, CFS. So what does it show in the first place? The true movements of cash. Tracking how much cash the company generated and where it was spent in the first place, separating into 3 main activities. Okay, so we're gonna have the OCF, and the OCF stands for the operating cash flow. And this is cash generated from normal business activities. Okay, this is the most important business section. Then we're gonna have the ICF. The ICF is cash used to buy or sell long-term assets, like equipment or real estate. Then we're gonna have the SCF. Okay, this is financing cash flow. Cash from issuing debt, paying dividends, or buying back stock. And the key takeaway, a company can show a profit income statement, but have a negative cash flow if customers haven't paid yet. So understand that cash flow is gonna be king in this scenario. So the power of ratios, quantitative deep dive, right? I'm gonna give you guys a deep dive here of the power of ratios. So ratios normalize the data, allowing you to compare companies of different sizes or evaluate a company's performance over time. They distill the financial statements into actionable insights. And the profitability and efficiency. These ratios measure how effectively a company is converting sales into profit and managing its resources. And the net profit margin, NPM. It tells you what percentage of every dollar of revenue ends up as net income. And a high and stable NPM suggests strong cost control and pricing power in general. And the ROE, the return on equity, ROE, it shows how much profit a company generates for every dollar of shareholder equity. And the higher ROE, which is typically above 15%, suggests management is using shareholder money very, very effectively. Let's talk about the ROE. Return on assets. It measures how effectively a company uses its assets to generate a profit. And it's crucial for asset-heavy industries like manufacturing. All right. And liquidity and solvency, right? The risk. So these ratios assess the company's financial health, specifically its ability to meet short-term and long-term debt obligations. And the current ratio. It measures a company's ability to cover short-term liabilities, which is due within 1 year, with the short-term assets like cash and receivables. And a ratio above 1 is generally preferred, indicating ample liquidity. Let's talk about the debt to equity ratio. It compares a company's total liabilities to its shareholder equity. And a high ratio indicates that the company relies more on debt financing than shareholder funding, leading to higher financial risk. And the interest coverage ratio. It determines how easily a company can pay interest expenses on its outstanding debt. And the high number suggests minimal risk of default on interest payments. All right, the context checked. So remember that a good ratio is highly dependent on the industry. And a utility company, for instance, can safely carry a higher debt to equity ratio than a high growth technology startup. Because one, the cash flows are more predictable. And always compare ratios with the same sector. So valuation metrics, finding the intrinsic value. Valuation is going to be final. And it's a crucial step in determining what the company is actually worth to you. If the market price is below this value, then that means it's a potential buy. And the price to earning ratio, PE. So this is arguably the most common valuation metric, and it tells you how much investors are willing to pay for $1 of a company's current or expected earnings. And the high PE, a high price to earnings ratio, often suggests investors expect high future earnings growth. All right, so that means it's a growth stock. Think of tech companies, for example. And a low price to earnings ratio can suggest the stock is undervalued, or that investors expect slow or negative growth. All right, and it's a value stock. And the caveat, comparing to price to earnings across industries is meaningless. Compare to the historical price to earnings for the same company and to its direct competitors. Let's jump to the DCF, right? Let's talk about discounted cash flow. And this is considerably the gold standard of evaluation. And conceptually, it attempts to estimate the value of a business today based on cash flow, okay? And it's expected to generate the future. And it focuses on its future cash. The model requires forecasting the company's free cash flow for many years into the future. So the discount. Future money is worth less than money today. And the model uses the discount rate, which reflects the risk and cost of the capital, to bring those future cash flows back to a present day value. And inherent subjectivity. The final value is highly sensitive to the inputs, like future growth rate and the discount rate, making it more of an art than a science. And the margin of safety. A key concept popularized by value investors like Benjamin Graham and Warren Buffett, it's the difference between the intrinsic value and the market price. And protection from error. When we buy when the market price is significantly lower than our calculated intrinsic value. And this margin protects us if our valuation assumptions were slightly too optimistic. And an undervalued asset. If we value a company at $100 per share and it's trading at $60 per share, the $40 different is the margin of our safety and the remainder of our profit. And the concept encourages a disciplined, conservative approach to investing, avoiding speculative purchases of overvalued assets. So the intangibles, right? Qualitative analysis and synthesis. So numbers don't tell the entire story. The best fundamental analysis blends hard numbers with an assessment of the company's non-financial and leadership. And management and leadership. Okay, the people running the show are crucial. Even a great business can be ruined by poor management. And the integrity and vision of the business is extremely important to take a look at. Does the management team communicate honesty with its consumers? And do they have a clear, credible long-term strategy for their business in general? And as far as capital allocation, how have they used the company's cash? Are they wasting it on poor acquisitions, or are they intelligently investing in R&D, buying back stock when cheap, or paying dividends? And its track record, look at its past performance. Have they met guidance? Have they successfully navigated previous economic downturns? Okay, and have they survived? All factors we have to keep it in mind whenever we're going to be investing. So the competitive mode. So this term is often used by Warren Buffett, for example, and it refers to what a company uses to protect them from being eroded by competitors. So one, their strength. Are they iconic? Okay, certain irreversible brands are here to stay. So for example, a certain beverage company, certain tech companies allow for premium pricing and customer loyalty. And network effects. As more people use the product becomes exponentially more valuable to existing users. For example, social media platforms. And switching costs. How difficult is it for a customer to switch to a competitor? And high switching costs, for example, business software systems lock in revenue. Okay. So, synthesis, forming the investment thesis. Fundamental analysis isn't about finding the best ratio. It's about building a compelling investment thesis. And this thesis is the unified argument that's based on your EIC review, the quantitative data, and the qualitative assessment. The company is undervalued and the market will eventually recognize its intrinsic worth are all going to be things you can put into play before making it your trade. And check some things out on the chart too, just to make sure it all lines up. Okay. Always look beyond the price of the intrinsic value of the business. Focus on free cash flow. Okay. It's the honest measure of a company's health, and invest with a margin of safety. Okay. Don't pay $100 for something that you value at $80. Okay. And if you value something at $300 and it's at $80, then inshallah you can make your decision. And management and the competitive moat are just as important as the numbers. Okay. Does the brand have its own stable concept? Okay. Is it super competitive in the industry that it's in? Is it a leader? Okay. Is it an innovator? All questions you got to ask before you put money into something. Okay. I love you guys so much. Stay prayed to God. Keep grinding. And if you want to learn how to invest, head over to stackmode.net. Catch you in the next one. Peace. Class, today we're going to be talking about how to read a futures quote. This is going to be a beginner's guide to just understanding the futures market, understanding the terminology. And before we even put any money into the market, we want to understand what we're investing in, how we're going to invest into it, and how we're going to make some profit in the first place. So let's decode the contract symbol and the price stage data. So if you guys have ever seen a symbol like NQH, for example, okay, NQ would go ahead and represent the index. Okay, it stands for the NASDAQ 100, which represents the 100 tech stocks. Okay. So the first part of the term we're going to see is going to be what you're trading. If you're trading CL, that's going to stand for crude oil. Okay. If you're trading NG, it's going to stand for natural gas. All right. If you're trading ES, that's going to be for the S&P 500. Okay. Also known as SPX. So when you're trading YM, you're going to be trading US 30, also known as the Dow Jones. Okay. So that's going to be what all of those mean. That's going to be the contract symbol. The contract symbol is going to be the first thing that you guys are going to be looking at. So once again, the contract symbol is the first thing that you guys are looking at. So futures contracts, the basics. So a futures contract is an agreement to buy or sell a specific quantity of an asset at a predetermined price on a specified date in the future. And it's an obligation, not ownership. And you're buying the right and obligation to transact later. Okay, so that's what you're doing whenever you purchase a futures contract. And the trade is secured by margin. It's a good faith deposit. So pretty much, let's say you want to trade with $1,000 worth of size. Okay, they would go ahead and let you do that, but you would have to have at least $200 deposited, for example. Okay, the margin is going to be the minimum amount needed in order to open up the trade. Okay, so make sure you guys have more than the minimum amount, okay, because if you go under that amount, you can possibly get what's called liquidated, okay, and you could potentially lose your account, okay, it could be sent down to zero, and if your account goes in the negatives, you could owe the broker money, okay. And unlike stocks, you don't own the underlying asset when you buy the contract. You're more just playing off of speculation, okay, and speculation is pretty much just playing off of directional bias, whether or not you think it's going to go upwards direction or downwards direction. Some common underlying assets, there's some indices. Okay, you can play the E-mini S&P 500, okay, or the NASDAQ 100, also known as the NQ. E-mini is the ES, okay, etc. And then you're gonna have commodities, crude oil like CL, you got gold, okay, GC, corn, okay, and then you can also trade some certain pairs too, similar to Forex. You could trade currencies, so you could trade euro, some Japanese yen, and some other currencies as well too. And as well as interest rates, you can trade 10-year treasury bonds and some other things as well too. Every broker is going to have different things you can trade, but for the most part, this is just what it's going to be. So the symbol, identity and expiration.
So example quote symbol, okay, ES. Okay, the part of the ES is going to be the first part that you're going to see here. That's going to be what you're trading. That's going to be the instrument you've decided to trade, whether it be the currency, the index, whatever. That is the index that you decide to trade. Okay. The M is going to stand for the expiration month. Okay, it's going to stand for when the contract is going to go ahead and expire. And the 25 is going to represent the year. Okay, so if I'm in 2025 when this video is dropping, then the contract will go ahead and have year. So first, the product code. So when it starts to pop out in your face, you'll see ES, for example. Okay, the first part that you're going to see of a futures contract is going to be the underlying asset that's being traded. Okay, and ES, for example, stands for E-mini S&P 500. Okay, GC for gold, CL for crude oil, etc. Okay, so the first part of it is going to be the product code. The second part of it, okay, the letter that you're going to see, you might see M, H, Z, etc. They're going to go ahead and represent the expiration month. So the month of the contract, okay, determines on the letters that's there. Okay, so whenever it's going to expire, look at the letter. So M is for June. So M is for June. U is for September. Z is for December. And contracts generally expire quarterly. And the expiration year is going to be the number at the very end of it. So the expiration year is going to be the last two digits of the contract ending. Okay, so the last two digits is going to really stand for the year. So you know how you guys abbreviate the year. So 2025, for example, would be abbreviated as 25. Okay, 2022 would be abbreviated as 22. Okay, so for instance, a 2022 contract would be like ES. Okay, say in the month of September, ES. Okay, if I'm trading the S&P 500, okay, U would represent the June expiration. Okay, and then the 22 would represent the year 2022. And this ensures that the symbol is always unique and points to the exact contract. And reading the price data. So last, the price at which the most recent trade was successfully executed. That's going to be the last price. Okay. And this is the most visible price, but not necessarily where you can buy and sell right now. And the difference between the bid and the ask is going to be the spread between everything. Okay. So the spread between everything is going to be how much you buy something for, which is normally going to be the ask price. Okay. And how much you sell something for, which is normally going to be the bid price. So a lot of the time for the ask price, it's actually going to be more expensive, okay, than the bid. And the bid a lot of the times is going to go ahead and be cheaper. Okay, so the reason why a lot of the times people might purchase the ask price is due to the fact that the ask price is going to go ahead and fill them faster. Okay, getting filled in means that you're being entered in the market. Okay, so your order is going to start being able to make you money, or you're able to lose money. So that's what getting filled is. Okay, how instantaneously the broker can put your position into the market. Okay, so you're going to have your ask price, and then you're also going to have your bid price. Okay, so your bid price is going to be the cheapest price. And that's what the buyer is going to be currently willing to pay. Okay. So your bid price is going to be cheaper. Your ask price is going to be higher. Okay. So risk management, let's talk about size and value. So the contract size. So the standardized amount of the assets one contract controls. Okay. So for example, to catch up with certain examples here. So for example, one crude oil contract, let's say CL, equals 1,000 barrels. And one E-mini, ES, okay, is 50 times the index value. Okay, and then the tick size is going to be the minimum movement. The smallest increment at future price can move. Okay, so for example, if ES moves 0.25 a point in increments, okay, then depending on how many contracts you have, you can calculate how much money each you want. So for example, for ES, one 0.25 tick, and it moves in 0.25 ticks. So you can calculate exactly how much you're going to make and how much you're going to lose in futures. Okay, that's the beautiful thing about futures. So you can calculate all of your risks. So for example, one tick is worth 0.25 points. Okay, and that's going to be worth $12.50. Okay, so depending on how many ticks stop loss that you want to do, go ahead and calculate your math depending on the tick value. Okay, so your total P&L is your price movement, okay, slash the tick size. Okay, so your price movement
depending on how much it's moved, how many ticks it's moved, and how many contracts that you have, how much size, how much money you have put in. That's also going to affect your P&L, your profit and loss total. So know your product code. And the first letters tell you what you're trading, okay? So you don't get confused with certain contracts, or if you're trying to just read the chart in general. And watch the expiration dates. Futures contracts have limited shelf life, okay, depending on the month and the year, avoiding holding into expiry. Okay, don't do that. And mastering the quote is going to be the first step to mastering futures risk. Okay, stay prayed up to God, keep grounding. Head over to stackmode.net for all trading education. Peace. Let's go and let's jump straight into the lesson. This is going to be the differences between stocks, shares, and options. Let's go. And at their core, stocks and shares refer to the same thing, a unit of ownership in a corporation or a company. And the terms are often used interchangeably, and though shares typically refers to the number of individual units held by an investor, and while stock is more of a general term used for the entire collection of shares. Okay, so for example, I own 10 shares. 10 shares is going to be the amount, the percentage of the company that you want to be a hold of. Okay, the amount of shares equals the amount of percentage ownership that you have in the company. Okay, so if you want to own 10 shares of Apple stock, okay, and Apple is going to be the primary stock. Okay, shares is the percentage amount that you own, and the stock is going to be the name. And here's what they represent. Owning a share means that you're a partial owner of a company, and as an owner, you have to represent. Okay, and you also have a claim on a portion of the company's assets and earnings. And this ownership gives you a right to the company's profits, and it's distributed as what's called dividends. Okay, and dividends, especially if you have enough shares invested into, then dividends will go ahead and be paid out to you. And this way you can be able to make money just by being an investor. And in saying the corporate matters though, it's also going to give you some voting rights depending on the amount of share that you have. And for every share that you own, you typically get one vote. Okay, so the more shares that you have, the more votes that you're going to have. Okay, so you're going to have one vote per share, for example. Okay, and that allows you to influence key decisions like electing the board of directors and who's going to be controlling the future of the company's growth. And why do companies issue them in the first place? Companies sell shares to the public to raise capital, and this money can be used for expansion. So whenever you guys see millionaires, billionaires, stuff like that, and they're company owners, a lot of the time it's not in raw dollar currency, okay, sitting in a bank account. A lot of the time they're rich through the company they own, and a lot of times it's on the stock market, okay, and then that company generates money. And since they're associated with it, or the leader, they get the money associated with the tag, so then they get to be a billionaire. For example, any creator of, like, say, company.com, okay, say they have $500 a share worth, okay, the owner of it, let's say the company does $10 million a year, okay, the owner of it would be classified as a billionaire because he's the owner of it. So that's normally how that works. So they sell shares to the public to raise capital and raise money. And this money can be used for future building expansion of the company, research, paying off your debt, and other business goals. And this process is known as an initial public offering, also known as an IPO. And this transforms a private company into a public one. And this is when shareholders, okay, can invest like me and you if we wanted to. And for a company like Google, for example, a public offering allows them to raise billions of dollars to fund new ventures. And when you buy shares directly from a company during an IPO, you're participating in the primary market. And after the IPO, shares are bought and sold among investors on exchanges like the New York Stock Exchange or NASDAQ, then that's going to be the secondary market. Okay. So when you're buying shares directly from the company from IPO, okay, that's a primary market. And after the IPO shares are bought and sold among the investors, okay, on exchanges like your New York Stock Exchange, that is the secondary market. So let's talk about equities. The broader view is ownership. So the term equities is a broader financial concept, and it encompasses all ownership interests in a business, which includes common stock, preferred stock, and retained earnings. And it represents the value that would be returned to a company's shareholders if all assets were liquidated and all debts were paid off. And on a company's balance sheet, it's often referred to as shareholders' equity or owner's equity. Let's talk about shareholders' equity. This is a fundamental metric used by analysts to assess a company's financial health. Okay. So, and it calculates it by calculating the assets minus the liabilities. Okay, so what assets are things that a company needs. Let's say like the light bill. Okay, a company might need a light bill in order to run a factory, for example. That's assets, something that's needed. And a liability is something that's not needed. Okay, any business expenses that's just going to be extra. Okay, like giving all your employees a vacation or something like that, for example. Okay, and then that's going to equal shareholders' equity. Okay. So, common versus preferred stock. Common stock. This is what most people mean by stock, and it comes with voting rights in corporate matters, but it's secondary to preferred stock in claims on a company's assets during liquidation. When you're a true owner, sharing in both the upsides and the risk. And let's talk about preferred stock. These shares typically do not come with voting rights, but have a higher claim on a company's assets and earnings than a common stock. And holders of preferred stock receive dividends before common shareholders, and this makes them a hybrid security. And it's often seen as less risky than common stock, but without the same growth potential. Okay. So, stock options, my favorite. Okay. One of my favorite things I like to trade, and it's pretty much when you get paid based off of the direction of a stock. Okay. If you think the stock is going to go up, then ideally you would purchase what's called a call contract, which we'll talk about here. Okay. And if you think the stock is going to go in a downwards direction, okay, then you would buy a puts contract. You can also have expiration dates on your contracts too, to choose how long you want to hold the trade for. And when the contract expires, it's going to automatically close on its own. So you either sell the contract before it expires, or it'll go ahead and just close on its own. Okay. So stock option is a contract that gives the holders the right, but not the obligation to buy or sell an underlying stock at a predetermined price. Okay. And that's also going to be known as the strike price. So let's say a stock is at $32 a share currently. Okay. Let's say a stock is at $32 a share. You think it's going to go to $34 a share. Okay. Then you could buy a strike price contract of $34. Okay. Or even $33, since that's above $32. Okay. So you could buy any number above your prediction, but below your take profit. Okay. And that's going to be a good strike price in order to purchase, inshallah. Okay. So when you do that, you're going to go ahead and get paid based off of your prediction. Okay, say for a put example, let's say share price is going to be at 20, for example, right? And you think price is going to go down to 15. Okay, so if price goes down to 15, you could buy a 19, 18, 16, or $15 strike price contract. Okay, because you're going to get paid based off of your prediction. So just focus on what you're doing. All right. Just focus on what you're doing. You're going to get paid based off your prediction. Okay. And it's also going to be within a specified time frame that you purchase. Okay. And the higher the expiration date that you go, of the underlying asset, and they're a popular form of compensation for employees and a powerful tool for investors to leverage their positions. So a call option, it's the right to buy stock at the strike price. Okay. Which is going to be the pretty much price that you're wanting price to go to. And an investor would buy a call option if they believe the stock's price is going to rise above the strike price, and you're betting on the stock's upward movement. Let's talk about a put option. And it's the right to sell a stock at the strike price, and an investor would buy a put option if they believe the stock's price will fall below the strike price. And this is betting on the stock's downward movement, often used for hedging. Yeah. And also sometimes companies often grant stock options to employees as a form of non-cash compensation. Okay. So it simplifies them to work towards the company's increasing value, because as the company keeps innovating, putting smiles on people's faces, okay, creating more product, generating more revenue, then inshallah the share price is going to increase, making their options worth more. And most of the time, inshallah, they're going to be getting paid in like some long-term cost contracts, I assume. So risk, reward, or purpose. So while all these terms are related to company ownership, they serve different purposes. Okay, so stocks. Okay, stocks are going to be the name. Okay, stocks are going to equal the name. Okay, stocks are the name. So let's say I open Stackmode. Okay, let's say I open Stackmode on the market. Okay, if I put Stackmode Network on the market, okay, inshallah will happen one day. If I put Stackmode Network on the stock market, that's going to be the name. So if you just hear the term stocks, that's going to be talking about the name. Shares. The term shares is going to be talking about the percentage ownership that you're trying to purchase within the company. So you can own 1 share, okay, or you can own 50 shares. And the share price is going to be determined on the current price. So if the current price of a stock, okay, remember the stock is the name. So if the current price of Stackmode is $32 a share, for example, okay, and I think it's going to go to $600 a share, okay, or $700 a share, okay, then whatever the current price is going to determine what the share cost is. So if price is at $32 a share, 1 share will cost $32. If price is at $700 a share, 1 share will cost $700. Okay. So inshallah, try your best to get in at a dip or a low and then catch the sweep up. And that's how money is made. Okay. That's how growth equity is created, by trading shares. Okay. And stocks and equities. Okay. The primary goal of these are going to be long investment. Okay. There's going to be also a lot of tax benefits when you hold your trades for over a year. And the primary goal is going to be long-term investments when it comes to shares and equities as well too. And the reward comes from dividends as well too, which is going to be quarterly money that's going to be spread out to everyone who has a decent amount of shares. Okay. So you'll get paid by dividends and capital appreciation. And the risk is that the company's value could decline, leading to a loss of your initial investment. But no risk, no reward. We're only here one life. Okay. Just trust God, take a risk, keep going. Let's talk about some options. The primary purpose is speculation or compensation, and the reward can be much higher due to the leverage they provide, and it makes you control a large number of shares for a small upfront cost. And this risk is that if the stock price does not move in your direction that you purchase, then the stock price could tank on the contract. Okay, but it's going to be fine. If it expires worthless, you just try again. Don't lose hope. Trust God. Keep going. Okay, and you could potentially lose your entire investment, but you could also play into that. Okay, whatever your stock option cost is, you could use that as your stop loss. So if it costs you $70 to open a contract, that could be your stop loss. Okay, instead of buying a $500 contract trying to play with the $70 stop loss, that might not always work in stock options as cleanly as you might want. Let's explain leverage. And with the call option, you might only pay a few dollars for the right to control 100 shares with leverage and the time expiration. And if the stock price goes up by just $1, you've made a significant percentage gain on your small initial investment, far greater than you would have buying the shares outright. Okay, but it also has time expirations on it. Okay, so this is why the longer the time you're going to buy on a certain play, it's going to be the better. Okay, give your trade time to work out. Okay, but the longer that you go trying to buy out, the more expensive that the contract is going to be. Okay, so for practicality, for example, if an investor wants to build a retirement portfolio, okay, you could buy stocks. Okay, so you'd be buying shares of those stocks for long-term growth, for long-term tax benefits, and just holding trades year after year, keeping money in the stash, keeping stack mode, okay, implemented into your portfolio. Staying down, not touching the bread, okay, staying down. And if a trader is looking to profit from a short-term market movement, then stock options would be able to amplify your return. So you can use the stock options profit to buy some more shares, but stock options in general is just going to be better to go ahead and generate some more income. Okay, so it's going to be time to just start going harder, get more education, and really understand what we're doing before we put money into the market. All right. Market capitalization, valuation, how a company is priced in general. So understanding that a company's market cap, okay, also known as the market capitalization, is pretty much how much a company is worth. And the valuation is crucial for making informed investment decisions. Now, market cap's not going to be everything. You could do your research and catch a good trade at the low, and then the market cap turns huge later. Okay, but market cap is just going to be a good decision to see if something's going to be a strong value play. And market cap is going to be the total value of all the company's shares, and it's a key metric used to determine a company's size. So here's the market cap formula. The calculation is pretty simple, but does a lot. It's quite advanced. So market cap, okay, the calculation concurs of it's the current stock price. Okay, so Stackmode is worth $700 a share. Okay, then it's worth $700 a share. Okay, so you take the current stock price, $700 a share, times the number of total outstanding shares, so whatever that would be, and that's going to give you the market capitalization. Okay, so this tells you what the market currently values the entire company, and it changes every minute as the stock price fluctuates. People are always going to be putting in orders, selling and buying, and especially something that has A high market cap is always going to be more orders flowing in due to the fact that it's popular. So there's some different market cap categories. Companies are often categorized by the market cap, which influences their risk growth and their potential. Once again, it's not going to be everything, but it's something to look for. So a mega cap, it's going to be something worth over 200 billion in market cap. So for example, big giants at the time, like Apple, Microsoft, for example, they're generally seen as stable, mature companies. And let's talk about large caps. It's going to be 10 billion to 200 billion. Okay. And they're established leaders in their industries. You got mid caps, 2 billion to 10 billion. That's companies with solid growth prospects. And small caps, 300 million to 200 billion market cap. They could be a bit higher risk if they don't decide to grow and have some future innovation, but with the potential, they have a bunch of high expectations, certain companies, and they can explode super duper hard. Okay, like for example, Palantir and microcap and nanocap, and below $300 million. And they're the riskiest category once again, because it's fresh, new startups, new ventures. Sometimes it could be people with a bunch of money investing into it, and then it doesn't go anywhere. So make sure it has some future value. So let's talk about valuation versus price. So it's important to distinguish between a company's price and its market cap and its intrinsic valuation. Valuation is a more complex process that attempts to determine a company's true worth based on its assets, earnings, future cash flows, and growth prospects. And a savvy investor is going to be looking for stocks where the price is lower than the company's estimated intrinsic value in the first place. So we'll talk about valuation methods. There are many methods for valuation, including the discounted cash flow, the DCF model, and a company's price to earnings ratio. Comparing that to its others ratios of other companies is going to be a good way to determine if what company is making more money than others. Okay. And these are essential tools for a fundamental analyst if you want to be an investor. So let's say, for example, let's say company A has 10 million shares outstanding. Okay. Let's say Stackmode has 10 million shares outstanding. Okay. And its stock is trading at $50 a share. Okay. And its market cap is going to be $50, okay, because that would be the current price. Okay, you're going to be multiplying the current price times the number of outstanding shares. So let's say Stackmode has 10 million outstanding shares. You're going to multiply that by the amount of outstanding shares. So 10 million. So $50, the current share price, times the number of outstanding shares, 10 million. And that's going to equal 500 million. Okay, and that's how the math is done. That's how you find out market cap. Let's say company B, for example, let's say it has 5 million shares outstanding and its stock is trading at $150 a share and its market cap is 750 million. And even though company B's stock price is higher, company A might have a higher intrinsic valuation based on future growth projections and its expectations. So the differences at a glance. So to summarize, it's essential to recognize the distinct roles of each of them. So shares and stocks. Stocks represent actual ownership in a company and they're tangible assets that can be fractional and traded on exchanges. Okay. Any stock exchange is going to be a broker where you can put in your bank account, your card, and buy some stock for yourself. Okay. That's what an exchange is, also known as a broker. So let's talk about equities. Equities are a broad term for the total ownership of a value of a company. It's an accounting term that includes all forms of ownership interest, and equities is the larger category, which includes stocks and stock options. They're a contract and a right to buy and sell shares, not the shares themselves. Okay, and you get paid based off of the direction that you think price is going to go into. And they're a tool for speculation or compensation and are not an ownership stake until they are exercised, until someone's to fill in the contract. So think of the company as a pie, okay, also known as the stock. A fraction of the pie, okay, is going to be known as a share. And let's say you're about to deliver pie. Let's say you project to sell 4 slices of pie. If you think that, you could buy an option based off of that. Okay. So put all of that into retrospective and understand. Okay. So if you think you're about to sell 4 slices of pie, then you buy in options. Okay. But the pie in and itself is going to be the shares. Okay. And the store name, let's say it's Stackmode Pies, is the stock. Okay. So that's how it all works. So by understanding these core concepts, you're just not a spectator anymore. You're getting informed, understanding the market, not a gambler, and you're becoming an active participant with the knowledge to navigate the complex world of finance. Alhamdulillah. So while the terms may seem confusing initially, their distinct definitions and functions are critical to building a robust financial vocabulary. And remember, stocks and shares equal ownership. Okay, they equal ownership. You can hold them for however long that you want. So use that money. Don't go buy clothes, stay down. Don't go buy drip. Don't go buy the best whip right now of paying the high monthly payments. Stay down, invest, and go ball out later. Let your money make infinite money and then go buy what you want. And equities are going to be a broad ownership value. And stock options are going to be the directional bias that you can get paid based off of. You can use all of these to create future value, provide for your family, and provide for yourself. Stay predictive to God. Head over to stackmode.net for all trading education and business education. Love you so much. I'll catch you in the next one.
So let's go and let's talk about central bank digital currencies, also known as CBDCs. Now, don't confuse this with cryptocurrency, because cryptocurrency is decentralized and doesn't have a ruler, and CBDCs are money ruled by the government. And think of this as a digital version of cash in your wallet, but with one massive difference: it's programmable. So that means that in theory, the issuer could track every single transaction you make, limit how much that you could save, or even decide what you're allowed to buy. And supporters claim that it is the upgrade our financial system needs to be faster and safer, but critics are calling it the end of the financial privacy embedded in us as humans forever. So we're looking at the future of convenience, or are we looking at the ultimate tool for our total control? Let's jump into it, inshallah. So what is a CBDC in the first place? CBDC stands for Central Bank Digital Currency. So imagine if the cash in your pocket turned into a computer code, but it was still worth exactly the same amount. That is the basic idea of a CBDC. And it's digital money issued directly by the country's central bank. Okay, it's not physical paper, and it doesn't come in coins. It exists only on computers or digital wallets. And unlike some cryptocurrencies that change value wildly, a CBDC is meant to be as safe as a dollar bill. Okay, so think of it like virtual cryptocurrency just created and ran by the government instead of it being on the peer-to-peer decentralized network. Okay, so the government's pretty much creating a currency in order to combat cryptocurrency coming out and its whole decentralized features. Okay, so we'll talk about the benefits. Let's jump into what it is and let's continue. Physical cash versus the CBDC. So we already use credit cards and apps like Cash App, PayPal, Venmo. So how is this going to be any different than things like that? So the commercial bank money that works today. So when you swipe a card, your bank promises to pay the store. Okay, and it's an IOU between the banks. Okay, and the CBDC, it's a direct liability of the central bank, and it's like handing someone digital cash directly without a middleman bank needing to promise the payment. Okay, and as far as the speed, so regular bank transfers can take days, especially on the weekends. And also when it comes to wire transfers, things like direct deposit when you're getting paid, things like that work on a time-based schedule, whether it be your direct deposit hit at 6 a.m. Some people have direct deposits hit at 6 p.m. Okay, some people don't have direct deposits that hit on weekends and have to wait for the following business day, such as a Monday or a Friday, etc. Okay, but with CBDCs, payments and bank transfers are going to be instant. Okay, so they're creating a base and a way for people to instantly send money without having to use outside apps. Okay, so sending money today is like sending an email that goes through 3 different servers before actually arriving, and it has to all get approved too. Okay, if you decide to send money via wire transfer, it could definitely bounce. Okay, and sending a CBDC is like handing whoever you need to instant money, okay, or instant $20 bill, but doing it over the internet instantly, instead of sending the $20 bill via the mail, waiting for the bank to sign off on it, and then sending the $20 bill to the person you want it to go to. That's how traditional banks work. So CBDCs really save a lot of time, make things a lot quicker. Okay, and hopefully, inshallah, that'll bring a lot more control back in the people's hands versus how we want to spend our money and when we need our money. So if CBDCs are out, what's the point of crypto, Chris? So if they're the same thing, and when they're not, and they both use digital technology, the real difference that comes in between them, okay? One is decentralized and one is not, okay? So they both use digital technology, okay? Sometimes the blockchain, but they're both different in the point of who controls it. Okay, so cryptocurrency, Bitcoin, Solana, your XRPs, Ethereum, all decentralized.
And the term decentralized means that it's not controlled by a centralized network. Okay. When you decide to send Bitcoin to somebody, okay, it directly gets sent to their Bitcoin wallet. Okay. No ifs, ands, or buts. Okay. Peer-to-peer transaction system, also known as the decentralized system. Okay. Then you're going to have the CBDC side. Okay. Which is going to be controlled, just like traditional banks, by that centralized bank fiat currency system. Okay. But the price will be stable. Okay. So $1 will equals $1. It's not going to be fluctuating as much. And as far as privacy concerns between the two, crypto is often anonymous. Okay. You have to go into the blockchain in order to check certain transactions out, etc. But CBDCs allow the government to see the transactions in order to stop crime, any type of money laundering, or any type of fraudulent activities happening. Okay, so think of Bitcoin kind of like a digital gold that you own yourself. And CBDCs are going to be like digital dollars managed by the Federal Reserve. So one is for freedom and investment and speculative purposes, and the other is going to be for stability and spending. Okay, so one's purpose, okay, it's going to be for speculative, freedom, and investment reasons. And the other purpose is going to be for stability, spending, and sending your money how you want within your centralized bank, okay, when you want, without having to use any type of external apps that you may potentially have to get approved for, especially when you already have your bank. Let's head over to the next slide. So let's talk about the two types of CBDCs. Not all CBDCs are for regular people. Okay, there's going to be two main types. One, you're going to have the retail CBDC. Okay, so this is going to be just for the day-to-day person. It's used for buying coffee, clothes, paying bills, and it really just acts like cash in an app. Okay, and then you're going to have number two. Other side of it, you're going to have your wholesale CBDC. Okay, this is going to be for banks, and it helps huge banks send millions of dollars to each other instantly and safely, replacing the old slow systems. Okay, so retail is like the debit card in your wallet, and wholesale is like the armored truck that moves money between bank vaults. Okay, so really understanding the two different types of services and reasons why is going to help you make some future investment properties, especially when we start seeing banks implement CBDCs more and more, due to the fact that they're trying to create some type of competitive edge against the whole cryptocurrency decentralized space. Okay, so why create a CBDC? Okay, governments aren't just building these for fun. Okay, one, it's for competition, to create a space for them to still be profitable in the financial world, especially as cryptocurrency grows year after year after year after year, and people are starting to wake up to what's actually happening and how the currency works. Okay, and the efficiency of everything. So payments become instant and cheaper. So no more 3% credit card fees for shop owners, etc. And financial inclusion is going to come into play. So people who don't have bank accounts can still have a digital wallet on their phone to receive money safely. So that means you can still be able to do jobs and get paid exactly how you want. And in case you get declined by any app such as Cash App, Zelle, or anything like that, you're still going to be able to survive and pay your bills how you need to. And programmable money is what it is. So the government could send stimulus checks that expire if not spent, or can only be spent on food using CBDCs. Instead of having to get checks or use certain cards to spend money, CBDCs could be used to fund government programs to help out citizens. Okay, so during an emergency, the government can pretty much airdrop money directly to everyone's phone without having to mail paper checks, and give everyone an essentially virtual card by using CBDCs. Okay, so we can start seeing things transfer away from traditional bank financial fiat currency system that we've been seeing for the past couple of decades into a whole new blockchain involved world. Okay, let's head over to the next slide. So let's talk about the risk and the concerns. So why are some people worried in the first place? So with great power comes great responsibility. Okay, so giving the government total control over digital money has risk, and it's going to be a privacy loss factor that comes into play. So cash is going to be private. Okay, if you buy a candy bar with a $5 bill, nobody knows where it came from even. With a CBDC, the issuer can technically trace every penny that you spend, which takes away people's privacy, which adds control back into people's lives. So if money is programmable, they could stop you from buying things. Okay, so that means that they could deny transactions, freeze certain things just as a normal bank account can, but banks and credit unions have a little bit more separate control from just the straight up government centralized system directly. Okay. So cybersecurity reasons as well too. If the central system is hacked, the whole money system could freeze, or even if it goes down. So let's say a CBDC risk system is running on like a system like AWS. Okay, if AWS were to go ahead and shut down, that means people weren't going to be able to access their funds. Okay, so do you want convenience or privacy? Okay, both things are going to go ahead and have concerns, and a lot of factors are going to come into play. So deciding what you're using your money for and how you want to invest is going to change year after year after year. So make sure you guys are staying on top of things. And as far as compliance for even your own stores, even if you want to take CBDC currency, and we'll see how the things change over the next couple of years. So are CBDCs real yet? Answer is going to be yes. Okay, it's not just a theory. Many countries are already using and testing them. Okay, for the Bahamas example, using the sand dollar. So the Bahamas is the first country to launch a full CBDC. So people use it to pay across different islands using mobile phones. And then we got China. Okay, China using the digital yuan. And millions of people in China are already testing the eCNY. Okay, electronic CNY. Okay, it's just digital fiat currency for China to buy subway tickets, groceries, etc. And then we got US. We got the Project Hamilton. Okay, the Federal Reserve and MIT are researching how our digital dollar would work, but haven't launched one just yet. But the United States is working on things. Okay, so over 100 countries representing 95% of the world's GDP are currently exploring a CBDC. Okay, and this is going to be research done as of 2023, and we can start seeing a lot of things change, especially when it comes to government-funded projects, such as like food stamps, unemployment, or anything like that. Instead of people getting the money placed on certain cards or traditional bank account systems, a CBDC wallet could be used in order to have people spend money on that throughout the entire network. So monies came a long way. It came from seashells to gold coins, seasoning, to paper bills, and now we got plastic cards, and now we can just send money digitally with numbers on the screen with our phone. And CBDCs seem to be the next logical step in a digital world realistically. So as you grow up, you gotta understand how money works, you gotta be able to adapt, and you gotta be ready to change how your asset classes are being moved and how your money is growing, especially as things get more expensive over time. Your money has to be working for you. Okay, keep that logical perspective. If the world is going to get more expensive over time, that means that your money can never stop working, especially when we have to do things like use the bathroom, sleep, etc. You have to be getting money while you're doing that stuff. Okay, if you want to be competitive in this world, you got to be getting money at all times. In your sleep, while you're awake, while you're getting money, you should be getting money, and it should be that serious, inshallah. Okay, so CBDCs offer speed and safety, but we must come to terms with the fact that you're going to be losing respect of privacy, but you are going to be getting a lot of convenience as well too. Okay, no more long paperwork, waiting for cards and stuff like that. And a lot of that stuff can be frustrating. Okay, just instant funds that come on a wallet, and we'll really see how it plays out for the future. So stay prayed up to God, keep grinding, and head over to stackmode.net for all trading education. Catch you guys in the next one. Peace.
Yo guys, it's Stackmode Chris here. Today we're going to be talking about what calls and what puts are in the options trading space. Let's jump straight into it. Options 101, the core concept of a contract. So the definition, right, not obligation. So what is an options contract in the first place? So an options contract gives the holder the right, but not the obligation to buy or sell an underlying asset, like 100 shares of a stock at a specified price, before a specified date. This separation of right and obligation is the fundamental difference between buying a stock directly and buying an option. So let's talk about the contract size. Standard contracts in the US represent 100 shares of the underlying security. So whatever option you purchase, you're technically purchasing 100 shares in a leveraged time asset manner. So when you buy one contract, you now control 100 shares worth. And the premium. This is the non-refundable price you pay to the seller for the right granted by the contract. And it's the maximum amount an option buyer can lose. Let's talk about the time constraint. So unlike stocks, options have a fixed expiration date. And if the option isn't profitable by that date, it typically expires worthless. So calls. You're going to play calls if you think price is going to go in an upwards direction. It's the bullish tool. A call option grants the buyer the right to buy the underlying asset at the predetermined price when buyers expect the price to rise in an upwards direction. Okay. And let's talk about puts. Okay. The bearish hedge tool. A put option. Okay. So once again, a put option grants the holder the right to sell the underlying asset at a predetermined price. So put option is going to be bought if you think price is going to go in a downwards direction. Okay, if you think price is going to fall in a downwards direction, then you're going to go ahead and buy a put option. Okay, and it's important to understand the concept of leverage as well too. Options allow you to control a large block of shares. Okay, so it's 100 shares per contract. Okay, so it's a lot of leverage. Okay, it's a lot of power you're going to have to control. Okay, when you start trading options, you're going to realize that it's a lot different than Forex, futures, anything else. Okay, that's a couple of factors that come into its profitability. It's not just you get paid based off of directional buys. There's going to be time that comes into place, strike price that comes into place, etc. Stuff we're going to talk about and get into. So you pretty much purchase 100 shares for a relatively small upfront cost, which is at the premium. And this magnifies both potential gains and losses. Okay, so if you're a good trader, you can really take advantage of this leverage. But if you're someone who's not consistent, you can get punished. So let's talk about the call option. Profiting from the upside. So once again, if you think price is going to go in the upwards direction, then you would go ahead and purchase a call option. If you think price is going to go in a downwards direction, you purchase a put option. Analogy I always tell my students is call. What do you do to call? You pick up the phone. And what do you do once you're done with the phone? You put down the phone. Okay, so think of put down the phone and call, pick up the phone. So profiting from the upside. When you buy a call, you're predicting that the stock's price will move significantly above your strike price before the expiration date. So buying a call, all right, let's talk about a long call. So you pay the premium and your maximum loss is limited to that amount. And your profit potential is essentially unlimited if the stock soars. So the purpose of it, right, is speculation on a stock price increase or buying the stock cheaply if exercised. And your max loss is the contract cost. So if a stock option contract costs you $500, the max loss you could lose is $5. You can't lose any more than that. Okay, it's not leverage in that sense with margin. Whatever the contract costs is the max you can lose. It's pretty amazing. But the profit you can make is going to be unlimited. It's crazy. So the max profit is unlimited, theoretically, as the stock can rise indefinitely. So there's been times where people have turned $5K to $300,000 on certain pumps and stuff like that. Options is amazing. Okay, thank God for options. So let's talk about selling a call, right? A short call. So it's when you receive the premium up front and you're betting the stock price will stay below the current strike price. So the strike price is going to be the current price. So if you ever hear the strike price, it's the current price. So you're betting that the stock price will stay below the strike price. Okay. So the strike price is going to be the price that you think the options contract is going to be going to. Okay. Typically the price that, you just want your options contract to go to. And the purpose of it is to generate income. Okay. To where you can bet against significant upward movement. And as far as the max loss, right, it can be unlimited, as the stock price can rise infinitely, forcing you to buy high. And the max profit, right, it's going to be the premium received. So for example, $200. So here's a call option example. So let's say stock A is trading at $50 and you buy a $55 call. The reason why you buy a $55 call is because you think it'd go up to $55. Even though it's trading at $50, if you think it's going to go up to $55, then that's going to be a contract you're going to go ahead and purchase. Okay. And so going back here, so the strike price is going to be the number that you want to buy. Okay. Not current price. So if stock A closes at $60, right, and you bought a $55 call contract, you'd make a lot of money. You're getting paid based off predictions. So if you think price is going to go to 70 and it's at 60, If you buy a 62 calls contract, that's in between 60 and 70. So any strike price contract in between 60 and 70, you're going to be able to purchase successfully. Okay. So if stock A closes at $54, right? And you thought it was going to go down to $50 and you bought a put option, okay? Then you'd be in the negatives, okay? If you bought a 50 puts and price at 54, okay, and price hasn't hit that, you'd probably be in the red, okay? Say price at 60, you bought it at, say you bought it at, yeah, let's say you bought it somewhere near 60, right? And then you think price is going to go down to 40, okay? If price A goes up to 70, that's further away from 40. Okay, so your put contract would then be in the negative. Okay, so the further away of the opposite side would make your money go to the downside. Okay, so if you think it's going to go up and the price starts going down, you'd be losing. If you think the price is going to go down and the price starts going up, you'd be losing. So the put option, protecting against the downside. So buying a put is like buying insurance, and it gives you the right to sell your asset at a fixed price, limiting your losses or allowing you to profit from a price drop. So buying a put, right? Let's talk about long puts. So it's when you pay the premium for the right to sell. And this is the primary tool for betting on a drop in the underlying stock price. So you can speculate, which pretty much means you place a bet on directional bias, okay? Or you can hedge, which means you buy puts and calls whenever something's going to happen to protect a long stock position. And your max loss is going to be whatever you pay for the contract. So if you pay $300 for a puts contract, your max loss would be $300. And your max profit, okay, would be limited for a put contract, as the stock can only drop to it can only drop to 0. And there's only a few instances of that happening. But if something's profitable and really helps the economy, there's short sale restriction laws to really prevent things from tanking down to 0 like that. So keep that in mind. So selling a put, so especially when you're trading the crypto and stock market too, keep that in mind. Okay, when you're trading against a market where people are trying to buy and hold their money, expecting it to go up, so your downside trade is going to be pretty limited. So keep that in mind. So let's talk about selling a put, right? Short put. So it's when you receive the premium and you're betting that the stock price will stay above the struck price, and your risk is substantial if the stock crashes. So the purpose of this is for income generation, okay? Or you could put on an aggressive bet on upwards or sideways movement, and your max loss can be substantial, okay? And the max profit is going to be the premium received. And a put option example, okay? Let's say current price is at 70, okay? Let's say you think price is going to go down to 60, okay? You could buy any contract in between 69 and 60 in order to try to make some profit, okay? Now, if price goes up to 75, you'd then be in the negative profit, okay? But if price goes down, any number between 69 and 60, you'd be in the positive profit. So decoding the details, right? The essential terminology. So let's understand 4 terms that they're vital to really interpret any option chain. So the strike price is the agreement price. This is the fixed price at which the option buyer has the right to buy, call, or sell put at the underlying stock. And this price is set when the contract is created. And the expiration date, it's a deadline. So every contract has an expiration date. The further you buy out, the better. We're going to talk about leaps here soon. So what a leap contract here is. So a leap contract is pretty much just a really, really, really long contract. Okay, so it's whether a couple of months or you have some years on the options contract. Typically, you want to make sure you have your options contract for at least months or years. Okay, this way you guys aren't going to be getting destroyed by what's called the Greeks. Okay, some crazy things that could destroy your profit if you don't position or do your research. So the premium, right? Let's talk about what that is first. So the premium is the market price of the option contract itself. So you're going to see options contracts in decimals. So you're going to see an option contract be like 1.70 or something like that. Okay, or you'll see like 2.10. And what you're going to do, any decimal that you see on the options contract, you're going to have to multiply it by 100. Okay, so that would equal $210. So 1.70 times 100 would equal $170. Okay. 0.75 times 100 would equal $75. Okay, so keep that in mind whenever you guys are trading options and you just see a bunch of numbers with decimals and stuff like that going on. Okay, that's what's happening. Keep that in mind. So moneyness, right? The profit status. So this refers to the immediate profitability of the option if exercised right now. And let's talk about in the money. It means the option has intrinsic value and immediate value if exercised. So for a call, stock price, or strike price. And for a put, you're going to be doing strike price over stock price. Okay. So at the money, it's when the strike price is equal or very close to the current stock price and contains only time value. And let's talk about the term out the money. It means that the option has zero intrinsic value. And for a call, right, the stock price must be less than strike price. For a put, stock price would be greater than the strike price. And these only consist of time value. And rule of thumb, out the money options are cheaper, but they have a lower probability of becoming profitable. And the money options are more expensive, but they carry less risk. Okay. So that's the reason why in the money options focuses on the stock price. Okay, especially for certain things like a call, for example. Okay. In the money option, you want to try and play or buy a strike price contract that's going to be as closest to the current price as possible. Okay, so focus more on the stock price more than you're focusing on the strike price up at the times. So let's talk about Greeks. Okay, these Greeks can be absolutely crazy. Okay, these are going to be things that could destroy your profit if you don't understand them. Okay, it can really destroy your whole portfolio, destroy a lot of things you're working hard for. So let's understand them. So the Greeks are measures of the sensitivity of an option price, right, the premium, to changes in key factors like time, price, and volatility, and they're crucial for serious risk management. So let's talk about the delta, right? So the delta tells you how much the options price to change for every $1 change in the underlying stock price. It also represents the probability that the option will expire in the money. And the theta. The theta measures the decrease in the option's value, right? It's the premium for every passing day. And as an options buyer, theta is your enemy. Once again, as an options buyer, theta is your enemy. As an option seller, theta is your friend as you profit from the time decay. Okay, but theta is typically a negative value. So gamma. So buying options and selling options is going to be two different things. I'm going to make a completely separate video on that. Buying options, you're wanting the direction to happen. Selling options, you're selling options to people. You're pretty much selling dreams to people. That's pretty much what selling options and selling dreams. So gamma. Gamma tells you how much the delta value changes for every dollar change and the underlying stock price. And that doesn't mean a good selling dreams too. They're pretty much betting on you to lose. Okay. And gamma is going to be the rate of acceleration of your options profitability, and it's the highest for at the money options. Okay, and it's always going to be positive for option buyers. So the Vega, right? Let's talk about volatility. So Vega measures the change in the options price change for a 1% change in the expected volatility of the underlying stock. And high Vega means that the option is sensitive to market sentiment and expected price swings. So the investor's perspective. If you're buying an option, you want high positive delta, high positive Vega, and low negative theta. And if you're selling an option, right, selling dreams to people, betting on their optimistic goals, okay, or optimistic views, betting on them to lose. And if you're selling an option, you want the opposite. You're looking to profit from the time decay, okay, the theta, and you want a stable stock price for the most part. Okay, that's just what you're going to be looking for as a seller. It's going to be two different games between buying options and selling them. Okay, two different games. So some basic strategies, right? Long versus short option. All basic option trading can be broken down into two core activities: buying contracts, okay, that's for going long, or selling contracts, okay, going short. So let's talk about buying options, okay, long calls and long puts. So this is generally the starting point for beginners because the risk is defined and limited, and you pay the premium upfront. So it has defined risk. If you think prices are going to go to a certain place, you buy the contract for it in the direction that you want. calls if you think it's going to go up, puts if you think it's going to go down. So you have a defined risk when you buy options, and your maximum loss is the premium paid. You can't lose more than the cost of the contract. But due to time decay, and this is why you would pay a leap contract. So a leap contract is going to be a contract over like 3 months to a couple of years long. So any contract with months on it, years on it, that's a leap. So you won't have a high probability of loss. Okay. So in order to counter high probability of loss, make sure you guys buy time. Okay. Buy leaps. Please don't try to trade 0 DTEs and weeklies and you don't know what you're doing. So due to time decay, theta, most options expire worthless. So this is why it's important to buy certain contracts close to current stock price. Okay, focus on the stock price. And you need a fast, large move in your favor to overcome the premium cost sometimes. Okay, but if you play options like shares, where you're buying options contracts years out or months out, expecting to hold for a long time, you can outplay the system. Yes, they cost more money, but trading's not just about making money. Okay, don't just focus on the trades that are going to make you money. Focus on the trades that aren't going to lose you money. Focus on the trades that are going to preserve your money. Focus on the trades that are going to keep you safe. And options has leverage returns. If the stock moves favorably, the percentage return on your initial cash outlay, right, the premium, can be really huge. So let's talk about selling options, right? Short calls and short puts. It's when you collect the premium upfront. And this requires a much higher level of caution and often higher margin requirements. So there's going to be unlimited risk involved in between selling options. Okay. So for short calls, selling uncovered calls has theoretically unlimited risk, making extremely dangerous for beginners and a high probability of gain, right? Since most options expire worthless, depending on which ones you do, let's say price is at 60. If you sell an option that's at 75 and somebody's optimistic and they buy that, okay, then you would make money, okay, because they didn't win. So it's trading. When you make money, somebody is losing. And when you're losing, somebody is making money. Okay, that's just how trading works. So since most options expire worthless, the seller has a statistical edge and profits if the options expire out the money. Now, if you're really good at the market though and eyeballing certain things, you could definitely slam buying options for sure. But the defined reward. Your maximum profit is strictly limited to the premium collected when you open the position. And a critical risk note, right? Never start by selling naked uncovered call options. This means selling a call without owning the underlying stock. If the stock unexpectedly surges, your losses can really wipe out your account really fast. Okay? And stick to just buying options until you have the to sell options if you wanted to. So, options give you the right, but not the obligation to buy speculative direction. Calls give you the right to buy, and puts give you the right to sell. So remember, calls are what you purchase if you think price is going to go in an upwards direction. And you're going to buy puts if you think price is going to go in a downwards direction. And risk is defined when buying options. Okay, your max loss is going to be what you pay for. If you pay $400 for a contract, you're going to lose $400 max. But guess what? The profit you can make is infinite. Okay? God is great. So theta is going to be the time decay. In order to counter that, make sure you guys are buying months out. Okay, buy months out, years out, and give yourself time. And shorter term options are riskier due to high theta. So even though they might be cheaper and look more intriguing, stack up, get into Stackmode, and buy the contract that's going to really get you to where you need to be. And practice first. Make sure you guys are paper trading. Try it out. Make sure it's what you guys like before you put in any type of real capital, all right? I want you guys to stay prayed to God. Keep grinding. I'm going to catch you guys next one. I love you. Peace.
When the dollar starts becoming worth less, people start running to assets such as real estate, gold, and silver. Today, we're going to talk about how to invest into gold and silver, why you should invest into gold and silver, and what inflation is, and why people run to asset classes in the first place because the dollar starts failing. Let's jump into it, inshallah. So gold and silver are going to be hard assets that are going to be pretty safe to invest in, especially in an inflationary world where things just get more expensive over time due to the fact that more currency just gets generated over time. So the currency devaluation. So purchasing power is melting over time. So inflation isn't just about prices going up over time. It's about the value of the currency going down. So prices go up to correlate with that. So governments print money to service debt, which dilutes your savings over time. This is why I tell you guys all the time about the asset river. Okay. You want to always try and have your assets and your money flowing in your river. If things logically get more expensive year after year after year after year, then you have to have your assets flowing in a way that your money is always making you more money. Okay. So once again, I'm going to repeat. Your money should always be making you more money. Okay. Don't get outplayed by the certain calculations that just debase in the world normally. If things get more expensive over time, then logically, in order to counteract that, in order to feed yourself and your family, your money should always be making you more money. So we'll talk about the 1971 shift. So that's when Nixon ended the gold standard. And since then, the US dollar has lost over 85% of its purchasing power. And the hidden tax. Inflation helps debtors, which is pretty much just the governments, but it hurts savers. Anybody just stacking up cash in your bank account. If you have just a whole bunch of cash stacked up in your bank account, it's actually doing nothing but hurting you. Okay, even if you've worked overtime for a job before, okay, you might have seen that you've actually had to pay more in taxes. Okay, the more cash that you have just stacked up stationary, the more that it hurts you. And it transfers wealth from you to the state, which goes back to the government. So in 1920, 1 ounce of gold bought a high-end suite. And today, 1 ounce of gold would be about $2,600. Okay, so it still buys a high-end suite. And the gold stayed constant and the dollar collapsed. Okay, so keep that in mind. The gold stayed constant while the dollar collapsed. So that means that having your money parked in an asset class like real estate, people are always going to need houses. Gold, people are always going to be wearing jewelry. And other asset classes that stay constant and only rise up while the dollar collapses are going to be the asset classes that you want to focus on for the most part. So gold, people call it the ultimate hedge. A lot of the times, if you pull up the chart, you'll see gold year after year after year after year heading in an upwards direction. Okay, it's not stopping. And due to the fact that something has to counteract the dollar. So gold is going to be the human standard that people just use whenever the dollar is crashing or the economy isn't in a good place. So here's why central banks buy it. And central banks are going to be the banks where me and you bank at. Okay, the banks that hold our fiat currency, where we can go pull out our money to pay our bills, go to the ATM, etc. And the fear trade. So gold performs best when real interest rates are negative. And that's when inflation is higher than bond yields. Okay, and central bank demand. So in recent years, China, Russia, and India have been buying record amounts of gold to de-dollarize their reserves. Okay, so they're trying to de-dollarize their reserves in a significant manner. Okay, buying less time storage for their fiat currency and buying more time on their actual currency by investing into assets. Okay, you're doing nothing but losing time if you have more fiat currency. So fiat currency needs to be thrown into the river immediately. Otherwise, you're wasting time. Think of theta on options, if you're familiar with that. Over time on a stock options contract, the options expires. Okay, think of your fiat currency the same way. Okay, if rent over year after year after year after year gets more expensive, if 1 year a house cost $200,000, but then 5 years later it costs $500,000, that means that your asset class has to be in a constant river, each and every single one of them. Okay, all your businesses, your profit has to be being reinvested into that. More stocks, more shares, more cryptocurrency. Okay, buying more houses if you're in real estate, etc. Okay, buying more land, and you could do whatever you want with the land. You could farm on the land, pay people to host ATMs on the land. Okay, people could build stores on your land. People could build antennas, cell towers, etc. But when you own assets and you keep stacking up your assets, it gives you a multitude of opportunities to be presented in front of you for your money to just make you more money because you invested in the right things. So volatility. So gold is slow, and it's not for getting rich. It's for staying rich, and it's wealth insurance, not a lottery ticket. Okay, so stacking up gold over time. A lot of people might buy certain jewelry. Okay, go smelt it, take it to the jeweler, whatever, and either the jeweler will give them an exchange rate for the gold. So you're going to have multiple ways to invest in the gold too, which we're going to talk about. If you don't want to go the actual physical gold route, you're also going to have the ability to buy things like shares, etc. So let's jump into it. So silver is going to be the industrial hybrid. So it's the green energy paradox. So silver is unique and it acts like money during crisis, but trades like a commodity during booms due to massive industrial use. So as far as conductivity, silver is the most conductive metal on Earth, and it's essential for electronics, 5G, and EVs. So for modern technology, silver is going to be needed. So silver is also going to be something you could invest to too. If you ever see a pullback on the charts or anything like that, silver is going to be an asset class that goes up year after year after year after year very confidently, especially while the dollar is collapsing. And let's talk about the solar boom. So photovoltaic cells, okay, solar panels, consume massive amounts of silver. As the world goes green, demand explodes. Okay, so photovoltaic, okay, that's just solar panels. Solar companies are booming all over America, all over the world, and other countries as well too. Okay, especially countries with less green, less trees, taking advantage of that solar energy. So seeing silver going in an upwards direction year after year after year would make sense. Try to plant your seeds with things that make sense with the future, whether it being putting smiles on people's faces or helping people work throughout the day by day. Silver is needed in absolutely everything. And let's talk about the gold to silver ratio. So it's historically about 15-1. So 15 ounces of silver will give you 1 ounce of gold. And today it's often 80-1. And many argue that silver is undervalued relative to gold. And we'll see how that starts changing, especially during the AI era. When we start seeing robots and certain things start getting developed, the use of silver could go up in an industrial rate. So there's going to be two ways to invest. So you could either have a bunch of bars, whether it be it silver bars or gold bars, stacked up. Some people do that, put it in a safe or leave it with the bank, etc. Some people also have jewelry. Buy Rolexes, Audemars Piguets, Pateks, certain chains, real Cuban links, whether it be it bracelets, chains, etc. And some people take it to the smelter, melt down the gold, take that to the jeweler, and then you can go ahead and get some money for that. Or you're going to have the digital way, which is going to be via stocks and ETFs. So you could buy shares that represent gold. So in the stock world, it's going to be the GLD. So if you want to buy gold shares, you'd have to look up GLD. You could also buy gold options as well too. I have some recaps posted on my channel, some wins I've taken on that. Used to trade that a long time ago. And SLV is going to be for silver. And then for miners, as far as the mining industry, in order to mine the asset classes of gold and silver, you can look up GDX. And the pros of them have very high liquidity. A lot of people trade gold, from Forex traders to stock traders, options traders to futures traders. Golden is extremely, extremely popular asset class that's traded. It's low fees. It's easy to hold in the Roth IRA as well too if you just want to buy shares and hold. And the cons, you don't own the actual metal. So if the fund fails, then you have a paper claim, not actual gold. And as far as investing in the miners, it gives you leverage. So if gold is up 10%, miners might go up 30%, but they have risk as far as fuel costs, strikes, etc. And the physical side of everything, you have no counterparty risk, total privacy, and it's useful in extreme disasters. That can be true and also not true. Your house could burn down, etc., and then it could be hard to get to the gold bars. The gold could maybe survive depending on how long it's in the fire, but still, that could be relative to a lot of cases. And cons, you got to worry about security. Hey, you can't be letting everyone know that you got a whole bunch of gold bars stacked up. That's not going to be ideal. Okay? You got to keep that very private between just you and your family. And storage issues too. When you start stacking up more gold bars, having a safe might be hard if you're trying to move houses or something like that, etc. Okay? And it could be hard to sell quickly. You got to go to the smelter, melt it down, and then go to the jeweler, get an exchange rate on that. And they might give you a lower price than you might actually should get because they're trying to make some money too. You know, it's the world. We're all trying to make some money. And tax. So it's often taxed as collectibles too, which is a 28% capital gains in the United States rather than stocks. So the strategic allocation. So how much is going to be enough? So most financial advisors suggest precious metals should be a hedge not your whole entire piece of the pie. So be conservative, 5%. Okay, it gives you just enough insurance to sleep at night. If you want to have a couple of gold bars in real life, then that would be fine too. And just keeping your asset classes divided in certain scenarios could really help you, especially during hard times. You might not have access to the internet, and you might need to go take the gold bar to someone who could exchange it for either some fiat currency or a car or just an item that you need. So having multiple sources of backup plans for your income is really, really going to help you. And gold pays no dividends if you do just have the actual gold bars. It just sits there. So try not to just invest 100% of your money into gold, or you're going to miss out on compound interest. And not even interest, but just compound equity curve just in general. Whether you invested into a stock that goes up year after year after year due to the fact that it's just making tons of profitable decisions, then you don't want to miss out on that. If you have one gold bar, 10 years later, if you don't do anything, if you don't get up and keep grinding and keep hustling, you're not going to have any more gold bars. Okay? But if you invest and put $1,000 into a stock, 10 years later, you could have did nothing and come out with $100,000. Okay, so having your asset classes divided is really going to help you. But there could be a time where you need to pull all your money out of your stock account and you have gold bars and you can exchange that, put it right back in your stock account. So there's going to be different scenarios and different floats, especially jewelry too. If you have any real gold jewelry that you don't care about, I would think about smelting it. Gold is extremely, extremely valuable, and just keep that in consideration. So is it a good hedge? I'm going to go ahead and say yes, but here's to clarify your goal. If you want to get rich, then focus on stocks, business, crypto. And if you want to stay rich and have protection over your purchasing power over decades, gold is going to be an extremely, extremely good standard. And if you want a speculative play to invest into, you could play gold futures. Gold is on Forex. Gold has stocks and shares you could trade. And same thing with silver too. So you could just make your decision in order to protect you over time. Take a look at the chart before you trade. If you're struggling with what to invest in, head over to stackmode.net. Stay prayers to God. Keep grinding. Catch you guys in the next one. After you've been grinding for years, really busting your tail, you want your money to work harder than you do. And dividend investing might be the easiest way to build passive income, but most beginners overthink it. But dividend investing is really simple. You just buy shares of strong, established companies, and they pay you cash just for holding them. And that's it. So imagine waking up to deposits monthly, weekly, and certain dividends pay out in different ratios and frequencies, and they hit your account while you sleep. That's the power of dividends. Let's go and let's jump into it. Let's understand what dividend investing is and how you guys can start building some passive income for you and your families. Inshallah. Let's talk about dividend investing. Making our money work for us is going to be the most ample way to, one, get our mental health back. Okay, I understand we're grinding hard, working year after year after year after year, but let's at least make our money make us some money. Okay, we're not just grinding. Okay, no more exchanging time for money. Okay, it's time to start exchanging money for money. Okay, this way you guys are going to be a lot mentally healthier. You guys are going to have time to get closer to God, work on your family relationships, work on yourself, work on your business, and understand that when you have your money flowing within that asset river constantly, you're using your cash and buying more assets with it, and it's flowing in the river, flowing in the river, you could pretty much never work again. Okay, so when people talk about passive income retiring, it's about putting your money within that income river. Let's go and let's talk about how to make our money work for us. Inshallah. So what is a dividend in the first place? A dividend is going to pretty much be a thank you payment. Okay, and they pretty much just tell you, hey, you've been investing in us for a long time. You've been believing in us, and I'm going to go ahead and give you some money back because we've been crushing it on the company side. So a dividend is a thank you payment. Okay, so whenever you invest into a company that pays out dividends, or you're invested into an exchange trader fund, okay, which is a compilation of companies just put into one big giant fund, then you could also get dividend payments from there if the fund pays it out. Okay, so let's say, imagine you lend money to a friend, right, to start their lemonade stand. Okay, you believe in them, you think it's going to turn up, and every month they start giving you $10 from the profits as a thank you because he started turning up, started making tons of money. Okay, so that friend who started the lemonade stand decided to give you a portion of the income because since you gave him that initial investment to believe in him,
okay, and you funded his company, he did the right thing and gave you some profits back because you had his back and you believed in him. And that's what a dividend payment is. When you believe in these companies, when you believe in these ETFs, then we're able to get some profit back, inshallah. And that's a dividend. It's real cash paid to you just for owning a piece of the company, okay? And it's passive, okay? You don't got to do no work for this money. All you got to do is buy, okay? All you're doing is turning money into more money, okay? Dividends is going to be one of the most extreme forms of passive income, especially after you guys have grinded out 6 to 7 figures, okay? Being able to plant that 6 to 7 figures into some dividends and get paid $5,000 to $25,000 a month just for having your money parked is going to be a really, really good way to just chill in life, okay? And it could be regularly, okay? It's usually paid every 3 months, okay? So quarterly, and it's very, very safe. So usually only strong, profitable companies pay them, okay? It's not a lot of broke companies paying out dividends because they can't afford it, okay? A lot of companies paying out dividends are companies that have it all based out. They know that you investing into the stock market, okay, is going to go ahead and give them more income. They're then going to be able to turn that income into bigger buildings, hire better and more employees, okay, which should lead to them making more income, okay, better products, faster products being made, etc. So that way their income can skyrocket, okay, and when that happens, we benefit from it too. And a lot of the times too, dividend payments, okay, have certain dates set to them. Okay, sometimes you get dividend payments monthly, sometimes you get dividend payments quarterly, a few times a year. Okay, and every single company and ETF is going to have its own different dividend payment cycle. So before you invest into something, make sure you're doing your research. So here's an example, okay, just one more time to make sure we understand it. Let's say you own 1 share of Apple, okay? Per 1 share of Apple, Apple pays you 24 cents, okay? You can check your phone, okay, and that money is sitting in your account, chilling, okay? You didn't have to sell the stock to get it, okay? All you have to do is just have your money chilling in stocks. So you get paid for turning your assets into more assets, okay? So after all the day trading is done, after grinding your business hard for years, after grinding corporate hard for years, take that money and you guys can easily park it into some dividends and start getting yourself some monthly cash flow, okay? Put some mental health back into yourself and take some of your money and let's try and get some passive income from the money we already have and we've been working hard for. Let's go to the next slide. So let's go and let's talk about the dividend yield. So the dividend yield tells you the return on your money right now, okay? And it's kind of like the interest rate number on your savings account, okay? So as you know, for APY accounts, okay, interest though, you know, is a reason why God says not to do it. It's not something that'll leave you profitable in the end anyways, okay? So focus on things outside of interest. But let's say annual percentage yield, let's say there's an account that'll give you like 3% per year, okay? With inflation and taxes though, that's not anything. Okay, so when you're focusing on dividends, though, something like that, okay, then you're going to be able to get a lot better bang for your buck and for your value. Okay, so average yield, right? Around a 2 to 5% average yield is going to be healthy. Okay, and a red flag, if the average yield is over 8%, okay, be careful. Okay, it might be a trap and the company could fall off later, even if they're paying out big dividend payments right now. Okay, you want to try and have your dividend payments be as consistent as possible. Okay, you don't want your dividend payments to go down. Okay, if you're getting $5K a month for the money you have invested, that's how much you want to be getting. Okay, you don't want it to go down to $3K one month and then your bills and calculations are all thrown off. That you don't want it to happen. It can be really, really frustrating. Okay, so let's do the math. So let's say the stock price of something is going to be $100. Okay, and then they pay you $4 per year. Okay, so the yield, okay, is 4. Since they're paying you $4 a year, divided by 100, okay, and that's the stock price, and that's going to equal a 4% return, okay, and that's how the dividend yield is going to go ahead and be broken down. Let's go over to the next slide. So, is it safe, right? The payout ratio. So let's talk about the pizza analogy. So think of a company's total profits as a whole pizza, okay, and the payout ratio. It's how many slices they decide to give you, okay, and that's going to go ahead and be exemplary for the shareholders versus how many they keep to grow the business, okay? So how many slices of pizza are they going to give to you, and then how many slices of pizza are they going to try and hold on to, okay? And safe, okay? So under 60%, okay? If they give you 6 slices and they keep 4, Okay, that's safe. Okay, that's safe. Why? Because they were able to pay you a little piece of the pie. Okay, make sure you eat and make sure they eat too. Okay, because they got to be logical. They can't feed you if they're not feeding themselves. Okay, so they be logical. So, but it could be dangerous if they're giving away over 90% of their pizza. If they're giving away their whole pizza every single time, then they're going to have no food left over for tomorrow. Okay, so you have to watch and look at the payout ratio percentages. Okay, so let's say company A, right? Let's say earn $10. Okay, and then they give you $2. Okay, they would have $8 left. Okay, and that's going to be pretty safe. Now, let's say company B, right? Let's say they also earn $10. Okay, and let's say company B paid you 9.99. Okay, they paid you $9.99. Okay, they would be left with 1 penny left. Okay, what type of investments or growth can they do then? Okay, so focusing on the payout ratio of the dividend you're looking at is going to be extremely imperative to making sure that you're not making any random decisions unnecessarily. Okay, focus on companies with safe payout ratios, because that way you can see that they have their math baked in for consistent scaling year after year after year after year, not just random sporadic payments being sent out and then they have a possibility of going broke and then there's really going to be no more dividend payments. Okay, so in order to avoid all of that, avoid the hardships, try and focus on dividends and companies and ETFs that pay out very safe ratios so that they don't go broke, so then they can continue to pay out dividends so you can continue to feed your family and yourself, inshallah. Let's go to the next slide. So let's go and let's break down the snowball effect. Okay, the compounding effect, stacking dollars. Okay, get into stack mode. Okay, stay down. I don't care if you got to wear the same clothes every single day. Okay, keep driving that old car. Okay, it's not time to get a new car right now. Stack it up. Okay, set some parameters. Tell yourself, you know what? Until I have 100,000 stacked up, I'm not going to get X, Y, and Z. Until I have 1 million stacked up, I'm not going to get X, Y, and Z. All this just takes a couple months and a couple years. Okay, you guys got it. Go hard. Go hard. Go hard, because it's really time to automate your wealth. Okay, and it's going to be the secret sauce. Instead of spending your dividend cash on coffee or random other things, okay, you can press a button called drip. Okay, so what drip is going to do is take your dividend income. Okay, so say you're making $100 a month from dividend income. Okay, you could take that $100 a month and buy some more dividend shares with that. Okay, so that way that $100 a month will turn into $150 a month. You keep doing that, it'll turn into $200 a month. Okay, and then it keeps stacking up over time. As long as you're in stack mode, your account will be in stack mode right with you. Just know that. Okay, so drip equals dividend reinvestment plan. A lot of brokers have it to where you can automatically just reinvest your dividend income back into more shares. Okay, so the computer or whatever broker you're using uses your dividend cash to buy more shares automatically. Okay, and next time you'll have more shares, so you get a bigger bag, bigger check. Then that bigger check buys even more shares and it spirals upwards. Okay, so trying to have your life together outside of the market. Okay, the more you have your life together outside of the market, the more money you'll be able to generate from the market. Okay, just keep cycling your money back into shares, back into more shares, back into more shares, and keep upping that income. So let's say year one, you own 100 shares. Okay, you invested super duper heavy. Then by year 10, okay, you own 150 shares. Okay, and let's say you didn't even pay for the extra 50 shares. It was just stacking up over time. Okay, so once you start planting that seed of ownership, your tree can do nothing but sprout and grow, inshallah. So plant your seed today so you can start sprouting. You guys can start dropping fruit everywhere. Okay, but you gotta plant your seed. You cannot start dropping fruit everywhere until you plant your seed. Okay, so then from year 30, 20, then from there you're earning a full salary from dividends alone. And then you could chill out. Okay, you still have your money parked away in the dividend and you're getting paid for having your money parked away. It's crazy. Okay, if you make the right financial decisions, you stay focused on God and you don't feed your flesh, you guys can get out of poverty. Okay, you guys can be rich forever. You can never go broke again as long as you maneuver your wealth into that constant asset river. You have to continue to flow your money in that asset river. Otherwise, things can get hard. Okay, so throw your money to the river and start flowing so you guys can grow like the big oak tree. Plant all your seeds today. Let's head over to the next slide. So let's jump into royalty stocks, right? Dividend aristocrats. So these are going to be the MVPs of the stock market. Okay, and to be on the list, a company must have been in the S&P 500,
okay, which is accumulation of like the most powerful stocks, okay, put into one index, okay, known as the S&P 500. And two, okay, they must increase their dividend every year for 25 plus years straight. So if a company is paying, right, 20 cents per share, okay, in 2010, okay, and then in 2011, let's say they're paying 25 cents per share, okay, that's going to be a 5-cent increase, okay. So if they're increasing their dividend amount every year for 25 years straight, then that's going to be a big MVP. And that means that these companies have survived recessions, wars, bubbles, and still paid their investors more money, which means that a lot of these companies are going to be constant investments due to the fact that it seems like that these companies have become a staple in human lifestyle. Okay, companies such as Coca-Cola, okay, or Johnson & Johnson, the Band-Aid company, for example. Okay, so companies that incorporate into lifestyle, okay, really are going to be the ones that will survive year after year after year. So let's go and let's talk about the risk with everything. Okay, pay attention to that yield trap, just like we talked about on the previous slides. The yield trap is going to be really important to pay attention to. Sometimes you see a stock paying 15%. Okay, you think you're about to be making bands every single month just by investing into a simple dividend. Okay, and they might pay you out for a couple of months. Okay, you might be getting 5K a month payments, for example. Okay, for 3 months, and the next thing you know, they start losing profit. Things start getting shambles, and then boom, and then the high yield decides to stop paying you out what you're used to getting paid out. And if a company runs out of cash, I'm telling you, they're going to cut that dividend to zero. Okay, so just with the pizza analogy, okay, you can't help anybody in the world if you're not helping yourself first. Okay, so if you have a box of pizza, right, there's 10 slices of pizza. Okay, if you give away 6 slices of pizza, okay, you'll still have 4 slices of pizza for yourself. Okay, you can still eat, you're not gonna be starving, and you're gonna be chilling. Okay, but then take person B. Okay, if person B gives away all their pizza, they're gonna have no pizza left over. Okay, and that might seem like a good thing instantly, okay, because they fed everybody and ignored themselves, but that's not. Okay, that'll turn into later frustration, later hunger on that person, regret on that person. Okay, and they're gonna be like, well, you know, people might not have fed me in certain type of ways. Okay, leading into certain type of mindsets. Okay, so even in dividends, it tells us it's really important, okay, to keep our bag right. Before we can help anybody else, our bag has to be right. Okay, and dividends show us this. If a company is giving away all their money, they're not going to have enough money to reinvest into more ads, into more workers, into better factories, etc. And they're not going to be able to scale at the way that they would like to, if at all. Okay, so if a company runs out of cash, they're going to cut the dividend to zero. So be wary of new companies, especially paying out big dividends, because it might not be consistently for long. And that's when the crash comes. Okay, and when they cut the dividend, the stock price drops even more because it's going to go ahead and lose value, which means you lose twice. So not only would you lose money on your base, money that's parked in there, your dividend payments are going to go ahead and get cut as well. So a golden rule, right? So a safe 3% return is better than a 15% risky return that has a chance of going to zero. Okay, don't be greedy. Focus on consistency. The name of the game in trading, investing in general, is consistency. Treat yourself like an oak tree, and you gotta plant yourself in the ground. You gotta give yourself water and sun. Okay, if you're not planting your seeds and you're just trying to hit the big 0 to 100, you're just trying to go buy an oak tree and plant it in the ground, it might not be stable. Okay, it didn't get time to connect to the roots, to the soil, and it might topple over. Okay, but when you're the tree and you grow it day by day, limb by limb, okay, root by root, okay, you're gonna know the field, and your money is going to be planted within the soil. It's going to have a lot better baseline to it. Okay, even if stock prices were to start dipping down, since you have so much baseline planted, okay, stuff isn't really going to affect you. Okay, your dividend payments are still going to be pretty consistent, and your profit fluctuation isn't going to be as bad because you planted your seeds. So focus on planting your seeds over a quick win. So how do you start today? Okay, I'm going to give you guys a 3-step plan. So the account, open up your broker. Okay, you guys can do Webull, Robinhood, Fidelity, Schwab, Vanguard, so many different options. Okay, open a brokerage account. Okay, then from there, okay, you can buy ETFs. ETF stands for Exchange Traded Fund, and they're pretty much going to be a bunch of companies put into one big giant company, for example. Okay, so you could buy really, really consistent ETFs like SCHD that pay out really, really good dividends, or VIWM, for example. Okay, and it's a basket of 100 plus dividend stocks that give instant safety. Okay, or you could pick individual stocks as well too. Okay, and then the button. So find settings for your dividend reinvestment and turn it on. This way, all your dividends are going to go back into shares consistently, instead of you guys just having random cash, and then you're going to have to go buy dividends, instead of you just having it all in that DCA consistent flow mode. Okay, so don't forget, diversify. Okay, and a good way to diversify is to really invest into ETFs as well too. Okay, let's head over to the next slide. So dividend investing is really like going to be the ending to everything. Okay, it's the furthest thing from a get rich quick scheme. But after you run up 5 figures, 6 figures, 7 figures, you've been grinding, you've been putting in the work, you've been praying to God, really staying down. Once you have some money stacked up, dividends is going to be a good place to park your money in, and you guys are still going to get that monthly income and that monthly reward from it. But make sure you guys are choosing to invest into things that pay you out consistently, and be patient, be consistent, and start now. Okay, start now. That's going to be the most important thing. Start generating your business now. Start generating income now. Start doing whatever you need to do now. If you say you want to invest in a certain assets, if you have $5 in your account right now, take that $5 and invest. Okay, start planting your seeds today, and that's going to be the most important thing. It's not really about the money. It's about your lifestyle, your consistency, okay, and how disciplined and focused you are when it comes to stacking your assets. All right, if you want help with it, head over to stackmode.net. Stay prayed up to God. Keep grinding. I'm going to catch you guys in the next one. Peace. Keep going hard. Don't ever give up.
What's going on, class? Today we're going to be talking about flash loans in decentralized finance. That's what DeFi stands for, if you're curious. What they are and how they work. Let's jump into a deep dive into decentralized finance's most atomic primitive. So, defining the flash loan primitive, the power of atomic transactions. Some key characteristics. So it's based off of atomic execution. The entire process, borrow, use, repay, must happen in one single non-divisible blockchain. Transaction block. If any step fails, the entire transaction is reverted as if it never happened. It's also going to have a zero collateral requirement. And unlike traditional or most decentralized finance loans, no upfront collateral is required, making them accessible to anyone with sufficient gas. And gas is going to stand for fees within the crypto world, if you ever see the term gas. To execute the smart contract is going to be an autonomous contract in which the crypto system works off of. So instead of having middlemen like the bank systems confirming whether or not transactions can approve or decline transactions, the cryptocurrency system runs off of autonomous contracts that work automatically, calculate transactions, and confirm them on the blockchain as well too. An instantaneous repayment. The loan tenor is less than 15 seconds. The time it takes for a block to be mined on Ethereum. Okay, so it's going to take 15 seconds to mine a block of Ethereum. And the borrowed funds must be returned within the same block. And citing the source, flash loans were popularized by protocols like AV, formerly ETHLend, and DIDEX, and the mechanism relies entirely on the deterministic nature on Ethereum's virtual machine, okay, also known as EVM, and transaction automacy. And the mechanics, how a smart contract manages payment and repayment. So the borrow, execute, repay sequence. So the code execution is handled by a sophisticated smart contract deployed by the user. So this is going to be the back end of how certain cryptocurrency structures are going to be ran. This is going to be the code and calculations behind everything, which is called the flash loan pool contract. So the 3 stages within one block. So this is going to be for the borrowing call. The user's contract call is the lending pool, okay, requesting X amount of dollars in assets, okay, for example, DAI, for example. And then the execution phase to get an example, okay. And the lending pool transfers the dollar amount to the user's contract and simultaneously calls the user's contract defined function, okay. For example, execute operation, parentheses, okay. And this is where the user's logic runs, okay. For example, arbitrage swap, okay. And repayment check. Once the user's logic completes, the lending pool's check its balance, and it must have received the original dollar amount plus a small fee. Okay, typically a 0.9% back. Okay. And the reversion guardrail. If the repayment check in stage 3 fails, aka an insufficient funds return, for example, the entire transaction, including stage 1, 2, and 3, is going to be reverted by the EVM, the Ethereum virtual machine, and the state of the blockchain remains unchanged. And the automaticity is the security feature that prevents lender loss. So a primary use case, decentralized arbitrage, and capitalizing on price inefficiencies across DEXs. Okay, so DEXs is going to stand for decentralized exchanges, if you're curious what DEXs stand for. So arbitrage is commonly and one of the most intendedly used things within the decentralized exchange space. And flash loans provide the instantaneous, enormous capital required to exploit tiny temporary price differences across decentralized exchanges. So here's an example of some arbitrage flow for a single transaction. So let's say you borrow 10 million, okay, in USDC. Okay, USDC is going to be a stable coin based off the fiat currency in the US, okay? And the US uses the US dollar. So that's where USDC is going to be based off of from, okay? And the stable coin's purpose is pretty much to be like the fiat currency's version of cryptocurrency's reserve, okay? So yeah, cryptocurrency is pretty much just trying to make its own stable dollar that doesn't change and fluctuate too much, unlike other cryptocurrencies. So for example, let's say the pair USDC slash Ethereum, okay, is 3K on Uniswap, okay? So that's DEX A. Then I'm gonna go ahead and say USDC is $3,005 on SushiSwap. All right, so that's gonna be $5 more, okay? And we're here to invest, so we're here to make money. So we want to be getting the cheapest prices possible, inshallah. So let's say that's DEX B. So execution 1. So you can use 10 million USDC to buy Ethereum on Uniswap, okay? That's gonna be DEX A for $3,000. And then execution 2, you can immediately sell the acquired Ethereum for USDC on SushiSwap, DEX B, netting a profit. Okay, so you want to make sure that you're buying on the cheaper broker, okay, and then you could sell on the most expensive broker, and you could go ahead and make a profit. And if you want to make a certain amount of profit, let's say 10 million, for example, okay, let's say you take 3,000, okay, 5. Okay, and then take that by the 3,000, okay, minus the 10 million, and it's going to give you a 16,666 gross profit, okay, and repay the $10 million USDC plus the fee, okay. So for example, $9,000 to have, okay, the original place where you bought the USDC from or borrowed it from in the first place, and the remaining profit, okay. So you have to take whatever you locked in minus the fees. So that's going to be the 16,000 number minus the 9,000. Okay. And then that's going to go ahead and be your net profit. So if successful, the block is mined. And the speed and scale of the flash loan execute the trade so fast that the price gap cannot close before the profit is secured. And it's a feat impossible with traditional capital. So advanced use case, collateral swapping and refinancing. So managing risk and optimizing debt positions. So beyond simple profit making, flash loans are crucial infrastructure tools for managing complex DeFi debt positions and risk. So collateral swapping, risk mitigation. So a certain scenario here. Let's say a user has a loan collateralized by Ethereum, but expects the price of Ethereum to drop sharply. Okay, let's say Ethereum's at 5K. And I think it's gonna drop down to 3K. And the user can flash loan the debt amount, okay, pay off the original loan, withdraw the Ethereum collateral, swap the Ethereum for a stable collateral like DAI, for example, and then repay the flash loan and recollateralize the loan with the new stable asset, all in one transaction The user can mitigate liquidation risk by swapping volatile collateral that fluctuates a lot for stable collateral without ever needing to close their debt position entirely, making your profit being able to be there, and then your profit's not going to be moving much afterwards, inshallah, because you're going to be investing in something stable. So refinancing, so rate optimization. So users can use a flash loan to instantaneously repay an existing loan on Protocol A, which has a high interest rate, and immediately take out on an equivalent new loan on Protocol B, which has a lower interest rate, all while preserving the original collateral. And this is known as debt migration. And the dark side, flash loan attacks and exploits, the vulnerability of price oracle manipulation. So while the flash loan contract itself is secure, the lender funds are protected by reversion, and the ability to access massive temporary capital exposed other protocols to sophisticated attack vectors, primarily through price manipulation, and how flash loan attacks work. So target vulnerability. The attack exploits a protocol that relies on a single low liquidity DEX or an easily manipulated on-chain mechanism to determine the price of an asset, okay, the price oracle, and the capital injection. The attacker uses a flash loan to buy or borrow a huge sum of the token. Okay, let's say for example 50 million. Okay, so just like we talked about, you could borrow 10 million of USDC. Let's say they try to get 50 million, okay, for a flash loan, and then price pump. The attacker dumps the 50 million loan worth of the token, okay, into the DEX, dramatically inflating the price of the token, okay, which the vulnerable protocol uses as its price oracle. Okay, so they're going to go ahead and dump 50 million into token X, and that's going to inflate the price of token Y. And the attacker then uses the artificially high price of token Y to borrow massive amounts of other assets from the vulnerable protocol, often exceeding the value of their collateral based on the manipulated price. And repayment and profit. The attacker repays the initial flash loan plus fee and keeps the huge surplus borrowed from the now drained victim protocol. And defense. Protocols have largely countered this by adopting robust, time-weighted average price, also known as TWAP, oracles that are resistant to single transaction price swings. So summary and future outlook, okay? Jump into it. So here's a quick summary of flash loans. Flash loans are not